The bar is high for success, and it also comes that make sure that the economy is on the same page, and that requires monetary policy to be on your side. Lizzie, what's on your radar there?
Yeah, well, Keir Starmer could inherit the first rate cut from the Bank of England. You've got economists, investors, I should say, pricing more than a 60% chance of a quarter point cut in August. Interestingly, economists that I speak to are not really worried about an enormous fiscal loosening at the first budget, which, as I say, comes back to this point that Labour does not want to be delivering surprises up front. They want to be, steady as she goes. But on the point of BOE reserves that was raised during the campaign by Nigel Farage, in particular, whether there be some sort of tiering, and it was backed by Gordon Brown, Rachel Reeves sticking to her guns. She does not want this. She says it could interfere with the transmission of monetary policy through to the real economy. And this is someone who's an ex-BOE economist, so not changing her mind there.
Probably doesn't want to steal one of Farage's policies in week one as well. Probably wouldn't be the look she was going for.
Maybe not a great look from the former economist at the BOE. OK, Rachel Reeves with the speech around reform and planning, of course, in terms of trying to build those homes, 1.5 million by the end of the Parliament. Of course, data centres, part of the mix as well, infrastructure and the rest in terms of what we look ahead to. Lizzie Burden, our UK correspondent with the details. Thank you. Let's take a look at what else is coming up today. 3 p.m. UK time. This is of great importance, of course, for the markets. Jay Powell of the Federal Reserve, that congressional testimony starting 3 p.m. UK time, and we'll wrap up at some point tomorrow. So zeroing in on what he has to say. Does he lean in to those bets? Cut, markets expecting a 70% first cut coming in September. 6 p.m. UK time, there's going to be an auction of 3-year notes in the US. These auctions have so far been relatively well received by the markets. We'll see if that maintains that theme today. 8 p.m. UK time, the Euros. It's the semi-final. This one I know Critty's very excited about. France versus Spain. 8 p.m. tonight. Are you going to be watching that, Critty?
Of course.
Are you staying up for it? It's a late one for us.
I'm surprised you haven't responded to my invitation yet.
What was the invitation?
To watch the Euros with me. No one will come join me.
So it's late, Chrissy.
I mean, you gotta make the sacrifice when Spain is on the docket.
No, but I've got to stay up late on Wednesday night to watch England. You see, so I can't.
Yeah, we're going to reserve that.
You can't do both.
We can't have too much excitement in our week.
We all have our loyalties.
Yeah, absolutely. So those are some of the things on the agenda. Interesting from a market perspective. I was reading on the Markets Live blog. They're talking about Powell, and not to downplay it before it's even started, but suggesting that market pricing, options pricing around the euro shows more expectation of volatility from the CPI data then at the end of the week, Chrissy, than from Powell. We were hearing from Mark Cudmore earlier on that the risk is that he isn't as dovish as the market expects, because it seems that many in the market do expect him to be dovish.
It's interesting that we're seeing that kind of positioning there, because I also read a story, I believe, by our FX team as well, that talked about, and I promise I'm going to connect the dots here, that when it looking at European bond futures and positioning as well, the open interest in of course, French debt is enormous, and enormous by historical standards as well. But I'm curious how much of that changes.
At 4 a.m. Eastern Time, we get comments from ECB's Panetta, who participates in the annual meeting of Italian Banking Association in Rome.
The U.S. policy story, the data hasn't actually given that much catalyst to the global bond market.
Paul Donovan, of course, chief economist, global economist at UBS, saying they are already too late in terms of cutting from the Fed. He says they have to cut, they should cut in September, but even if they do cut in September, it would be too late. Would suggest maybe there's more money to flow into US debt. Currently, the 10-year at 4.29. We talk about the euro, the euros. Wait, are we going to put some numbers on the France-Spain game? France should be. I mean, they should be given the game, shouldn't they? Given the political turmoil.
I'm not going to extend myself beyond my area of expertise, which means I'm not going to call the result of Spain.
Here's what I'll say. My loyalty is to Spain, but France has been doing very, very well. And they just played against Portugal, against Ronaldo. I'm a big Ronaldo fan as well. And open invitation for him to join the show, just saying. But
it's getting complicated.
It's getting complicated, but it's something I imagine everyone is going to be watching, at least in Europe.
I have the boring job to bring us back to markets right now, because from the football, I'm not sure I can make a segue, but here's a quick check on some of the stocks that are on the move. This one, Page Group, has a macro read across. This is an interesting story, because this business downgrading expectations in the market for how well it's going to do in the second half of the year. It's about recruitment, and that story is weighing on recruiters. Does this set us up for something more negative around the labour market story in Europe for the rest of this year? Indivior very much on the move, 38% down. This in the biotech, the drug space. BP under pressure, 3.5% lower. Dassault Systèmes also under pressure, falling after a rare profit warning from that business. Overall, Tom, though, stocks are down 0.2%. 0.2%.
outperforms
a little.
Yeah, the UK, the FTSE 100 keeping its head above water, up 0.2%. as you say. US futures also in positive territory, looking to build on that 35th record for the S&P yesterday. S&P E-minis up 0.2%. That is it for the opening trade. The Pulse is up next. This is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders. From breakfast cereals to pet foods, General Mills has an iconic array of brands. But future success depends on efficiency, innovation, and insight. CFO Kofi Bruce does much more than crunch numbers.
Our first job is to intimately understand and anticipate the consumer's needs.
Watch Chief Future Officer. New episode Wednesday on Bloomberg Television. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Access the financial world on demand.
Shortly expecting comments from ECB's Panetta.
Policymakers and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything.
U.S. futures heading for another record high as investors wait for Fed Chair Jay Powell to testify on Capitol Hill. The NATO summit begins in Washington today. The event will be overshadowed by domestic turmoil across the alliance, from Biden's candidacy to the results, of course, of the French election. Plus, Bloomberg learns that Boeing is in talks to preserve U.S. defense contracts after pleading guilty to a criminal charge tied to fatal crashes of its 737 MAX jets. So good morning, everyone. Let's take a look at the European markets map. Let's see where they are after another record high on Wall Street. Now, the FTSE's pretty much gaining some 0.3%. Again, we're trying to learn more about the cabinet, some of the positions that Keir Starmer has put in place in the UK and what that will do to the FTSE 250. CAC 40 over in Paris down some 0.4%. Again, there's quite a lot of political wrangling over in France as those non-decisive elections mean that there's going to be some kind of coalition building through the next couple of weeks or months. This is what I was talking about, the S&P futures, so gaining 0.2%. Yesterday was a stellar performance. Once again, an all-time high on Tuesday. Investors on a wait for Fed Jay Powell to try and figure out when that cut is coming. And then European stocks, you can see, practically unchanged. Now, the one thing we're watching out for in terms of political risk is the spread between German and French bonds. You see it peaking higher when some of the polls came out that Marine Le Pen, not fiscally prudent like the current government, we think was going to have a majority, and then that spread widened a little bit yesterday with the left doing quite well, and it's now come down a touch. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, the U.S. S&P notched up its 35th record high this year. That's as traders gear up for Jay Powell's testimony to U.S. lawmakers and the start of earnings season. Well, let's talk now to Ian Steely, International Chief Investment Officer of Fixed Income at JP Morgan Asset Management, and Bloomberg Managing Editor for Markets Today, Christine Aquino. What a treat to have you both. Christine, after also we had another record high on Wall Street, I can't really figure out what's supporting this, if I'm honest.
Yeah, Francine, I mean, it's a lot of hopium, isn't it? But there is just incredible optimism in the U.S. equity market right now for reasons that is really hard to explain by anyone. Even if we see yet another record high, with that comes a lot of nervousness over how long it's going to last, whether that's going to be supported, because a lot of worries over the fact that the concentration of the gains in the S&P 500 increasingly just very dependent on a number of big tech stocks, particularly Nvidia. So the question really is what's going to happen when the fumes start running out and the economy starts slowing, which we are seeing some evidence of, right?
Ian, what are you seeing in treasuries? And again, if you look at the broader market, what are some of the market forces that play apart from the Fed?
So I guess over the last couple of weeks, we've had quite a decent tug of war between the market's view of what happened post the debate, and we saw obviously yields move higher, and we saw curves steeper, concerns about a sweep. And then obviously, as you said, we had some of the data come in over the last week or so, and actually maybe it's pointing to a little bit of softness. I'm not quite sure I'd go to weakness just yet. But I think from a market standpoint, that's really continues to build this view of the soft landing. It continues to build the view that the Federal Reserve will be able to ease policy later this year, and ultimately the markets seem to like that at the moment.
But you have a lot of chief executives saying, actually, we're running with the narrative that a soft landing is a given. It's not.
I don't think it is a given, but I think actually when you look at what's going on, you're still getting government spending. So that's helpful. That continues to support the economy. And then if you do get just, taken off the brake by some of the central banks and a little bit of impetus into the economy that way, then ultimately that's going to at least stop the downtrend. And actually the economy still looks pretty robust at the minute.
The question is, of course, what happens with unemployment in the U.S. And again, the number is 4.2. They were fine, ticking up a little bit. But is there at some point, the concern that they lose the narrative of employment and actually that unemployment soars?
Yeah, I mean, that's definitely the concern, isn't it, Francine? Because again, the Fed isn't just concerned about inflation. They're also thinking about the level of employment or unemployment in the economy at the moment. And I think, from the last few labor market prints, what's really been concerning is this gap between some of the household surveys versus the quote-unquote official labor data. There's definitely some discrepancy there. Some of that tends to be a bit more forward-looking than the other pieces of data that we've gotten. And so that's where the concern lies, really, is that some of these kind of more forward-looking indicators starting to, as Ian says, point to a bit of softness in the labor market. The question is, is it softness that the Fed is able to control and therefore engineer a soft landing, or is it the sort of softness that could very quickly turn into something worse, and then the Fed will have to scramble to do more rate cuts than they're anticipating?
Yeah, so Ian, when are you expecting the first cut from the Fed?
I think you've got to be anticipating it for September now. And I think, to Christine's point, what the Fed needs to do is they need to get ahead of this narrative.
Yeah.
So they've taken rates into restrictive territory. They know they're restrictive. Jerome Powell's been very clear about that. Inflation is now behaving. We'll find out on Thursday if it's going to continue to behave. But what market forecasts are is that Q1 was a bump from an inflation standpoint. We're now back on track to have inflation coming down. If that's the case, they can react and hopefully get in front of this possible weakness in the jobs market.
So I was in Sintra at the ECB forum where there was Jay Powell, a number of other, of course, Mr. Goolsbee as well. And there was a concern that actually inflation picks back up, which is why the narrative, frankly, which was not concerted but felt like from all the major central bankers was, look, let's wait until we have more data. Is it counterintuitive, and does that risk actually creating more problems if they wait too long?
It does. I guess they're still living in the fear that they repeat some of the previous mistakes of previous central bankers, where they don't get it. Yeah, they don't get it under control. But if you actually take a step back and say we had particularly weak inflation in Q4, we then went accelerated again in Q1, we've come back down again in Q2. Let's just smooth that out. The trend is definitely down. I think there's definitely clear evidence when you look at wages, when you look at other measures, some of the survey data. Prices are falling, inflation's coming down, and it's no good waiting to 2% to start acting. You need to wait before that. And I think a combination of the inflation data we're seeing today, plus the jobs data that seems to be coming out a bit softer, should give them and should embolden them to get moving.
I mean, there's also belief, I think, in the markets, or when you speak to market chief executives, that as soon as the Fed cuts, something unlocks. That it's like the animal spirits, that M&A is coming back, that IPOs are back. Is that far-fetched?
Well, Fred, I mean, I guess it really depends, right? If we are kind of, again, going back to that soft landing scenario, then, it could possibly kind of create this animal spirit sort of environment and would give, again, the S&P 500 more momentum to reach yet another record high. And that's certainly the hope amongst the markets. But, it really just depends on, the reason behind a likely Fed rate cut. Is it because they're trying to kind of engineer just a gradual slowing of the economy, or are they cutting because they see something more worrying that perhaps we, among as market participants and observers, not necessarily in tune to? And that's, I think, what is going to be important from comments from Powell today and in the subsequent weeks and months. That's really what we're going to be looking out for, is that, are we headed for something more of a gradual slowdown, or is there something worrying that the Fed is looking at the moment?
You're definitely expecting a more dovish Powell in his testimony?
Yeah, I think so. I think the data is basically pointing towards that. I think the concern would be that everyone seems to be expecting a dovish Powell in his testimony. So maybe we need to think about that. I think to the point of the cuts, though, and from kind of an activity standpoint, I think they need to be doing more than 25 basis points, though. I don't think just doing the 25 and maybe another 25 and sort of alluding to doing a little bit more is going to help. I do think you need to have that view from a market standpoint that it's more of a cycle and we're going to see rates don't necessarily need to go to zero again, but that we're going to see a gradual path down by 150, 200 basis points. I think that's what the market would really like to get a comfort around, I guess, from the Fed.
Because that'd be almost impossible for them to say, given all of the uncertainty around inflation, all of the uncertainty around the U.S. election and global affairs.
And I think that is also one of the problems at the moment, because they do not want to make the same mistake that the ECB made. They do not want to preempt and say we are definitely going to be cutting rates, and then the data kind of comes out and maybe disagrees with them. And I think, if you look back to that ECB meeting and think if they hadn't pre-announced it, would they have actually cut? Probably not. Lagarde might say differently, but I think the Fed don't want to go down that rabbit hole.
How do you game treasuries depending on who wins in the election? It feels like some bets were placed after that debate where Biden performed very poorly. It feels a little bit too soon.
It does feel a bit too soon. I think the trade that's been obviously frustrating a lot of market participants for the last probably 12 months or so has been the steepener. You would expect that if you do get more fiscal spending, if you do get tariffs, if you do get a kind of a cut down on immigration, then ultimately that should be a steeper curve. The problem with that trade is it's very negative carry, and it hasn't really worked. And we've sort of been bouncing around in this negative range, and it's just been painful for participants. For that trade to actually really work, you probably need a combination of the sort of back-end yields moving, but you'd also really need the Fed moving. You need short-end yields to be moving lower. That's really going to when the steepener should work.
So all traders now also political analysts. Of course.
Definitely.
Welcome to 2024. Ian Steely from JP Morgan Asset Management and Bloomberg's MLive's Christina Kino both stay with us. Coming up, the NATO summit begins in Washington today. Eyes will be on Joe Biden as the president tells Democrats to stop the infighting over his re-election campaign. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
politics to the world of business. 2 times a day at 1 p.m. and 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world twice a day at 1 and 5 Eastern, only on Bloomberg TV and radio. Context changes everything.
The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, NATO leaders are holding a summit in Washington this week. The 3-day event will be overshadowed by domestic turmoil across the alliance, from Biden's candidacy to the results of the French legislative elections. Now, for more on all of this, let's bring in Bloomberg's EMEA News Director, Ros Matheson. Ros, I mean, it's like a microcosm. Good morning, first of all. But NATO is like a microcosm of some of the concerns that these leaders have at home. Will they be able to, put their differences aside and come together on something, or is it going to be kind of campaigning for domestic issues at NATO?
Well, as you say, ideally this NATO summit in the US is a moment for NATO to show that those issues around unity and strength, particularly in light, again, of the missile attack that we saw by Russia on Ukraine just yesterday. What we know is that this meeting is not going to formally invite Ukraine to join NATO. There'll be a bit of wrangling around wording for eventual pathway to joining NATO. But other than that, the focus is really going to come back to these domestic issues. We've got a bunch of leaders coming to this meeting with domestic issues dogging them along the way, and a lot of focus on that, not just for the US president, the host Joe Biden, and the questions around his durability as president and as candidate for the Democrats into the next election, but also Emmanuel Macron, the French president, fresh off this election on the weekend, and a lot of delicate times ahead for him to navigate a new government from various parties at home in France. You've got in Germany the Chancellor Olaf Scholz, his party not having done very well in recent European parliamentary elections. And so he's arguably weakened and distracted also. And we've got a brand new leader in the UK, Keir Starmer, of course, very strong win here for him electorally just recently, but this is his first big moment on the global stage as leader, and he's still in trying to get all his ducks in a row for his new administration in the UK and trying to get started on all these economic and other pledges. So a lot of focus on how they're going to come together in the US, but really also how they're going to be on the phones, no doubt, working all the issues at home at the same time.
But Ros, it seems that the urgency of the task ahead for these NATO leaders was really also laid out on Monday after a Russian missile struck a children's hospital in Kyiv. What will they be able to achieve as an alliance?
Well, obviously what Ukraine wants is that formal invitation to join NATO, and that's what Volodymyr Zelensky is saying that he hopes comes from that meeting. But it's obvious that that's very unlikely to happen. What we do know is there's a bit of discussion already about wording that would be a little woolly, but would open the way to Ukraine at some point potentially joining NATO, and that's probably about as good as it's going to get for Ukraine at that meeting. There is that caution, obviously, about embracing Ukraine fully into NATO at that point. What are the obligations around collective defense for Ukraine, for example, and what does it mean for further aid for Ukraine? And there's that unease about being bound into things over a long time frame when it comes to Ukraine. But obviously that's not good news for Ukraine when it comes to the war on the ground in the minute. As you say, aside from that attack yesterday, what we're seeing is Russia really stepping it up militarily in the east and the south and making some inroads, slowly, but progressing around some of these key towns in the east. And bit by bit, getting some further ground. And they're not making massive gains, but the longer they hold that territory in Ukraine, the harder it's going to be to get them back out again. And so time is really on the clock here for Zelensky when it comes to Ukraine's future with NATO, but he's not going to get a lot really out of this meeting.
Roz, do we know what NATO allies and European officials actually think of the Biden candidacy?
Well, we know from talking to European officials and sources just in the past week, they're very concerned about the picture in the US electorally. They're concerned about Joe Biden and his health, his age, some of those recent episodes that we've seen, his debate performance, for example, and that here he is hosting this week, and it's going to be a demanding meeting either way. There's going to be a big press conference at the end. There are dinners involved, so late nights. And how does Joe Biden hold up under all of that? And there's a real level of concern going in. So they're going to be watching very closely for all those small moments. Is he coherent throughout? Is he presenting, a strong, statesman-like appearance throughout? The kind of microcosm that's deeply uncomfortable for the leader of one of the biggest countries on the planet. But really that narrative again around him is just arcing over everything at the moment. It's certainly going to be something that all the officials are going to be watching and taking note of closely.
Roz, thank you so much. Bloomberg's EMEA News Director, Roz Matheson. Let's get back to Ian Steely, International Chief Investment Officer of Fixed Income at JP Morgan Asset Management. You have, Ian, thank you so much for sticking around, all the leaders at NATO, and you can see by going through the list who has a good mandate, who is, in question in terms of power. I mean, can you just from that decide where you put your investments in terms of bonds? Does Keir Starmer, have a good enough standing to keep investors happy?
I think it's quite interesting, isn't it? Because going over there, Keir Starmer's in a position of strength. He's got a 5-year mandate, and not everyone else in the room is going to have that. I think actually, from a sort of a global fixed income standpoint and investment, you do need to take a step back and think what's happening at the domestic level. How are we thinking about it from an inflation, from a growth standpoint? Obviously, deficits, as you mentioned earlier, are really front of mind both in Europe and in the US, and then how the central banks are going to ultimately have to deal with that, because everyone's assuming they're going to be easing policy. Are they going to be able to, if we do see a lot more government spending coming? And that's obviously a bit of a fear for the markets.
So what's your take on gilts? Is it are you waiting for more policies from Labour? Are you waiting for the cabinet to start to work, or does it look like a good opportunity because it's a pretty good house in like a bad neighbourhood?
I think actually, when we look at gilts, probably one of the more attractive government bond markets out there, just due to a valuation standpoint. Where do they stack up versus Bunds, and where do they stack up versus Treasuries? I think we've heard from the manifesto from the new government that they're not going to do anything too extraordinary on the deficit side. They've obviously learned from previous experiences over the last couple of years, not looking to repeat that. And I think what I'm going to be quite interested in is trying to figure out what the Bank of England are doing, because we obviously went through a blackout period prior to the election, and then we had the meeting, which they didn't have the press conference at, but it did, it lent to the dovish side. Lots of people talking about August. Does the data come out? Does the inflation data come out and continue to push towards that August cut and let the Bank of England get going? I think that's where I will be focusing on for the next couple of weeks.
So the French elections definitely kept everyone on their toes. Where do you see that German Bund and French bond spread going?
I think probably going to stabilise around these levels, and I think what happened over the 2 weekends is you took out some of the fear factor of the extremes in either direction. Ultimately, you're going to have this hung parliament. You're not going to be able to get a lot done on the fiscal side. Obviously, Macron was looking to get that deficit down from around 5.5% towards 5.1%, and obviously continue to go lower. Are we going to be able to achieve that now? Question about that, but what that probably means is you do need to have a bit more risk premium. So the 40 to 50 basis points that we saw prior to the snap election announcement, we're probably not going to go back there. But I think that tail risk of the people who are talking north of 100 on a sort of a far right or a far left victory, that also has gone out the window. So I think we stabilise here. I do think though that there are better credits in Europe, places like Spain, where they are being a bit more fiscally prudent.
Okay, interesting. Ian, thank you so much for joining us. Ian Steely there from JP Morgan Asset Management. We'll have plenty more to come. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything. The top names in business are on Bloomberg.
You need to have an AI game plan. We used to say that every company needs to think about becoming a software company. Now we say that every company needs to become an intelligent software company.
Context changes everything. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West. Only on Bloomberg Television. Context changes everything.
DOJ or other authorities
could face bigger challenges next.
Fed was going to keep rating World Cup. This is a three.
As the economic picture
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Jumpstart your trading day with 2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
Bloomberg Open Interest premieres Monday at 9 a.m. Eastern, only on Bloomberg Television.
The conversations that matter, the insights you need. This is The Pulse. I'm Francine Lacqua here in London. Now, the Hungarian Prime Minister Viktor Orban has met with Chinese President Xi Jinping during an unannounced visit to Beijing. This comes just days after a similar surprise trip to Moscow for talks with Vladimir Putin. Well, EU leaders have sought to distance themselves from Orban's shuttle diplomacy, which comes as Hungary takes over the bloc's rotating presidency. Now, Microsoft has told employees in China that from September, they'll only be able to use iPhones for work. According to an internal memo, the measure is part of a company-wide effort to protect against hackers. Now, Google Play is not available in China, leaving Apple's app stores as the only place Microsoft employees can download mandatory security apps. And Chinese EV maker BYD has signaled a deal with Turkey for a $1 billion factory. Now, the company wants to produce 150,000 electric and hybrid vehicles each year in the plant, which also includes a research and development center. Now, the move could bolster the Chinese automaker's foothold in Europe. While not an EU member, Turkey has a customs deal with the bloc. Now, this is a picture across U.S. futures. Yesterday, we had another record high for a lot of these U.S. companies, actually. Wall Street was higher. Again, investors today await the Federal Reserve Chair Jay Powell's testimony to Congress for clues on the U.S. interest rate outlook. Coming up, United Airlines says another of its Boeing aircraft lost a wheel after takeoff. We'll bring you the story and more from the industry next. This is Bloomberg.
German economy minister says we are not satisfied with the economic situation in Germany.
The business of sports has gone global.
I want sports to grow. I want sports to be bigger because we have talent.
And how mammoth value is coming from the smallest of players.
Hello.
3,184 hits, 431 home runs, and of course the most famous stat that everybody knows, 2,632 consecutive games played. Unmatched career. Why are you doing this?
What we have achieved in the NWSL from an investor perspective over 2 years is the equivalent of what it took other leagues 25 to 30 years to achieve.
You've got to have a business that's sustainable. The only way it's sustainable is got to make money.
There's only one word, winning. You win on the court, you win off the court. And as you do that, you bring people along.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacroix here in London, and these are your top stories. U.S. futures are heading for another record high as investors wait for Fed Chair Jay Powell to testify on Capitol Hill. The NATO summit begins in Washington today. The event will be overshadowed by domestic turmoil across the alliance, from Biden's candidacy to the results of the French elections. Plus, Bloomberg learns that Boeing is in talks to preserve U.S. defense contracts after pleading guilty to a criminal charge tied to fatal crashes of its 737 MAX jets. United says another of its Boeing aircraft lost a main landing gear wheel on takeoff, a near repeat of an incident in March. So let's now get more on all of this story with Bloomberg's global aviation editor-leader. He is Benny Campbell, who's in Berlin for us. So Benny, what's exactly behind this United story?
So this incident was reported yesterday, and it was eerily similar to what we had a couple of weeks ago, as you said, a wheel coming off the landing gear of a United aircraft plane. It was, again, a Boeing plane, but in this case, as was the case in the last incident, you know, it's hard to pin this on Boeing, really. This is a plane that's long been in a United fleet. It's an out-of-production plane. It's a 757. So really a maintenance issue that falls squarely on United rather than sort of on the Boeing side of things. But what it tells you is sort of there's a perception out there that flying has possibly become less safe. There's a sense the number of incidents are on the rise. People are a lot more sort of acutely aware of what's going on around them. We had a report yesterday that the US regulator, the FAA, is demanding inspection of oxygen masks on Boeing aircraft. So these sort of incidents previously might have not been reported that widely and are a lot more sort of in the public sphere now and on people's minds as they board their planes.
So what's the latest on Boeing, Benny?
Well, there was a sort of flurry of announcements yesterday from Boeing. The company said that they would enter a plea deal with the Department of Justice. This followed these two accidents that they had in 2018 and 2019. What this means for Boeing is that they are now a convicted felon, which obviously is a huge blemish on its reputation. And the question, you mentioned it just now in your teaser, is what does that mean for sort of future contracts, particularly on the government side? Normally, if you are convicted, doing business with the government is much harder. And in this case, obviously, we're talking about Boeing. It'll be very difficult to take Boeing out of the equation. They are a huge defense provider. They put people into space. So they will probably see if they can find some sort of workaround, some kind of waiver. That's something we'll be following in the next couple of weeks. And defense, obviously, has become a very important business for them, always was, but is more crucial now than ever as a civil side, the normal sort of aircraft that we all know that they're, you know, in trouble right now.
And Benny, we also had Airbus numbers. Can you break them down for us?
Sure. So we get the monthly orders and deliveries from both plane makers. Airbus came out with theirs yesterday. It's a closely watched number because it gives you a sense of sort of where they stand in terms of their annual target. And Airbus last week, to remind people, put out a pretty comprehensive profit warning. They downgraded their delivery target for the year. They downgraded a couple of other metrics. So this was a very closely watched number, and it was essentially a fairly good number. They delivered 67 planes last month. And that's their highest tally so far on a monthly basis this year. So it looks like they've got a grip on sort of their supply issues, or at least things are improving and not getting any worse. We'll get the numbers from Boeing later today, and it'll be interesting to see just, are they also improving? Are they heading into the latter part of the year with a slightly sort of more upbeat tone? And what will the divide be between Airbus and Boeing? You've got to remember this was a duopoly essentially, and it's become a more sort of tilted towards Airbus sort of duopoly over the last couple of months. So it'll be interesting to see how that exactly plays out. Will Airbus be able to sort of play its advantage even more?
Benny, thanks so much. Bloomberg's global aviation editorial lead there, Benny Camel. Now, Lamborghini chief executive Stephen Winkleman speaks exclusively with Bloomberg about the luxury's carmaker plan to roll out new models in 2024, including a hybrid twin-turbo V8 model.
We started last year with the Revuelto as our V12 with a plug-in hybrid. Earlier this year, we showcased the Urus SE, and now it will be the third one. So the follow of the Huracan will be completely new. And this is going to be the third car with a plug-in hybrid system. And it has an incredible engine, which is revving up to 10,000 RPM, and combined with the battery solution, we are heading at the launch already to 920 horsepower. Something really exciting, and we call it a 40 class. So somebody who's really playing in a different field, much better than all what has been seen so far in this field.
Stefan, I get the hybrids. For supercars, it just makes sense because you get the instant torque of the electric motor, plus the feeling, the vibes, the smell, the sounds, the character of the internal combustion engine. But how do you expect to see these cars resell? Normally if Lambo sells a vehicle for, say, $300,000, it goes on the secondary market for $400,000. Like, they command instantly a premium. But we haven't seen that with, for example, Ferrari's hybrids. They're the first cars that company puts out that actually fall in the aftermarket. So what do you expect for the plug-in hybrids in terms of resale value?
So first of all, you have to keep the promise. The first promise we are making is to be more performing and more sustainable. The second one is that the car always has to be a complete new car in terms of design. These are the two things, so design and performance, including better sustainability. Then, for sure, the big risk is always that you get too excited, that you produce too many cars, and therefore the residuals are going down. This is a mistake which we are not going to do, so we will leverage very much on the length of the order bank and balance accordingly.
Lamborghini chief executive Stephen Winkleman there speaking exclusively to Bloomberg. Now returning to the markets, Morgan Stanley's chief U.S. equity strategist says investors should brace for a potential correction in the S&P 500 in the coming months. Well, Mike Wilson told us where he sees risks in the U.S. markets.
What worries me is that momentum is so strong and people have a lot more exposure to high multiple stocks than they think they do. And if you have an event that's unpredictable, then you could have a real reset on valuation of 10, 15%. Like, I think the chance of a 10% correction is highly likely sometime between now and the election. Not just because of the election, but because uncertainty is going to prevail for a lot of different reasons. Earnings reasons, election outcome reasons, some of the things you mentioned earlier around tariffs, potentially immigration, Fed policy still remains uncertain. So yeah, I think the third quarter typically is that period, and it's going to be choppy. Now we're hoping that's going to create some opportunity, but like right here, valuations to me look very, very unexciting.
And it's a great point, too, on you might be more exposed to tech than you think, especially if you're sitting in the S&P 500, which is, what, 30% tech or so. I do want to actually talk about how all of this rolls into price targets. And typically at this point, I would ask you what your year-end S&P 500 forecast is. But I know that you've backed away from those sorts of calls. And it was interesting. If you take a look at Friday, we got some news from Piper Sandler saying that they're actually going to drop their S&P 500 forecasts, that basically it's bad practice. And when you think about that, I mean, are we starting to see the beginning of the end of these big, bold S&P 500 forecasts?
Well, no. What we do is we rolled forward our forecast 12 months in May, so we take away our year-end target. And look, first thing I would say is S&P targets at a certain time and price is kind of silly. But what I would tell you is that the risk-reward from here we think is lower. Like over the next 4 to 6 months, for the same reason I just mentioned, we have volatility probably picking up in the third quarter. I would say your likelihood of upside between now and year-end is very low, much lower than normal. I'd call it 20-25% that markets are higher between now and year-end. Okay, specific target, I don't know, but let's say it's down 10% or so. Then we would get interested. Then we'd be interested to say, okay, maybe there's some things happening at the index level. Where the opportunity remains is at the stock level, at the factor level, okay? And in that regard, we still like sort of growth, but not just quality growth, but like, quality in general, large cap, good balance sheets, companies that can deliver on earnings, and that momentum will continue. It's just hard to find companies that are cheap. So if they were to come in 10%, then we'd probably get interested again.
Morgan Stanley's chief U.S. equity strategist, Mike Wilson, speaking on the debut of Bloomberg's Open Interest. Now, coming up, she's 27 years old, has started several companies, and has more than 1 million followers online. We'll be speaking to Grace Beverly, founder of activewear brand Tala, next. This is Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders. From breakfast cereals to pet foods, General Mills has an iconic array of brands. But future success depends on efficiency, innovation, and insight. CFO Kofi Bruce does much more than crunch numbers.
Our first job is to intimately understand and anticipate the consumer's needs.
Watch Chief Future Officer. New episode Wednesday on Bloomberg Television. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Access the financial world on demand. Hear from leading economists, policymakers, and
So ECB's Panetta says the ECB can gradually reduce rates in line with the actual and expected inflation rate, which will complete the disinflationary process underway. But the ECB should be ready to respond quickly to any shocks in one direction or the other. I'm concerned about high service sector prices, and it's understandable, but it's normal that they will fall with a lag compared with goods prices. Previous rate hikes will continue to dampen demand output and inflation for months to come. Italian GDP probably grew at about 0.3% quarter over quarter in the second quarter, and wage growth can also be expected to ease.
Economic growth is the only route to the improved prosperity that our country needs and to improve the living standards of working people. Where previous governments have been unwilling to take the difficult decisions to deliver growth or have waited too long to act, I will not hesitate. Growth was the Labour Party's mission in opposition. It is now our national mission. There is no time to waste.
That was a new UK Chancellor, Rachel Reeves. Now, my next guest is a top UK entrepreneur. Grace Beverley founded the activewear label Tala, aged 22, and now has more than 1 million followers on social media. Now, according to a recent Bloomberg intelligence report, women's activewear could be a $290 billion market by 2032. And Grace Beverley joins me now. Grace, thank you so much for coming on. I mean, there's quite a lot of excitement. I have a very young and fit newsroom, so there's quite a lot of excitement actually that you were coming on, but there's so many brands at the moment. So how do you really make a difference and kind of, I guess, stand away from the crowd for Tala?
So for us, it's really just been about listening to our customer over and over and over again for the past 5 years. We're all about making problem-solving clothing, and for us, that means multi-way, multi-wear, versatile, flattering. We know that our customer, she wants to buy some flares and not just wear them to the gym or kind of to and from the gym. She wants to be able to wear those same flares to go and see her friends, to brunch, to a Pilates class, whatever it might be. And I think that more and more, especially at the moment, people just want to get more out of their clothing. And so for us, it's really been about understanding how we can directly serve our customer and know that when she is deciding to spend money with us, she is getting a piece that she will wear not only to a lot of different things she does, but also for years.
So Grace, what does that look like? I mean, you've been amazing actually at marketing this, on having the vlog, like you're everywhere, you're a lifestyle, you're a brand. And so do people buy into that, or is it actually, do you spend time looking at, how the clothes is resilient and kind of, breathable and things like that?
I mean, we spend more time than I care to share on exactly that. We always talk about the fact that we are a team made up hugely of our target customer, and what that means is that we will spend an hour debating the placement of a gusset or, how that kind of fits and feels. And for us, that's what makes us special. So, absolutely, we've had great traction online, and that's been incredibly exciting. But to me, you cannot build a business with repeat custom, which we all know is pretty much the secret to being able to build a lasting business that people kind of know and care about and consume again and again, where it comes to like choosing their clothing. But you cannot purely do that through great marketing. The product has to be the marketing too.
How big do you want to be? And actually, who do you see as your most formidable competitor?
I think for us, it's really, when I look at competitors, I look at the fact that it's not necessarily who else she's buying her clothing from, it's who else is on her Instagram feed. It's who, there is a huge amount of choice nowadays, and what we've really doubled down on is making sure that the service we're giving her and the quality we're giving her is above and beyond, and that's shown in the fact that we're rated higher on Trustpilot than any of our competitors, and for us, a competitor might be, especially with at the moment, purse strings are tighter than ever. It may be that she wants to buy some new makeup this week, but it may also be that she wants to buy us. So we look at it less like this person sells leggings and therefore that's our competitor. We look at it more, how much value can we give to our customers' lives and every day, and for us that's kind of the way we think of competition. And as long as we're making sure that our quality is constantly benchmarked highest in the industry, we're happy.
And how do you see the US consumers? So how big do you want? Are there any areas actually where you want to grow?
Yes, absolutely. So the US has been a big part of our strategy. That's kind of something that over the past few years, since our last funding round, which was 3 years ago, we spent a lot of time really learning and understanding that US customer. We've had an organic US following from the beginning, which has been incredible because, as we know, the US is a tough place to break. But we've started recently doing a lot more marketing activity over there. We just did an event in LA, and the excitement has been absolutely incredible. So we've been really excited about the traction there.
So in 3-4 years, are you expecting like 20-30% of your sales from the US, or how do you see that changing?
I mean, ideally, that's absolutely the case. I think that for us, though, it's always been about not forgetting our core customer, and we know that the UK is really, really excited about us. I'm really, really keen on making the UK a great place for entrepreneurs, especially female entrepreneurs, to be. And when it comes to athleisure, that also means not just kind of jumping ship and hopping over to the US. We know that our UK customers have been really, really core to the brand. So absolutely, as much as we want to be able to service our US customers, we know that on our home turf, that's also will always be an incredibly exciting opportunity for us.
Are you expecting great things from the new government?
I would love to see a little bit more certainty. The Conservative changed the business tax rates, I think 26 times during their tenure. So it would be great to see, Labour's promised corporation tax kind of fix. That would be great. I also would love to see a task force on getting more female funding. We know that 2% of venture capital funding goes to women, and actually women co-founders, so businesses with at least one woman co-founder, the VC funding rate went from 14% to 10% last year. So it's actually getting worse. So I'd really love to see a task force put in place in order to actually make sure we're moving in the right direction, because currently we've not been.
Have you heard actually from people inside Labour that that's what they want to focus on? I mean, we have for the first time a female chancellor. Mm-hmm. I don't know whether that makes a difference or not, but certainly it's good to see.
It's absolutely good to see. I think, obviously it's incredibly early days. We'd been working within the Treasury on actually creating this task force in the past few months, so obviously that's been shaken up. I would love to see that brought into the new government. I think that, we know from the Rose Review that £200 billion could be added to the UK economy if women raised at the same rate as men. We've talked about how much the athleisure market could be, especially within women's athleisure. So we know that women's consumption is incredibly important. Now, it's incredibly important to me that women founders can build those businesses too. So haven't heard about it yet, but very excited to see that movement in the right direction.
And this crisis at what level? Is it angel invest? Is it right at the beginning, or is it actually that women start sometimes companies, but then it's when they need to grow that they have limited access to capital?
So the limited access gets worse and worse as companies grow, but we do know that, for example, with venture capital, which is often early on in a business's kind of life cycle, at least within the kind of seed Series A, Series B, we know that that is at an only 2% rate. We also know that angel investment is a lot lower in women's businesses, and women hold a lot less wealth, and obviously are more likely to invest in a like-for-like kind of a company that they would buy from. So it is across the board, and it's really terrible across the board. It's not when, it's not this kind of like 46, 54 kind of discrepancy. This is a 2% to 98% discrepancy. So in my opinion, this should be an urgent fix. And I also think that this is a huge opportunity, because this is a worldwide issue. We've seen that in the US, 2.8% was the highest amount of VC funding that ever went to women founders. So if we can make the UK a great place for women entrepreneurs to be, then this is a huge opportunity for us to get great talent, to get great businesses being built here, to stop a little bit of the drain of the UK businesses going to the US when it comes to venture. We could get, the opposite of that. So I think it would be a great opportunity for us to take.
And Grace, what do you think makes your success? I mean, a lot of time, a lot of viewers will say, Grace Beverly started this at uni. She's kind of like built on it. She's done so much.
At 5 a.m. Eastern Time, we expect comments from ECB Cipollone, who gives a video message at Digital Euro event organised by the Central Bank of Cyprus.
Of course, there's good and bad, but to me, really, you cannot overstate the importance of having that direct feedback with your customer and really listening to them. We can hop on tomorrow or today and say, hey, we're actually creating these running shorts. Do you prefer the inseam to be like this and come out of, like in the bottom of the double layer, or would you like it to be a little bit shorter? And we can get that live feedback, and we hold that so dear to us, and that is what we've worked on again and again and again. So really, our customers have built our business, and I think to me, that's definitely been what set us apart.
Grace, thank you so much for joining us today. That was Grace Beverly, the founder of Tala. Now, coming up, the relentless AI rally helps TSMC's ADRs hit $1 trillion in market cap. We'll have plenty more on Taiwan Semiconductor next. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
ADRs in chipmaker TSMC briefly hit a market cap of $1 trillion on Wall Street overnight, driven by booming demand for AI. Now, this is a picture for Taiwan Semiconductors, 0.7% higher. Well, Bloomberg's Charlotte Yang actually joins us with the very latest. Charlotte, good morning. So could there be further upside from here?
Yeah, so to the more bullish analysts, there's certainly upside, especially with TSMC's high bay listed shares, which has underperformed its ADRs this year. And the key catalyst everybody's watching is the world's largest contract chip maker's second quarter earnings results, which is scheduled next Thursday. So Morgan Stanley, which has just raised its price target for TSMC earlier this week, is expecting the company to revise up its revenue guidance for this year. And if that happens, this will even confirms the bullish for the AI bulls to say that the rally this year is no bubble because they are backed up by fundamentals.
At 5 a.m. Eastern Time, we expect comments from ECB Cipollone, who gives a video message at the Digital Euro event organized by the Central Bank of Cyprus.
For the second quarter on a year-over-year basis, and that will be the fastest quarter since the December quarter of 2022.
So, meanwhile, Microsoft is also ordering staff in China to swap Androids for iPhones. What's behind that move?
Yeah, so Microsoft is telling its staff in China that starting in September, they will only be able to use iPhone devices. And that means effectively cutting off all Android-powered devices from accessing corporate resources. And the reason why they're doing that is part of the efforts of the company-wide efforts, to improve their security measures. And because a lot of the Android-powered devices cannot access Google Play, which will not be able to access the security apps, which is why they're asking them to use the iPhone devices.
Charlotte, thanks so much. Charlotte Yang there with the very latest on some of these stories. Up next, Bloomberg Brief, Danny Berger and Manoj Krani in New York, and this is Bloomberg.
In recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that was started in 1977 when by then I had a little research station and 4 of my students were kidnapped and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
From the world of politics to the world of business, 2 times a day at 1 p.m. and 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lyons deliver news, insight, and analysis from and about politics.
Shortly expecting comments from ECB's Cipollone.
That is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world twice a day at 1 and 5 Eastern. Only on Bloomberg TV and radio. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
This is Bloomberg.
Good morning from our global headquarters in New York. I'm Manus Cranny alongside Danny Berger. Welcome to Bloomberg Brief. Let's set that agenda.
Powell is in the spotlight. It's day one for the Fed chair as he testifies before lawmakers growing impatient for interest rate cuts. NATO leaders head to Washington for its 75th summit as global election turmoil overshadows its mission.
So the OECD sees slower employment growth and a slight rise in unemployment in 2024 to 2025.
Its guilty plea. Good morning, Manus.
And sees continued recovery in real wages as profits cool.
Mike Wilson 24 hours ago said these equity markets could have a 10% drawdown in them. A correction is highly likely. Then you look at what Citi are saying. AI exposed equities. There's a risk of a bubble. No shock there that people are going to call that. But when it comes to the flow of money, Goldman Sachs, Rubner over there says buyers are out of ammo, and I'm on the lookout for outflows in August. That's the next leg of the stool maybe to come under pressure. We go into earnings season. You got banks hitting the tape on Friday. So again, it's going to be a high bar to beat there. Intel furiously higher this morning, up 4.3%. It was up as much as 6%. You've got TSMC making $1 trillion valuation. All the chip stocks moved a little bit higher yesterday. Piper Sandler have an interesting note out talking about the size of the GPU business being $400 billion by 2027. So again, there's fuel to the elixir of life within the chip story. Tens, you've got $58 billion worth of 3-year notes coming down the pike. But term premium, go on the term premium. It is back. It's almost on the plimsoll line of zero. So we've rallied in terms of term premium. Is there enough term premium to tempt you in? I put BP in here because they've made an announcement this morning in the United Kingdom that they're going to take a hit of up to $2 billion in terms of their exposure on the refineries in Germany. Stock down 3.39%. I'm excited for earnings season. Good morning, Danny.
You have to wait until Friday, Manus, until earnings season starts in force with the banks kicking off. It is a busy week until then. Today, as we've been mentioning, is the start of Powell's testimony. And I think it takes on more importance than it usually does. Usually the congressional testimony, you hear the same sort of language. But Powell now has another data point, and that is the jobs figure. Unemployment at 4.1%. This is the question. He's talked about the reaction function being really dovish, that should there be cracks in the labor market, that they would act and they would cut. Is this enough? Is he going to acknowledge the weakening in this labor market? Because right now the summary of economic projections has labor markets coming in, has unemployment falling. And that's not what the trend has been.
I would say these politicians are going to be pretty aggressive. This is going to be the last time that you're going to officially see Powell in front of politicians before the election. They're going to be chomping at the bit to go at him from all sides. This is what Paul Donovan wrote overnight. And he talked about the fact that he's not a PhD, he's not an economist. Powell has tended to focus more on the issues politicians care about and less on what the independent central bank should worry about. And of course, what you're going to hear here is it's the argument. If your inflation inflation is lower than Europe. Why are you hanging on? Well, it goes back to the 1970s. They don't want a 1970s redux. If they're data dependent, how reliable is the data? So I think he's going to be salvoed from all sides.
Yeah, I mean, this is a criticism that you hear a lot against Powell, basically saying, look, the man is trained as a lawyer. He's not an economist. One could say the same for Madame Lagarde, potentially, too.
But she's doing a fine job.
But look, he's got a lot of people on his side, and that's why you listen to people like Williams, who takes on an increased importance because they do have that economic background. But the thing is Powell can be as dovish as he wants. We're also going to hear from Bowman today. If there are those hawkish members of the FOMC, especially if we're in election year, does he need to get basically everyone behind a rate cut to say, okay, that's why we moved? Or else does it start to sound political if you don't have everybody on side? And I think that's the risk right now.
Well, the Doves are in the ascendance at the moment. They have got, Mary Daly talks about a tipping point. You've got others, Goolsbee also going down that road. So the narrative is shifting behind. He's got a fair wind behind him in terms of the disinflation narrative, and that's what our guests have said over the past couple of days. The disinflation is perhaps a little bit more than we all anticipate.
Right, and Ed Cole of Man Group writes something similar about this, Manus. Yeah. He says a much clearer disinflation trend is now evident in the U.S. To me, that's at odds with the caution that the Fed is still telegraphing. Perhaps that is a precursor to bringing back the hard landing conversation that was so prevalent at the end of 22. Time will tell. Ed joins us now, who is the head of multi-strategy equities at Man Group. Ed, it's always a pleasure to talk with you, and I think that's so prescient ahead of what we're going to hear from Powell, because the Doves are louder, but they're not saying it's time yet. So what is the risk of a policy error at this point?
I think policy error is a bit rich. I think that Manus put it well, which is that, you know, there's a degree of caution which is probably warranted to prevent any kind of resurgence in inflation that could bring back the spectre of the 70s. My sense is that, you know, if you're trying to ensure the Fed's independence, that what you have to do is take your mandates extremely seriously. Since November last year, we've started to have a little bit more symmetry in how the Fed talks about its mandate. So we had that kind of pivot at the end of November where it became, where Powell started to talk about policy being restrictive. And it started to be a bit more obvious that they were thinking about those dual mandates in a slightly more symmetrical way. My sense is that we'll continue to hear Fed speakers being a little bit cautious, or Powell in particular, particularly today in front of politicians. But the trend is becoming increasingly clear. For markets, it's fascinating because markets seem what's priced in today. Markets are assured that this is soft landing territory. And, you know, we're going to start asking that question, I think, in coming months about whether soft is really soft or maybe if it's becoming a bit harder.
Oh, Ed, you've upset her now. But the question is whether it's a double soft, and whether then. So we're all assuming it's going to be 25, very symmetrical, 25 before the end of the year. But if that landing does become double soft or even incrementally harder, let's throw one out there before the election. Let's get 50 basis points in and get it away, or would that be the shock and indicate a panic?
Oh, I don't know. Yeah, I mean, my sense is that would be too much. You'd have to see a precipitous decline in activity data that at the moment is not that obvious. Now, as I say that, I'm conscious that typically what happens before recessions is things look fine, right? I mean, we had that pattern of things in the GFC, as far as I remember. I think the fourth quarter 2007 was 2.5% real growth, and then we dropped off a cliff. So, you know, maybe they'll see something that requires 50. My sense is probably not. My sense is they'll go gently. Okay. I'm pretty bad, to be totally honest, on predicting anything, but in particular predicting with any accuracy timing of anything. I think the important thing for markets is the trend and the fundamental data that underpins the trend, and to me that's quite clear at the moment.
The trend at this moment has been AI, NVIDIA over everything, Ed. I find it interesting, the issues that people are having, trying to get their heads around it, because it is scary when you look at the very thin leadership. Terry Smith over at Fundsmith had an investor letter out that FT got their hands out, and it basically said, we have been underperforming this market because we do not own NVIDIA. And NVIDIA, we have yet to convince ourselves that its outlook is as predictable as we seek. But then he goes on to say, outperformance has been difficult to obtain because we don't own this thing. So as a fund manager, Ed, how do you think about this? The uncomfortableness of just owning and being overweight NVIDIA, but the fact you can't really outperform this market unless you do so.
Yeah, look, I defending underperformance is.
So German Chancellor Scholz says, "I am not worried about Biden's mental fitness."
I think I would probably offer a slightly different reflection on the opportunity set at the moment. What we do is market neutral, right? So we're in the pure alpha business, which is a job of trying to select securities that can beat other securities and play the spread between the winners and the losers. This has been a phenomenal environment for that. And I would say in the funds that I manage, in the multi-manager hedge funds that I manage, where I'm allocating capital to some really great PMs across Man Group, we've had a really good year. And we've had a good year with minimal or perhaps even zero exposure to NVIDIA. And actually it's been an environment, a fascinating environment, and something that we suspected might be the case as rates moved higher, is that dispersion in stocks has moved quite a lot higher. So vol's been very low, but dispersion's been quite high, which really means you get rewarded for placing correct bets on winners versus losers. And it's been a much better environment for that than the period during very low interest rates. So I think if you're a stock picker, there's been plenty of opportunity. It's been interesting how that opportunity has been broad-based. You know, we've got value managers who have outperformed, we've got growth managers who have outperformed. It's actually been a good environment. So I'm resistant to the idea that not owning one company can be a determinant of all of your year's returns.
Look, Ed, we've had you on several times, and this conversation seems to be the most understated bull that I've heard you be. And you talk about loosening regimes as being overwhelmingly bullish for equities and bonds. Are you equitably bullish on both? We've seen a steepening in the curve, a phenomenal steepening in the United States of America. I mean, are you latently a roaring bull or just a bull?
No, I'm latently a terrible pessimist, actually. I saved a little caveat in what I sent over to you so that I'd have something more interesting to say. I think the point about our analysis on loosening regimes and curve steepening is, yes, they're overwhelmingly bullish for equities and bonds. You know, this time is different, perhaps. Normally, when central banks cut interest rates, they do it against a backdrop of manifestly obvious weak growth, right? Mm-hmm. So you've typically got weakness in growth, you've probably got weakness in asset prices, you've got that sense of kind of, you know, pushing on a string, everyone's so despondent, they think, is anything ever going to help if central banks cut interest rates? And then bit by bit, the loosening of financial conditions and monetary policy starts to support activity and the discounting of improved activity. It is a bit different this time. I mean, I'm worried again about a hard landing. As things stand today, there's not enough evidence of that. So what we can tell you about the pricing of rate cuts in Europe or the UK or the US is they're coming against the backdrop of pretty full inflation and activity data that looks okay, if not stellar. That's unusual. And therefore, it may well be that what I suggested about the exceptional rewards for bonds and equities in loosening regimes don't apply in a 2024 loosening regime that might be very different. Okay. My real preference here, to your question about kind of equal confidence, my real sort of preference here is actually bonds. But I'm an equity person. So how do I think about that preference in the equity market? And I think, you know, you gave in your intro, I was worried because I felt like you stole all my thunder, all the things that I think at the moment you cited. But actually, I agree with a lot of the speakers you referenced. I think we're entering a seasonally difficult period for equity markets. I mean, August and September are the only two consecutive negative months on average over the last 30 years. Off the back of July, which is on average the best month. We've had like $500 billion of ETF inflow this year, so loads and loads of really bullish things. You already mentioned the bar's high on corporate earnings, and I've said there's plenty of things weakening at the margin, not least some of the consumer data where credit card delinquencies in the US are picking up. And
it's certainly going to be a tough couple of months. Ed, we'd never steal your thunder. We just like the notes so much that we just thought we'd sort of put out the big, bold headlines for you there. Ed, good to have you. An equity manager who's bullish on bonds. You can't beat that with a big stick. Ed, thank you very much. Ed Cole there of Man Group, our guest this morning. Other stories trending on your Bloomberg terminal this morning. This is what we got for you. Shares in BP, as we said to you, have been dropping. The company warns of weaker oil refining and write-downs. BP sees significantly lower refining margins and says it will take up to $2 billion in impairments in the second quarter. Now, that figure includes charges related to the scaling back refining operations in Germany due to the high costs and the declining fuel demand.
Most of Houston remains without power in Tropical Storm Beryl's wake. Authorities warned the blackout may last for days. The storm flooded streets, downed trees, darkened traffic lights, and left power lines on the ground. 3 deaths were linked to the Category 1 hurricane.
President Biden says he's firmly committed to staying in the race, allowing his physician to share health details and quell concerns. Despite calls to drop out, he's won support from some progressives he once battled with. Meanwhile, Wall Street's most influential donors have lost sway over Biden, given his sizable campaign war chest. Context matters on Bloomberg.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent.
Russia and India discuss building 6 more nuclear power plants, according to TASS. And Giorgetti says Italian growth may reach 0.9% in 2024.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news.
According to people familiar, Bank Japan showed no specific bond plan at the meeting, and another mega bank wanted the Bank Japan to cut to 3 trillion yen.
Right here on Bloomberg. Context changes everything.
So just repeat from earlier on what we've said before with the Bank Japan in the morning.
It's your Bloomberg Brief. Danny Berger and Manus Cranny in New York. So yet another hiccup for Boeing. United Airlines says one of its Boeing aircrafts lost a wheel while taking off yesterday, and that was nearly identical to another incident that happened in March. Joining us now is Bloomberg's global aviation editorial leader, Benny Camel. Benny, I look forward to a day when we can stop talking about this. And of course, the reason we're talking about this is because it continues to have a black mark on Boeing with every single incident that we hear about. So what's happening with this latest one?
Yes, hi from Berlin. I mean, in all fairness, this is probably more of a black mark on United than it is on Boeing. It's unfortunate that it happened on a Boeing aircraft, but this is a plane that is out of production. It's been in the United fleet for a long time. So this is not something that, would be similar to what we saw in January when we saw this panel blow out of a brand new plane. That was very much on Boeing. In this case, this is more of a maintenance issue that has to do with United. Obviously, it's a serious incident. Luckily, nobody got hurt in this. But you know, the bigger picture really is that the public, the flying public, regulators, everybody is acutely aware of these incidents. Previously, maybe a year ago, even 6 months ago, people wouldn't have cared much about these things. But now a lot more attention is on each and every one of these. And Boeing is kind of in the firing line, even when they are not directly to be blamed. So that's a difficult narrative for them to get out of. And they're trying to do their best. They've had a dismal first half of the year with everything that's been going on. But these incidents obviously don't help, because people will say, oh, it's Boeing again, when in fact it's more on the airlines than on the manufacturer.
Yeah, I mean, the preoccupation is with the cash burn, and now obviously having taken this guilty plea, you know, what will their relationship with the government, will the government be? There's United Airlines down 3.4%. Let's just pivot to Airbus, because it depends what way you read these Airbus numbers. They've come in, they've had their best monthly deliveries of 2024, but does that mask, does that say that they've solved their supply chain issues, or does it simply mask over a bigger issue?
Well, very much the latter, Manus. I mean, this is something that will remain with them, these supply issues, for years to come. The CEO has said as much. We're talking about 2-3 years until this is properly fixed. Remember, they had this pretty dramatic profit warning at the start of last week, where they spoke of all the issues with the supplies. It's not a demand story, it's a supply story. Yes, you got the numbers yesterday from Airbus, 67 planes that were delivered in the month of June. That's a good number. It's the highest monthly tally so far this year, so it sort of points in the right direction. But they have a long way to go to meet their even reduced target for the year. Remember, originally the plan was to hand over 800 aircraft this year. Now it's only 770, and they still remain quite a ways away from that at the halfway mark of the year. So good news on the one hand, that the direction seems to be right, but still quite a lot of catch-up to be done in the latter part.
Okay, well, it's certainly feeding through to prices. I can tell you that from very sore experience with my Amex card, which is one flight to Ireland. I can't even name the price. But anyway, there you go. It's called a lack of supply and bums on seats. Benny, thank you very much. Benedict Kammel in Berlin. Let's turn our attention across to retail. It's the attempt to rebuild relationships, the most important part in retail. But this is with the partners. Nike has brought back a retired executive to be the new VP of Marketplace Partners. Joining us now is Charlie Wells. So Nike tried to bolster and build their own shops, but it looks like they do need partners, and they brought back Tom Petty. Who is he, and what magic touch does he have?
Tom Petty is a 30-year veteran of Nike who is tasked with rebuilding those retail relationships. And this reads a little bit like a cautionary tale from an MBA case study, because we know that there's a cyclical trend in retail away from bricks and mortar and towards technology, but it looks like Nike just pivoted too fast into tech, projecting at one point that they could potentially bring in 50% of sales from digital. That never materialized, excuse me, and they realized they need to rebuild those relationships, and that is what Petty is there for.
It's a difficult time for Nike. The CFO was talking at their last results, saying that they're feeling increasing pressure by the value customer, and they want to give out now a shoe price below $100 that for Nike would be, you know, relatively cheap. So how do they marry these two things? A brand that is struggling, trying to rebuild retail partners, and at the same time, Charlie, a consumer who is starting to feel some price fatigue.
You know, look, that $100 price point is something that they had shied away from. And I think a big issue here is going to be innovation. So you can innovate digitally, you can innovate and rebuild relationships with retail partners, but that innovation on product is what is so difficult. It's hard to get the price points right. And look, Nike's core, fundamental principle years ago was athletics first, and then the consumer will follow. So they would innovate on the court, and consumers would follow after that. They sort of missed a trick recently with that. They've come into 2024 without that innovation, and that could hurt them in the long run.
All anybody wants is Adidas Sambas, I'm sad to report. Charlie, thank you so much. Bloomberg's Charlie Wells. We'll have your top headlines next year on Bloomberg Brief.
Jason Kelly, and this season on Power Players, we're taking you behind the scenes to see how the business of sports has gone global.
I want sports to grow. I want sports to be bigger because we have talent.
And how mammoth value is coming from the smallest of players. 3,184 hits, 431 home runs, and of course the most famous stat that everybody knows, 2,632 consecutive games played. Unmatched career. Why are you doing this?
What we have achieved in the NWSL from an investor perspective over 2 years is the equivalent of what it took other leagues 25 to 30 years to achieve.
You've got to have a business that's sustainable.
House Democrats are to meet behind closed doors at 9 a.m. Eastern Time, according to ABC News.
You win on the court, you win off the court. And as you do that, you bring people along.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close, weekdays at 3 p.m., only on Bloomberg Television. Context changes everything. From the world of politics to the world of business, 2 times a day at 1 p.m. and 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world twice a day at 1 and 5 Eastern, only on Bloomberg TV and radio. Context changes everything.
Time for your front pages. This is what's making news headlines around the world. First up, we have a coalition conundrum in France. You've got Le Figaro leading with this. President Macron, the coalition is not found. Legislative election results prevents an absolute majority. The Left Alliance, far from the mark. Alliance centrists seem inaccessible.
This from the Wall Street Journal, Manis. They're reporting that a Russian missile has struck a children's hospital in Kyiv. At least 33 dead, more than 100 have been injured. President Biden has said that it is critical that the world continues to stand with Ukraine ahead of a NATO summit meeting.
Now, look, it's a story that we've both been tracking quite furiously. The FT leads with their interview with the billionaire David Ellison, Larry Ellison's son. He's got his hands on Paramount, and it is what is he going to do? I think the title of it is...
To further into this ABC piece, House Democrats are to huddle behind closed doors amid debate over Biden's path forward.
And what they're going to make Paramount.
And I'm skeptical. How many times have we heard this of media companies trying to become more tech-like, and it doesn't work? I mean, they have Paramount Plus. They've lost billions on this thing.
I mean, he talks about wanting to reduce the churn, use algos to keep you close to the brand. I mean, you could say that it's a pro forma script of what they're going to do.
Yeah.
And they're building studios in the cloud.
I wonder how much they're going to spend, because they cut spending a lot, and that didn't work out for them. So, you know, time will tell whether this time it works.
In terms of how we should deal with the challenges that are, facing the world and also internally, I think it's just an opportunity also, an angle. And you could see that in a lot of activities that are picking up in this region. simply because it's a region that is actually a bright spot amongst very few in the world today. And people always talk about the flavor of the month. Actually, I don't want to sound too, large-headed, but actually we will be the flavor of decades. We are determined, we have long-term plans, and we are very clear and committed on our commitment to the investment community at large. I'm not talking about one individual country, but at large in the GCC, that we mean business, that we are willing to take every step possible to make it easier for investors to do business in the region, that we are willing to do a lot of structural changes, including actually making it very predictable, very consistent policies.
DOJ or other authorities
could face bigger challenges next.
Fed was going to keep rating World Cup. This is three
As the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
From our global headquarters in New York, I'm Danny Berger alongside Manis Cranny. Let's set your agenda.
Powell in the spotlight. It's day one of the Fed chair as he testifies before lawmakers who are growing impatient for interest rate cuts. NATO leaders head to Washington for the 75th summit as global election turmoil overshadows its mission to show strength and unity. Finding a path forward, Boeing faces yet another incident while grappling with its guilty plea.
Somehow, in all this turbulence, no pun intended with the planes there, Manis, 35 all-time highs. Are we going to hit a 36? We're up by 0.25% for your S&P 500 futures. 10-year yield not moving anywhere fast, up by, let's call it a basis point. 4.28% is where we stand. It's the front end that's been under pressure as we gear up for Powell, as we did see some bond buying last week off the back of weaker economic data. Euro, that is very much so calm and settled this morning after European elections, after France over the weekend. But as the dust settles in Europe, Manis, I can't help but wonder if we start to take the cues of the narrative once again of interest rate divergence, especially because we're going to hear from Powell again. How dovish or not dovish will he be? Will he talk about this labor market? Will he talk about 4.1% and the weakening? Or does he just continue to reiterate, as so many speakers have, that we're not there yet?
Yeah, I mean, the narrative around unemployment and the dual mandate, everybody, the furious focus has been on inflation and the disinflation narrative. But as you said earlier, does he genuflect? Does he acknowledge that softening? And what does that mean for the rates market? The rates market at the moment is going for 2 cuts. We just had Ed Cole from Man Group, and he is mildly bullish, and he's got 2 cuts penciled in there. He's more, for an equity manager, he's more bullish on bonds than he is on equities.
I loved when you were like, you're kind of bullish. He's like, I'm a pessimist, Manis. You have to kind of caveat everything in this weird market where only one stock leads the way. You kind of have to say, yeah, I'm bullish, but I'm pessimistic.
But even on Nvidia, he said, he's got a minimal exposure, and we can outperform without that. But we can ask our next guest whether she's in the same camp. Speaking of which, our next guest says this about the horizon, and a little bit of context for you. Earnings expectations are fully discounted, and volatility from U.S. election. Potential greater economic slowdown from higher rates and inflation. Geopolitical risks are heightened relative to history. She is Stephanie Gould, the head of investments over at Robinhood. Good to see you this morning.
You too.
From that introduction, my sense is that we are perhaps underestimating the scale of slowdown and the pace of disinflation. It's something we've asked a lot of guests this week. We're going to get CPI, we're going to get Powell. So my question to you is the same as to everybody else. What scale of disinflation are you anticipating, and what scale of slowdown?
I think for a scale of disinflation, you sort of just only talked about the risks. I do actually think there's like a balanced view out there. I think bulls and bears are sort of, neck and neck at the moment. Okay. And that's because of the tech super cycle on the other side of this. But from an inflation perspective, I do expect it to continue to fall, but be slow. And I think actually Powell acknowledged that a bit in the semi-annual report, which I'm sure he'll address today or tomorrow. That special section on housing, I think that's the thing that's kind of keeping inflation sort of sticky, and he's acknowledging that it takes a long time to kind of show up in the official numbers. And that's what I think will continue to happen. I do think the rate cuts, which I think they'll have one this year, I'm not necessarily on the same side as the market, although a lot of the data that we got last week actually helps. I think that's what moved expectations up. But I think like we will get a cut this year, and I do think like this kind of a couple of cuts will actually help lower inflation because it will kind of unleash a little bit of demand, I think, on like rents, right? Like I think that will actually help the housing market and sort of cool the rental market.
I find this such an interesting point because I mean, it's this madness of higher rates haven't really affected the economy as much as we thought.
Because there's so much stimulus.
Well, right, but then in that same camp, is lowering rates going to be as effective? Also, kind of to what you're saying in terms of reawakening some growth, helping us avoid any hard landing. If again, it's the stimulus out there that's been aiding the economy, how much more is 1 basis point, 25 basis points, one cut, 1 basis point would be literally nothing. But how much would that really do to kind of avoid any type of undue weakening in this labor market?
I don't think it's going to do very much. That's why I think like they can cut a little bit to acknowledge the fact that like inflation is not nearly as high as it was. And I think you saw it with the ECB, right? Like they cut once. And then you had a note put out saying like we're not sure if we're going to cut a lot more. And I think Powell should wait until he can cut a couple of times rather than like one and then see how it goes.
How much tolerance is there though? I mean, the markets have been at loggerheads with the Fed pretty much the whole way through this. I mean, okay, they were brought to heel from 6 cuts to 2 cuts over the past couple of months. How impatient will the politicians be today?
I mean, I think they have to pander. I think they have to show their constituents that they care about them, and it does matter. Like interest rates have affected the everyday consumer quite a bit, especially the housing market, right? Like people cannot buy houses. The housing market has stayed where it is from a price perspective because people have low mortgage rates. I think it's something like 2/3 of mortgage rates out there are below 4%, which you can't get today. So I think they're going to have to, ask a lot of questions about this.
So you mentioned earlier that basically some of the oddities of this market have to do with AI leading. But if you look at the rest of the market, there are some pretty boring consumer staples that have done well too. Costco, Walmart, Kimberly-Clark, all of them up more than at least 15%. What does that tell you about the contours of the market? That if we're not buying tech, we're buying safety?
Yeah, I think if you look at like outside of the tech space and comm services space, the economy is starting to slow down. The consumer has slowed down. We've seen that, right? Like in the consumer discretionary space in the retail sector, a lot of those companies are like, oh, we're going to put out value menus. We're going to put out ways to give you discounts. Places like Target and Walmart have said the same. So it's showing that they're listening to their customer base, and the consumer is being more discerning about where they're spending their money. I mean, inflation is, they are ground zero for inflation.
But then this is the bifurcation in terms of, who's hurting the most on higher interest rates and on mortgage rates at that price and inflation. And it is those people perhaps at a different income point relative to the wealth enabler or the wealth holders and the wealth builders. Look, we've got a whole host of notes with Mike Wilson 24 hours ago saying, there's a lot of fully valued markets here, 10% drawdown. You got Citi saying book your profits, AI exposed tech. I mean, a 10% drawdown, I'm just sitting reading these notes and I'm thinking, actually, I'd probably welcome a 10% drawdown at this stage because it might just give us a little bit of a draw for breath. And then when the rate cuts come, you have got the opportunity to get into perhaps those higher concentrated areas of the market that are so rich and so expensive at the moment. I'd welcome a 10% drawdown.
I actually think it's very normal. Like if you look back in history, I think over the last 50 years, something like 36 out of those last 50 years, you've had an average drawdown of more than 10%, even when their markets are up for the year. And that's normal. Volatility has been extremely low, and I think I would welcome some volatility too. Typically September is the worst month in the year, and so that may be coming, and I actually do think we'll get a little bit of a correction, but I still am pretty positive for the year and for next year.
Okay, before we what's the one thing that could actually cause that 10% drawdown quickly?
I think it's just expectations being very high.
Okay, we're overpumped. Okay, there you go. Stephanie Guild of Robinhood with her view. It's going to be a tricky September for us. The Turkish Sovereign Wealth Fund is considering a stake sale of over the 26% holding in the country's largest telecommunications operator. I caught up with the CEO to discuss the company's future and the prospect for any IPOs.
Overall, what we are doing is, so actually in the telecommunication industry, we are always going with the tariffs of 12 months. So we are just lagging a little bit behind. So because if you have like 12 months ago, you have your subscription, so we need to wait for the change on the pricing. So that's the reason that we believe in that we are just going to continue on inflationary pricing. And then at the end of the day, still, if you look at all the inflation, the telecommunication industry is well below the inflation rate. So we have still room to go.
So you still think that there's no sign of a slowdown at all in demand or price pressures?
Yeah, not at all.
As I say, orthodoxy is returning. We're looking at inflation rolling over. Does that mean that the window to IPO some of your business is now seriously open?
Yeah, definitely. So we have business in the different, for example, instant messaging app. We have a TV broadcasting app. We have a payment app. So we are looking for all the opportunities, but we are looking for the right time with the right price.
Okay, you've got three major businesses, as I understand, that you want to IPO: the towers business, the broadband business, and the fintech. Which of these is going to be the first and the easiest to get to market?
So actually, we are looking for all the opportunities. So to say the truth, that I'm not going to pick one of those. It's for me, all of them are so valuable. So I'm just going to look into all the opportunities, because currently around the world, the fintech is just also can be a possible option. But also, tower business is also so profitable, and it can be another option as well.
Do you think there's more appetite? If I look at the towers business, typically these will do better. They're much better cash generative, cash flow orientated businesses. So in order of priority, you say you won't pick one particular child that you like the most, but can we expect you to pull the trigger on one of these deals this year? Markets are trading strongly, capital markets are strong. Are you tempted to go this year on one of the businesses?
So again, we need to figure out the perfect timing. So the inflation rate is going down, and then there's a huge appetite about the investments. So we are looking for we are checking the waters, and then we are going to figure out the best time and the best price. For example, the same thing happened for our Ukraine business. We figured out that we have to get out of the Ukraine, so that's the reason that we sold it to our Ukraine branch. So that's the reason that we are looking for the opportunities.
When you choose the timing, is it going to be an IPO in the Turkish market, or would you consider here in the US? Is there a real possibility the US could be on the table?
Yeah, of course. We are just looking at all the opportunities, but the main IPO is going to be mostly in Turkish markets, but we are looking for if possibilities in here as well.
You're interested in renewables, you're interested in data centers. If I said to you, the transformation or the next evolution for Turkcell under your tenure will be what? If you and I sit down in a couple of years, what is Turkcell going to be?
So actually, a data center business, we are just planning to make it bigger. And currently, I have 4 new next-generation data centers, and then I have more than 4,000 customers, local customers, that I'm providing them cloud services. So I can definitely tell that my data center business is going to grow bigger, and I have a huge appetite and ambitious targets with respect to.
So if it's 4 at the moment, what do you want to grow that to? What do you think the demand? Because that's ultimately going to come down to the AI usage in Turkey. So where can that go to? 4 to 8, and in what time frame? Just give me some parameters.
Of course. So the biggest problem with as you may know, the data center business is the sustainable energy. So we need to figure out the first energy cost and sustainable energy sources. So that's the reason that after that you need to keep on growing on the data center numbers. So because of that, I am spending $240 million for 300 megawatts of solar energy farms in Turkey right now to provide a sustainable, renewable energy for my data centers. After it is over, I have more time and more appetite to invest more on the data centers.
The Turkcell CEO catching up with us yesterday. Coming up in the show, all eyes on the President Biden ahead of the NATO summit. That begins in Washington today. We'll break down Biden's effort to stop the infighting over his re-election campaign.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
What about artificial intelligence? Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders. From breakfast cereals to pet foods, General Mills has an iconic array of brands. But future success depends on efficiency, innovation, and insight. CFO Kofi Bruce does much more than crunch numbers.
Our first job is to intimately understand and anticipate the consumer's needs.
Watch Chief Future Officer. New episode Wednesday on Bloomberg Television.
The bottom line here is that we're not going anywhere. I am not going anywhere. I wouldn't be running if I didn't absolutely believe that I am the best candidate to beat Donald Trump in 2024.
That was President Biden insisting he is staying in the race and that he is the best possible candidate to beat the former President Donald Trump to the White House. Let's get to our Brussels bureau chief. It is Kevin Whitelaw. Kevin, thanks for joining us. I mean, first of all, we have this NATO gathering. Is the gathering overshadowed by the politics of the United Kingdom, of France, and of, let's say, miniature chaos in the Democratic Party? Is it being subsumed? What will the chat be?
Yeah, I mean, I think everyone's going to be watching first Joe Biden. They'll be looking to see, how he's doing, how his health looks, how he's coping. Obviously, some of these leaders saw him in France recently for the D-Day celebrations. They saw a few saw things that worried them. So I do think there's going to be, everyone's eyes are going to be on him. Obviously, Emmanuel Macron comes from France, politically wounded, although maybe not quite as wounded as everyone at first thought he was going to be, but still in a pretty precarious position. Chancellor Olaf Scholz still also weak himself. And obviously, the strongest leader is suddenly the UK Prime Minister. That's kind of a shift from where it's been for a while. And everyone's going to want to get their moment with Keir Starmer.
For sure. I mean, look, if anyone understands the idea of momentum, it is Joe Biden, both positive and negative. And right now, there's a lot of negative momentum that he's tried to quell. You have 6 Democrats come out and publicly say they think that he shouldn't be the candidate. You have him do a media blitz on talk shows, on the campaign trail, basically anywhere they can get Biden saying, I'm not backing down. Now we have the progressives of the Democratic Party, like Alexandria Ocasio-Cortez, coming out and supporting Biden. So has he done enough? Or does it at least seem like there is some turn in momentum? Or is he still climbing a very steep hill?
I mean, I just don't see how he breaks out of this news sort of cycle, because at this point, every single moment he's out there, everyone's just essentially waiting for him to falter, waiting for him to fail in some fashion. And everyone's going to be looking for it and likely over-interpreting every little blip that comes out there. So I mean, extremely hard for him to come out and do something that's going to sort of prove to one and all that he's actually just fine. And so it's going to be a long cycle for him with repeated attempts, repeated efforts, and repeated exposures to go out and show that he's still fully with it and is really in control. Kind of hard to almost, if we talk about often hard to prove a negative, in this case, it's actually going to be hard for him to prove the positive.
Well, look, for as long as there's chaos and infighting within the Democratic Party, and we've got ABC talking about a huddle of the Democrats this morning, that will happen at 9 a.m. And again, this is building on a video conference that Hakeem Jeffries coalesced on Sunday. So this is a building internal narrative within the Democratic Party. All Trump and the Republicans have got to do at the moment is do what they've done, which is remain relatively quiet. But of course, it's going to come down as well. Who does Trump pick as his vice president? And there are some names that are put out there as well. He's talking about a person that can do a fantastic job as president as well, and he hopes to announce it perhaps at the convention. So who's in the frame?
Well, you know, we're looking at a couple of different senators: J.D. Vance, Marco Rubio from Florida, a couple of Doug Burgum, governors. So there's a handful of folks whose names are out there. I don't think anyone really knows what's in Trump's mind, and he does like to keep this kind of thing very close to the vest. Ultimately, it could well come down to simply sort of a gut pick for him. He's got to pick someone that he sort of trusts politically, but he's also going to want someone who's not going to really overshadow him, because ultimately, for Donald Trump, everything starts and ends with him, and so he's got to find that balance. He likes to make a splash, he for all we know, he's going to pick the name out of a hat for a day or two beforehand, and not tell anyone. For all we know, it's going to be a surprise to the pick.
Love the idea of picking a vice president the same way you pick who's going to be your secret Santa for the holidays. Kevin, thank you so much. Bloomberg's Kevin Whitelaw in Brussels, who of course has had a long history covering DC as well. Okay, let's turn to the other politics in France. Lawmakers are preparing for negotiations over the next government. Tracking it is Bloomberg's Caroline Conan, who is in Paris. Caroline, it's quite surprising, the scantness of what we've heard from President Macron. We really haven't heard a lot from him since the election. So what do we know about this debate, the horse trading that's happening behind the scenes of coalition building and the next prime minister?
Unlike Germany, France doesn't have at all this tradition of having a wide coalition. So that's something that is very difficult to picture politically.
At 6 a.m. Eastern Time, get US NFIB Business Optimism Index, forecast 90.2 on the prior 90.5.
In the National Assembly, he is likely to have to extend a hand to at least the center left in order to try and get some fragile majority in Parliament. In the short term, he's asked Gabriel Attal, the current Prime Minister, to stay on to deal with current affairs. That could last for a few days, perhaps even a few weeks, given you have the Paris Olympics coming up on July 26th. So it would be kind of weird to change the government just a few days before. At least for security reasons, for continuity reasons. Now, in terms of who he could pick, you could have a few personalities from the center left. That's assuming that this alliance of the New Popular Front explodes and the far left is sidelined. You could see some personalities coming back, perhaps former President François Hollande, because you need someone who's experienced, who's skilled, who's consensual, and obviously you don't have that many of them on the left wing. A Green also would be a possibility. There is a Green leader. She's female. She's called Marine Tondelier. She's been named also as a possible prime minister. But you never know exactly where Macron is looking at. And some
so it's a broad field, Caroline, as you say, and the former prime minister himself, Gabriel Attal, he's coming up with things. He's talking about a broad political offering. It requires a bold move. Let's just talk about Marine Le Pen and in terms of what she's pivoting towards. So she's looking much more broadly within Europe to galvanize her position. She might not accede to power in France, but she is pivoting to Matteo Salvini to join Orban's far-right EU alliance. So this is about building for the next 4 years for her, isn't it?
Of course, because she was using this as a springboard for 2027 presidential elections in France, unless, of course, those elections happen before that. And as you know, the National Rally suffered a big setback in this runoff, only 140 seats, when just a few days ago we were talking about an outright majority for the far right. So she waited for one day to go and see Viktor Orban and say, we're going to join this Patriots for Europe new group in the EU Parliament. In fact, the National Rally is going to become the biggest party within that that new group in the EU Parliament, along with Vox from Spain, along with Matteo Salvini, and clearly this is very different from Giorgia Meloni, who is from a different group in the EU Parliament.
Well, Caroline, it's the coalition of the unwilling. One could say this cohabitation could get very uncomfortable. Caroline Conin in Paris. Thank you for joining us. Context Matters on Bloomberg. Good morning from New York.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
It's a multi-trillion-dollar industry. We'll show you.
So a reminder, in about 5 minutes' time, we're expecting the NFIB Small Business Optimism Index forecast of 90.2 with a prior of 90.5.
Covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything. The top names in business are on Bloomberg.
What I can say is that we've been making significant investments across the franchise, across regulatory reporting, across data, and across resolution and recovery planning. These are areas we've been investing in because we know they're areas that, frankly, the industry likely needs to further enhance, and we certainly want to enhance them for ourselves.
Nobody covers business like Bloomberg. Context changes everything.
Let's get you set up for your trading day. Today, we're going to get numbers for small business optimism at 8 a.m. Eastern, so in just a few minutes. 10 a.m. Eastern, U.S. Treasury Secretary Yellen testifies to the House Financial Services Committee. Fed will deliver his semi-annual testimony to the Senate Banking Committee. And then at 9 a.m. Manus, we learned from ABC that the Democrats will be meeting behind closed doors. Will they have to check their cell phones? Just to give you an idea of the flavor of what the conversation will be about.
Yeah, that is going to be closed door to say the least. And just to reflect on what Biden said, the party has spoken. The Democrat nominee is me.
Yeah, he's been really strong about that.
To succeed in Wall Street,
yeah.
What skills do you need? You need to be somebody that claws people on the back, people that you have to be tough, you have to be fighting people all the time. What are the skills that really take to succeed in Wall Street?
Great question. Of course, you have to work hard. So I can tell you what I found for me, and it's probably counterintuitive. I had to stick out. Which is interesting because I made the decision earlier. Being really the only woman, I already stuck out, and I thought I might as well double down on that. I can't hide. So how did I do that? It was by being a contrarian. And I refused as a research analyst to ever publish research reports that said me too. That said, oh, IBM reported earnings. They came in 2 cents ahead. One of the pennies was currency, the other penny was lower G&A, blah, blah, blah. Forget it. Big calls on big stocks. My very first piece of research I published was very negative at a time nobody did it. I stood the heck out. And when I was right, that elevated me. And David, I've done that as a research analyst, but I did it in business as well. Here's a business strategy.
1 minute to go now.
If everything's fine, just keep your head down and execute. Every once in a while, you have a big insight, and you can build an entire business, in fact, an entire industry around it.
At 91.5, 91.5. That's higher than the forecast of 90.2.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
The growth has definitely turned a little bit the last month, and I think the key part of that is it's just gotten more broad.
We're not seeing a weakening, we're not seeing a contraction, but this is what drives the economy, and we are seeing a deceleration.
What we're seeing is signs that the consumer is slowing down.
When you look at last quarter's GDP, a little bit lower, a little bit below trend, I think this means we are going to start to see more slowing in GDP and overall spending.
There are key pockets of weakness. This is a lopsided economy.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance begins right now. Coming into Tuesday on a 5-day winning streak on the S&P 500. 35 all-time highs on the S&P so far in 2024. Chairman Powell taking center stage down in Washington, D.C. A little bit later on this morning. It is day one of his 2-day testimony.
At a time where people are wondering where the threshold, where the balance of risks is for him, I wonder how much the Fed has left the room. I wonder how much the market is moving ahead of the Fed, because whether they cut or whether they don't cut, how much is that the important message versus the actual weakening in the economy versus ongoing resilience? That, to me, at this point for markets, is the real question.
Are we being too cute by thinking about this? Will it be about the economy and not about President Biden and his leadership? Because it's a double-header today. It's not just the likes of Chairman Powell, it's Secretary Yellen on Capitol Hill as well.
That's right, and she's going to be the one that probably gets more questions about potentially the deterioration in the president's health that was on display at the debate. And the questions now are swirling, even from Democrats within the party, about whether or not he should step aside. Biden was out full front yesterday, defiant, digging in his heels. He did a call-in on Morning Joe. He wrote a letter to congressional Democrats. He got on the phone with the donors, and then at night, he had the Congressional Black Caucus held a meeting with them. He is shoring up the Democratic Party that at this point in a campaign should be firmly behind him.
Well, and whether he is shoring it up will be the key question, and we can analyze Defiant Joe and, for the rest of the show. Well, just to put these two ideas together, the idea of the Federal Reserve and how it responds to some of this political pressure. Peter Scheer coming on the show later today saying, I physically wince at the thought of the first rate cut in September, stocks soaring 5% and literally all hell breaking loose on social media, as it is portrayed as helping the incumbents, how that political risk really calls into question the likelihood of a September rate cut.
We can sit on the economy just for one beat longer. We might as well.
Thank you.
That's what we're here for. Chairman Powell last week said something quite interesting. This was the quote. Because the US economy is strong and the labor market is strong, we have the ability to take our time and get this right. And then we got some jobs data a little bit later in the week. We had an ISM services print. I just wonder how much time he thinks they actually have, how strong he thinks this labor market is. And I think the update, that assessment today is probably going to be the important one.
100%. Do you think he's going to give it?
I think he's got to.
Well, here's the issue. If he says the exact same thing, my question is, do you think that people are going to believe him? Or basically, is he trying to keep all options on the table for things to move aside? The reason why I ask that question is because I would love it if he comes out and he says, the balance is shifting. The issue is he hasn't wanted to say anything conclusive whatsoever. Whether he can help himself, I guess, is the key question.
And when it comes to Jay Powell, it is going to be highly political. This is what Rep. Andy Barr had to say, telling reporters yesterday evening. I want Powell to reiterate that the Fed's monetary policy trajectory is going to be data dependent and not political. And he was talking about this September rate hike, this whole debate the market is having. What Rep. Barr is saying, and he's the House Financial Services, he's on the committee, he said, quote, it will not be perceived as apolitical. It's gotten very tense in terms of whether or not the Fed cuts in September. It's becoming more intense on Capitol Hill if that's going to be seen political, given the dire straits the president's in.
Chairman Powell, just around the corner. Let's start with equity futures and the scores this morning. Equity futures on the S&P 500 positive by 0.2%. Make it day 6, and we will equal the longest winning streak, daily winning streak of the year so far in the S&P 500. In the bond market, just about unchanged on 10s, 428.42. Lisa focused on one thing, tons of supply coming out a little bit later.
Yeah, we're going to have a 3-year auction today. We've got later this week, we've got 10 years and 30 years. A question I'm going to have is, how much do you see some of the fears that we saw previously giving sort of a floor to how much longer-term treasuries can rally? Do we see that floor start to ebb away and actually demand coming back as growth concerns, to your point earlier, really come back to the fore?
Yields just about unchanged on a 10-year. This is the lineup this morning. For the next hour or so, we'll catch up with George Goncalves of MUFG, with US stocks reaching fresh record highs. Sarah Bianchi of Evercore as President Joe Biden refuses to end his campaign, and Kelsey Barrow of JP Morgan saying risks are rising for the labour market. We begin with our top story, the S&P 500 reaching its 35th record high of the year. George Goncalves of MUFG says now comes the hard part. US markets, especially a narrow set of stocks in the equity space, have moved from pricing in perfection to the euphoria phase of the risk bubble. Eventually there will be an exhaustion point that sees assets return back to earth. George joins us around the table. So, George, good morning, first of all.
Good morning.
And second of all, the first question. You're expecting a difficult second half. What's bringing that about?
Well, the first half itself has been proven to be much softer and weaker, and has been decelerating all throughout the last few weeks, few months. And I think that that's setting up the stage for a really challenging summer and into the fall. We have this very highly contentious election to go through. And think about like the setup that we're coming in at the highs for risk markets. We have earnings season ahead of us, and we have the kind of the doldrums of summer, right? We have a few key macro event weeks. We have this week, we have the end of this month, and then we have Jackson Hole. In between that time period, there's very low conviction in the market. Look at the way the VIX is. Like, that's setting up for an environment of difficulty when we get into the throes of the election, number one. And number two, like, you know, which corporates are going to be really embarking on new R&D projects, capital projects. They borrowed all this money at the beginning of the year. They've done their hiring, probably overhired in my opinion. And so now we're into the phase where there might be a pullback on actual hiring and maybe layoffs into the second half, and that will contract growth.
Neil Dancer of Renmax said the cost of doing nothing is going up. It sounds like you agree.
Look, I think that the Fed should be easing. That's been my position for such a long time, that they should have been easing and being preemptive, but they're dragging their feet because they want to get the confidence on inflation. They might get it this week if we get a big catch up on shelter inflation, but nonetheless, you know, it's going to be hard for the Fed to change their message until at least Jackson Hole, I think. And by then it might be too late. And the September cut really comes down to 25 basis points or 50. Remember, first cuts have been historically large when the Fed has actually made a policy mistake. And I think that they're in that potential window where they're actually creating a policy mistake the longer they wait.
This is a key question. What does too late mean? What is at stake? What kind of consequence could there be if they don't cut, as you believe they should, this month?
Well, so look, this month is going to be the path towards a July cut. And listen, I was one of the last holdouts on having a July cut as our base case, and we moved it after, you know, the hawkish rhetoric and the May NFP, which has been proven to have been revised lower. But nonetheless, I mean, it'll take a lot for the Fed to set us up for a July cut. It's not impossible, but it's really going to be setting us up for September, which takes us throughout the whole summer, and this can drag out. And as we're waiting, that uncertainty with markets at the highs, again, markets don't have to stay at the highs. I mean, I know we were running on 35, maybe 36 days of all-time highs, but it's been a grind, right? It's been a grind. It's been an unloved kind of like, hey, yes, markets keep going higher. Any sort of pullback in equities through September, the Fed can be much more aggressive.
When you said unloved, there's sort of a real kind of tension right now. Unloved versus euphoria, unloved versus bubble. So which is it? At a time where you have Citigroup saying it's time to book profits and AI high flyers, you've got Bank of America coming out talking about the fragility of tech stocks simply because of the huge swings that you're seeing on any kind of day-to-day volatility. How do you sort of understand euphoria with this sort of very uncomfortable rally that you see going on?
Yeah, I mean, look, so obviously these concentrated moves and these handful of names have really masked everything. But everyone looks at the indices. They don't just look at individual names. And the fact that equities are up so massively up until the middle of the year, that gives you that kind of confidence that maybe there's financial conditions easing. But we haven't really seen that pick up in sort of retail spending. And we haven't seen the translation of financial conditions translating into broader growth. So it's euphoria to the point where it's not. So the question that I think most people really ask me is, if we see like a retracement in tech stocks of 10, 20, 30%, will that change? Will that be much more damaging than the rally itself, right? So we've had a massive rally in all of these handful of names. Did that result in financial conditions easing, or was it too concentrated to not matter? And therefore, if they pull back and they bring the whole indices down, you'll focus on the indices more than the individual names. So it's kind of like this kind of a mixed sort of a performance message. But nonetheless, if we were to see those stocks no longer go up and actually pull back, then you can get an environment where people focus on the indices, not the individual names, and say, oh, it's just because of these handful of names that they pulled back.
Are you saying that basically if you do see a 10% pullback, that Fed Chair Jay Powell has the green light to cut rates?
I think he has the green light to cut rates given the sort of data that we're getting on the jobs front. We've been getting it for the last 2-3 months. And it continues to be mixed, continues to get revised lower. And I think it's going to get worse from here on out until September. So I think that the hiring plans, as I said earlier, are going to stall. And you're going to get into that tough environment before the election. So, I mean, I don't think that this idea that the Fed's being political is true. They're going to do what's right for the economy. And if that requires a larger cut to start off the process, they'll do it.
But right now, the President of the United States, who's the presumptive nominee, is in a very vulnerable position. Doesn't this make September that much harder for this Fed?
I don't think so. I mean, I think that, in fact, actually going and doing what's right for the economy proves that they are obviously not being driven by the political sort of winds. So I think that this idea that they have to hold off until November, until after the election, then you're really ensuring a much more, not a harder landing, but your chances of soft landing really decrease the longer you wait.
Can we get some trades from you? What are we looking for? Bull flattening, wider spreads, credit? What are you looking to do in treasuries?
So, I mean, this is the challenge. We've had the inverted curve for over now 2 years running, roughly, on the 2s10s curve. It's been the most difficult trade to maintain, but the curve trade is the right trade, because ultimately, if the Fed can fix this really quickly, they can go much faster than what's priced into the forward curve. And so we do think that the curve steepener is the right trade. And as we're waiting and we get into this period of realizing that earnings are not going to be that robust, and that the Fed ultimately will be like a bridge loan between now and the next administration, whichever one that is. So if the Fed's the bridge loan, they have to cut at least 100, 150. And then we'll see what sort of policy measures get implemented by either, whoever wins, right?
I'm just listening to the words you're using. They could, they should, they have to. Will?
Well, the will come when they start realizing the revisions become much more dominant. We get into the September-October time period, and we realize that the economy has decelerated, and they'll be completely agnostic to the political backdrop. They're going to be focused on, we don't want to have this thing unravel.
George Concalves, good to see you. Of MUFG, great to catch up. Looking ahead to Chairman Powell Day 1, another name on a long list of names that have joined this program saying they should, they have to, will they do something soon?
That's the reason why it'll be interesting to see whether the balance of risks has shifted more materially for Fed Chair Jay Powell. That said, right now, priced into the futures markets, doesn't look like they will. Certainly not in July.
Equity futures this morning, just a little bit positive. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. United Airlines says another of its Boeing aircrafts has lost a main landing gear wheel while taking off Monday from L.A. No one was injured on the flight, which went on to land safely in Denver. The incident is similar to one aboard a United flight in March, which helped trigger a federal safety review of the carrier. Nike is bringing back a retired executive to try to revive its slumping sales. According to a memo obtained by Bloomberg, 30-year veteran executive Tom Petty is returning as Nike's vice president of marketplace partners. He left the sportswear giant back in 2020. Nike is trying to rebuild relationships with retailers like Foot Locker after pulling products from many stores in favor of its own shops, e-commerce, and apps. The company's stock has declined 33% this year through Monday, with sales continuing to fall. And after 134 days of pre-celebrations, Arnott Ambani, the youngest son of Asia's richest person, is set to tie the knot this week. Celebrations began in March, and they featured performances by Rihanna, visits to the family's personal zoo, and a luxury cruise from Palmero to Portofino in May. The family had also held a mass wedding for 50 underprivileged couples last week, and a musical event with Justin Bieber as the headliner. Sources familiar told Bloomberg that the guest list for this Friday's nuptials include Hillary Clinton, Boris Johnson, among the 1,200 people expected to attend. And that's your brief, John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next on the program, the White House comes out swinging.
So I am telling you that he has seen a neurologist 3 times while he has been in this presidency. That's what I'm saying. I am telling you that he has seen them 3 times. That is what I'm sharing with you, right? So every time he has a physical, he has had to see a neurologist. So that is answering that question.
Kinda. That conversation up next. Live from New York City this morning. Good morning.
The top names in business are on Bloomberg.
You need to have an AI game plan. We used to say that every company needs to think about becoming a software company. Now we say that every company needs to become an intelligent software company.
Context changes everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Equity futures on the S&P 500 positive by 0.25%. Yields are higher by a basis point. 10-year 428.81. Under surveillance this morning, the White House comes out swinging.
So I am telling you that he has seen a neurologist 3 times while he has been in this presidency. That's what I'm saying. I am telling you that he has seen them 3 times. That is what I'm sharing with you, right? So every time he has a physical, he has had to see a neurologist. So That is answering that question. Guys, hold on a second. There's no reason to go back and forth and be in this aggressive way. Every time I come back and I answer the question that you guys asked.
Correctly, you didn't have to come back and clean
I
up.
never answered the question incorrectly. That is not true.
It's like kindergarten at the White House. My new favorite phrase, let's take a step back. How many times do you hear that? Let's take a step back. Let's take a step back. Here's the latest. We'll take a step back. The Biden administration trying to quell concerns after visitor logs showed a neurologist specializing in Parkinson's disease visited the White House 8 times over the past year. This coming after the president said he's staying in the race. Sarah Bianchi of Evercore outlining 3 reasons why she doesn't think Biden will back down. It's his decision to make. It would take an extremely strong push from his party to change his mind. And if he survives this week, attention shifts back to Republicans and the RNC. Sarah joins us now for more. So, Sarah, we understand your base case. What would change your mind?
Well, I'm watching a couple of things. One, I'm watching to see the meetings on the Hill today. They are finally really back and able to have conversations with each other to decide what they think should happen. And I'm watching in particular the leadership, not only Leader Schumer on the Democratic side and Hakeem Jeffries, but also Pelosi and Clyburn, who are very, very close to Biden. And then let's keep an eye on those senators and House members who are up in very, very vulnerable races. What are they saying? What is Bob Casey in Pennsylvania saying? Those are the voices that are going to be the strongest. And if they unite, and they will have to at this point, then they are going to, have a president who's a little bit more willing to listen to the perspective than he is right now. The second thing that I'm watching is the polls. We have not seen lots of state polls coming out. We should get some more this week. That will also be informative.
But Sarah, when it comes to the polls, the president yesterday, when he was on Morning Joe, talked about the fact that the majority of Democrats want to see him. But the polls going back a year now showed that most of these individuals, the American electorate, including Democrats, think he is too old. So how does he square this circle of the Democrats want me there, but all the polls for months have been showing actually they think he's too old to carry the torch?
Well, I think the point that he was making in that context was leadership, the leaders in the party. But look, your point is right. He has a really big challenge. It's hard to see the path right now for the president, given that he is down in some of the key states like Georgia, Nevada, and Arizona almost seem out of reach for him at this point. And Michigan, Pennsylvania, and Wisconsin, he would have to have a 3-for-3 sweep. And that is difficult too. So you're right, the voters have been sending a message, but this president's perspective is that he's been counted out before and that he is the best one to take the case to the folks. And whether or not Democrats agree with that privately, they're going to have to mount quite an effort to change his perspective.
If he were to step aside, how do you view this playing out? Does it immediately go to the vice president?
It doesn't immediately go. He has to the president would have to release his delegates, and then there would be an open process in some sense to figure out who that nominee would be. That would happen at the convention, and somebody would have to get a majority of the delegates. I think what people are saying that's right is that process does favor Vice President Harris. She is more popular with that set of delegates than she is in the country across the board. There is a lot of women of color in that delegate group. There's a lot of people who care about choice, where she's been very active. So it does favor her. She is vetted, but there is certainly
Le Pen faces investigation into possible illegal campaign funds.
What would matter is how Biden would frame it if he were to get out of the race. Would he and Obama and others really signal that they really want delegates to go that direction? Or would they say, you know what, this is really a time for our party to decide? Those are things I'd be watching for to decide how big Vice President Harris's advantage would be.
Sarah, there are so many double haters. There's so many people who are disenfranchised from the current system based on the fact that a lot of people don't like either option at this current point. Do you think that it basically undermines Joe Biden's argument when he basically says, get behind me or get out, and there's sort of this feeling that you need to coalesce around him and not speak publicly what you think privately, which has been the reason why there was such an outrage from the debate in the first place?
The president's trying quite vigorously. And by the way, I am surprised it took him as long as it did to really put up the fight that we've seen since Friday. That was really more than a week after the debate performance. So I think potentially he could have stemmed a bit more of this if he had got going a little bit early. That being said, his point is quite clear, which is he has won the delegates, the overwhelming portion. He has been through a process. And so I think he is trying to turn the page on this episode to tell people to move on or to challenge him at the convention. I think my sense of it is that if he makes it through this week and the conversation actually changes to the Republican convention, maybe to NATO in the week, then he's going to be in safer ground. And those who want him to step aside probably need to put together an organized effort, really starting today and this week to make that case, because certainly over the weekend he has come out swinging, as you mentioned, calling into Morning Joe, doing a range of events, and doing what this president does when his backup is against the wall, and that is to fire up a bit and press on.
Sarah, I'm glad you mentioned NATO. It feels like lame duck NATO, where you have Emmanuel Macron meeting with Joe Biden to talk about policy at a time where neither of them have particular domestic strength. How much is that going to be on display in a way that can't really be positive, given how much confidence can you get from any resolution they come to, given they're all facing some really big challenges at home?
It's a great point. There are so many elections globally this year, not just in the United States and France, but across the board. And it's always challenging to govern in these kinds of really disruptive periods. That being said, there's a lot of issues on the board for NATO in and around Ukraine. And to the degree that voters think about this, certainly Biden has a different approach to addressing world leaders than we've seen with President Trump. He is a bigger believer in multilateral institutions. So he's going to try and use this opportunity to remind people why they should want him in charge. Again, very difficult to do on foreign policy issues, but you're right. It is a challenging time, and certainly when I travel around the world, leaders there are very focused on the United States election as well, and trying to plan for what their future might look like, no matter what happens in November.
Sarah, it's good to hear from you. Sarah Bianchi there of Evercore. We all know where the noise is. Let's talk about where the quiet is right now, and that's the VP pick of Donald Trump. And there's two reasons for that. One is obvious and one is less obvious. The obvious point is that he doesn't want to be in the news cycle right now, wants to keep Biden firmly front and center. The less obvious one is how what happens with Biden dictates or shapes his VP pick in the coming week. And I think that's the point here that maybe needs to be explored a little bit more.
He insinuated that last night when he called in to Sean Hannity on Fox, and he said, I have to have my VP pick. I know I need it for the convention. He said, I'd love to do it during the convention because that'll be exciting. But he also said, I'd love to see what's going on with the Biden camp because that could change things, but didn't elaborate on that. But potentially would that mean, does he need to pick someone from the African-American community? Does he need to potentially pick a woman?
What are these phone interviews about? You get a script and you can sit there and read it? Is that what it's about?
You do it in your pajamas.
Oh, right. You don't
That's
get
the
changed.
reason why.
Ah, okay.
Yeah. No bronzer.
global investors that aren't interested in China anymore, but there's a lot that are. And obviously the local investors have money in China and are doubling down on investing in China. Many of the Asian investors, and in fact a lot of the Middle East investors, the Americans are gone away. Therefore, there's an amazing opportunity to put capital to work and get returns which are excess what you would get in other places. Where there is lack of money, there is usually opportunity. So we continue to build out our business in China. It's just where the money's coming from is different. And so we're raising local money in China for investing and bringing those that choose to be there to invest in China. So it's just a different, where the money's coming from is just different.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European
So Paris
day.
prosecutor says the Le Pen probe is about 2022 presidential run.
Top market moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Five days of gains on the S&P 500. Looks like we might make it day 6. We're positive by 0.2% on the S&P. On the NASDAQ, up by 1/3%. You all know the number by now. It's, what is it, Lisa? 35? 35 all-time highs on the S&P 500 so far in 2024.
Yeah, although the nature of it is shifting a little bit. As much as it is led by the NASDAQ, yesterday we saw outperformance by the Russell 2000, and you have a growing number of strategists saying maybe things have gotten a little over their skis with valuations with artificial intelligence-related names. That's the sort of shift that I'm very curious about, the sort of de facto broadening out simply because there's nothing left.
Is that a shift, or have we heard that the whole way up?
Well, we have heard it the whole way up, but we haven't necessarily seen it put into practice. And it comes at a time where it's not necessarily driven by bond yields. And I think that that's of note. It's also not driven by anything because essentially there's not a lot going on. I will just say that the NFIB Small Business Optimism Index did come out early this morning, and it came out at its highest level this year.
Let's turn the page to the bond market and talk about the 2-year. The 2-year yield inching higher after dropping for 3 consecutive days, inching higher yesterday and then again this morning. So 2 days of this now, up by about a basis point on a 10-year, just about unchanged at the front end now. At the front end of the curve on a 2-year at 462.85. Going into Chairman Powell, we have to sit on what inspired that bond market rally of last week. And that was the weak economic data and how responsive Chairman Powell will be to that going into the Fed decision later this month.
He has a tendency to want to be dovish. Does he really deep into his dovish soul and come out and deliver some sort of message that this should change the script? The problem with this is that the data is what you want it to be, and it continues to be that way. On a headline number, we've seen something like 42 straight consecutive months of job creation, of positive job growth. We've seen a lot of positive sort of signs in the economy and disinflation. No signs that are screaming huge issues, at least not to most people taken in aggregate. You can tell your own story, so it's going to be interesting to see what he emphasizes, because then he'll be taking a view at a time when a lot of people are, you know, kind of arguing on one side or another using the exact same data.
You can see why people are split, though. You can identify rising unemployment, and at the same time someone else can say, but on a historical basis, we're still very, very low, in the low 4s. Is Chairman Powell in camp 1 or camp 2? Based on recent comments we've had from the Fed chairman, it sounds like he's in the latter and not the former.
Because he's been indicating that he wants to cut rates, and he's been doing it since late last year. Why? Because they want to get ahead of this and they want to land that perfect soft landing. The issue is an upward trend in unemployment doesn't usually happen in a linear way. This time would have to be different for it not to. A lot of people have said a lot of things are unique about this cycle, so this time is different. Does he lean into that? And can he just remain agnostic at a time where you have George Goncalves and other people saying, we're on the threshold of a shift and he could be too late?
How difficult is it to make the argument that we plateau at these levels, these low levels in the low 4s on unemployment? Let's turn the page and get to the FX market. Euro dollar just about unchanged. Not much happening here. 108.28 on the single currency. Under surveillance this morning, another Democratic lawmaker telling President Joe Biden to pass the torch.
I think he should step aside. I think it's become clear that he's not the best person to carry the Democratic message. A lot of Democrats are saying, well, let's move on. Let's stop talking about it. We're not the ones who are bringing it up. We're not the ones who said anytime, any place. And only Joe Biden was on that stage with Donald Trump. Our constituents are bringing it up. The country is bringing it up. And the White House, campaign strategy of be quiet and fall in line and let's ignore it simply isn't working right now.
Congressman Adam Smith of Washington becoming the latest lawmaker to go public with a call for Biden to end his campaign. The president coming out swinging yesterday.
The president coming out swinging on multiple fronts, writing letters, joining TV shows. The issue you have with this is that Representative Adam Smith was talking about this behind the scenes privately. Now he's coming public. How many more individuals are set to come public? And you're going to have senators today meeting behind the scenes. And you go what Sarah Bianchi says. What is it going to take? Potentially some of those individuals in leadership positions, like a Senator Schumer, like Hakeem Jeffries, saying the calls are just too big, and to really bring it to Biden that something has to happen.
As Sarah said, though, why did it take so long for him to come out swinging? It's taken more than a week for him to have a sort of response. Before he sat back and we heard rumors that he was saying, yeah, he has to prove himself for the next 4 days. Does he think that the interview proved it on Friday night? These are some of the questions that are swirling at a time where, the jury's still out.
I think there's two things. The campaign probably thought that internally, the Democratic Party would not be airing these grievances out loud, that they would, to Representative Smith's point, just get in line. Two, the president was out campaigning. He sat for an interview. They thought that would be enough. But then clearly after the weekend, they realized this is not going to quell some of these concerns.
Scripted radio interviews? Was that the interview?
Two scripted radio interviews. Well, I can't for sure say they were scripted, but obviously the president, I believe the campaign said, did have notes in front of him, a sit down with ABC, and then he was in Pennsylvania, where our poll shows Trump is leading by 7 points. Biden has to hold the blue wall, Michigan, Wisconsin, and Pennsylvania, or it is a very challenging, pretty much zero path back into the White House.
How many people believe that was an off-the-cuff phone interview yesterday on US cable news?
Okay. Why is it phone? We all ask the same question, right? What is it about phoning into a television show? I don't know.
Everyone's asking if this was impromptu. Likely was not. It's interesting that the President of the United States decided to use a phone when there is a slew of cameras outside his door on Pebble Beach. I used to stand in front of one.
I always felt like with Donald Trump, it was a proper impromptu phone interview. I felt like he was consuming cable news that morning and he would just call into the control room and say, put me on.
Yeah.
Always felt like that was real. And there was certainly no script because he was all over the place. With Biden yesterday, with the president, it just felt like there was a script.
Russia edged closer to June OPEC plus target, according to ministry data showing.
How many people believed that? I don't know. Maybe the hosts, certainly the hosts, based on their reaction to it. But I don't know if many others did.
The interesting thing is, and Emery, you mentioned this earlier, is that this is something that's been swirling in the public imagination for a long time. It's just that some of the Democratic leaders are now saying the quiet part out loud. So a lot of this is sort of like, you can split hairs.
So the nation produced 9.078 million barrels per day of crude last month, according to people familiar with the data from the Energy Ministry. That's about 100,000 barrels a day above the nation's production target under its agreement with OPEC, a narrower gap than prior months. However, a change in the way Russia reports its production makes independent assessment of the nation's compliance with OPEC plus cuts increasingly difficult. So since May, the Energy Ministry has switched to reporting the nation's crude output in barrels rather than the usual metric tons. After the change, Moscow appeared to be using a ton-to-barrel ratio at the lower end of the traditional conversion factors used by analysts for Russia's crude.
You do. 3 hours later, he's on the phone to some of those elites saying, thank you so much for supporting me. Please give me your money. I would like to speak to some of these people and wonder how much resonates or whether it's just sort of, you have to say that so everybody sort of believes that you're on their side.
We'll talk to a donor in about an hour from now. Let's turn a page to this story. It's connected. Former President Donald Trump is preparing to announce his running mate. Trump telling Fox News the vice presidential pick will be named in the coming week, possibly at the Republican National Convention. Here's the lineup. Senators J.D. Vance, Marco Rubio, Tim Scott, Governor Doug Burgum are all expected to be on the short list. And based on his comments yesterday, it sounded like he still doesn't know who he's going to pick.
These are also the obvious choices, right? Because they're showing up at the rallies, they're with him at the debate. There are some other names I would say you should throw into this mix. One, former Secretary Ben Carson. His name has been brought up to me a few times. And also, and the Wall Street Journal editorial board continues to bring up his name, and this would be what Terry Haynes has called a unity ticket light. Governor of Virginia, Glenn Youngkin. this also is a man that potentially can help Trump win Virginia. And where did Trump go immediately after the debate? Virginia, and stood next side of him.
Watch this space in the next week or so. Watch this space this morning. Top of the schedule in Washington is actually this. It's NATO leaders looking to reaffirm support for Ukraine. Despite widespread problems at home, President Joe Biden, France's Emmanuel Macron, and Germany's Olaf Scholz all heading to the summit in Washington with domestic distractions. Bloomberg's Piotr Skolomowski joins us now for more. Piotr, wonderful to catch up with you, sir. Walk us through what's meant to be the priority in Washington, D.C. this morning.
Hi, indeed. So the summit starts today, and what's obviously the 75th anniversary of the NATO, and what the leaders were supposed to come with is the sense of unity. But obviously, what's it's going to be is it's going to be slightly different. What we're talking about is that, at least for the European leaders, they're all, or most of them, are slightly distracted by the fact that Emmanuel Macron is just now emerging from the election, where obviously the cordon sanitaire worked, and the far right was repelled. They came third, but still it's a deadlock. We don't know what's going to emerge. What kind of government are we going to have in France in the end? In Germany, Olaf Scholz, obviously, he didn't really, his party didn't do very well in parliamentary elections, in European parliamentary elections. So the only leader who's coming there with sort of a mandate and strength is Keir Starmer. But still in the UK, his priorities are social spending, and it's not entirely clear whether and how quickly UK will deliver on the commitments on defense spending. So obviously, that's the picture we're seeing from Europe. And above all this, we also have Viktor Orban, Hungary's prime minister, who's just angered all of the allies and EU leaders as well by first obviously visiting Volodymyr Zelensky last week, but then going to Putin and then going to China to meet Xi without ever consulting anyone in the EU. So he's also coming in. He's part of the NATO crew, part of Hungary's part of the members. Of the membership. So that's kind of the picture that we're seeing. But above all this, the focus is obviously on the state of the U.S. politics and what happens to Joe Biden and what happens afterwards. After the election.
I'm really glad you brought up Viktor Orban. We were in Kyiv together when he was visiting Zelensky. He immediately went to Moscow and then to Beijing. How can this NATO group get anything done when it comes to fortifying Ukraine when you have the likes of Viktor Orban basically going against their will and meeting with Putin?
Yeah, it's a very good question. I mean, obviously, they will just continue to carry on. I mean, the question is obviously how much spending that there can come. And there is a certain commitment to spend $40 billion to help Ukraine. What's been very difficult is that's the commitment for the next year. What they haven't achieved, and what's been sort of the goal of the outgoing NATO chief Stoltenberg, was the goal of a commitment for 5 years for $400 billion. So it's obviously Viktor Orban is one of the people who are openly against further aid to Ukraine. He's talking about peace deals, but at the same time, you're not seeing like full commitment from most of the European leaders to kind of commit for years on military spending to Ukraine. He's like the most obviously extreme example of where it's going. And obviously he talks about peace, which at this point it's really difficult to imagine how it's going to happen. So what we're going to get at the end is obviously the question is, as you mentioned, Zelensky said he's hoping to get some kind of invitation to join NATO. He's not going to get it. What he's going to get is some sort of a commitment that it's irreversible. The path towards NATO membership is irreversible, but there will be conditions attached. So we'll see how it goes.
Piotr Skolomowski, big week, not just for NATO, for the President of the United States. I think Justin Sink of Bloomberg called this the big boy news conference, and now everyone within the administration is calling this a big boy news conference, which sounds kind of odd, but that's taking place on Thursday, right?
The idea is that potentially he won't just take 2 to 4 questions because they have something to prove. Well, he offered up for more journalists in the room to ask more questions, and that potentially can quell some concerns. Does he perform better this Thursday than he did at the debate? the previous Thursday 2 weeks ago.
That's the big test coming up later this week. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Just wanted to revisit that Viktor Orban story. The Hungarian Prime Minister shocking his European and Western allies, paying recent visits, as Piotr mentioned, to both Russian President Vladimir Putin and Chinese President Xi Jinping. EU leaders have sought to distance themselves from Orban's shuttle diplomacy, which they emphasize does not represent the bloc. But their attempts to denounce his visits are complicated by the fact that Hungary has taken over the EU's rotating presidency. Orban now heads to Washington for that NATO summit. BP shares, let's get a check on them, slumping in London this morning, down 4 1/3%. The company warned of weaker oil refining and write-downs. BP sees significantly lower refining margins and says it will take up to $2 billion in impairments in the second quarter. The figure includes charges related to scaling back refining operations in Germany due to high costs and declining fuel demand. The Fed is considering a rule change that could save billions of dollars in capital for the U.S.'s largest 8 banks, according to a Reuters report. The update would impact how the Fed calculates an extra layer of capital and imposes on systematically important banks, known as the GSIB surcharge. The deliberations are reportedly still ongoing, with no final decisions yet made. And that's your Bloomberg Brief. John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next on the program, testing U.S. growth.
Maybe the US can push that narrative, the fiscally driven growth narrative, a bit further, but how far are we going to test it? You only find that point of no return until after you've crossed it. Markets are pricing in on course for a September move.
That conversation up next, live from New York City. You're watching Bloomberg Surveillance.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal.
The Deal.
That deal.
The Deal.
Huge deal.
Who dug this up? One of y'all's in trouble.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, The China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, The China Show. Weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything.
The ECB's Nagel says that we don't lower interest rates on autopilot. So ECB's Nagel in an interview with Tagesspiegel saying that we don't lower interest rates on autopilot.
Yield every Friday right here on Bloomberg. Context changes everything.
Live from New York City, welcome to the program. Your S&P 500 positive by 0.25%. In the bond market, yields drifting higher by a single basis point. 420.
Nagel adding that I expect inflation to ease to 2% target by the end of 2025 at the latest.
Maybe the US can push that narrative, the fiscally driven growth narrative, a bit further, but how far are we going to test it? You only find that point of no return until after you've crossed it. Markets are pricing in on course for a September move. A steeper curve, but in a gradual, normalized, steady manner, or is it going to be something less so? I think that's what markets need to watch out for.
So here's the latest this morning. Fed Chair Jay Powell giving his semi-annual testimony on Capitol Hill at 10 a.m. Eastern. Traders will be looking for clues about Fed policy in the second half of the year. Kelsey Barrow of JP Morgan saying this: the Fed's motivation to cut may need to shift from fine-tuning policy to offset falling inflation, to easing policy to protect a weakening labour market. If core CPI comes in at expectations, we would expect the Fed to start signalling for September. Kelsey joins us now for more. Kelsey, good morning. I'm always happy when people frame things this way because not all rate cuts are created equally. What kind of rate cuts are you expecting? The kind of bearish ones when you respond to labour market cracks, or the bullish ones where it's just about fine-tuning off the back of disinflation?
I think we're really teetering on the edge of those two options, and it's a little uncertain, where we're going to land. But I do think for now, we're still talking about rate cuts that are preemptive. It was at first when we started the year rate cuts that were preemptive because inflation was falling and that was going to give the Fed scope to fine tune. Now the rate cut narrative is shifting a little bit to we may need to protect the labor market, but again, that's still a preemptive action to keep the expansion going rather than one where we're worried about an immediate risk of recession.
We started this program this morning with a quote from Chairman Powell in Sintra, Portugal last week. I'll share it with the audience again. Because the US economy is strong and the labor force is strong, we have the ability to take our time and get this right. How much time do you think he actually has to get this right?
I think he does have some time, and that's because not everything is pointing to things turning very quickly. So even though we've seen this rise in the unemployment rate, even though the breadth of job growth has narrowed fairly significantly, we're still seeing an economy that's operating basically around trend. So you look at the Atlanta Fed GDP tracker right now, it's at 1.5%. And this is generally still an okay environment for most companies that our analysts talk to. So when you look in the investment grade, the high yield universe, I tell them growth is around trend right now. What does that mean for your companies? They say, that's still a fine environment for us.
Which is the reason why some people are saying, actually, he should wait. I mean, there still are those people who are expecting, and I'm thinking of Torsten Slok, no rate cuts this year, because if you look at 35 record highs on the S&P 500, you look at some of these indicators, there still is quite a bit of strength. Why do you think the threshold is 0.2% on core CPI or below in the reading that we get on Thursday, and then it's all clear for September?
Well, that's the framework that I'm using for this week and how I think markets will react. Right now, you're kind of at a 50-50 on a cut in September, and I think by the end of the week, it's either going to be very close to 100% or that's going to start drifting down below 50% again. But I would say that right now, actually, the data is very clear, and it's sending a green light to the Fed that they actually can adjust policy. So let's just take a very simple approach. Think about the Taylor rule, right? The Taylor rule has two functions. It's the inflation loss function and the job loss function. Well, right now, inflation is coming down and the unemployment rate is rising. Both variables are actually telling you that it's okay, particularly when policy is restrictive as it is, to start moving the policy rate down. Now we're really just talking about the semantics of exactly when they go. But in terms of, is the overall economy appropriate to start thinking about that reduction, I would say yes.
So if Neil Dutta is listening to this, he's banging the table saying, yes, 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 because that's what he's been saying. Just look at unemployment, look at inflation. That's all you need to know. They're both giving the green light. Some people might say, look at policy. Look at what's coming down the pike with tariffs, looking at what's coming down the pike with immigration, regardless of who becomes president. Doesn't this sort of raise the risks of sort of a reignition of inflation down the line, in addition to just year-over-year comps that become less easy as they have been over the past couple of months?
That's fair. I do think that for the short term, I'm still more focused on the economic data. And I think that on a day-to-day, you may see the markets react or overreact to the politics, but the market will again refocus on the near-term data because we know that markets can't focus on more than one thing at a time. But that being said, I know that we're focused on these huge headline figures for tariffs, 60% tariff rates, 90% tariff rates. But when I think back about the experience we had with the trade wars in the prior administration, the real impact from tariffs was not the inflation impact. It was the negative growth impact. So I think people are maybe a little bit too focused on the inflation impulse and a little not focused enough on what this may do for global trade and global sentiment and the negative growth impact associated with it.
If it's going to be more of a negative growth impact than inflationary impact, does that mean that the Fed is right also to cut before potentially we see those policy shifts?
I don't think that they're going to react before any of these policy shifts. So again, that's why, as it relates to how we're positioning portfolios
So
for the
just
next
from
few
the article,
months,
Nagel says that core inflation is still quite high and remains cautious on monetary policy.
Data, what is happening in the current economy, what is happening currently to companies. And then I think what's really key with our portfolios is not to be too dogmatic, not to be too stuck in one view, to stay nimble, to stay tactical, because there's been a lot of opportunities even in the last week. You know, I think my colleague Ian was on talking about the elections in France. We mentioned that we were nibbling at oats. I mean, that was a classic overreaction, a period of time where it was short-lived. The market was focused on it, but then look what happened as the week progressed. We refocused on ISM services. We refocused on the jobs report. And ultimately, those opportunities to nibble were good ones.
Oats being French bonds and not breakfast, Kelsey, just to sort of clear that for our audience who maybe aren't.
You're just talking straight to me. I nibble on oats every morning.
With European bonds. Kelsey, what else have you been doing? What other opportunities have there been over the last month or so? Have you responded to that backup in yields off the back of political considerations here in the United States as well?
Yeah, we did. Yeah, that was kind of an interesting confluence of events, but we certainly looked at the price action, and I vividly remember it last Monday, and yields were backing up fairly substantially. We're testing 450 on 10s or getting closer to it, and it was on nothing related to the fundamentals in the U.S. economy. And, you know, those are the moments when you can really look to yourself and say, okay, when the price action is really being driven by technicals, really being driven by factors that are outside the purview of the U.S. economy, do we have a view on what's coming next? And in that case, the risk reward looked actually very...
Just quickly, is that the playbook for the summer for you guys? If you get backups on yields off the back of political considerations, not economic data or the Federal Reserve, that's something you want to buy?
We have been approaching it that way. And we have to continue to stay nimble. But I do think that when you're looking at the risk reward on the labor market, we talked about the risk that it could be weakening. If the market is backing up for reasons unrelated to the fundamentals, that's a buying opportunity.
Kelsey, this was great. Phenomenal to get some insight into what you've been doing over the last month or so. Kelsey Barrow there of JP Morgan. It's like the political considerations versus the fundamentals, the economic data. At some point, though, those political considerations can become the fundamentals.
Well, but what are the fundamentals? And I think that Kelsey's point there is really salient, which is some of these tariffs might have a one-time pop in inflation, in the prices going up, but it's not continued inflation. It's actually depressive to growth because people will buy less. So this is sort of some of the dynamic that people are looking at under the hood and saying, hold up, let's just really take a look at what the ramifications are.
We'll continue this conversation in the second hour of Bloomberg Surveillance. Up next, we'll catch up with Peter Chair of Academy Securities, Bloomberg's Jordan Fabian, Democratic donor and advisor Trey Beck, and Wei Li of BlackRock. All of that still to come from New York City. Good morning.
From the world of politics to the world of business. 2 times a day at 1 p.m. and 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world twice a day at 1 and 5 Eastern, only on Bloomberg TV and radio. Context changes everything.
Looking at your portfolio of businesses, it is about resilience, it's about pressure, it's about women. Like, so how does that come together how does it manifest in the deals that you're doing now?
Yeah, it's one of the things that I became increasingly passionate about after I retired, was acknowledging the fact that focus and this performance mindset was a huge asset that I had gained and that I had worked on and perfected for over 20 years. And now working through brands and founders, I just recently announced a collaboration with the Amman Hotel Group where I bring in the best talents in sports recovery and performance mindset in retreats and offering it there to their clientele. Our first one is actually in Phuket in February. So working through what that means, I mean, if you see the stats of Fortune 500 female CEOs, 80% of those women have played sport competitively through their life journey. And all those skill sets that they've built, to me, they were part of this first chapter, right? But how do they now apply to everything else I'm doing? And I'm so curious and interested in how I can bring that to the audience now and make it more mainstream and accessible.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders. From breakfast cereals to pet foods, General Mills has an iconic array of brands. But future success depends on efficiency, innovation, and insight. CFO Kofi Bruce does much more than crunch numbers.
Our first job is to intimately understand and anticipate the consumer's needs.
Watch Chief Future Officer. New episode Wednesday on Bloomberg Television.
What's helping to support the market is the majority expectation that we will experience a soft landing.
As you're approaching a soft landing, you have to obviously increase the odds that the hard landing is actually where you end up.
We've seen kind of head fakes before with the soft data and the hard data.
The Fed has to make the policy stance less restrictive sooner rather than later.
If they don't start to respond to what we're seeing in the consumer and the economy broadly, then we have a higher risk of that hard landing scenario that everyone was so fearful of.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance begins right now, counting you down to day one of semi-annual testimony for Chairman Powell on Capitol Hill a little bit later this morning in front of the Senate Banking Committee. Ahead of that, some of the commentary for you from the South Side. Neil Dutta, good friend of this program, over at REMMAC. The cost of doing nothing is going up. Citi's Andrew Honhorst thinks this labour market is getting closer and closer to the so-called danger zone. Andrew with this to say, rising unemployment, rising downside risk.
Which is what we've heard an increasing number of people, including Kelsey Barrow, just saying basically they have an opening, they're getting the green light from unemployment going up and the fact that inflation's coming down. That's all you need to know. That's the same kind of line of reasoning that we've heard from Neil Dutta. Here's the question. Does he want to lock them in? Because if he says that and the data doesn't change and they have to go in September, is that what he wants to do, given he might not have the rest of the committee on his side?
A pretty interesting double screen taking place a little bit later this morning, 10 a.m. Eastern Time. Take a look at the day ahead. This is what it looks like. At the same time, we'll be taking coverage of Chairman Powell's testimony to the Senate. Janet Yellen, the Treasury Secretary, goes in front of the House. And I imagine one might be about the economy and the other might be about something else.
She's supposed to talk about international finance. So you're going to hear a lot of people also want to talk about what's going on with those Russian frozen assets and some of the progress the administration has made, especially after the G7. But obviously, when it comes to Republicans asking her questions, it's going to be about, is the President of the United States, she is a member, a serious member of his cabinet, is he fit to serve? That's entirely what the next 24 hours in Washington, D.C. is going to be about.
Yeah, although, okay, it's hard to say that she's actually going to weigh in on that. Are they also going to ask her about the deficit, given that you're having all of these auctions? That this is still sort of percolating out there. I'm serious. I want to know what she has to say about the financing of this country.
Only you could make the turn to that, from the health of the president So the bond issue's coming up a little bit later.
Is she going to say anything about the president's health?
She's going to be asked.
She's going to be asked.
Without a
She's going to have to say, I have confidence in the president. Let's move forward, right? I mean, this is basically going to be the question. You could say, how much does it diminish the United States on the world stage that we're having these discussions? How much does that actually challenge some of the negotiations around Ukrainian aid? I'd love to hear that. And I also want to hear, how much does this diminish his ability to get certain things done having to do with the deficit?
She's probably practicing her answers now because she is going to be asked this question over and over and over again today. This is a moment for Republicans also to clip it ahead of their November campaigns in their districts.
All roads lead to one thing for Bramo. It's the deficit in the United States of America. Here are the scores in the bond market. We look like this on Treasuries. Unbelievable. The 10-year at the moment yields higher by a single basis point. The 10-year 4.29. In the FX market, bit of a snooze, 108.23 on the euro. In the equity market, nothing snoozy about it. 5 days of gains. Looking like we might make it 6. On the S&P 500, equity futures positive by 0.25%. Coming up this hour, we'll catch up with Academy's Peter Cheer as the S&P 500 reaches another all-time high. Democratic donor Trey Beck as President Biden vows to stay in the race, and BlackRock's Wei Li on whether AI can keep driving the equity rally. We begin with our top story. Stocks hitting fresh record highs as investors await Fed Chair Jay Powell's testimony. Academy's Peter Cheer writing this. We have argued quite aggressively that the Fed should make their first cut in July, partly because the economic data supports it, but also taking the spotlight off of the Fed in the heat of the election. Peter joins us now for more. Pete, good morning.
Morning.
2 reasons. One's about the economy. The second is about the politics. So let's start with the second one. The politics. Why is that an important consideration for this Federal Reserve?
Well, I'm going to start with the first one, but basically every guest has been on saying September looks likely. They should be doing it. They should be acting sooner than later. I completely agree. And if anything, I would err to the side that they do it in July. If you do this in September, I just envision a world where this is going to blow up in social media. Clearly, if they cut in September, say stocks rally 3-5%, you will see the Trump campaign aggressively go after the Fed, blame them for playing favorites. It won't be the case, but the reality doesn't mean anything anymore, right? It's how these things play out in the social media narrative is what's important. You do the first cut in July, you'll get some flack, but it's July 31st. No one cares, it'll quiet down, and you can move on, and you set up a September rate cut, I think, much easier. That's how I would play it. You know, maybe you're not supposed to think that way, but to me it makes the most sense.
We've drawn a distinction repeatedly this morning between what they should do and what they will do. This is what you think they should do. What do you think they will do, and what do you expect to hear today from Chairman Powell this morning?
I think they're going to set us up for September. I think they're going to continue to look at the data. I think the data is going to come in weak. I'm hopeful that CPI comes in low enough. Maybe it lets them squeeze towards July, but I think it's already too late with the messaging. So I think we get that September cut, 25 then, another 25 in November, and then 25 in December. So we get 75 this year.
Some people would say that just because the Fed has even signaled the cut, we've already gotten the easing in financial conditions that have given a shot of stimulus to the economy. Why is that not the case as we have just experienced the 35th record high of this year?
Well, so for example, I just pulled up the equal weighted S&P, which month to date is down 0.2%. Year to date is up 3.5%. So this market has been very narrow rally, right? It's really all about AI, the AI story, this transitional. So I don't think we should set policy based on the excitement over AI, right? If AI is real, it might still be undervalued. So when you look at the broad market, you know, the Russell 2000 still done poorly, value stocks. So I think we get caught up in the broad indices. You look below the surface, markets are only doing okay. I think the job data is turning, it's turning fairly quickly. And with inflation around 2.8% or somewhere in that neighborhood, you don't want to risk a recession. Back when we were 5%, the Fed could afford to risk a recession, right? Inflation was so bad, so painful, they could do that. Now there's no reason to create a recession. So all those reasons tell me cut now, even if financial conditions look pretty decent. And what I've liked in the last week or so, 2s, 10s is widening. And I do think one thing people are going to find mistaken this time is even as the Fed cuts, I don't think 10s and 30s are going to respond that much. I think 10s and 30s are going to focus on the deficit, the supply, and you're going to see 2s, 10s go back to zero, maybe slightly, even uninverted over time, and you're going to see that 430 to 450 range on 10s hold, even when the Fed begins cutting rates.
There's a lot to unpack there. Let's go to the deficit. I am curious about how much the politics of the moment. You guys are laughing at me. No, I'm serious, because this is something that people talk about. We just had Kelsey Barrow on saying, by the 10-year. I know you guys are laughing at my obsession. It is important.
Iraq sets Basra heavy OSP to Asia at $3 a barrel, discount for August.
Takes away the opportunity to really buy into weakness.
So again, I think that's why yields are going to stay somewhat high, stubbornly high at the long end. It comes up in conversation after conversation. And what I try and bring back is, if you remember August and September last year, where treasuries were for sale every single day, I think we went from 4% to 5%. No matter what the data was, maybe we'd rally briefly, treasuries would go for sale. There was a huge fixation on the deficit, our willingness to kind of talk about not paying. You're going to see episodes of that. It's not going to be nonstop. It's not consistent, right? Because this deficit's going to take time. But I would expect every year or so you get that sort of noise. Even earlier this year, right? We went from 390 to 470. Same sort of trend. So I think more and more you're going to see these breaks to the upside on yields because people fixate on the deficit, and neither party's going to change that.
But you don't buy those dips in price.
Not until we get high enough in that range, because I think everyone's comfortable with treasuries right now. I think people position too long. So down here at 430, I'm selling treasuries. Maybe they go to 420. I think we get back to 450 before long, even with the Fed cutting. I think that's going to be the realization is, yeah, whatever the Fed's doing at the front end is great, but it doesn't solve the deficit problem. It doesn't solve our long-term debt problems, and this overall supply is still real. So that's why I'm not that comfortable at the long end.
Can we go back to the optics, the political optics of the September cut? Take that a step further. It's not just going to be that the Trump campaign would come out and maybe say, they're in the tank for President Biden. If Trump is elected, does this give him the excuse with his own party to go back to that Wall Street Journal report, which is that they want to blunt the independence of the Fed?
Yeah, I think over the last year or so, right, there's a lot more both from Trump and others talking about the Fed's independence, questioning, Congress, what Congress says over the Fed. I think if they cut in September, it leaves them much more open to, under a new administration, attack about what their mandate is, whether they have to be rule followers, how much flexibility they have. Again, I think all of that may play out one way or the other. I think it's less likely if they do this in July. And again, the data is there for them to think about cutting. And you would argue, right, I think other people there's this lag effect. Why not get a couple cuts in earlier? I just feel it would be very prudent and better for the Fed's long-term health and independence to get something done sooner than later.
And does he need to signal that today?
I think he should be pretty strong about if we get good enough data in the coming weeks, we could cut sooner. And that kind of gives him a little bit of, like CPI, I think will actually be a miss. So it'll be lower than expected. So I don't know whether that's now a miss or a win anymore, and however we want to interpret it. But I think we'll get a lower CPI. Any problems with CPI will either be one-off things explainable, or they'll be housing related, which everyone now knows is lagged effect. It's one reason the Fed looks at PCE, and I've been learning more and more about this, but supposedly it would take an act of Congress to change how CPI uses that, which is why people go to CPI. You look at anything like Zillow or anything that's kind of contemporaneous rent, rents come way down, so it's artificially inflated. I think those are the things that give him the leeway between the jobs report and that to put July on the table.
Kelsey Barrow was with us about 10, 15 minutes ago, and she really drew a distinction between cutting interest rates to fine-tune policy in response to disinflation and cutting interest rates in response to a much weaker labour market. Now, I said that there were bearish rate cuts and bullish rate cuts. I'd actually like your opinion on that. Do bearish rate cuts exist? Are there rate cuts that are bearish for this market?
I think it's all relative what's been priced in. So right now, I think, yeah, if we had a really steep drop in employment, then we get a bearish rate cut, and maybe equities couldn't keep up and couldn't keep going. But as it stands right now, I think everything's going to be really positive. I think we're all sitting there trying to watch what triggers this breakout, though, of the Russell 2000, the value, the equal weighted versus. That still, to me, isn't clear, right? It feels to me we've been on this path where the data is good enough, you should see the broad economy doing well. The Fed's accommodating enough, you should do that. And those still aren't working.
We all remember November 2016, and we've talked about this a few times. Small caps rallied almost 11% in November 2016 on the Trump election. I think the question we've all gone back to around the table in the last couple of weeks is just how relevant that playbook is this time around. Is it relevant at all?
I'm kind of ignoring most of the election stuff. I think, one, it's too clear what's going to go on, who's going to be even representing, and I think we see time and time again, right, whatever they say they're going to do, the policies wind up coming much more narrow. I've been a big fan of Mexico recently, right? There was a lot of concern after the Mexican elections that it would change. You saw the Mexican case. All that's coming back to normal, right? Whatever you say to get elected and whatever you wind up doing tend to be two very different things. So I'm paying very little attention to any of the rhetoric. And I would say, on top of all of it is, it feels that people are very willing to put their own interpretations on it. So if you're
hold up. If we get politically induced dislocations in the
So
markets
Iraq,
through this
Basra,
summer,
medium OSP,
Eurobond,
Asia to Asia at 10 cents a
That's
barrel,
exactly what
discount
Cassie
for
Burrows
August.
said 10 minutes ago.
Even though her sense of what to buy was somewhat different. So that's, I guess, my question to you. What are you a buyer of during these dislocations?
So the one thing I would say, maybe slightly different, is I do like energy. And I would say when you look at the world right now, you've got Putin, dictator, Xi, dictator, Kim, dictator, Khomeini, effectively a dictator. They have to be looking at what's going on here, and they probably don't understand our political system, but they see the leader of the free world, the commander-in-chief, internally focused, facing all these questions. I think the risk that someone takes some action and tries to take advantage of that over the summer is much higher. So I am looking for the potential for a geopolitical risk. That I would not fade, and that's why I kind of want to own commodities ahead of that. I think almost anything that gets done would affect energy prices in particular. And on top of that, not quite even in that same vein, we're sitting here, all this internal focus. Oban's traveling to Russia, right? Putin and Modi met. The rest of the world's moving on while we're internally focused. That I don't like for the future.
I've got to squeeze this in. You're surrounded by generals at Academy. You just said take advantage. What does taking advantage look like? What does that mean?
I think if you watch what's going on, right, the last time we did funding for Ukraine, right, a lot of this plays out in social media, how difficult that was to get over the hurdle. You watch what's been going on with Israel and Gaza, where we're supposed to support, what we're not supposed to do. A lot, again, plays out in social media. So we're having a lot of activity around the second Thomas Shoal in the Philippines.
US stocks set to test another high before Powell. Remember, he has his semi-annual testimony to Congress today.
Stretched. We're engaged in 2 wars. Neither of those are going smoothly, certainly by any stretch of the imagination. So do you push the envelope? Do you do something different? I think China could do something. Maybe, North Korea's been extremely quiet. Do you get weapon sales? Something to just shake it up where they view that, 1, we're stretched, 2, they can use misinformation, social media to push against us, and the time frame is ripe for that, where we already have enough questions without their misinformation.
Pete, we could do this all hour. It's good to see you. I know you've got to go. Peter Cheer there of Academy Securities. So let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. A check on BP shares in the London trade down 4 1/3% after warning of weaker oil refining and write-downs. Boeing sees significantly lower refining margins and says it will take up to $2 billion in impairments in the second quarter. The figure includes charges related to scaling back refining operations in Germany due to high costs and declining fuel demand. Donald Trump says that he hasn't decided who will be his vice president. Speaking to Fox's Sean Hannity, and said that he plans to make an announcement in the coming week. The former president said his running mate would be, quote, a person that can do a fantastic job as president, as well as somebody that helps you get elected, and there's nothing wrong with that. Trump said Senators J.D. Vance, Marco Rubio, Tim Scott, and North Dakota Governor Doug Burgum were under consideration. Hamad International Airport in Qatar takes the top spot in this year's Air Help survey of the world's best airports. The rankings are partially based on customer feedback, along with the quality of food and shopping at 239 airports globally. Punctual arrivals and departures represent 60% of the score. Rounding out the top 3 were Cape Town International Airport in South Africa and Chubu Centrar International Airport in Japan. One U.S. airport cracked the top 10, and that was Salt Lake City International Airport. And that's your brief, John.
And nobody's surprised. Danny, thank you. We'll catch up with Danny in about 30 minutes' time. I love this country. It's just the airports, okay? Just for the record.
I just want to say,
just the airports.
LaGuardia has gotten a lot better.
I agree.
Comparatively to what it was, but you stack it up against airports around the world, is it that great? Also, the traffic getting in and out. It's awful.
At JFK is just, I know. How long have we got to wait now? 2 years for them to fix JFK?
I agree. And getting in and out, you might as well just take public transportation. It's better off, just a PSA. Newark does look like you're flying into a third world country.
Yes, it really does. Up next on the program, the White House firing back.
Has the president been treated for Parkinson's? No. Is he being treated for Parkinson's? No, he's not. Is he taking medication for Parkinson's? No. So those are the things that I can give you full-blown answers on.
Coming out swinging yesterday, line of the morning, favorite line of the morning so far. If you missed this, it was an absolute winner. There's a lot to unpack. So let's talk about the deficit. Does it get better than that? Peter could have been talking about anything.
Okay, hold on a second. He was talking about the deficit, which is the reason why he's not buying treasuries when they dip. Those are not the opportunities. It was actually relevant to the conversation.
Got it. All right. That's not next. This is Bloomberg.
countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close, weekdays at 3 p.m. only on Bloomberg Television. Context changes everything.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
DOJ or other authorities
could face bigger challenges. Listens next.
It was going to keep Rain World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Stocks on the S&P 500 positive here by 0.2%. Let's talk about the deficit. Yields are higher by, I'm going to repeat that all morning. Yields are higher by a basis point or two. The 10-year 429.59. Under surveillance this morning, the White House firing back.
I can tell you this, just going back to Parkinson's for a little bit, so to give you some answers here. Has the president been treated for Parkinson's? No. Is he being treated for Parkinson's? No, he's not. Is he taking medication for Parkinson's? No. So those are the things that I can give you full-blown answers on, but I'm not going to confirm a specialist, any specialist that comes to the White House out of privacy.
So here's the latest. President Biden vowing to stay in the race despite mounting concerns over his fitness for a second term. White House visitor logs showing 8 visits in the past year by a neurologist specializing in Parkinson's
According
disease.
to state media, China Premier Li Qiang says factors impacting economic growth are becoming more complicated than ever.
It was in this administration.
It was one of a handful of moments where things got very heated, and these moments have tended to happen when the press secretary is not forthcoming about something that was plainly obvious to everyone in the room. And this was, as you just mentioned, a neurologist who specializes in Parkinson's disease visiting the White House complex 8 times. Now, it took the White House until yesterday evening to say why that Dr. Kevin Kennard was at the White House, that he was conducting clinical consultations, treating some other military members. But her stonewalling in the middle of the day just made the story worse for the White House and certainly got the hackles up of the reporters in the room.
Jordan, I woke up to that letter from the president's physician in my inbox and thought,
China's Premier Li Qiang says we should reform unreasonable institutional mechanisms.
For a few days. Why is it taking them so long to get ahead of all of these issues, including Biden yesterday coming out swinging? Why did it take him a week after the debate?
Yeah, it's puzzling. These are all good questions, Anne-Marie, and there's no real clear answers to them. This is a press operation throughout Biden's presidency that has struggled to get the message out, that has struggled to get ahead of stories, as you just mentioned, to drive the narrative on what they want to talk about versus getting put on their back foot. And that was another example that happened
China's Premier Li Qiang says we should implement macro policies and continue to put efforts based on achieving the expected full-year economic growth goals, according to Chinese state media.
10 times more intensely. And so they haven't adjusted their approach. They only started this full-court press to try to save Biden's presidency more than a week after that debate. And that's why they're digging out of such a deep hole that they're in.
Jordan, John brought this up earlier, and it was that moment a few days ago with Justin Sink and Karine Jean-Pierre about the, quote, big boy press conference. What can we expect from the president on Thursday?
Well, Thursday at 5:30 or so, he's going to appear before the press. And look, I mean, we're going to have to see whether this qualifies as a so-called big boy press conference, as my colleague Justin put it. Is he going to stand up there for an hour, take questions, all comers, or is this going to be a tightly controlled affair like we've seen throughout this White House? A lot of Democrats, it's emblematic because a lot of Democrats have wanted to see Biden put himself in more unscripted settings, speak more off the cuff. And we've seen him do a little bit of that. He's done the interview with George Stephanopoulos. He called into Morning Joe yesterday morning on MSNBC. But he hasn't really let it loose like other presidents I've covered who've just been unafraid to take all questions, all comers. So we'll have to see if Biden does it on Thursday. And if he doesn't, there could be more backlash that he could face from his fellow Democrats.
And Jordan, there's already been quite a bit of backlash. We've been talking about the Democratic elected officials that have come out saying that Joe Biden should step down. Why are the progressives, one of the wings, that are now actually coming out with aggressive support for the sitting president?
Well, one thing we've seen, Lisa, is groups that make up Biden's base. So like labor unions, voters of color have been some of the most outspoken supporters of Joe Biden since this debate crisis occurred. And the more vocal segments of the party that have been calling him to step aside are the donors, some of the party consultants, more of the so-called elites that Joe Biden called out in his interview yesterday morning. And so I think you're seeing some of those progressive members respond to their constituents, respond to the people who support them, and voicing their support in that way. And so what you're seeing Joe Biden do is actually kind of divide his party between black voters, union voters, and the so-called elites. Now, that might help him save his presidency in the short term, but in the long term, you're heading into a November election with a divided party against Donald Trump, who has the Republican Party in an iron grip. That's going to probably hurt his chances of winning even further.
Jordan, just a thought exercise. Do you think if the former president could move the RNC, the convention, maybe a couple of weeks, do you think he'd push it back?
That's a great point, Jonathan. He's been content to sit back and just let the storm clouds gather around Biden. But look, this is Donald Trump. I mean, he's playing a disciplined politician now, but this is a guy who has constantly gotten in his own way throughout his time in politics. And I'm sure, he is itching to get out there and say things. And look, if you look at his true social account, the social media accounts, he was on Sean Hannity last night. He's been itching to get out there. He likes the spotlight on him, whether it's good or bad for him. So, maybe his consultants want the debate to happen at a later date, but I'm sure Donald Trump wants to get up on that stage.
Hey, Jordan, great to get your views. Come back soon. Jordan Fabian there of Bloomberg News on the week ahead for the sitting president and a big week next week for the former president.
Absolutely. It's the RNC, so he has to come out with his VP pick. He said it himself. I'd love to maybe wait. Maybe I'll do it at the RNC. My team says I got to go. He's got to announce.
The next couple of days, we're all waiting for it. Up next on the program, Trey Beck, Democratic donor and former managing director of D.E. Shaw Investment Management, joining us on this program. Looking forward to his thoughts just around the corner. If you're checking it on the price action right now on the S&P 500, equity futures are positive by 0.2%. Yields are a little bit higher on a 10-year by 2 basis points. Your yield this morning, 429.78.
Top names in business are on Bloomberg.
What I can say is that we've been making significant investments across the franchise, across regulatory reporting, across data, and across resolution and recovery planning. These are areas we've been investing in because we know the areas that, frankly, the industry likely needs to further enhance, and we certainly want to enhance them for ourselves.
Nobody covers business like Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
This is Bloomberg. Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Equities on the S&P firmer here, positive by 0.2% on the NASDAQ 100, up by a third, another all-time high to close yesterday on the S&P 500. If you switch at the board and get to the bond market, 2-year, 10-year, 30-year, let's talk about the deficit, Bramo. Okay, let's talk about the debt that's coming to market today. $58 billion of 3-year notes. And then tomorrow, $39 billion of 10-year notes. The day after, Lisa, $22 billion of 30-year bonds. I don't need to tell you that. You know these numbers by heart.
Okay, so some people might say, why should we care about the deficit? Why should we care about these auctions? You don't care about them until you do. This is the reason why we've seen this sort of range that the bond, long bond in particular, has been trading in. We heard from Kelsey Barrow, buy the dip, buy any kind of sell-off in longer-term bonds on political noise. Then you have Peter Scheer, also buy the dip to political noise, but not with treasuries, because he thinks that actually they're going to sell off further. And why? Because of the deficit. This is the reason why you might see a bigger term premium than you otherwise might see. I think it's interesting.
I'm pleased you brought up Kelsey and Peter just to extend some of this conversation. There is a tug of war right now between political considerations.
So Russia's weekly crude shipments dropped by almost 1 million barrels per day, which is the biggest since the Ukraine invasion.
Can become real. Can actually influence the fundamentals. And I think that's what's difficult for a lot of people right now. What do you do with these so-called political dislocations in the market when this could get more and more real as the year progresses and we get closer and closer to November?
And exactly to that point, Kelsey and Peter had completely, actually opposed views on how to take advantage of political dislocations. Because the view of exactly how this is going to play out, whether it's going to play out in policy or not, or whether the economy is going to just overwhelm that, or whether it's going to be basically played out in the international sphere with some sort of geopolitical incident. By the way, Peter's saying that some of these leaders don't really understand the U.S. political system. I think at this point, a fair number of us might also have some difficulties.
Yeah, I think all of us included right now, given the way the last week's gone. We'll try and give some clarity if we can in the next couple of minutes. Let's switch to the board and get to the euro, the single currency. Things have been confusing in Europe. They always are. In the FX market, the euro.
Let's take a look at the market wrap for the US session. US stocks are set to scale yet another all-time high. Tuesday's investors await Fed Powell's testimony to Congress for clues on US interest rate outlook.
Out in the bond market as well, at least with respect to the spread between French bond yields and German bond yields. Question is, really, has anything been resolved? And the answer is a resounding no. So is this just basically people thinking about the worst case scenario, or is this just simply the people who are nibbling on oats, as Kelsey Barrow
nibbling on oats.
Yeah.
I love that. It sounded like breakfast.
Well, it is breakfast
really
for me.
Yeah,
I like oats.
French bonds is breakfast for you. Bramo, killer line. Under surveillance this morning, United Airlines saying one of its Boeing jets lost a wheel while taking off yesterday in Los Angeles. It's nearly a repeat of an incident in March that helped trigger a federal safety review of the carrier. Okay, I don't have the answers, but I've got a big question. And we'll ask Elaine Becker a little bit later this morning in about 45 minutes. At what point do we stop talking about Boeing and start talking about the airlines when you see incidents like this take place?
Well, obviously it's not good for either of them. It's deja vu, and not the good kind of deja vu, because this exactly happened to the carrier in March. But and that launched the FAA investigation. But it's a great question. Is this a Boeing issue or is this a United issue? Because it happened once again to United. And I think that's what this investigation, the FAA, is going to try to find out.
And it's difficult to really parse because United does have a disproportionately high number of Boeing planes. So there is this sort of duality of it. I will say, though, it might be a similar problem plaguing both of them, which is there were a lot of employees who retired with a lot of institutional knowledge, including a lot of the tech staff, et cetera. How much was that the problem, both with Boeing and potentially even United support staff, if you lose that expertise in a highly skilled profession and it's hard to hire those people back?
The sky's too busy as well. With that in mind, relative to the absence of the expertise that you've just described?
You know, it's difficult for me to say because I enjoy traveling, and if I say the skies are too crowded, that means less volume, which means much higher prices, and that would be a big problem. We don't see planes crashing in the air. So, you know, hopefully we can move forward.
Record numbers over the weekend. Thanks for that, Lisa. I think we're all touching wood after that. Let's get to a different story. US consumer borrowing rising in May by the most in 3 months. Total credit outstanding soaring to $11.4 billion after a revised $6.5 billion gain in April. This all according to Federal Reserve data. This once again extends the conversation around what we talk about in the labor market, which is what is normal and what is deterioration when you look at stats like that.
Does it mean that people don't have the income to support the spending and are therefore borrowing as a result? These are the kinds of indications people are looking at to understand the turn in the cycle. That's really the key. At what point are we turning into something that's a little bit more malignant than just sort of a welcome softening?
This is the hard data that's come up in that recent Michigan survey when you had people saying that they normally identify as the middle class, but they feel like they are now in the lower income stratosphere of the electorate. You see this in polls and polls again. Inflation, this is what people are struggling with, and this data shows that potentially now they're relying on credit cards.
Unemployment's very low still, in the low 4s, but this consumer's stretched in certain places, and for a long time those labour market stats at the aggregate level, the headline level, have masked what's happening beneath the surface.
I wonder if you dig beneath the surface of these numbers, whether there's a disproportionate number of younger people, of people in lower and middle income families who account for that much bigger than expected increase in borrowing.
We'll come back to that story a little bit later. I want to turn to this one. It's been the #1 story for the last 2 weeks in this country. President Biden is now pledging to stay in the race, brushing aside concern from Democratic lawmakers and donors. Biden saying, "I don't care what the millionaires think. I want their support, but that's not the reason I'm running." Democratic donor Trey Beck saying he would like to see Biden drop out. Trey, I'm pleased to say, joins us now. Trey, wonderful to catch up with you, sir. For people in the audience who aren't familiar with you, can you just share with us how you've supported Democratic causes, this president, in years gone by, and what changed for you 2 Thursdays ago?
So I've been a defender of President Biden as, first of all, his presidency. I think by any objective measure, he's done an extraordinary job. You know, he has passed 2 infrastructure bills, one of them bipartisan, CHIPS bill, prescription drugs, addressing, you know, real issues for Americans. And I think on a sort of degree of difficulty adjusted basis, if you consider he's facing an incredibly hostile opposition, one that in many cases doesn't even recognize the, you know, legitimacy of his clear win in 2020, right? Those are the conditions in which he's operating. I think he can make a case he's the best Democratic president of my lifetime in terms of what he has accomplished. I supported him in 2020. I supported him again in this cycle. And to be clear, however this resolves, I will support him or whoever the Democratic nominee is. And I think that's an important note. I think whatever happens with this, you know, inter-family squabble, we're going to have to unify around our candidate. And if that's Biden, I will get behind him. I'll walk on glass for the guy. What's changed is that the debate confirmed, you know, the concerns that I think everybody had. And I think most notably voters. I think the Biden campaign has very understandably come out and shrewdly attacked this as sort of a cabal led by elites or donors, millionaires, in that quote you just showed. If I were them, that's what I'd say too. But I think what's actually happening here is that, in a sense, donors and the electeds who've come out, and I've talked to electeds privately who share their concerns and would like a change, that are not there yet to do it publicly, and I understand some of the calculations there. I think what's happening is people are coming around to exactly the view that voters have been expressing through polls for a year. I think that's what's going on. And so I think that what the debate confirmed, and for that matter, the radio interview he did and the Stephanopoulos interview, they have confirmed the degree of impairment from age. So it's true, everyone knew that, this was an 81-year-old man running for president, and that's hard. What we were hoping for was that he was anomalous and that he would have the stamina and acuity to do this. And I think what a lot of people are saying now is we need a candidate who can express, who can make the case, with the vigor that this moment deserves, given the authoritarian threat that we face in Trump and the administration that he would install.
Trey, is the concern with you and the people you're speaking with about Biden winning in November or Biden's ability to govern for the next 4 years?
I think the two are related, right? So historically, Biden has represented a vote for safety.
So
In 2020, he was, old by the standards of somebody running for president, but he was considered establishment, he was coherent, he was not saying crazy things and threatening authoritarian policies like the alternative, which was Donald Trump. I think what some voters are struggling with now is they already know Trump is a bad guy. They know he lies. They know he's literally a criminal. He's a convicted criminal. They know he is threatening policy implementation that they don't agree with, whether it's reproductive rights, firing, much of the civil service and installing loyalists, using the judiciary to punish people. But they're struggling with this because they now see a less vigorous Joe Biden. And I don't blame Joe Biden for this. I believe that the Biden campaign, when they greenlit this campaign, had a different candidate. And I think what we've seen is significant impairment. I'm not a doctor, but I saw what I saw, and others saw what they saw. And we need somebody to make the case during the campaign. And then, of course, should we win, and I fervently hope we do, we want someone with the vigor to do one of the hardest jobs in the world. Now, I want to make clear, I don't have any substantive concerns about Biden's age. You're not electing one person, you're electing a team in my mind. And many, many people I know understand this. You're talking about an army of bureaucrats, high and low.
Markets are
and
pricing
I know
in
the team
chance of
that
2 rate cuts
Trump is
this year,
assembling. I
with,
know what he assembled
roughly
previously and what he was
70%
talking about doing now
chance of the
looks
first in
and
September.
frightening. And I know that Biden is surrounded by hyper-competent people handling things domestically and abroad. But the way most voters see it is they see 2 names on the ballot, or in this case, maybe 3 or 4, depending on the state they live in.
But Trey, didn't his team around him do the American people a disservice by hiding a lot of these issues that they have over the past few months that we saw out full display for 90 minutes on CNN 2 Thursdays ago?
Powell is also likely to face pointed questions over U.S. plans to force Wall Street lenders to set aside significantly more capital. A report that seen that regulators are considering a change to his calculations that could save the nation's 8 largest banks a combined billions of dollars.
People rightly say, well, haven't there been signs of decline or physical impairment, slower gait, et cetera, prior to the debate? Absolutely. But I think what we were hoping was that those were anomalous. And I think when we saw on the biggest stage the performance we saw, it confirmed a lot of people's concerns.
Yeah, well, Trey, there's also this issue of whether Joe Biden is currently operating at the same playbook, with the same playbook, in some ways, that Donald Trump is, by just simply coming out and being defiant and saying, people get in line. Yeah, so on the one hand, I do find that dispiriting that, he's describing, everyone as either a cabal of elites or, acting in bad faith. On the other hand, the positive of that is he's fighting, and he's showing the sort of scrappy Joe that got him elected. His campaign has clearly mobilized and forced to, enlist allies. Now, a lot has been made of those allies and saying, well, look, the labor movement, people of color who are historically, critical to his political power are lining up behind him. I think that's a very,
good political line of attack by them, but I don't think it's substantively true. I think what you've seen is elites from those, labor union leaders lining up behind them. And by the way, privately, labor union leaders have expressed grave concerns to me. I've also, I can cite any number of polls that show that people of color are deeply concerned about Biden's age. Something like 64% of all voters would like Biden replaced on the ticket. And that includes 55% of black voters. So I think it's substantively not true that the average person of color who's a voter has no concerns at all about Biden's age.
Trey, appreciate your input today. We're going to have to do this again soon. Trey Beck there,
Thank you.
The Democratic donor, on the latest with the president, how much things changed for him 2 Thursdays ago. Let's take the opportunity to get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Nike is bringing back a retired executive to try to revive its slumping sales. According to a memo obtained by Bloomberg, 30-year veteran executive Tom Petty is returning as Nike's vice president of marketplace partners. He left Nike in 2020. Now the company is trying to rebuild relationships with retailers like Foot Locker after pulling products from many stores in favor of its own shops, e-commerce, and apps. The company's stock has declined 33% this year through Monday, with sales continuing to fall. Pershing Square USA launched a roadshow for the initial public offering of its common shares. The hedge fund management company is expected to list at $50 a share, and it's seeking to raise $25 billion from that offering. That would make it the largest fund of its kind in the U.S. Pershing Square will apply to list the shares on the New York Stock Exchange under the symbol PSUS. Much of Houston remains without power in Tropical Storm Beryl's wake. Authorities warn that the blackout could last for days. More than 85% of the city lost power, and at least one person was killed after Beryl made landfall yesterday. Most of the outages are in Houston and areas to the southeast, where strong winds and heavy rain knocked out electric lines. The city is now facing threat of high temperatures, with the National Weather Service posting a heat advisory for the region through Wednesday. And that's your brief, John.
Danny, thank you. Up next on the program, AI in the driver's seat.
There's policy fog, but I think there's opportunities for money to work in certain sectors. You got all this demand for AI, these data centers. There's only one country really that can feed this beast, right? This AI beast in a relative way, and that's the United States.
The latest from BlackRock, up next.
Jason Kelly, and this season on Power Players, we're taking you behind the scenes to see how the business of sports has gone global.
I want sports to grow. I want sports to be bigger because we have talent.
And how mammoth value is coming from the smallest of players. 3,184 hits, 431 home runs, and of course the most famous stat that everybody knows, 2,632 consecutive games played. Unmatched career. Why are you doing this?
What we have achieved in the NWSL from an investor perspective over 2 years is the equivalent of what it took other leagues 25 to 30 years to achieve.
You've got to have a business that's sustainable. The only way it's sustainable is got to make money.
There's only one word, winning. You win on the court, you win off the court. And as you do that, you bring people along.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure. Don't miss Bloomberg's interview with the...
Let's get you a check of the market. The scores look like this on the S&P 500. Equity futures positive throughout this morning, up by 0.2% as yields bleed a little bit higher, up by 2 basis points. The 10-year just short of 430 at 429.98. Under surveillance this morning, AI in the driver's seat.
There's policy fog, but I think there's opportunities for money to work in certain sectors. You got all this demand for AI, these data centers.
Also, European stocks dropped as awareness grew over French government spending following the left's resurgence in the weekend election.
And that's the United States. These companies are backing up these valuation with earnings growth, and we see that continuing.
Here's the latest. The S&P notching its 35th record high of the year so far as earnings season kicks off this week with big banks. Tech set to report at the end of the month with the AI story very much at the forefront. Wei Li writing this in BlackRock's 2024 mid-year global outlook. We have seen the AI theme drive broader equity returns in the first half of the year. We're sticking with our overweight. Wei joins us around the table. Wei, good morning.
Good morning.
The mid-year outlook's just dropped, I think, a couple of minutes ago, so thanks for coming on straight afterwards with us. Your highest conviction overweight, I think, is Japanese equities. You've maintained this overweight on US equities as well. Let's start with the US, and then we can move over to Japan. Walk me through the US call, what really underpins, what the biggest pillar of that call is.
Absolutely. So we can look at the cyclical factors. If we look at kind of the first half of the year, we have had positive surprises on earnings driven by AI. We had negative surprises on rates driven by Fed repricing. As we look ahead to the second half of the year, maybe we have less negative surprises from rates, maybe even positive as we head into rate cuts, but less positive surprises on earnings just because the bar has risen. But the bigger picture is, which is something that we lay out in the outlook, we got to look beyond the cyclical ebbs and the flows and really focus on the transformations that are happening around us. So AI is driving that, but the low carbon transition is driving that as well. When we add up the capex numbers from these transitions, from these transformations, we're talking about magnitudes comparable to the industrial revolutions, comparable to the internet revolutions. So we really think that we're moving from the financial economy to the real economy, and investing needs to change as well. It doesn't mean, given the elevated uncertainty, we need to de-risk. In fact, we need to properly use risk budget to lean into the transformation, but it does mean that we're going to be more selective, be more active, and private market plays a bigger role.
You offered some historical examples. Let's dig into that just a little bit more. Sometimes you can identify the mega force with ease. How easy is it to sort of identify the winners of these mega forces? Just taking the internet as an example. The internet was a big deal, but sometimes it was difficult to identify who would be the ultimate winners of that mega force. How easy is it this time around?
It's hard. It's hard. It's highly uncertain. So if we think about the various forces that are playing out, it actually means that as we look ahead to the future, there is an unprecedentedly wide range of outcomes possible. So no longer can we think about investing around a central base case with deviations around it, but we need to think about it in terms of scenarios that can be very different from each other, that may have very little overlap with each other. So that's how we kind of rethink investing and portfolio construction as a whole. But as we think about kind of identifying winners and losers, because this is an environment that does create more winners and more losers, we need to think about it in sequencing, in stages, right? So phase one of AI is really around AI build out. So there's need for energy competition, arms race for energy and data center build out. And phase two is around really kind of the broader adoption, companies building out their AI capacities. We're seeing healthcare already doing that. Phase one and two can both be inflationary because we're talking about creating demand before the benefit on the supply side and productivity side can really come through. Phase three is around productivity boom, but that's hugely uncertain. And it cannot happen if phase one and two does not happen. So it will have to be inflationary first before it can be deflationary.
Which is the reason why when you talk about going long high quality bonds, you're talking about short term. Before we get there, before we get to Japan, I know we should get there, but I really want to dig in with the idea of AI being a trade that is very hard to sort of distinguish. You have Citigroup talking about how some of the AI exposed high flyers are probably overbought. We've been hearing the B word, bubble, in say certain stocks like NVIDIA. Does the AI trade include some of those names that have already gotten bid up dramatically?
And Moody's says fiscal implications of France's parliamentary election outcome are credit negative.
Overweight also include the tech sector overweight, telecommunication, communication services overweight as well. But we are starting to broaden out our kind of AI play as well. So the initial beneficiaries are the likes of Magnificent Seven. And just to note, their earnings have come through. Their earnings have been revised a lot, and they have actually give or take delivered, if not beat expectations. So valuation is not as stretched as the price appreciation would suggest. But as we think about kind of the phase 2 of AI implementation, as broader sectors starting to adopt AI and benefit from the gain, efficiency gain, we have sectors like financials and healthcare and industrial as well positioned for the AI infrastructure build out. We want to include them in our AI play as well. And if we look at kind of the earnings picture, the last earnings season, we had 8 out of the 11 sectors growing their margins, which is incredible, showing a sign of broadening out. Looking ahead, tech is still expected to lead, but sectors like energy and healthcare are also expected to drive earnings growth in the second half of the year.
Okay, so just a really short bit on Japan. I know that that's your biggest overweight. I wonder how much this is sort of betting on a Bank of Japan rate cutting cycle that isn't necessarily a rate hiking cycle, excuse me, that isn't exactly tightening, but is an adjustment to deal with where the yen's at.
I would say that our Japan core is actually mostly a micro core at this juncture. The macro story, exiting deflationary decades and benefiting kind of from the macro lift, inflation coming back, we have already benefited from that. Now we're looking at companies delivering earnings. Expectations are for Japanese equities to grow earnings by 7-8% in the coming 12 months. We think that they can do better. You look at the latest AGM season, corporate governance, shareholder reform, that's progressing as expected. The currency, we talked about it not that long ago, is somewhat inconvenient because it's so volatile. It has been very, very weak. In part, it's helped earnings upgrades for manufacturing part of the Japanese equity market, but more broadly for foreign investors, it's just so volatile. It's gotten to a point, initially weaker currency was helpful for Japan achieving their inflation targets. Now, as we head into kind of election cycles in Japan as well, both for the party as well as for the country next year, it's less helpful. So I think there will be policy, we're not talking about explicit intervention, but maybe encouraging repatriation of foreign ownership back into Japan, maybe attracting foreign inflows that could help with the currency stabilization.
Well, it's getting tons of inflows now, lots of tourism. The Nikkei up 2%, at the close today. We are higher this year, Lisa, by 24.25% on the Nikkei.
Yeah, I do wonder how much tourism is giving them a boom economically. I just know from some discussions.
I'm not sure how happy the Japanese are.
No.
With that boom, and these cities becoming even crowded.
Yeah, I've seen. Have you seen some of the angry messages?
Yeah,
please stay out. Stop photographing us living our lives.
They don't want dollar yen at 161 either. Welly of BlackRock Way, congratulations on a new outlook. Thank you very much for joining us. The third hour of Bloomberg Surveillance. Up next.
So what's it like moving from the East Coast, where everything is finance and money, to the West Coast, where everything is technology? Did you fit in right away? And did you really know how to use all the computer things that they give you to use?
So it was pretty fun. There were plenty of times where I would sit around in meetings and literally I would be Googling terms. And at one meeting, Larry Page actually caught me Googling terms, and he kind of pointed that out to other people in the room, which was a little embarrassing, but I figured there were some things that I could do that they couldn't do. And so it was a learning curve. And my dad always, he taught me at a young age a term that I've used constantly with my teams. He said, in his lab at Stanford, if a physicist could not define a quark in under 30 seconds, they didn't know what they were talking about. And so I use the quark test all the time. If somebody's rambling on and they can't get to the point, they probably don't know what they're talking about, they fail the quark test. My finance team knows this quark test. And at Google, I'm working with amazing computer scientists, so they never fail the Quark test. They can explain things really clearly, which shoots you up the learning curve.
But did you understand what they were talking about from the beginning, or did you have a special tutor that's taught you technology? Or did you
I had actually run tech banking and took Google Public, so I had a little sneak preview.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, The China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, The China Show. Weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything.
What about artificial intelligence? Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry, and one that is
Secured overnight financing rate unchanged at 5.32% July 8th.
Companies, how they use it and how they use large language models, and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
Politics to the world of business. 2 times a day at 1 p.m. and 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world twice a day at 1 and 5 Eastern, only on Bloomberg TV and radio. Context changes everything.
The growth has definitely turned a little bit the last month, and I think the key part of that is it's just gotten more broad.
We're not seeing a weakening, we're not seeing a contraction, but this is what drives the economy, and we are seeing a deceleration.
What we're seeing is signs that the consumer is slowing down.
When you look at last quarter's GDP, a little bit lower, a little bit below trend, I think this means we are going to start to see more slowing in GDP and overall spending.
There are key pockets of weakness. This is a lopsided economy.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City, the third hour of Bloomberg Surveillance begins right now with quite a day ahead. In many ways, the week begins a little bit later this morning. At 10 a.m. Eastern Time, you will hear from Chairman Powell going in front of the Senate Banking Committee, in front of the House Financial Services Committee tomorrow on Capitol Hill. And then at the same time, 2 screens up at the same time, I think, a little bit later this morning, Chairman Powell on one. On the other one, Lisa, Secretary Yellen testifying to the House.
So there are 2 issues. Will Fed Chair Jay Powell set up a September rate cut? That is essentially what a lot of people are looking for in terms of his rhetoric and whether he puts a bigger emphasis on some of the weakening in the economic data. And then there's a real question about how politics affects this. He's not going to say that. Maybe we're going to hear a little bit from Janet Yellen about some of the political ramifications of some of the issues that we've heard with Joe Biden, with NATO, and a question around just how strong of a leadership the U.S. can have.
And of course, as well, she'll probably be asked about the deficit, but most entirely, she will be asked by the Republican side of the aisle about Joe Biden's health. This is going to be very political for Secretary Yellen, even though she's supposed to be talking about international finance. Andrew Hollenhorst, though, when it comes to the other side of the split screen, he's saying Chair Powell will likely sound incrementally more dovish in congressional testimony this morning after the unemployment rate rose to 4.1% last week. Is this the moment, potentially, he takes to really set up September?
With good reason. I want to understand how he's going to characterize the unemployment rate. Will he lean on how much it's moved, how much higher it is? The fact that it's going to be above potentially where they forecasted to be by year end? Or will he say that on a historical basis, it's still very low? Because we kind of know what he thinks already about the payrolls number, because he alluded to this in the news conference. He basically said, to some extent, and I'm paraphrasing here, that he thinks perhaps that's overstating the real strength and the gains that we're seeing in the general economy. And then we saw that backed up by the number on Friday anyway, when we saw the revisions to the previous 2 months. So really, for me, it's less about the headline number on payrolls and much more about what he thinks about what is happening with unemployment.
Whether he views this as a window to make an adjustment, and whether you start to see a shift in the rhetoric. You were pointing earlier to what he said last week, John, when he was talking about how they have time. Does he see that they have less time now, at a time when you basically are having a growing number of Wall Street analysts coming out and saying, actually, you know what, this might be the window that they have to really cut rates before it really becomes a pernicious increase in unemployment?
You can see the obvious sequence of things right now, right? Sort of tee it up a little bit today, you talk about it more in July, you go to Jackson Hole, really lay out your plans, and then you deliver it in September. Is that too cute? Do you think we're being too cute about the path here? Do they have to lay things out that clearly for everyone and give you advance notice over the course of 2-3 months?
No, they don't. And this is the issue, is that they don't from any economic perspective. But on a political perspective, there is this question that Peter Scheer was talking about. If they aren't a little cute about this, where they can basically forecast it now, does it basically set, as he was saying, social media spinning? I mean, basically, does this end up jeopardizing credibility of the Federal Reserve because of the timing, if there is some sort of market response and people say, oh, they're just trying to juice the markets ahead of the election?
Well, let's talk about the markets. Not the juice part ahead of the election, but the broader part of where we are right now. Equity futures on the S&P 500 positive by 0.2%. Yields up by 2 basis points on a 10-year, 429.59. And in foreign exchange, the euro just a little bit negative here, softer by 0.1%, 108.14. I wonder for the audience out there what you think the biggest market moving event might be. Whether it will be the testimony from Chairman Powell later this week, or whether it will be the news conference with the president on Thursday. Which one will it be?
I'm obviously looking at the news conference. I think it's really important. This is going to be his moment to potentially quell those concerns. He tried to do it yesterday. I don't think it worked. And yesterday he really was hammering on all cylinders, firing on all cylinders. It was a letter to congressional Democrats. It was an appearance on TV. It was a phone call with donors. And then it was an evening Zoom with the Congressional Black Caucus. And still today you have people. I mean, we just heard from a donor who said behind the scenes, that number we know of is 9 congressional Democrats that are saying he needs to step aside. The number is obviously much bigger. And how bigger is it? And can Thursday really mean the dams are breaking for real?
We know the mood the president's in. Came out swinging yesterday, some choice comments on party officials. The party has spoken. The Dem nominee is me. On donors, I don't care what the millionaires think. We know what mood he's in. The mood of the press is really interesting. And I think you've got an example of that yesterday in that news conference. And I think you're going to see another example of it again on Thursday. We had a conversation earlier this week about career risk of analysts, okay? We have to talk about career risks of journalists, people who've been in that room every single day, very close to this White House, who haven't reported on this. And I know some people have done a good job. I think of Axios, the Wall Street Journal, select names of this institution as well, of course. There are other companies, other institutions that have ignored this for months. And they're the ones that are really fired up right now because they don't want to be the individual that didn't cover this if things get a whole lot worse. And it's the mood of them that I think you got an example of yesterday that you're going to see again on Thursday.
You have people who feel like they have been betrayed, whether it's a cover-up, whether it's this idea that their indication was they should just sort of be quiet about this. It wasn't that serious, when it became very serious at the debate. And that sense of betrayal you're seeing sort of play out in real time.
You're going to see it again on Thursday. Coming up this hour, you might see it this hour too, with Emily Rowland of John Hancock, as she talks about stocks hitting fresh record highs. You really won't. Helene Becker of TD Cowen as holiday air travel surpasses records, and Lauren Goodwin of New York Life ahead of Chairman Powell's testimony a little bit later. We begin with our top story, stocks hitting the 35th record high of the year so far, but Emily Rowland of John Hancock remaining cautious, saying this: if the US economy had a relationship status, it would be it's complicated. Amidst weaker economic readings, we came back to the bad news is good news regime for markets, with everything rallying on these releases. It has been a good run, but bad news is likely to start to mean bad news for markets soon. Emily is with us right now for more. Emily, just walk us through that. I understand the regime we're in at the moment. Bad news, good news, saw it in the market, saw it in the price last week. Why do you think that's going to change sometime soon?
Well, look, you just look at those June business surveys. They showed vastly different trends for the U.S. economy. The ISM survey on both the manufacturing and services side falling below 50. And meanwhile, you have the S&P version that showed that we're in expansionary territory, both again on manufacturing and services. Then you look at things like the jobs report, which you all have been referencing this morning. You saw great on the surface, 206,000 new jobs added, but underneath the surface, massive revisions to the tune of 111,000, and then the unemployment rate jumping to above 4.1%. So the economic data right now are about as clear as mud. But we do see a broad decelerating trend happening, and that's something that investors need to be aware of. Right now, we're celebrating the idea that we're reviving hopes of rate cuts. Now bond market's pricing in 2 cuts for this year, but at some point the Fed's going to be cutting, not on a preemptive basis, but because growth is decelerating meaningfully and the labor market is deteriorating.
So, Emily, what are you selling and what are you buying? I mean, is this basically sell the S&P, buy long bonds?
Not necessarily. We continue to see momentum driving markets. We've seen this kind of combination of quality and momentum really taking center stage. We've been overweight quality, overweight U.S. tech stocks, and that's really been important. So I wouldn't say we're overly bearish in this stage. It's funny. I listen to you guys every morning, and it just feels like there's very few bulls out there. Everybody that comes on has kind of a bearish tilt to them, and bear markets don't really start that way. They usually start with a lot of optimism. So we're really not seeing that. There's also a ton of cash on the sidelines right now. Money market assets are sitting at $6 trillion. There's $23 trillion in bank accounts. There's still a lot of dry powder here to keep this market going. We just want to think about participating, but getting a little bit more defensive. In addition to those higher quality options, we're looking at defensive areas like utility stocks. We want to lean into quality at a reasonable price, looking at the value side for stocks and sectors that are trading on sale, areas like healthcare, U.S. mid-cap equities, industrials, which we're seeing as an opportunity here. But of course, a lot of that's in the price on the equity side, trading at 21 times forward earnings. Bonds are not sniffing this out yet. We started the year at 388 on the 10-year Treasury, sitting at about 430 right now. There is a really nice opportunity here to look at getting paid income as we wait for this potential contraction in economic activity to play out.
We've been talking all morning about sort of the push-pull between weakening economic data and the political backdrop that's been whipsawing bonds. And I want to go there. You think it's a good opportunity to buy long-term bonds at a time where there's a backup and you do have this potential slowdown. How much do political concerns weigh on this, whether it's trade policy, whether it's the deficit?
Yeah, we actually think it's noise on the political side. We tend to underweight political analysis and making cross-asset decisions. It's really difficult to do. We have made mistakes trying to do it in the past, and we found that looking at the economic backdrop, looking at fundamental trends has been far more relevant to portfolios. So to your point, as we've seen these backup in bond yields reflecting some of this political concern and we've seen it globally, we would be looking at those backups opportunistically to start leaning into high quality bonds and again, getting paid that income. We do think inflation's decelerating. We'll obviously find out more this week, but we're looking at things like average hourly earnings falling, used car prices are falling. The shelter component is likely to come down as the housing market starts to cool off a little bit here. All of those things mean that inflation, which was bonds' worst enemy, we think is going to start to be our friend here as we approach the back half of this year.
Emily, are you saying it's complicated in terms of the U.S. economy, Fed relationship status is not, it's complicated plus because of the politics surrounding it? You saying that just you have to look through it?
Yeah, not necessarily that you have to look through it, but we're at this point right now where economic data is not bad. And certainly it's great in the U.S. versus the rest of the world on a relative basis. You look at things like initial claims, which to us is one of the best, most timely macro indicators. Yes, they're perking up and a lot's been made of that, but we're still in this range of 200,000 to 260,000 that we've been over the past couple of years here. So really not all that bad. Again, we're still adding jobs. We're looking at an environment in which some of the surveys tell us that economic growth is in expansionary territory. So we just want to be mindful here because there are cracks underneath the surface if you look really closely at the data, and we want to be prepared for an environment where we do see slower economic growth. Look, inflation coming down, it feels great right now. There's nothing better than waking up to the smell of disinflation in the morning, and we'll see if that happens with this latest CPI report, but it's not great for corporate revenues. So as we see corporate profits come down amidst that slowing inflation environment, the cost of capital is still elevated right now. The Fed hasn't cut yet. That means there's likely to be margin compression. And as companies deal with defending those margins, they want to stay profitable. They have to cut costs. Typically, the biggest cost most companies have is labor. So we are looking at the sequence of events, which should ultimately result in the unemployment rate rising. And again, that's an environment where you will get paid owning higher quality bonds.
Emily, thank you. We've got to leave it there. Emily Rowland of John Hancock looking ahead to the smell of disinflation on Thursday morning. Looking for CPI, headline CPI to come in at 3.1% year over year. Lisa, down from 3.3.
There's nothing better than waking up to the smell of disinflation with, as you mentioned, French oats. I mean, honestly, this to me is
sort of a breakfast theme in financial markets. We're a sad bunch, aren't we?
I think so. And then there, of course, we've got Peter Scheer saying, I don't even know what reality is anymore because everything gets spun by social media.
So let's talk about the deficit.
Look, okay, you don't have to go there again. I know. But it was relevant at the moment, and he actually cares about it. So let's park that for a second. I am curious, though, just how much people are looking through some of this noise. And we heard that now from two people on the show this morning, Kelsey Barrow, and now from Emily Rowland, this idea that this backup in yield is a buying opportunity. Look through everything and just look to the idea that you're getting the smell of disinflation.
Is it noise or is it news? And that's part of the challenge right now. Let's get you an update on stories elsewhere this morning. Commercial Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Donald Trump has said that he hasn't decided yet who will be his vice presidential pick. Speaking to Fox's Sean Hannity, he plans to make an announcement in the coming week. The former president said his running mate would be, quote, a person that can do a fantastic job as president, as well as somebody that helps you get elected, and there's nothing wrong with that. Trump said Senators J.D. Vance, Marco Rubio, Tim Scott, and North Dakota Governor Doug Burgum were all under consideration. The lawyer representing Archegos founder Bill Hwang has made his final pitch to a jury. Hwang was accused of being behind a scheme that artificially jacked up stock prices, eventually costing Wall Street banks $10 billion. Hwang's lawyer repeatedly said that the case, quote, makes no sense, and that Archegos experienced a black swan event. The jury's verdict will bring an end to a trial that's lasted 8 weeks and force many to revisit what led to that implosion of Archegos in 2021. Hamad International Airport in Qatar takes the top spot in this year's Air Help survey of the world's best airports. The company creates the rankings partially based on customer feedback, quality of food, and shopping options at 239 airports globally. Punctual arrivals and departures represent 60% of each airport score. Rounding out the top three were Cape Town International Airport in South Africa and Chubu Centrar International Airport in Japan. Just one U.S. airport cracked the top 10, and that was Salt Lake City International Airport, which opened in 2020. And that's your brief. John.
Danny, thank you. More from Danny in about 30 minutes' time. Politics is the gift that keeps giving. Just it writes its own jokes. You ask the former president what he wants to see in a running mate, a person that can do a fantastic job as president, somebody that helps you get elected. That's it. That's the only description we've got. That's what we're basing on all this speculation, like who it's going to be in the next week. Someone that helps you get elected.
Right. What is that? And that's going to be the key question.
Baseline.
Yeah, basically. I mean, but at what point is that going to change depending on what happens on the other side?
Well, that's the key point. That is the key point for the next week or so. Up next on this program, the Morning Calls and Helene Becker of TD Cowen as summer travel demand continues to skyrocket. That conversation up next from New York. This is Bloomberg.
Top names in business are on Bloomberg.
You need to have an AI game plan. We used to say that every company needs to think about becoming a software company. Now we say that every company needs to become an intelligent software company.
Context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Counting it down to the opening bell of 1 hour and 12 minutes away. Equity futures on the S&P 500 in the green and just about positive by 0.2%. Yields are higher on bonds by 2 basis points. The 10-year 429.78. Time now for some morning calls. First up, Piper Sandler upgrading Bank of America to neutral. The analysts no longer seeing a reason for the bank to underperform, expecting net interest income to rise to a stronger level, but the analyst still prefers its peers, Citi and JP Morgan. Next up, Wolfe Research downgrading Paramount to underperform on the back of the Skydance takeover deal. The analyst saying that the investment debate is now simplified to whether the media giant can invest profitably in direct-to-consumer products. And finally, Wells Fargo raising its price target on Airbnb to 129, maintaining an underweight rating. The firm highlighting near-term momentum for reservations, but it's less optimistic about margin pressures into next year. That stock is just about positive, 0.1%. Sticking with travel, the TSA screening more than 3 million people on Sunday. Rounding out the July 4th holiday weekend, it's the first time that many passengers have been screened in a single day in the agency's history. 8 of the 10 busiest screening days have come this year as travel demand tops pre-pandemic levels. To discuss this and a whole lot more, Helene Becker of TD Cowen joins us. Helene, let's talk about this super busy weekend at a time when Boeing is struggling to build planes and United Airlines, at least their jets, are struggling to hold on to the wheels. Helene, I'm just wondering if things too busy.
Yeah, thanks for the question, John. Yeah, I mean, we've never seen these kind of travel levels
So in 10 minutes time now at the bottom of the hour, we're expecting the possible text release from Fed's Powell ahead of his semi-annual testimony. So this is based off of historically when he does the semi-annual testimonies. The text release is normally released at 8:30 a.m. Eastern time. We're expecting it to be the same time this time around as well. So again, text release from Fed's Powell due just under 10 minutes time now.
And we don't often, you and me and Lisa and the team, we always talk about airline traffic. We don't talk about what's happening at the airports. And the airports are having their own issues with lack of parking, with the lack of, in some cases, lack of food options and lack of seating, especially at some of the older airports where people, are asked to come early. And then they have to wait. There's no charging stations in a lot of older airports. The charging stations in newer airports don't work. So, there's this whole ecosystem that was built around a smaller level of population that travels. And now we're seeing so many people travel on a regular basis. To your point, 8 of the 10 busiest days have been this year, and most of them have been in the last 6 weeks.
So do you think that, Helene, this is introducing a problem that would have been the case even pre-pandemic, or do you think that it's been exacerbated to a big degree because the personnel just isn't there after a lot of the layoffs in 2020, in 2021 that have left a lot of senior people no longer in the workforce?
Yeah, that's a great question. And the answer is yes. I think this level of travel was coming anyway, because you have an aging population and you have a lot of people who have more time to travel, and they're doing so, right? They're doing a lot of bucket list trips and so on. So you're seeing this huge increase in international travel. For younger people, they got used to traveling with their parents and they want to continue to travel with their own families. So you're seeing a lot of that. But to your point, we were expecting those kind of travel numbers maybe a little bit later in the decade, not so much now. And also, all of those people who left, whether they were furloughed or they chose early retirement or they chose other careers, in the 2020 to, let's say, 21, mid 2022 timeframe, the people who have come in to replace them are less experienced. The FAA says we're short about 3,000 air traffic controllers. Congress approved the new budget, which allows for the hiring of more. It also allows a path for those who have been air traffic controllers in the military to come into the network without going through the entire FAA training academy. So there is a way to increase that. But at the busiest airports, the pay scales are still relatively low. So people don't want to do that career. They don't want that job because they have to live within, I think, an hour and a half of their base. It's very expensive to live in the New York area. It's very expensive to live in Chicago area, San Francisco. And so people don't want those jobs. And the result is that we have this limitation on how much capacity can grow, which is should eventually be good for airlines because they should make more money. But for travelers, it means they have to pay more for airline tickets.
Can we talk about what happened yesterday with United, the most recent mishap when it comes to losing its wheel? And John asked a question earlier that was the right one. Do you think this is a United issue, or do you think this is a Boeing issue?
I think it's an issue. I think it's more of a supply chain issue. And I think in this case, it was probably a United issue, not a Boeing issue. Aircraft come out of maintenance. They have to be double checked, triple checked before they go back on the line. This was a case of a wheel falling off. This is not obviously the first time United has had an issue. I don't want to disparage them because they're a safe airline. I fly them a lot. You guys probably fly them a fair amount being in the New York area. So I don't want to say negative things about them, but yeah, I mean, every airline can be good or bad on any given day, and they're just having this issue. And for them, this was the 757, I think, that you're talking about. And that's an older plane that's been around for a very long time with a really good safety record.
Elaine, what do you like right now in the airline sector? Everyone seems to love Delta. Terminal 4 is a mess, just to throw that out again. Elaine, what do you like in the airline sector right now?
Well, Delta actually was our top pick for 2024, so getting thrown under the bus there. But yeah, I think from a balance sheet perspective, from a traffic perspective, growth, opportunity, their big advantage is that only pilots are unionized on property. Everybody else is not union, so they have the ability to make adjustments without going through an entire big process, unlike the other airlines. If they want to make adjustments,
it's been 5 minutes time now at the bottom of the hour. We are expecting the possible text release from Fed's Powell ahead of his semi-annual testimony. Again, this is based off of historically where the text has come out ahead of this event at 8:30 a.m. Eastern Time.
Other ideas, COPA. I've talked to you guys a lot about COPA in the past. It's one of our favorite names in the mid-cap airline sector. So I think those would be our top 4 or 5.
Elaine, thanks for jumping on for us. Appreciate it. Elaine Becker there of TD Cowen. Looking ahead to Delta reporting later this week. Someone around this table flew Delta over the weekend, right, and had some problems at Terminal 4. Coming back from the airport.
Is that right?
Yeah, deeply personal.
Does somebody want to talk about said problems?
You were part of the record, though, the TSA screening record.
I'm very proud to be part of the record. I don't know how pleased I am to be part of that Terminal 4 mess, honestly.
But did you get there on time?
Did I get to my destination on time? Oh, yeah, sure.
And did you get back on time?
No, delayed.
Okay.
Technical issue.
All right.
Delayed by about an hour, I think.
Maybe they wanted to make sure the wheel didn't fall off.
And then delayed trying to get, transport back from Terminal 4.
Yeah, well, that's not fair.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders. From breakfast cereals to pet foods, General Mills has an iconic array of brands. But future success depends on efficiency, innovation, and insight. CFO Kofi Bruce does much more than crunch numbers.
Our first job is to intimately understand and anticipate the consumer's needs.
Watch Chief Future Officer. New episode Wednesday on Bloomberg Television.
One minute remaining till we expect Fed's Powell's text release.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
10 seconds.
Equity futures on the S&P 500 positive here by 0.1%, elevated across the board on the NASDAQ as well by 0.25%, the 35th all-time high of the year at the close yesterday. The fate of today's price action in the hands of one man, Chairman Powell, and maybe some other stuff too.
There's still no sign of this text release from Fed's Powell, just keeping our eyes peeled.
463.89, yields up by a single basis point on the 10-year, up by 2 to 429.59. We've talked a lot about the debt issuance coming up a little bit later. We get $58 billion of 3-year notes, Lisa, then we get 10s, and the day after that we get 30s.
Yeah, I was just trying to understand why we suddenly saw a real tick up in yields and why we saw the Russell 2000 go negative, considering the fact that there isn't really anything out there that I can particularly key in. I don't think it is the auction, since we've known about that for a long time. I do wonder whether you start to see political risk creep into the appetite for the longer duration bonds. We heard that from Peter Scheer. We heard that also on the flip side from the likes of Kelsey Barrow, who say use any of those dips to buy. Do we see that buying activity on a day like today, tomorrow, or Thursday?
Ian Lincoln of BMO said exactly the same thing about this bond market. Want to watch a little bit later. I want to finish on foreign exchange, take a quick sneak peek at what's happening with the euro. Just a quick one, because not much. Euro dollar 108.16. We're negative by not even a 1/10%. Under surveillance this morning, the White House firing back at reports about President Biden's health, including a New York Times story citing multiple visits by neurologists specializing in Parkinson's disease. Biden's doctor releasing a statement last night saying the specialist had only conducted routine exams.
And what they're saying
So
is that
ECB Santino has released an interview on Econo Stream. So just looking into this then, Santino notes that the PPI data is a concern because falling prices are precisely the opposite of inflation. CPI in relation to France, not a topic that needs to be on the table at the moment. Says the latest inflation numbers increased our confidence, and that I continue to expect a few more cuts this year if the baseline scenario is confirmed. Again, these are comments from ECB Santino on an Econo Stream interview. Says the July Governing Council meeting is the same as all the other meetings. Not seeing a soft landing for growth, growth is below potential. Given weak growth, better to have inflation at 2.1 or 2.2% than at 1.8 or 1.7%.
Press corps. I'm wondering, when you talk about the relationship to markets, what the playbook is if Biden is or isn't the Democratic nominee. If there is a shift in the belief whether he could actually maintain that, how much does the market trade change? Do we have a sense of that at a time where maybe it's noise, call it noise, but the noise happens, and so at some point, some people are going to be making bets on this.
Didn't we get a taste of that 2 Fridays ago? When we started to price in.
So again, we haven't seen a text release from Fed's Powell. Historically, it has been released at 8:30 a.m. Eastern Time ahead of these semi-annual testimonies.
I just wonder when people start to actually get their head around this. There's one thing when you say Joe Biden looks like a weak candidate and he's going to remain in. That's the Trump trade. What happens if there's another candidate that is a stronger competitor with Donald Trump who would like to see this unfold with Joe Biden being the candidate?
We'd have to get to know the candidate, wouldn't we? If it's Kamala Harris, I wonder how much distance there is, how much daylight fight there is between the VP and the president at the moment on the same ticket?
It's a great question. I would like to see some notes on that.
I'm sure you would. Write them, I think is what Lisa's saying. Let's talk about Nike. Bringing back a veteran executive to try to fix its sales slump, Tom Petty is set to return as vice president of Marketplace Partners. The sportswear giant is trying to rebuild its relationship with retailers like Foot Locker after pulling products in favor of its own stores and e-commerce operations.
This is actually a really interesting story. During the pandemic, a lot of the big brands, Nike in particular, said, we don't need you, Foot Locker. We don't need you, Loman. Loman doesn't exist anymore, but any other store that distributes some of these things. There's this question of, we can go direct to the consumer and we don't have to lose profits in the transaction. Now they're realizing that didn't work. They're trying to lure them back. So they're bringing back a previous executive. I find this quite interesting. How much are they going to bring those relationships back into the fold when they realize that those physical distribution centers are actually incredibly important?
What's old is new. They're bringing back an individual who is in retirement, but likely, to your point, he probably has these relationships that they need to, what the sounds of it, really shore up in a quick way.
Have they got a distribution problem or a design problem?
It's a great question.
I can speak from my own personal perspective on this.
We know what you buy. You've told us all.
Sure. I know where to get Nike from. I don't think they've got a distribution problem. I think they've got a design problem.
Or a relevancy to the people who buy sneakers, which are runners and athletic endeavors. I mean, I do wonder how much this is just basically getting away from some of the bread and butter and counting on Air Jordans to carry them through, and then Air Jordans lose some of their luster, and suddenly the reselling trade doesn't work in the same kind of way, et cetera. And you lose some of the glass. Look, I have a personal relationship with this.
I know, which is why I'm smiling.
I know, you're laughing at me, but...
On the side, Lisa trades Jordans.
No, I do not trade Jordans, but at a time that was cool for the kids to do that. It's not anymore.
Okay, let's move on from this story. You can't keep it together. That's the latest on Nike. The latest this morning for the market, it's all about this. All eyes on Capitol Hill at 10 a.m. Eastern Time. Fed Chair Jay Powell beginning his two-day congressional testimony in front of the Senate Banking Committee. And Treasury Secretary Janet Yellen speaking to House Financial Services on the same day at the same time. This all ahead of more inflation data this week, including CPI and PPI. With us around the table, waiting patiently and holding it together, is Lauren Goodwin at New York Life, alongside Brett Ryan at Deutsche Bank. To the both of you, thanks for being with us. Lauren, I want to start with you. What are you expecting to hear from Chairman Powell in about 90 minutes' time?
I'm not expecting to hear a whole heck of a lot. I think that he's going to toe the line, just do some basic explaining of where the economy's been, where inflation has been. I don't think we're going to get a clear monetary policy signal from him. However, I do believe that we've been getting a clear monetary policy signal from the data. We all know that the Fed cares about price stability, full employment. What we've been seeing, what we've been looking for in terms of signaling a next rate cut are things like stable inflation expectations, inflation moving lower, an unemployment rate breaking 4%. These are factors that have all started to turn in the last couple of months. I think the Fed will want to see one more month confirming that turn, but I expect September's on the table for a first rate cut.
Last week, Chairman Powell said the labour market's strong and that gives them time. That's a reason to wait. Do you share that view, that analysis?
The labor market is strong, but the real reason why the Fed has the opportunity to wait is because financial conditions in the market have been easy, because stocks have been well behaved, credit spreads have been well behaved, and the reality for the job market is that in 9 out of the last 10 recessions, the economy was adding jobs until we were already there. And so the labor market tells us all kinds of things about where the economy has been, not where we're going. And so I believe that that financial condition easiness, it allows the Fed to be patient, but it could turn on a dime.
Lauren, it's fascinating to me, and Brett, I'd love you to weigh in on this idea that it seems to be getting clearer and clearer where the economy is going for a growing number of at least our guests. Today, a number of people have come on and said, if you look at just the unemployment rate, if you look at inflation, the signals are clear. Do you agree?
Well, I think from the chair's perspective, the growth data and the latest labor market data would say that they're more confident that they're restrictive, right? We came from a 3.5% growth in the back half of last year. We're now tracking about 1.5, a little bit over 1.5 for the first half of this year. We're seeing payroll growth slow. But I think to the point of what Powell's going to be talking about, what we saw in Central last week was him emphasizing all of the dovish points. This is a strong labor market, not because hiring is strong, but because layoffs and discharges are low. And so question is, how long is that going to last? With inflation, though, I think the message has been clear. We need to see more and better prints. This week's data should show a bit of a rebound. You know, the weakness in last month's CPI report was really all due to airfares as well as motor vehicle insurance. So, you know, they need to see rents starting to move back down to get sustainably to 2%. So they're not there yet. But that said, you know, as Powell had said, an unexpected slowing of the labor market would be a reason to move earlier. So, you know, our base case remains that December is going to be the first cut, but the door is definitely wide open, to Lauren's point, on September.
Brett, what would you have to hear in today and tomorrow's testimony from Jay Powell to change your call to be September from December?
So what was interesting in what he phrased, how he phrased the recent inflation data at Central last week was that he compared the May, April, and prints to the first quarter of the year. And he said, you know, May was a step in the right direction. April was not as good, but still better than Q1. But April was actually worse than the February print. And to me, it sounded like, okay, for Powell's starting point for how many good prints we need to see, April was sort of his starting point. April, May, you know. So if you're thinking to yourself, okay, how many more prints do they need to see? You know, 3, 4. It seemed from the way Powell phrased it, which was a little awkward, but deliberate, that his starting point was the April print. And so maybe, you know, that to me speaks to he really wants to get a cut on the board soon. It just comes down to whether inflation data give it to him, and he has a committee that goes along with it.
Do you think the election matters? Do you think that Canada matters and that date in November circled in red?
Right. So I think the election matters in the sense that one of the big unknowns here is the fiscal outlook. Now, arguably, from a deficit standpoint, it's going to be the same. But when you have extreme differences in terms of policies such as tariffs, inflationary, and then, you know, I think that could cause a little bit of caution because you really don't know how that's going to shake out. You know, you can get a sweep one way or the other, and the fiscal outlook could change in a more inflationary direction. So that's another reason to kind of, you know, stay the course for now unless you're forced to. Don't give up the policy space. By the way, that you've gotten to over 5% yields, which nobody thought was possible 5 years ago. You know, wait as long as you can. Obviously, you don't want to wait too long, as Powell's emphasized, and you know there are those little warning signs there.
But if they're trying to potentially look apolitical, you wouldn't want to cut right before the election, which would be September. And if April you think is maybe his starting point, why aren't more people talking about July then?
Yeah, they haven't been. I mean, it'd be a lot to signal right now, and I don't think he has a committee that's willing to go there just yet. But you know, to your point about September, without a strong labor market story, cutting on an inflation story alone, it may why give the appearance even if there isn't. You know, certainly the Fed is not political. They're going to do what's right for them. But what's right for the economy. But at the same time, you know, I think it's going to take either a sharply slowing growth story or an unexpected, as Powell talked about, an unexpected, you know, drawdown in the labor market.
One thing we've discussed on this program repeatedly is that not all cuts are created equally. There's two very different kinds of rate cuts. One is a fine-tuning off the back of some disinflation with a positive economic backdrop. The other is a labour market that's breaking and something they have to respond to and really put the emphasis on the other side of their dual mandate. Lauren, you've said repeatedly that this market can thrive up and until when this labour market really starts to crack. And a question we've been asking on this programme is how close we are to that danger zone, with unemployment through 4 and claims starting to creep a little bit higher. Do you sit here and say that on a historical basis these are still very, very low levels, or do you look at the change, the rate of change and the time we've had that change in, and start to say we're getting close to that danger zone?
For the market signal, you look at where we've been most recently. The reality, from my perspective, that any impending slowdown or even recession is likely to be mild is sort of besides the point when it comes to a market transition. And so what we're looking for market concern about a turnaround in the labor market are things like the SOM rule. Right now, we would need to see 4.3% instead of the 4.1 where we are. Again, or jobless claims moving higher considerably. Neither of these things have been really moving in that direction so far. And so for investors that can be tactical, this is a market that we still see as fairly constructive until those labor market indicators or earnings expectations really start to turn the corner. We believe the equity market rally can continue to trudge higher.
This is sort of the confusion with the way that the market has rallied, that it hasn't been all names, right? It's been a number of names that have kind of led the charge in a pretty significant way. Isn't this market already positioned for some sort of significant slowdown? Isn't that the base case of what we're seeing in the Russell 2000 and the equal weight S&P?
I challenge that position. I'm sympathetic to the position, but I challenge that position a bit because we really haven't seen more than a couple of days of pullback over the course of this market. And so while there is a divergence, not just in particular equity names and sectors, but also in the health of the consumer, really depends where you sit on the income spectrum. We're still looking at a corporate environment overall, a consumer environment overall that are relatively healthy. And in order to see a true reset in investor expectations, we typically need to see an equity market revaluation of about 20%. And in the names that haven't been trudging higher, we haven't seen a revaluation of anywhere near that level. And so I anticipate that until economic activity really shows signs of slowdown, we haven't seen that reset yet.
Get a taste of everything. CPI on Thursday, and we get the earnings kicking off on Friday. Bank earnings just around the corner. Lauren Goodwin of New York Life, Brett Ryan at Deutsche Bank. To the two of you, thanks for being with us. Massive week ahead. Kicks off with Chairman Powell a little bit later this morning, testifying in front of the Senate Banking Committee at 10 a.m. Eastern Time. Let's give an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. A quick check on BP shares in London, falling by 4 1/3% after warning of weaker oil refining and write-downs. BP sees significantly lower refining margins and says it will take up to $2 billion in impairments in the second quarter.
It's in 10 minutes time now at 8:55 a.m. Eastern Time. See the release of the US Red Book year over year. The prior was 5.8%.
Pershing Square USA has launched a roadshow for the initial public offering of its common shares. The hedge fund management company is expected to list its IPO at $50 per share, and it's seeking to raise $25 from the listing. That could make it the largest fund of its kind in the U.S. Pershing Square will apply to list on the New York Stock Exchange under the symbol PSUS. And Aramco is looking to raise at least $3 billion from its first bond sale in 3 years. That, according to people familiar with the plan. Meetings with fixed income investors are expected to start today. The offering, debt with 10, 30, and 40-year maturities. The final size could be larger depending on investor demand. And that's your Bloomberg Brief. John.
Danny, thanks for this morning. Appreciate it. Up next on the program, setting you up for the day ahead. You're watching Bloomberg Surveillance live from New York City. This is Bloomberg.
There are many global investors that aren't interested in China anymore, but there's a lot that are. And obviously the local investors have money in China and are doubling down on investing in China. Many of the Asian investors, and in fact a lot of the Middle East investors, the Americans are gone away. Therefore, there's an amazing opportunity to put capital to work and get returns which are excess what you would get in other places. Where there is lack of money, there is usually opportunity. So we continue to build out our business in China. It's just where the money's coming from is different. And so we're raising local money in China for investing and bringing those that choose to be there to invest in China. So it's just a different, where the money's coming from is just different.
The top names in business are on Bloomberg.
What I can say is that we've been making significant investments across the franchise, across regulatory reporting, across data, and across resolution and recovery planning. these are areas we've been investing in because we know the areas that, frankly, the industry likely needs to further enhance, and we certainly want to enhance them for ourselves.
Nobody covers business like Bloomberg. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
So a couple of times this morning, Danny's joined the program and she's broken down this list of the top airports in the world. Is that right?
Yeah.
Top airports in the world, top 10?
Yeah.
Where is JFK on that list?
You know, it's a good question.
Still
I can't
looking?
seem to find it. It's not on there.
What's the worst airport on the planet?
It's in Tunisia.
Okay.
I've been to both them, the top and the worst.
Yeah, well, all I
You've
can
been to that
say...
airport?
Yes.
Is it that bad?
Honestly, I don't really remember it being that bad.
Well, I guess it's a matter
They didn't have a lot of extras. All right, so you go to the airport in Doha, and there's everything. There's even Ralph Lauren coffee.
Okay.
There's not a lot of extras at the Tunis
It's just
airport.
basically like a hangar. You walk through and you get
Fly
a
in
plane.
and fly out.
Okay, all right. That's all you need. That's all you need. All right. Equity futures on the S&P 500 positive by 0.1%. Going into the opening bell about 41 minutes away. Lisa's still looking at this list. I can see you doing it. Looking at the bond market, yields are higher by a single basis point. Focus, Bramo. 429.39 on the US 10-year. Counting you down to the opening bell. Here's the trading diary for the rest of this week. It is absolutely stacked. At 10 a.m. Eastern Time, we'll get Fed Chair Jay Powell beginning his two-day congressional testimony in front of the Senate. At the same time, you'll hear from Treasury Secretary Janet Yellen speaking before the House. Tomorrow, more Fed speak from Goolsbee, Bowman and Cook. On Thursday, US CPI plus another round of jobless claims. We'll also get Delta earnings too. On Friday, US PPI and UMich, plus JP Morgan, Wells Fargo, Citi, all kicking off big bank earnings. With us around the table, I'm pleased to say it's Michael McKee to get us ready for what we're about to hear in about 1 hour and 10 minutes. Michael McKee, what are you focused on?
Tempelhof, that was a bad airport.
That was a
That's
bad
gone
airport.
now. That was a bad
Okay.
airport.
All right.
Okay. From Jay Powell,
what people want to actually talk about.
And by the way, JFK is 113th. But carry on.
Right, that makes sense.
Jay Powell is probably not going to give us a whole lot today. There are two categories, or we could say three categories of issues for him. One is monetary policy. He's going to say the same things that he has said. We are committed to the 2% inflation target. We have more to do, and we will think about cutting rates before we get to 2, but when we feel there's confidence that it's going to continue going down. The second aspect is bank regulation. He got the last Humphrey Hawkins testimonies were almost completely taken up by bank regulation questions from both the Senate and the House. So we'll probably get a lot on that today. And then, tomorrow maybe more so with the House, but there are always some political questions. And I'm sure that however you wrap them up, it's either do you support Joe Biden or do you support Donald Trump? And he will say, I'm not touching that with a 10-foot pole.
There is this issue, and we've been talking about it all morning with all of the guests that we've had on surveillance, which is, will his tone be different this week than in Sintra, given the jobs report, given some of the data that indicates that unemployment is rising and inflation is coming down?
Well, that's going to be the debate after it's over, was how dovish was he? Did he shade one way or another? But they have been talking about paying more attention to unemployment and the other half of their mandate in recent weeks, over the last couple of meetings even. So it wouldn't be new news. It's really what the market is looking for, is some sort of thing to hang their hat on in terms of when we get a rate cut. And probably he's somewhat constrained by the fact that the CPI comes out on Thursday when he's done talking. So why go out at the end of the plank and maybe fall off if you don't have to, if there's more data coming?
Representative Andy Barr said yesterday to reporters, though, that a September rate hike, quote, will not be perceived as apolitical. If Powell is thinking about potentially there is a cut before the election, doesn't he need to do some work today and tomorrow to make sure that he is preparing at least the political voices in D.C. for that to potentially happen?
I don't think he needs to do it today or tomorrow. He can make it clear that the Fed will do what it feels it needs to do when it feels it needs to do it, and that they are not influenced by politics. But I think when they get the problem is you can't say anything on Capitol Hill that doesn't go straight into the newspapers. And so he doesn't want to do that and let people start speculating, because you're going to get a lot of market volatility once the markets start to think that it's coming. But he does, remember, spend a lot of time talking to individual members of Congress, and that's the kind of thing that maybe if he trusts somebody, he can go off the record and he's not going to say we're going to do it, but say we're getting closer.
Can you just give me some insight on this? Because this morning we got the NFIB small business optimism come in actually stronger than expected at the highest level this year. Why isn't this being talked about as sort of highlighting that this is still an economy that has quite a bit of steam behind it?
Oh, it depends on whom you're talking to. There are people on both sides, on Wall Street. There are people who say that the economy is doing fine, and the Fed is sort of along with them, saying we don't need to move now because we're not in trouble. And then, of course, the doom crew has been saying we are about to go into recession 6 months ago. And so he's going to balance those two things. But the narrative,
We're shortly expecting the US Red Book year over year.
It's a political year too, is what's wrong. That tends to be the journalist view. I mean, you don't get a lot of stories on the front page saying everything is wine and roses.
10 a.m., what will you be watching? Chairman Powell or Secretary Yellen? If you had to pick one.
Oh, I'd be watching Chairman Powell because he can have a direct influence. What'll be interesting from Yellen is any talk about what their debt policy is going to be. We have auctions this week, and that's going to be important to a sector of the bond market. But the overall impression of the economy and the overall idea about what we do about interest rates will come from Jay Powell.
We know what Lisa's watching at 10 a.m. Eastern Time. Mike McKee, thank you, sir. Appreciate it. Coming up tomorrow, Brian Levitt of Invesco, Dan Skelly of Morgan Stanley, Lisa Coleman of JP Morgan, Steve Englander of Standard Chartered. That's your lineup for tomorrow. Just some final thoughts around the table going into Chairman Powell later this morning.
Buy the dip on political noise.
Yeah.
Which dip? And that, I think, is the most interesting aspect as people look to some of the disruptions in markets and what they think is noise and what they don't.
You did the week ahead, but honestly, we missed, I think, what is the biggest event, which is Biden and the need for him to perform Thursday evening. He needs to be like the Biden of early 2022, when he did that record, nearly 2-hour-long news conference and took questions from everyone in the room, things he wasn't even prepared for. He cannot just come out and take 2 to 4 questions. That's not going to cut it.
Will this be a news conference on NATO or a news conference on the president's health? What's this going to be a news conference on?
The questions will start with something about NATO and the U.S. looking strong, and how can we look strong if people are questioning your ability?
That's the week ahead. Look ahead for that on Thursday. All of that still to come this week. It kicks off with Chairman Powell a little bit later this morning, 10 a.m. Eastern Time, in front of the Senate, then in front of the House tomorrow. Then we get CPI data on Thursday morning. Then on Friday, we start to get earnings. We can talk about what's coming from the likes of JP Morgan, the likes of Citi, and look ahead to Goldman and Morgan Stanley into the next week as well.
That might actually be potentially the most market-moving event if they signal some sort of weakness, if people basically are looking for that.
US Red Book year over year, 6.3%, 6.3%.
Kelly Bradford, Matt Miller with Bloomberg Open Interest. That program about 4 minutes away from New York City. That does it for us. This was Bloomberg Surveillance.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
In terms of how we should deal with the challenges that are, facing the world and also internally, I think it's just an opportunity also, an angle. And you could see that in a lot of activities that are picking up in this region, simply because it's a region that is actually a bright spot amongst very few in the world today. And people always talk about the flavor of the month. Actually, I don't want to sound too large-headed, but actually we will be the flavor of decades. We are determined, we have long-term plans, and we are very clear and committed.
We are shortly expecting the ECB bond settlements for the week.
At large, I'm not talking about one individual country, but at large in the GCC, that we mean business, that we are willing to take every step possible to make it easier for investors to do business in the region, that we are willing to do a lot of structural changes, including actually making it very predictable, very consistent policies.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins,
the effective Fed fund rate is unchanged at 5.33% for July the 8th.
The deal. The deal. That deal. The deal.
Huge deal.
Who dug this up? What are y'all in trouble? Stocks are set to scale yet another all-time high, less than 30 minutes until the start of trading. I'm Matt Miller.
I'm Shanali Bassick.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
So ECB bond holdings under PEPP, 1.66 trillion euros as of last week. They settled 305.8 billion euros in corporate bond purchases and 2.249 trillion euros in public sector bond purchases.
Washington as a defiant Biden battles infighting about his presidential campaign.
And Citi says it's time to book profits on your AI bets, even though that rally shows little signs of stalling. They say that the gains in some names is, quote, concerning. Let's take a look at where markets are trading right now. About 30 minutes until the opening bell. We have another rally on our hands. The S&P 500 up about 0.2% in the pre-market. Saw its 35th record close this year yesterday. We'll see if today is number 36. It's a similar story if you take a look at big tech. The NASDAQ 100 currently up about 0.3%. A tiny bit of a sell-off in the bond market. Matt, currently yields on the 10-year up about 1 basis point.
Maybe we're seeing record high after record high because financial conditions are so loose. Of course, the Fed wants its policy to be restrictive, and here you see the blue line showing Fed rates holding high, and yet financial conditions continue to loosen. So that's why we hit record high after record high.
And there's some stocks I'm watching as well into the pre-market because speaking of record highs, you have Intel pre-market set to rise for 5th day. Its longest winning streak since January. Remember, this is a stock still down 32% this year, but it does just go to show that the latest rally in chip makers has some traction. Intel up pre-market about 2.9%. Also watching Boeing taking a little bit of a lift here, but roughly flat on the day. Remember, just a day ago, United said another one of its aircraft lost a wheel while taking off from LA. Remember, Boeing also in talks to preserve government contracts in the United States after agreeing to plead guilty to a criminal charge put forth by the Justice Department. We'll give you updates as we get them.
All right, let's hope we don't lose a wheel on day 2 of our new show. Open its debut yesterday, and there's not much less news today. I mean, it's been incredibly busy for a July launch.
Incredibly busy. Of course, we have Jerome Powell taking the spotlight today. We'll count you down to that one. But if you think about day one, I thought it went pretty well. I mean, we had Howard Marks, we had Greg Jensen, and of course, we had Mike Wilson, Shonali.
We have another all-star lineup today. Of course, Lori Calvasina joining us from RBC, Torsten Slok. There's so much to unpack here between the equity market and the bond market, particularly before 2 hours of Powell testimony.
Yeah, absolutely. Let's get to what Mike Wilson told us yesterday about the chances of a market correction.
I think the chance of a 10% correction is highly likely sometime between now and the election. Not just because of the election, but because uncertainty is going to prevail for a lot of different reasons. Earnings reasons, election outcome reasons, some of the things you mentioned earlier around tariffs, potentially immigration, Fed policy still remains uncertain. So yeah, I think the third quarter typically is that period and it's going to be choppy.
Now, since he said that, I think a lot more people have been worried. Yesterday, I read Julian Emanuel pointing out that the road to his 6,000 target is going to be bumpy. Let's bring in Lori Calvasina right now, head of U.S. equity strategy at RBC Capital Markets. Lori raised her year-end forecast for the S&P 500 to 5,700 and 5,300. Lori, welcome to the show. Thanks so much for joining us on the inaugural week of our program. What do you think about, what seemed like worries about these new highs that we're hitting day in and day out?
So look, I'm admittedly in the pothole camp, as I like to call it. I'm getting a little tired of the correction, pullback, NOMR. But the reality is that I do think we might go a little bit higher before we hit that pothole, and that's what we tried to reflect with our target increase last week. If you think about some of the reasons to be worried, I agree with a lot of what Mike said. Seasonality, if you look especially the past 5-10 years, we tend to run into trouble August, September, or October. If you look at the election, usually there's some sort of uptick in the VIX in presidential election years. We haven't really seen that yet. And then also, if you think about what's happening economically, we're seeing consumer sentiment take these hits. It really seems, I'm not in the recession camp by any stretch. I want to make that clear. But we are hitting a soft patch, and the City Economic Surprise Indicator has really taken a pretty big hit in here. So it feels like the right time for the market to take a breather. That being said, I've noticed a lot of people are starting to call for that as well. And admittedly, I'm in that camp. But sometimes when that happens, it ends up being more like a 5% drawdown than a 10% drawdown.
It's interesting. At the same time, you have sky-high expectations for earnings season, and whether you're Goldman or Evercore, there's a lot of thinking here that perhaps a lot of this is already baked in. So how much risk is there this earnings season?
So I will say on earnings, I actually nudged my number up from 237 to 242, and I think the consensus
In 10 minutes time now at 9:15 a.m. Eastern Time, Fed Vice Chair for Supervision Barr speaks on financial inclusion at an event in Washington. The text is expected, no Q&A.
Does a fantastic job of tracking those bottom-up consensus estimates. And they do. I mean, they've got some investigated on the street on that. And, what we're seeing right now, there hasn't been too much movement in those recently. They are really baked on the idea that margins are going to continue to expand, so we do have to be mindful of that. But what I will tell you is if you go back and you look since 2009, where the estimates are around mid-year, June or July, that is pretty much where they end up at the end of the year. So strategists like me can come in and run their models and fight, and say, oh, that's a crazy assumption. The reality is I feel like I've learned to really give these management teams the benefit of the doubt to manage through for a couple quarters. They keep showing us, especially since 2018, especially on the margin side, that they are able to do that.
Let's talk about the management at some of the smaller companies in corporate America, because small caps, it feels like they just can't get off the ground. I've heard a lot of people tell me that, okay, the Fed is going to cut rates, so buy small caps now. You want to get ahead of that. Then you take a look at the Russell 2000, and it has just badly lagged the S&P 500. What's going on with those small names?
So if you look at, we can't really look at this on the Russell 2000. That's a whole tangent we don't want to get into right now. But if you look at the S&P 600 and the downward revisions to this year's earnings estimates that have been in place for basically the past year, it's pretty much in line with the median drawdown, the median downward revision. The S&P is kind of flat versus last summer, right? So there's a resilience in the bigger cap companies. The smaller cap companies are not able to replicate. They just don't have as many levers to pull in terms of cost management, whether it's addressing labor, input costs. They're just not able to defend their margins as well. So I think that's part of it. I think the other thing that's happening with small caps is we all just need to stop overthinking it. If you look historically, small caps versus large around rate cuts, they don't tend to pre-trade them. They tend to wait until you actually get the cuts in place, and frankly, sometimes even lag the cuts a little bit, and then start outperforming. And so if we think the Fed's not going to cut, to September or December is our RBC house view, it's a little too early to do it right now, especially at the same time that economic expectations really aren't moving up anymore.
Right.
We've lost the economic tailwinds, and we've got this Fed headwind that's still in place, and you've got an earnings headwind.
But Lori, aren't markets these fantastic forward-looking vehicles that are supposed to price things in advance? Why would that small cap trade actually maybe lag the rate cut?
So historically, it just hasn't happened that way, and I think it's because the balance sheets, any metric you can pull up, first of all, small caps, their balance sheets are better than they have been in the past, but they're still much worse than large caps, right? So they are bearing the brunt of that impact. But also, let's just think about practically what's happened over the last year. We had a fierce rally in November and December in small caps. Every hedge fund I talked to was trying to go long small caps, pre-trading their Fed.
Chinese state media Xinhua states that Chinese vice premier, in a meeting with Saudi Arabia's PIF governor, says that China will deepen cooperation with Saudi Arabia in areas such as energy, trade, investment, and finance.
Got burned once is going to make them a little bit more reticent to pre-trade it. Now, that being said, I don't want to be underweight in here. Relative valuations are cheap. And if you look at the CFTC positioning, we're down around SVB low. So I think you want to watch that inflection. But there's no reason to be a hero here. People have already gotten their heads lopped off once by trying to do that.
Speaking of heads being lopped off, you have S&P 500 on track to potentially hit a 36th high today, a 36th record. How do you hedge your positioning from here? Is that perhaps a more important trade?
So I'll tell you what I'm looking at right now with S&P is, and with all this stuff that's going on election-wise, and I think, look, there's just a lot of fog out there, right, in terms of what it means for the U.S., but I do think we've seen a little bit of momentum for Trump since the debate. I do watch the betting markets. I know that's very controversial, but what I have found is that if you look at the Trump-Biden spread in betting markets, looking at the RCP average, and you look at it against U.S. relative to Europe, what we're finding is that when Trump has the momentum, U.S. is outperforming Europe. And when Biden is bouncing back, that's when we start to see Europe bounce back relative to the U.S. So I feel like there's fog on both sides right now, in terms of looking at Europe, what all the results there mean, what exactly is going on here. But the one thing we know is Trump seems to be coming out of this with a little bit of momentum, and that's resulting in a buy the U.S. trade.
All right, Lori, hang tight for a minute. We want to take a quick look at markets. We're going to get right back to you. We are, in terms of futures, continuing to see gains on the S&P, continuing to see gains on the NASDAQ. And, yesterday we closed out the S&P at 55.72. As Shanali mentioned, a 35th record high. If we finish even a little bit higher today, that'll be a 36th record. Heading into Jerome Powell's testimony, everybody is going to be watching for any hint that the Fed
In 5 minutes time now at 9:15 a.m. Eastern Time, Fed Vice Chair for Supervision Barr speaks on financial inclusion at an event in Washington. A text is expected.
Kelly, and this season on Power Players, we're taking you behind the scenes to see how the business of sports has gone global.
I want sports to grow. I want sports to be bigger because we have talent.
And how mammoth value is coming from the smallest of players. 3,184 hits, 431 home runs, and of course the most famous stat that everybody knows, 2,632 consecutive games played. Unmatched career. How are you doing this?
What we have achieved in the NWSL from an investor perspective over 2 years is the equivalent of what it took other leagues 25 to 30 years to achieve.
You've got to have a business that's sustainable. The only way it's sustainable is got to make money.
There's only one word, winning. You win on the court, you win off the court. And as you do that, you bring people along.
bigger challenges next.
Fed was going to keep rate World Cup. This is a 3.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond. Now to high interest, to look at what's making headlines around the world. President Biden has won support from Alexandria Ocasio-Cortez and other Democratic progressives who previously criticized him. The mood seems to be shifting against calls for him to step aside. He allowed his physician to share health details to quell concerns. The doctor says Biden only saw a neurologist for annual physicals and that he's not being treated for Parkinson's disease. Most of Houston remains without power in the wake of Tropical Storm Beryl. Authorities warn that the blackout may last for days. The storm flooded streets, downed trees, darkened traffic lights, and left power lines on the ground. 3 deaths were linked to the Category 1 hurricane so far. And Fed Chair Jerome Powell begins 2 days of congressional testimony today at 10 a.m. It's his last scheduled address to lawmakers before the election. He'll likely have to defend the higher for longer policy stance and the Fed's claim to be a dependent, especially ahead of a possible Trump regime in the White House. Now, for more on what to expect from Powell, let me go over to Katie.
Definitely of high interest, of course, anything that Powell has to say. So let's get to it right now with Michael McKee. He is Bloomberg Chief Economics and Policy Correspondent. What are we expecting to hear from the Fed chair?
Well, there are probably 3 categories that Jay Powell will be
Shortly expecting comments from Fed's bar. The text release is expected in just under a minute's time. Unsure how much monetary policy talk there'll be.
2% target. They don't have enough confidence to start cutting rates, but they will do so when it is necessary. Basically the same stuff that we have been hearing, because he doesn't want to go out on a limb with CPI coming out on Thursday that could change everybody's perception of what monetary policy should be. There will also probably be a lot on banking regulation. That's what we got at the last Humphrey Hawkins testimonies, both in the House and Senate. Senators and congressmen wanting to know how tough the Fed is going to be on Wall Street. Powell last time said they were planning some major overhauls of the regulations. We'll see if there's been any progress. And finally, as Matt said, the question of Fed independence and the question of what happens politically going forward. Republicans, Democrats will try to get Powell to wrap himself in their flags, and he will probably say, we are independent, we're going to remain independent, and we don't want to get involved in any political discussions.
Mike McKee, we thank you so very much. We're looking forward to catching up with you later, closer to the Fed's testimony. But meanwhile, strategists at Citigroup out with a note this morning saying that now might be the time to take profits from some of the biggest names in AI. And yesterday's trade suggests that the AI rally actually might be now broadening out, with Corning, Supermicro, and Intel ending as some of the biggest gainers on the day. And we spoke with Greg Jensen of Bridgewater about how they're playing the AI trade.
Big productivity miracles are pretty separate from economic cycles. So when you look at what we're doing in Pure Alpha, we're generally...
So the text for Fed's bar has been released again on inclusion in the financial sector. No talk on monetary policy that we can pass through here.
So when we trade U.S. equities, we trade them kind of with AI hedged.
Lori Calvasina of RBC Capital Markets still with us, and curious, Lori, about how you feel about this Citi call, this idea that maybe we're not in a bubble here, but maybe that it's time to take profits in those high flyers.
So I sympathize with the impulse. I'm not sure I'm quite on board with the timing. And in terms of why I sympathize with the impulse, if you look at the top 10 market cap names in the S&P, I think they're trading around like 27, 28 times forward earnings now. We've seen them get as high as 29.8. That's really close to the ceiling of about 30, 31 times that we've seen post-COVID. So they're having trouble breaking through past highs. If you also look at the CFTC data on NASDAQ 100 futures positioning, as sort of a proxy for positioning in this trade, it's basically, kind of starting to move back to past highs. It hit them, moved down. It's looking pretty elevated. So I get the impulse. I think the problem is in terms of timing. I think you really have to see the earnings prowess proved of the rest of the market. If you look again, I'll go back to some Bloomberg intelligence data they put out every week, but if you look at the Mag 7 versus the rest of the market, the gap in earnings growth has gone from about 40% in 2023 on actuals. It is shrinking, so the rest of the market is expected to catch up while that Mag 7 cohort decelerates. The gap is sort of stuck around like 2-3% for 2025, and we haven't seen any movement in that. So it feels to me like the seeds are there. It's not getting the proper sort of water, sunlight, nutrition. I think the other thing, frankly, GDP forecasts for next year are stuck around to 1.8%. To really get back into the value cyclical part of the market, to see that broadening out, we need GDP above average, and average is around 2.5%, 2.6%, or we at least need it to move up the way it was late last year, and it's just sort of stuck. So I get it. I think we should be vigilant, but I'm just not quite sure now is the time.
You know, we all know the market is concentrated, but I think it's interesting to see how that bears out in terms of earnings, right? You mentioned the BI data. I was looking at Torsten Slok's notes. He's going to come on later. He points out that the top 10 companies in the S&P 500 make up 35% of the market cap, but only 23% of the earnings. So his interpretation is the market must be super bullish on their earnings. We know that's true. But also the converse, the market is pretty bearish on the 490, right, in terms of earnings.
But, you know, it is and it isn't. Like, if you look at the rest of the market, again, going back to that BI data, I think there was like minus 5-ish% earnings growth in 2023. And so it's already expected to rebound into really healthy territory this year and next year. And I think next year it's getting into kind of like the mid to low teens. So there's already a recovery that is baked in. The problem is just the understanding of how powerful that recovery in the rest of the market isn't improving, right? And this is one thing I've learned on Wall Street over the years. It's not just about levels, it's about momentum, it's about trend, it's about things getting better and continuing to move on that curve. And we're not pushing that curve. And again, I go back to the GDP data. I think the rest of the market is a bit more cyclical. And if we're not sort of seeing those cyclical headwinds strengthen and they're starting to weaken a little bit, I'm sitting here as a strategist wondering, how am I going to get, you know, let's call it 12% earnings growth in the rest of the market expected for next? How is that going to keep getting better? It's not. It's stagnating. I think it's stagnating because our understanding of where the economy is headed is stagnating.
Well, on the topic of concentration, and to bring it back to the Citi note, they did concede that not owning or betting against AI would, quote, be difficult for many on the buy side. So you think about just how top-heavy this market is. It feels like you, at a certain level, can't fight it, that you kind of have to just embrace it and go with it.
I think you also just have to wait for it to shift. And like, I know we want to forecast every single little move in the market, but I do think, you know, one trade that made sense earlier this year was when we saw utility flows suddenly pick up. That last reporting season, the utility companies all said, hey, we're going to get a boost from AI because of the boost of power demand. That wasn't priced in. That was a cheap sector. It made sense for money to suddenly move there and start chasing it. So I think those are some trades we can look for, but just to sit here and say, you know, it's time to short these things, it's time to just go all in on the other side, I think you want to be a little bit more careful than that.
You've underlined the fact that you're not expecting a recession, right? Even though you don't see GDP really coming back to normal. I wonder how much of a concern commercial real estate is, because I keep seeing, you know, vacancy rates remain high. It's not like more people are coming back to the office, even as more people are getting jobs and, you know, the economy is growing some. We're headed towards a wall of maturity as the Fed is holding at 5% and change. I mean, it seems like a recipe for disaster, especially considering the great financial crisis came down because of other real estate concerns. Right?
I think it's, you know, it's something that comes up a lot in our meetings, comes up at conferences as well. You know, it's something we certainly pay attention to, whether we're looking at REITs or banks when we're reading through transcripts. And here are the two things I've been telling people is, number one, there are so many eyes on this problem, whether you're talking about investors, regulators, or the media. We're all watching it. We're all, you know, really trying. I think that gives me some comfort, frankly. This is very different from the housing bubble, right? When there was just denial, denial, denial. I used to go to those crowded home building conferences and just hear, you know, lies coming out of companies' mouths, right? And everybody would sort of, you know, get frustrated, but half the people were in the room were buying what they were selling. That's not what we're in right now. We're all heavily scrutinizing this. The other thing that I feel like we're starting to understand is this is part of the new post-COVID normal. Where simply work from home, not being in the office 5 days a week, that is just sort of around to stay in some shape or form. And I think that this sort of commercial real estate headwind, it's a slow-moving train wreck, right? I think that it is being dealt with. It is still a concern. It is still causing some problems, but it's moving slowly enough people are able to manage the fallout.
Well, that's a reassuring note to end it on. Lori, it's always great to see you. Really appreciate your time today. Our thanks, of course, to Lori Calvasina of RBC Capital Markets. Now, coming up, we're going to take a look at the companies making the most social buzz today in our Social Climber segment. Up next, this is Bloomberg.
games in business are on Bloomberg.
You need to have an AI game plan. We used to say that every company needs to think about becoming a software company. Now we say that every company needs to become an intelligent software company.
Context changes everything. Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders. From breakfast cereals to pet foods, General Mills has an iconic array of brands. But future success depends on efficiency, innovation, and insight. CFO Kofi Bruce does much more than crunch numbers.
Our first job is to intimately understand and anticipate the consumer's needs.
Watch Chief Future Officer. New episode Wednesday on Bloomberg Television. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
All right, it's time now for Social Climbers. A look at the companies making waves on social media this morning. And first up, big trouble in big oil, with BP saying it expects significantly lower refining margins. The energy giant also predicts a write-down on the value of a German plant of up to $2 billion. That, of course, is the latest in a string of impairment hits and lower profit announcements in that sector. Next up, we have Helen of Troy losing an epic earnings battle. The maker of Hydro Flax, Vicks Vapor Rub, and Dry Bar products, it announced that profit and revenue will actually fell well below expectations. Now, the consumer products company also slashed its full-year outlook thanks to weakness in its beauty and wellness brands. And finally, we have Disney unveiling plans to launch a new cruise ship that will set sail from Tokyo starting in 2028. Disney has plans to launch 3 more ships, including one that will set sail from Singapore later this year. The cruise line expansion comes as the industry is enjoying a rebound from the pandemic, even though, take a look at shares, well, that's Disney. Disney shares just about flat. You can follow all the latest company buzz on TREN Go on your Bloomberg terminal. But Matt, let's take a quick check on these markets. We are minutes away from the opening bell.
Yeah, absolutely. We're looking at gains again in terms of futures. S&P got an all-time high again yesterday. Of course, the 35th record high, and today, if we close any higher, it'll be the 36th. The Russell 2000 futures, so small caps, are down, but not really significant. 0.1%. It's really all about the big tech companies, obviously. That's why you see NASDAQ 100 futures higher.
But it's interesting because you see the Russell still kind of weak here, even when you see U.S. small business optimism really rising for a third month. It's a high for this year. The reason that's interesting is it's because inflation expectations are coming down. Let's see if Jay Powell has the same to say.
But Lori had such an interesting point on the small caps that even though the temptation is to get ahead of the rate cuts, get ahead of that trade, that actually take a look at small caps and that rally really tends to lag.
I wanted to ask about cruises. You guys, does either one of you cruise?
Absolutely not.
No, right?
Keep me away from the
But
ocean.
I have, and I don't either, but I have heard that Disney has like the best ships.
Yeah.
That's what I've, high service.
You do have
high
2
quality
children
service.
now to take them just
Yeah.
there.
It's
Anyways,
an
coming up, we're going to talk to Torsten Slok of Apollo. He's going to talk about what he's expecting from Powell today. This is Bloomberg.
Operating in a very volatile environment. So JetBlue has a very large presence here in New York, and there are air traffic control challenges. And so we've had to overinvest in hiring excess crew members and building flexibility into our planning process. And so over time, we hope to wean some of those investments back as the operating environment around us stabilizes.
We made the decision early on that we were only going to invest internally on key differentiating technologies, and clearly the powertrain is the key differentiating technology. So our investment is a recurring investment with respect to the powertrain team, the battery team, which is part of it, the engine team, electric engine team, which is part of it. And we also have a lot of non-recurring costs with the other components because we're not developing those internally. We're using the existing aerospace defense supplier base for most of the other components.
We invest a lot in the offices, that you feel home, that you can actually be at your best yourself, and people work very differently. We take a lot of input from the sports world, actually, the athlete spirit, right? Building a sports team that can perform at the best.
Just less than a minute to go now to the market on open imbalance and the cash equity open in the US.
Tap into new things, continue being disruptive. We have 80 different nationalities head-on. It's very important to have a diverse team because we have a very diverse landscape of customers.
Bloomberg Surveillance covers the latest in global markets and the political events that influence. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
All right, moments away from the start of trading on the New York Stock Exchange and the NASDAQ. I'm Matt Miller. This is Bloomberg Open Interest. Take a look at futures. We're up again today.
So we're looking now to the market on open imbalance. The S&P 500, 130 million to the sell side. NASDAQ 100, 40 million to the sell side. Dow 30, 40 million to the sell side. Mag 7 stocks, 35 million to the sell side.
And on the NASDAQ market site, Chicago Innovations ringing the bell. Let's go over to Katie Greifeld right now and see which stocks are moving right at the start of trading. Katie?
Yeah, one stock I'm keeping an eye on at the open is Nike. You have the sneaker giant taking a senior executive out of retirement to help with their slumping sales. Of course, we got a pretty ugly earnings report from them a couple weeks ago. The stock is down 33% year to date. You can see Sonali right now currently up about 0.4%.
Katie, I'm also keeping an eye on Boeing, fluctuating a little bit pre-market here. Remember, yesterday, United said another one of its aircraft lost a wheel while taking off from LA. Boeing is also in talks to preserve U.S. government contracts after agreeing to plead guilty to a criminal charge put forth by the Department of Justice. Boeing now down about 0.25%.
All right, Intel, also a stock we're watching, gaining for a fifth straight day this morning. There's been a lot of talk, especially after that Citi note, about broadening out your AI investments. And there's some technical or optionality involved in this. Let's get a closer look at Intel with Bloomberg's Abigail Doolittle. Abby?
Well, as you mentioned, Matt, we do have Intel up for a fifth day in a row. Over the last 5 days, up more than 10%. The best 5 days going back to November of last year. So investors liking Intel up 2.8% this morning. You were just mentioning the option action because from a fundamental standpoint, there's not a lot of new news except for the possibility of what you were talking about, a catch-up trade. If we go into the Bloomberg terminal and take a look at what's happening for options, we have an absolute surge here in call buying, suggesting that that some investors think the stock will go higher. What could that be? Well, AI. They, of course, have struggled with some of their more traditional businesses, the foundry. The AI has been off to a slow start. If we take a look at a chart of Intel relative to the stocks and NVIDIA, take a look at NVIDIA up almost 160% on the year. The stocks up about 30%. There is Intel down more than 30%. A beautiful catch-up trade if Intel can put up results. Investors right now betting they can.
Yeah, we'll see, of course, if Intel can actually pull it off. Abigail Doolittle, thank you so much. Meanwhile, markets will also be keeping an eye on Jerome Powell's testimony starting in about 30 minutes' time. And joining us now to help preview, I'm thrilled to say we have Torsten Slok. He is Apollo's chief economist joining us on set. It's great to see you, Torsten.
Thanks for having me.
So
S&P 500 and NASDAQ open at record highs.
Clear that he would like to cut rates. The data so far hasn't been quite cooperating with that impulse, but maybe a little bit of weakness in the last couple prints. Where do you think he stands right now?
Well, I think for him today, the reality is that we still have 3 inflation prints before the 18th of September FOMC meeting. So that means that he doesn't need to come out with a strong view in either direction. It's pretty clear that they will not cut in July. And it is quite fascinating how the market always says, oh, it's not this meeting, but the next meeting is when the cut will come. So I still think we have some time here for at least 2 or 3 more inflation prints before we find out if the Fed has enough confidence in inflation actually moving down towards 2%.
Why do you think no cut in July? Peter Cheer of Academy Securities was on earlier, and he said he thinks it'll be at July. It's the last day of July, right? Because the Fed doesn't want to cut too close to the election.
Well, I think there's a number of challenges with that view, namely, first of all, if you look at the weekly Red Book retail sales data, is still very strong. If you look at auto sales monthly data, also very strong. If you look at some of the numbers that have been coming in across the board on CapEx spending, on AI spending, on AI earnings, and when it comes to the value of stocks going up, the tailwind to the economy from easy financial conditions is also very strong. So I think that for the Fed, the issue is they need to get inflation to come down towards 2%. And we'll see on Thursday what we get on CPI. But the question is whether they will have that confidence at the end of July. And I still think it's questionable. If this is the case, they definitely need to change their communication sooner rather than later.
If I type ECSU on the Bloomberg terminal, I see economic surprises, and they're all to the downside. And I read your notes every day. You've mentioned commercial real estate recently and the fact that vacancy rates continue to remain high. I was talking about this with Lori Calvasina. And there's a maturity wall coming due. You know, isn't the Fed worried about tripping us into a recession?
I think they are, but from their chairs, they will probably say, well, we need to raise interest rates to make it more difficult to get financing for consumers and for firms and in commercial real estate. And if you look at the progress of this process of the Fed having raised rates since March of 2022, we're just still not quite there yet. If you look at the employment report last Friday, for the last 3 months, employment growth has been 200,000. For the last 6 months, 200,000. For the last 12 months, 200,000. Yes, the unemployment rate is going up, but a very important reason why the unemployment rate is going up is not because people are getting fired. It's because more people are showing up at the labor force, most likely immigrants and others. That are
Seeing the S&P 500 extend gains out the open here, up 0.2%.
Doing reasonably well. So I still think that overall, yes, that process of destroying demand as a result of rates going up is playing out in certain parts of the economy, including commercial real estate. But when you look at the aggregate impact with 206,000 jobs created in the month of June, that's still an economy that's doing quite well.
Torsten, even though you have a Fed chair who will meet Congress, who maybe wants rate cuts sooner rather than later, you still have a situation where the monetary seems to be fighting the fiscal. How much concern is there that if they were to cut rates and the government keeps spending as it is, then the problem compounds into 2025?
Well, when interest rates go up, of course, interest expenses for the government will go up. It will take a little bit of time, but it will eventually happen. But when interest rates go up, you also have that people who live on fixed income and people who own fixed income, including people who own public credit, private credit, will get cash flows that are higher than they basically have been in decades. Combining that with the stock market going up every day, with home prices going up, the wealth of a significant part of consumers, the wealth effect is just really still quite strong. So yes, interest rates going up is biting certainly harder on highly levered companies, on highly levered consumers, and also on some parts of commercial real estate, to Matt's point. But I still think that the net effect still tells you that job growth is still strong. And yes, again, the unemployment rate is going up, but the rise in jobless claims has also been more seasonal. So we don't see this as any sign that the economy really is slowing down to the same degree that the narrative at the moment is in markets.
I'd really be curious about your view on the demand for T-bills as issuance has been really flooding the market. When does demand evaporate and why?
Yeah, this is really important because there has been a very deliberate decision, of course, to issue more T-bills over the last several quarters. And ultimately, debt levels are growing so significantly that we will need to see more issuance of coupons, being bonds and notes. So the more issuance of T-bills rises, of course, it begins to create the question, who is going to buy all these T-bills that are coming to the market? And that begins to raise some issues and fears about what happened in September 2019, where funding markets started to be impacted because there was a significant amount of supply coming to the market. At the time, there was also a lot of issues with supply was so big that created, in particular in the front end of the curve, issues with supply being high. So yes, the change in the structure of debt outstanding is a very important topic in rates markets at the moment.
But when it comes to T-bills and T-bills demand, you've made the case in your notes that once the Fed starts cutting rates, that some of that demand is going to dry up. And I would just want to meditate a little bit longer on why. Because you take a look at money market funds right now, over $6 trillion in there. Is a 25 basis point cut and then maybe another really going to really meaningfully shrink demand there?
That's a good point. And I think fair enough. It's probably not going to shrink demand dramatically, but given the Fed is so keen on continuously telling us that the next move in rates is lower, that means that there's a lot of people that are then thinking about, okay, maybe I should be buying some duration, but what about the front end? If the next move is lower and we'll get a number of more cuts, then that could begin to have some implications for what will happen to the amount of money in money market funds. And the other thing in that discussion is, remember also, what really is intriguing at the moment is that the amount of money in money market funds is going up, and at the same time, the stock market is going up. So we have a very bullish environment where all assets, both the safest asset, namely T-bills, and also the stock market is going up simply because there's still a lot of money slushing around buying investments, both in risky assets and in safe assets.
I have a viewer writing in with a question. I happen to know that he's a bond trader. He's asking, when does the market price out euphoria over a cut for the realization that cuts always signify something breaking in the market?
Well, a very important part of that discussion is, of course, what we've seen in the last few weeks is that with the election coming up, there's a lot of debate about what would the implications be for tariffs, what would the implications be for restrictions on immigration, what would the implications be for the amount of T-bills, and what might even be the restrictions be on in terms of, are we going to get a bigger fiscal deficit or a smaller fiscal deficit? So when it comes to the outlook for rates, it is partly the cyclical discussion, meaning inflation, unemployment, jobless claims, but there's also this whole new theme emerging of, does the fiscal position matter? Does it matter that we have more T-bills outstanding, and what are then the implications for the shape of the curve? And the most likely scenario to that question is that we'll probably have a steeper curve at the end of the day if the Fed does eventually start to cut, and we still have some fiscal challenges that are very difficult to deal with, no matter who wins in November.
All right, Torsten, really appreciate you dropping by for our inaugural week. Torsten Slok there of Apollo. Coming up, the 75th NATO summit is set to kick off in our nation's capital with a lot of uncertainty surrounding it, certainly surrounding the president. We'll have the details for you next. This is Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal.
The Deal.
That deal.
The Deal.
Huge deal.
Who dug this up? What are y'all in trouble?
When South Africa has an election, Bloomberg Television has it covered.
South Africans are very connected politically. They know exactly what they want.
In developing countries like South Africa, when there is one-party dominance for too long, we don't get that economic growth, we don't get accountability.
Whatever we do will be based on stability.
Nobody covers global elections like Bloomberg. Context changes everything.
I'm Manus Credit.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg. Context changes everything.
This is Bloomberg.
This is Bloomberg Open Interest. Let's get you a quick check at what's going on in terms of stocks right now after hitting a 35th record high on the S&P 500 this year. In yesterday's session, we are up again today. You can see 55.84, the level on the S&P 500. The NASDAQ climbing a little bit more than a third of 1% at 20,514. The tech stocks obviously continue to power this rally, even though Citi said maybe take some profits in the high flyers. The Russell 2000, the small caps, down about 1/3 of 1%.
All right, let's get now to some of our top calls. The analyst action that's in focus this morning. And first up, Piper Sandler upgrading Bank of America to neutral. The analyst predicting an uptick in its net interest income after a trough in the second quarter. Of course, we'll get those results in the coming week or so. Next up, TD Cowen raising its price target on Netflix to $775. The analyst cites optimism over membership trends. Now, this move comes ahead of the streaming giant's second quarter results out next week. And finally, we have KeyBank coming out with positive calls on chip stocks. The analyst also raising NVIDIA's price target to $180 thanks to robust generative AI demand. Definitely have heard that one before.
All right, uncertainty is clouding NATO's summit in Washington. President Biden's health, along with domestic elections in France and Germany, are creating headwinds for the alliance. Joining us now with more is Anne-Marie Jourdain, Bloomberg's chief political correspondent, as well as co-host of Bloomberg Surveillance. So, Anne-Marie, my big question is how many of these leaders are coming over worried about the President Biden they saw in the debate, worried about the President Biden they saw on the ABC interview, and wondering if they're not talking to a lame duck?
Well, take it a step back, worrying about the President Biden that some of them also interacted with. They're part of the G7 summit, because we had reporting prior to the debate that there were concerns about individuals in the room, other leaders in the room, other teams in the room, Sherpas, watching the president about how he was really interactive and on it when it came to discussions about Ukraine, but then would sort of zone out when it was some other issues. So this has been a concern, I would say, even prior to the debate for some of these countries. But not only is it going to be overshadowed by Biden and the domestic issues he's facing at home, but you named France. Emmanuel Macron, he comes with his power diluted. Olaf Scholz had a reckoning at the European parliamentary elections. A lot of this summit is going to be about NATO. You had members of the far-right group in Germany actually decide that they're not going to sit through Zelensky's latest speech recently to the Bundestag. So this is a number of these countries coming here dealing with a tremendous amount of domestic issues that's going to overshadow this entire event.
Overshadowing the event and also these early stages of the election cycle, can you give us an update here on how the Democratic Party is becoming more and more split on the issue of Biden?
There's a schism for sure. I think you have 9 congressional Democrats by either telling Bloomberg off record or finding out from calls that they're saying that they want him to step aside, or publicly coming out and saying it, like we heard from Representative Smith yesterday on CNN, thinking that he says there's another individual that should be able to bring the Democratic message more clearly forward. Do these calls grow? Potentially they do. Senators are going to be behind closed doors today. Potentially you hear more about more people coming out and saying he should step aside. But Biden tried to do everything he could yesterday. Many are saying it was delayed, but he went on MSNBC. He wrote a letter to congressional Democrats. He called donors up. And in the evening, he Zoomed with the Congressional Black Caucus. Will this be enough? Thursday is really seen as this test. The White House, jokingly, with our own reporter Justin Sink, is conference take just 2 to 4 questions. He needs to really be able to field questions from the press on Thursday to show that he is capable of being the nominee, not just being the nominee, but leading for the next 4 years.
So a lot of focus, of course, on that Thursday press conference, a lot of focus on anything he does at NATO. But of course, this NATO summit, it's happening, 4 months to go until the election. And if Trump gets another presidential term, I mean, what could that mean for the future of NATO?
Well, that's why there's some consternation amongst NATO members. You hear people talking about they're trying to Trump-proof NATO. But if you look at some of the facts, Trump wanted GDP of all these countries to be 2%, which they're either at or getting much closer to. He also fortified some eastern flank countries. But the rhetoric sometimes unnerves them, even if some of the actions didn't unnerve them if they were members of the group. And obviously, this is most important for Zelensky. He had told me last week he's not expecting a formal invitation to be into the alliance, but he wants to see that strong commitment from NATO that they're going to be there for basically security guarantees of his country.
But your point, I mean, it's an important one, right? Before Donald Trump was in the White House, these people weren't paying anything for their defense, for what we were doing. And now, I mean, Germany, for example, the biggest economy in Europe, was paying almost nothing into NATO.
Yes, but partially Germany's massive U-turn, was it so much rhetoric from the former president, or was the fact that there was a war now on their soil? I would say it was probably the latter.
Anne-Marie, we thank you so much for being here. Day 2 of Bloomberg Open Interest. That is, of course, Anne-Marie Hordern, host of Bloomberg Surveillance. And coming up next, Pershing Square starts its roadshow for what could be the largest fund of its kind in the country. That and more on our Wall Street beat up next. This is Bloomberg.
It's been 10 minutes time now at the top of the hour. The Fed's Powell semi-annual testimony to the Senate Banking Committee is due to start. So the live video is pinned to Fed's Powell's entry in the calendar for anybody interested. Keep in mind at the same time, US Treasury Secretary Yellen will be testifying to the US House as well.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Welcome back to Bloomberg Open Interest. Let's take a check on the stock market right now. You can see the S&P 500 building on that momentum, on its gains. Of course, yesterday was the 35th straight record high. Maybe we'll see lucky number 36 today. Big tech powering the way, up about 0.4% on that NASDAQ 100. And the small caps, they are your biggest loser today. The Russell 2000 currently down about 0.2%, I would say, Shonali.
And Katie, it's time now for the Wall Street Beat. We're going to get to the most talked about stories in finance. First up, an inside look into how Bobby Jane pulled off one of the biggest hedge fund launches earlier this month, of course, in history. There is a most read story here on the Bloomberg terminal by Bloomberg's Hema Parmar, really detailing how he brought people on board here. And of course, this is pretty unprecedented with the scale he's launching at. Of course, in a multi-strategy hedge fund boom that's been waning a little bit, but of course, bringing in still $1 billion from the Abu Dhabi Investment Authority in a more than $5 billion launch.
Yeah, so most hedge funds, I gather from reading Hema's reporting, start small and then grow. Right. And Jane's idea was we're going to do it all at once on the same day, launch multiple strategies across, $3 billion that he's raised.
The pitch he's making here is that you have a hedge fund that is avoiding the costs, the complexities, if it took longer to build.
Right. No, I get the logic there that you're avoiding duplication. Hopefully, maybe this is a cheaper way to do it in the long run. Can we talk a little bit about how much he actually raised? Because $5.2 billion, nothing to sneeze at, but it's not $10 billion.
It's not $10 billion, and he had to do fee cuts to really get there. Of course, this massive charm offensive. Fun fact about Bobby Jane, though, you guys will enjoy. He was really a pioneer here in some of the big strategies in arbitrage we know today, in index options, for example, and index rebalancing. Well, actually, back at Credit Suisse.
Ah, I see. And so he had led this charm offensive, from the breakers in Palm Beach?
Hopefully, maybe we'll perch outside there next, guys. But there's another story I want to talk about.
Another sort of fee-cutting story in a sense, right?
Absolutely. Yeah. And we're going to talk about Pershing Square because it has started its roadshow for the IPO of a U.S. closed-end vehicle. It could be the largest fund of its kind here in the United States. And to Matt's point here, it is something that also provides investors here with a lower-cost alternative, doesn't it, Katie?
Yeah, absolutely. So this U.S. structure, it would have a 2% management fee. He actually has a closed-end fund that's listed in Europe. That one charges a 1.5% annual management fee, as well as a 16% performance fee, which might go a long way to explaining why it trades at that discount. Because it's a closed-end fund, it's at a 22% discount. It's going to be really fascinating to see how this one actually trades with that lower fee. Maybe it won't see quite the dramatic discount that we see in the European version.
But it's interesting how massive his aspirations are. I mean, I know Bobby Jane wanted to go 10 and he only got basically to 5 and change, but Ackman wants to go 25 billion in a closed-end fund. And you showed me a story this morning that reported about all the U.S. closed-end funds only being worth 250 billion. So he wants to raise one that's a 10th of the entire U.S. business.
Absolutely fascinating. And to Katie's point a little earlier to us, this is more than double of the size of the fund that's already listed abroad. Remember, this is all part of a grander plan that Bill Ackman has to eventually take his hedge fund firm public.
It's, of course, $25 billion. That would be enormous. We'll see if he can get there. But $10 billion in the Europe vehicle is pretty impressive. This is something I've talked about at length with Matt Levine, for example. You think about sort of Ackman's name brand in the U.S. and the fact that this will also appeal to retail investors as well. You think about Ackman's social media presence, and I don't know, we'll see if it gets to $25 billion, but he does have more of a brand when it comes to the U.S.
So in 5 minutes' time now at 10 a.m. Eastern Time, Fed Powell's semi-annual testimony to the Senate Banking Committee is due to start. The text is expected for this. We're expecting it now to come out at 10 a.m. Eastern Time at the start of the testimony.
Like 20 banks are helping him raise it. I mean,
Keep in mind at the same time, U.S. Treasury Secretary Yellen also testifying to the U.S. House as well on global financial systems.
Weinstein has waged somewhat of a campaign against some closed-end funds that have underperformed.
Not his Europe vehicle, mostly just BlackRock.
Which is also at a discount, as you point out.
Yeah.
All right, really interesting stuff indeed. Let's get to the trading diary right now, what you need to be watching this week. Obviously, today, you're going to want to stick with us here on Bloomberg Television. Watch Fed Chair Powell delivering his semi-annual testimony on Capitol Hill. That kicks off at the top of the hour. Plus, later, we'll hear from Michelle Bowman from the Fed, and she has made some very interesting comments, I think, about immigration and its effect on the labor market. On Thursday, we're going to get CPI. That's after the 2 days of Humphrey Hawkins, because Powell speaks in front of the Senate tomorrow. On Friday, we get a kickoff of earnings season. From the banks, JP Morgan, Wells Fargo, and Citi will all show us what they got in Q2. Coming up in the next hour, Constance Hunter, Macro Policy Perspectives Senior Advisor, joins us as we hear from Fed Chair Jay Powell. She'll help us preview the testimony. This is Bloomberg.
Archer's laid plenty of groundwork for future revenue, but for now, Mark Messler's most pressing challenge as CFO is conserving capital.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, and but we also have to be nimble around that as well because things change by the day.
Archer went public in 2021 in a reverse merger with a SPAC, Ken Moelis's Atlas Crest Investments. Through August 2023, the company raised over $1 billion from investors including Stellantis, Boeing, United Airlines, and Cathie Wood's ARK Investment Management.
Does that ARK investment open doors for you to bring in different kinds of institutional money going forward?
It does. I mean, I think there's a lot of credibility that comes in with an investor like ARK. As I think about, my top targeted list of investors over the next 2 to 3 years, an investment like that gives us some credibility and gives us a little bit of staying power as I go in and talk to other investors.
With the SPAC pipe now closed, Archer's facing a new phase of
1 minute
raising
remaining.
capital.
I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. I'm wanting to show them progress. I want to create credibility with them that we are marching towards our goals of commercialization.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
10 seconds.
We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Basak.
So seeing these comments come through from Fed's Powell says restrictive rates are helping to balance demand and supply. Easing too soon and too much could harm inflation's progress. Recent inflation data shows modest progress to 2% inflation. So it says inflation has eased notably but remains above the 2% goal. GDP growth appears to have moderated in the first half of this year. Easing too little and too late could unduly weaken the economy. So Fed's Powell says that more good data would boost confidence on inflation. Inflation is not the only risk we face, and the labor market is strong but not overheated.
Can I just point out, I know, ever since Pharaoh landed on these American shores of ours, we have stopped showing the Dow Jones Industrial Average. The kids don't like it.
It's just 30 stocks.
Right? But it's down as the S&P and the NASDAQ are up. And
The panel also comments that the first quarter data did not support the greater confidence in the inflation path needed to cut rates.
You could make the argument to look at the sort of the real economy of some old economy stocks in there, but I don't know. I'd rather look at the small caps index.
All right. Well, or the S&P, right, or the NASDAQ. But we've been to 40,000, and we're now back down to 39.
And add a policy rate cut not appropriate until Fed gains greater confidence in inflation, heading sustainably to target.
Now Chairman Powell prepares to testify. Bloomberg's Mike McKee joins us with the top headlines.
Well, basically, it's short and pretty much as expected in terms of his prepared remarks remarks. You've pretty much heard it all before. The economy is solid, as is the labor market. Quote, in the labor market, a broad set of indicators suggest that conditions have returned to about where they stood on the eve of the pandemic. Strong, but not overheated. Nominal wage growth has eased over the past year. Inflation has eased but remains above their 2% target, Powell says, which they are committed to reaching. The most recent inflation readings have shown some modest further progress, and more good data would strengthen our confidence inflation is moving sustainably toward 2%. We continue to make decisions meeting by meeting. So no guidance in the opening statement on rate cut timing. The usual warning that cutting too soon would be as bad as cutting too late. And he does say that inflation is not the only problem out there, referring to unemployment as well. Nothing on bank regulation. Sorry, Shanali. That should be a topic of a lot of questions. Nothing on taxes, tariffs, or fiscal policy, but one pointed Fed comment on independence. Congress has entrusted the Federal Reserve with the operational independence that is needed to take a longer-term perspective in the pursuit of our dual mandate of maximum employment.
Dollar index edging higher after comments from Powell. The S&P 500 slightly higher, if not unchanged, on Powell's text here.
The questioning as well as the bank regulation stuff that he did not refer to in today's opening statement.
Bloomberg's Michael McKee sticking with us. Thanks for that nod to bank regulation, by the way. I'm sure he will be asked about it a whole lot. And joining the conversation here is Constance Hunter, Macro Policy Perspective Senior Advisor. And you look
Treasury
at the
steady
initial
after
move of the
Powell's
bond
comments
market,
as well.
Just a drop lower in yields and a pull higher once again. And you have a moment here where still, of course, the data is not quite enough. Constance, what are you looking to hear today?
Well, it's not so much what I'm looking to hear. I think he's going to be very disciplined in his remarks. But in that discipline comes information, right? The fact that he's saying we're looking meeting to meeting means that it leaves the door open to September, which is really important. And the fact that the labor market is balanced right now with this level of restrictive rates suggests that it is unlikely to remain so. Equilibrium is a mythical beast, right? We talk about equilibrium in economics all the time, but it doesn't really ever exist at any point in time. It's always shifting and changing. So with rates as restrictive as they are, we're already starting to see cracks in the labor market, and it's very likely those cracks will continue. At the same time, inflation is making steady progress. We're going to get more data later this week, and we think that the combination of those two things will allow the Fed to cut in September.
And even still, I mean, you take a look at some of these headlines that just came out, and I know I'm cherry picking to a degree here, but let's read a few of them. Powell says that basically easing too soon, too much could harm inflation progress, that inflation has eased, quote, notably, but remains above the 2% goal, and also that restrictive rates are helping to balance demand and supply. And Constance, I'm reading through that. This doesn't sound like a Fed chair that's about to cut rates at the end of this month, for example.
No, not at the end of this month is unlikely unless we get a crazy surprise on Thursday. But even then, they're not going to look at just 1 month's data. With that said, rates are restrictive. Cutting slowly and gradually means rates will remain restrictive. And if we look at where rates were coming into the pandemic with this level of labor market, we had much lower rates, right? So it all argues for the fact that rates don't belong at this level of restrictiveness anymore. And if you look around the world at what central bankers say, right, a lot of them are talking about inflation getting to their target within the next year, yet they've already started cutting rates. So this idea that they would begin to cut prior to inflation reaching the 2% target as it's on its way there is consistent with how central banks operate globally.
Constance, I want to say first off, thank you so much for joining us on the first week of our show, Bloomberg Open Interest. I've learned so much from you throughout the years, so I definitely wanted to have you a part of the mix. In terms of rates being restrictive, at the top of the program, I showed a chart of financial conditions as measured by the Bloomberg. You can type FConGo to see that. And they look very loose, right? We're probably going to make a 36th record high on the S&P 500 today. That would, give me more power to spend as well if I'm a consumer invested, and if I'm getting any kind of interest income on my bond portfolio, that's just getting fatter and fatter as the Fed raises rates. So how restrictive are these rates really?
So the key thing in what you said is if I'm a consumer invested, right? So we have to look at how broad-based are people's allocation to equities. Are they accessible, right? Are they in 401ks or IRAs, or are they in liquid, non-taxable accounts, right? So yes, people are getting more interest, and that's great. If they've moved some money into money markets, they're getting more interest. But, you know, we look at a broad swath of Americans who don't have as much access to credit. We see increasing auto delinquencies, really back to levels that we were approaching at the beginning of the global financial crisis. We don't see delinquencies in other areas, but I think that there's some concern. We're going to get bank earnings later this week and into the rest of the month, and we'll see some visibility with regard to how banks are seeing credit conditions of their customers. So while for Wall Street and corporates, large corporates, yes, we have pretty easy financial conditions. If you look at
dollar hitting session highs now against the Japanese yen following Powell's comments, up at 161.30.
Income, they are not seeing easier financial conditions.
This is Mike McKee. I'm wondering whether or not there is enough evidence for the Fed to get worried about the economy at this point, as opposed to just looking at inflation or the unemployment rate. A lot of the bears on Wall Street are saying the economy is slowing down because, as you pointed out, Constance, the policy is restrictive right now.
Yeah, that's an excellent question. I think I think we're starting to see some cracks. I think the Fed does not want to be anticipatory, right? They want to see the expression whites of the eyes. They want to see the whites of the eyes of the recession, perhaps, before they start cutting. On the other hand, if they wait that long, it's going to be too late. Ergo, the SOM rule, which, we're getting pretty close with regard to triggering the SOM rule. Now, Claudia herself has said that, like so many other indicators that broke during the pandemic, she's not sure that the rule will hold this time, and so there does need to be a bit of humility and caution there, but there are signs outside of the labor market. As I mentioned, the higher delinquencies on credit card loans. We're seeing obviously some cracks in real estate, right? If you look at the concessions that builders are giving for new homes and the rate lock buy downs, you're looking at pretty significant discounts in housing prices. Obviously, we know there's significant cracks within commercial real estate. None of that has led to significant contagion yet, but these are signs that there are cracks within the economy the Fed should pay attention to.
Speaking of, Constance, I don't know everybody at this desk wants to ask you the same question about the yield curve, so I'm just going to do it. Carlisle this morning came out.
I lost you.
Can you hear me, Constance?
Now I can hear you, sorry.
So Carlisle this morning had said that last week marks 2 years since the most reliable of recession indicators, the Treasury yield curve, flashed red. And it's the market's way of expressing the view that current monetary policy is too tight. What is the yield curve telling you?
Yeah, so, look, that indicator is one of the indicators that looks like it broke during the pandemic, in part because we had so much fiscal stimulus that created a lot of extra liquidity, and people didn't necessarily need that much liquidity from the banking system. But we know from the senior loan officer survey, right, that credit is still tight at banks. Banks are holding extra liquidity on their balance sheets because of the inverted yield curve and losses they've taken in their portfolios. And so it certainly impacts the economy. And one of the things that we had been thinking at the beginning of the year was that the Fed would be able to have data in hand about inflation that would allow them to cut enough for the yield curve to become positively sloping. And to me, this is the big question about where we are. If the Fed cuts because inflation is slowing enough, then they have the chance of being ahead of the curve. If they wait until the unemployment data or other economic data is significantly worse to start cutting, then they risk not being able to uninvert the yield curve, right? If they're ahead of the curve, we could see long rates stay about where they are or inch up a little bit, and the Fed cuts into that, we get a positive sloping yield curve. if the conditions worsen and the Fed cuts into that, we risk not having a positive sloping yield curve.
Constance, can I ask the obvious question, which is the yield curve broken as a recession indicator? Because you think about when we first inverted, it was quite a long time ago.
Yeah, it seems like it's certainly injured. Maybe it's not fully broken, maybe sprained. It is not proving as reliable. But again, that doesn't mean it won't prove reliable in the future. We just have so many reverberations from the pandemic still impacting the data and impacting reliable indicators, or once reliable indicators, like the yield curve.
In terms of the Fed's independence, Mike mentioned the statements from Powell, and a lot of people now have betting odds higher that Trump wins the White House. How does Jerome Powell react to something like that, or does he at all, Constance?
Well, he was asked about this last week at Sintra, and Powell really excels at navigating these types of choppy waters. He's very steadfast, of course, to Fed independence. And he will just keep hammering that home. And I think it was very telling that in his remarks today, he said it really matters on what happens on Capitol Hill. And that's where the mandate comes from. And that's where I think he is betting that the mandate will remain.
So he's betting that the mandate will remain. But if he doesn't remain, how does the market react to that?
Yeah, well, I mean, if Trump were to remove the Fed chair and put in someone who was seen as perhaps more malleable, I think the market would send an immediate message, right? The bond vigilantes are always at the corners waiting to take control, right? And as Bill Gross said, I want to come back as the bond market in my next life, right? So you don't go up against the bond market and win.
So, Constance, more on political issues here, because if you have a situation where the market is expecting, say, a cut, let's say September, then what do you have in terms of next year's issues? Because if you look past November and if you had a change in administration and then you do have a set of tariffs that are put on a range of goods, then do you worry about that inflationary pressure once again? How does the Fed navigate that?
Yeah, I mean, I feel like I'm having deja vu all over again, or as my friend Diane Swank says, it's Groundhog Day. I remember in 2016 being asked to write a paper on the border adjustment tax and delving deep into tax policy and the implications. And of course, at the end, they realized that that was untenable because it wouldn't achieve their goals because the currency markets would have adjusted. And so that tax regime was never put in place. I think it's a bit premature to start gaming out what will happen once if the leadership changes, if Trump is elected. There are so many things that can change between now and a time that he's in office and has a cabinet in place that I think it's sort of, I mean, gaming this out is important, but spending too much time on things that may not even come to pass also is maybe not the best use of time.
Well, Constance, when it comes to sort of the political risk, when it comes to Fed policy, of course, as Matt mentioned earlier, we had Peter Cheer saying on Bloomberg Air that he expects the Fed to cut in July, basically to get ahead of the election, so close to the election. But would a 25 basis point cut in September really sway the election at all? What is the actual impact there when it comes to Fed policy, maybe a cut a month before or to the election?
Yeah, I think it's unlikely if they started cutting in September that it would sway the election. Also, this is such a difficult thing to game out, right? We're not in the heads of the FOMC members. We're not in Powell's head, but certainly he said that political considerations don't come up at all. And if you go back and you look at the minutes, you see it's not discussed. They really are focused on what is the economic situation and what are the financial conditions that are needed given the current economic situation.
Constance, do you expect Powell to make any comments on fiscal spending, because it's working at cross purposes with his monetary policy, right? I mean, as he raises rates, we get the CHIPS Act spending billions, the Infrastructure Act spending billions, trillions, the Inflation Reduction Act, which ironically maybe boosts inflation. So, you know, and this spending isn't expected to change regardless of who comes into the White House, right? Drunken sailor, the term drunken sailor has been thrown around a lot in regards to the federal government spending. Is he going to say anything about that to Congress, or does he keep mum?
Well, I think he won't say much. He will try to avoid saying as much as he can. And as I said, he's very adept at towing the line there. However, I don't know that all of this spending is inflationary. It is part of the reason that we've had such a hot labor market and almost a reverse hysteresis that is allowing us to have a productivity surge. And it seems like that productivity surge is going to continue. And so a productivity surge actually makes the Fed's job much easier. So if we go back to the period from 1995 to 1998, when we had a similar productivity surge, the Fed was able to keep rates steady while the economy grew faster and inflation continued to fall. So in so much as much of this spending is targeted in ways that promote productivity enhancement, I think that it's not clear it makes the Fed's job more difficult.
Hey, I want to bring in McKee for a minute here again, too, because the reality, too, is we have CPI data around the corner as well. And when you take Powell's statements today compounded by that next data point, as he's looking for more data, what are you looking at?
Well, I think you're looking at a cautious Fed chair who doesn't want to get out over his skis, walk to the end of the plank, and might fall off if something comes in weird for CPI. So there's not a lot of incentive for Powell to be very specific today, which kind of tells you something in the sense that if the Fed is thinking about moving at the next meeting, whenever the next meeting is, they're going to want to start hinting at that. They're going to want to price the markets for it so that the markets aren't surprised. So if we get through today and he doesn't say anything about we're thinking about this right now, then you can pretty much write off July, which most of the market's done to this point. And then the focus will turn to what does he say next week when he speaks? Does that set up September? Or what do they say when they get into August or Jackson Hole?
All right, let's take a quick check on these markets. Of course, we are waiting for Fed Chair Jerome Powell to come out. In the meantime, you take a look at the S&P 500. It's really building on those gains. Again, hanging out about 0.2% higher. This slow
So looking out at the Fear and Greed Index, 54 out of 100, which indicates neutral, while the Crypto Fear and Greed Index is 27 out of 100, which indicates fear. We're keeping an eye on the VIX as well in the wake of Powell speaking. A little changed after the release of that text, up spot 4% at 12.4 points.
The 10-year Treasury yield is what we're looking at. We're camped out rated about 430, I would say, currently higher by about 2 basis points. And Constance, I want to ask you, where on the curve should we be looking when we're trying to get a sense of where the markets are pricing in the Fed? Because classically, you would take a look at the 2-year yield, but we actually had Torsten Slok argue in a note this morning that it's the 10-year that has been moving around with Fed expectations.
Yeah, he's correct about that. The 10-year's been moving around quite a bit, but I wouldn't exclusively look at the 10-year. I would still look at sort of that belly of the curve, the 2 to 5 year, to see what's happening. And so you're going to need to look at both of those ends of the curve. The 10-year is also moving around in part because of political risk that we see not just in the U.S. but around the world, right? So the 10-year has some noise in it, so you want to look at that plus, I think, the 2-year.
I want to just point out we're still looking at Congressman talking, making statements ahead of Powell's testimony. Sherrod Brown was telling Powell that he doesn't work for the big banks, he works for the American people. And now it looks like Powell is going to start to respond. Let's listen in.
Semi-annual monetary policy report. The Federal Reserve remains squarely focused on our dual mandate to promote maximum employment and stable prices for the benefit of the American people. Over the past 2 years, the economy has made considerable progress toward the Fed's 2% inflation goal, and labor market conditions have cooled while remaining strong. Reflecting these developments, the risks to achieving our employment and inflation goals are coming into better balance. I will review the current economic situation before turning to monetary policy. Recent indicators suggest that the U.S. economy continues to expand at a solid pace. Gross domestic product growth appears to have moderated in the first half of this year, following impressive strength in the second half of last year. Private domestic demand remains robust, however, with slower but still solid increases in consumer spending. We have also seen moderate growth in capital spending and a pickup in residential investment so far this year. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In the labor market, a broad set of indicators suggests that conditions have returned to about where they stood on the eve of the pandemic, strong but not overheated. The unemployment rate has moved higher, but was still at a low level of 4.1% in June. Payroll gains averaged 222,000 per month in the first half of the year. Strong job creation over the past couple of years has been accompanied by an increase in the supply of workers, reflecting increases in labor force participation among individuals aged 25 to 54, so-called workers in their prime working years, and a strong pace of immigration. As a result, the jobs-to-workers gap is well down from its peak and now stands just a bit above its 2019 pre-pandemic level. Nominal wage growth has eased over the past year. The strong labor market has helped narrow long-standing disparities in employment and earnings across demographic groups. Inflation has eased notably over the past couple of years, but remains above the Federal Open Market Committee's longer-run goal of 2%. Total personal consumption expenditures prices rose 2.6% over the 12 months ending in May. Core PCE prices, which exclude the volatile food and energy categories, also increased 2.6%. After a lack of progress toward our 2% inflation objective in the early part of this year, the most recent monthly readings have shown modest further progress. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. In support of these goals, the committee has maintained the target range for the federal funds rate at 5.25% to 5.5% since last July, after having tightened the stance of monetary policy significantly over the previous year and a half. We've also continued to reduce our securities holdings. At our May meeting, we decided to slow the pace of balance sheet runoff starting in June, consistent with the plans released previously. A restrictive monetary policy stance is helping to bring demand and supply conditions into better balance and to put downward pressure on inflation. The committee has stated that we do not expect it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. Incoming data for the first quarter of this year did not support such greater confidence. The most recent inflation readings, however, have shown some modest further progress, and more good data would strengthen our confidence that inflation is moving sustainably toward 2%. We continue to make decisions meeting by meeting. We know that reducing policy restraint too soon or too much could stall or even reverse the progress that we've seen on inflation. At the same time, in light of the progress we've made both in lowering inflation and in cooling the labor market over the past 2 years, elevated inflation is not the only risk we face. Reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering adjustments to the target range for the federal funds rate, the committee will continue its practice of carefully assessing incoming data and their implications for the evolving outlook, the balance of risks, and the appropriate path of monetary policy. Congress has entrusted the Federal Reserve with operational independence that is needed to take a longer-term perspective in the pursuit of our dual mandate of maximum employment and stable prices. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to achieving maximum employment and stable prices over the long run. Our success in delivering on those goals matters to all Americans. I'll conclude by emphasizing that we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. thank you. I look forward to your questions.
Thank you, Mr. Chair. And the senior member of the committee will begin the questioning. Senator Reid.
Thank you very much, Mr. Chairman. Former President Trump has indicated that he would propose, if elected, a substantial increase in tariffs of between 10 and 60%, and by doing thus, eliminate the federal income tax. First, on the question of what would be the impact of tariff increases on prices, consumers, and the economy?
Thank you, Senator Reid. So I'm going to say that we go very far out of our way not to comment on campaign-type information. We just don't do that. We also don't comment on trade policy. We have really specific and important jobs, and we try to stick to those.
Well, I'm glad I allowed you to establish that principle up front, Mr. Chairman. But let me opine a bit. 10% increases in tariffs is going to have an effect on prices in the shop aisle. It's going to increase them because they'll be passed on likely. 60% tariff increases are significant. And in fact, I've been told that to replace the income tax, you would have to raise tariffs across the board 70% to make up for the loss of the income tax, which would, I think, create huge economic problems. I respect your impartiality and your neutrality, but the numbers don't seem to add up to anything that would help the country. Let me switch to something else that might be more within your line of response. You said in your opening statement that the labor markets appear to be in a better balance. And that's one of the key factors to judge whether interest rates can be raised. I must say I'm concerned a bit that we're not on a very faster track to decreasing interest rates from the Fed, and because of the better balance you cite. Could you comment on that, Mr. Chairman?
Sure. So the most recent labor market data do send, to your point, a pretty clear signal that labor market conditions have cooled considerably compared to where they were 2 years ago. This is no longer an overheated economy. This is an economy, as I mentioned in my opening remarks, that is more or less back by most measures to where it was before the pandemic. And that was a strong labor market, but it was not an overheated labor market. So I think the upshot of that really
The Fed's power now coming through in the Q&A says most recent labor market data have pretty clear signals about the labor market cooling considerably.
The labor market appears to be fully back in balance. We know that if we move too quickly,
labor market more or less back to pre-pandemic levels.
We risk, unnecessarily hampering economic activity and possibly interfering with the ongoing expansion. We know that if we move too slowly, that we may undo the good we've done. Well, actually, it's the other way. If we loosen policy too late or too little, we could hurt economic activity. If we loosen policy too much or too soon, then we could undermine the progress on inflation. So we're very much balancing those two risks, and that's really the essence of what we're thinking about these days.
But the direction seems to be going towards lowering interest rates at some point, we would hope. That might be a wish rather than a direction.
Well, I think if you look at the last summary of economic projections, I guess I would say it this way. It doesn't seem likely that the next policy move would be a rate increase. We don't take things like that off the table, but that does not seem the likely direction. The likely direction does seem to be as we make more progress in inflation and as the labor market remains strong, we begin to loosen policy at the right moment.
Thank you. Just 2 weeks ago,
Powell says it's not likely the next policy move would be a rate hike.
Every federal regulatory agency, including the Federal Reserve, they overturned the Chevron case, which had eliminated judicial deference to agency decision-making for many, many decades. And they also dramatically extended the statute of limitations under the Administrative Procedure Act. What is your judgment is the cumulative effect of these decisions on the Federal Reserve? More broadly, what does it mean to the economy if virtually any regulatory decision the Fed makes can be second-guessed by a judge? What position are we in now?
So we're as an institution very focused on reading the actual letter.
US Treasury Secretary Yellen now as well says restrictions on investment into China for artificial intelligence are narrowly targeted at clear national security risks, as she speaks to the House Financial Services hearing.
I don't have anything for you on them, but we will, of course, follow the law as the Supreme Court has read it, because that's their job.
Well, thank you, and I concur with compliance with the law, but when you do your analysis, and if it is detrimental to your ability to regulate the banking industry in the United States, I think you have an obligation to make that public. Thank you, Mr. Chairman.
Thank you, Senator Reid. Senator Scott from South Carolina is recognized.
Thank you, Mr. Chairman. Chair Powell, we've heard a steady stream of commentary that there will be changes to Basel III endgame proposal. That can be seen certainly as good news. Some reports say it could be finalized as soon as August. Others say you are circulating a term sheet for a revised proposal. Through it all, this proposal will have outsized impacts on our banking system, from big to regional to our U.S.-based foreign institutions, as well as impeding access to credit for consumers. So even though you yourself have said there will be broad and material changes, I believe this proposal is flawed, both in process and in substance, and should be withdrawn. Do you agree, and will you commit to withdrawing the existing proposal and issuing a new proposal with a robust notice and comment process?
So let me update everyone on the status of all that. So over the past several months, we've had, in fact, Vice Chair for Supervision Barr has held a series of discussions with the other bank regulatory agencies around potential changes to the original proposal. I'm pleased to say that we've made quite a bit of progress on those and are very close to agreeing on the substance of those changes. And I can't really be specific because nothing is agreed until everything's agreed, so I won't have a lot of specifics for you today. The question where we're continuing to try to make progress is that of process. So it is my view, it is the strongly held view of members of the board that we do need to put a revised proposal out for comment for some period. And the reason is, when there are broad and material changes, that has been our practice. We don't see a reason to deviate from that practice. It seems to be consistent with past practice and with the Administrative Procedure Act. So that's very much what we think. And we're working through that question with the FDIC and the OCC. We haven't reached agreement on that, but I'm very hopeful that we will. We're prepared to move forward when we do reach agreement on that.
Well, I appreciate most of your response there. I do want to discuss one aspect more of Basel before we move on to another topic. I find it very concerning with how much of this proposal, this process, appears to have been done behind closed doors. The Fed, the FDIC, OCC proposed Basel III endgame last July. Then in October, the Fed began the collection of data to conduct a quantitative impact study on the cost of Basel III proposal, a study which I will note should have been conducted before any proposal was ever issued. Move forward to January of this year, Vice Chair Barr committed to a public comment period once results of the study were published. We are still waiting to view the results. Keep in mind, all the while, we're hearing rumors that the Fed is working on revising its proposal and moving towards an updated version. Please help me understand, how will the Fed revise or reissue a capital proposal before receiving public comments? Basically my question.
Well, as you know, we have received extensive public comments, and we've also evaluated the quantitative impact survey that you mentioned.
Yes.
And so the idea would be when we do reach agreement with the other agencies fully, that we would publish the proposed changes and also the quantitative impact survey, and also the effects that the QIS suggests that the changes would have. So we'll put all that out for comment again for a period of time, and then having had yet another round of comment, and we can then move toward finalizing. That's basically the broad strokes of how I would see this moving forward.
And how long do you see that opportunity for public comments?
So it would be meaningful. I mean, it might be 60 days. We don't need to it doesn't need to be a long one. But, before we do that, there's a lot of work that needs to take place, before you actually put out the revised proposal, quite a bit of work. So it will take some time, and then we would put it out, and then there would be, I'm just taking that number, 60 days of comment, and then we would get the comments back, and there would be another period of evaluating the comments, and only then would you go final. So there are a number of steps here.
Yeah, thank you. Just final point, as I'm running out of time here. I think Senator Reid made the comment about the Chevron case and the impact that it could have, certainly in curtailing, from my perspective, the regulatory state. The necessity of a cost-benefit analysis on new regulations that will impact the economy, I think, is quite helpful. In the 1,000+ pages of Basel III, I think there were about 20 pages that reflected some kind of cost-benefit analysis approach. I really hope that we see more of that going forward.
Thank you.
Senator Tester from Montana is recognized.
Well, thank you, Mr. Chairman. Thank you for the courtesy. Chairman Powell, good to see you here today. Appreciate your work. Look, regardless of where I go in the state of Montana, housing is a big issue, whether it's Billings or Butte or Bozeman or Busby or Big Sandy, it doesn't matter. Larger towns to medium-sized towns to small towns, housing is a huge issue. And I think it's a huge issue all over the country, and correct me if I'm not correct in that. And I was wondering how the housing challenges fit into the overall economic picture that you're seeing.
So we do pay a lot of attention, and I would agree with you. We have significant housing issues in the country, and we had them before the pandemic. Certainly, the pandemic has created new distortions, and you know, monetary policy works through interest-sensitive spending. There is no more interest-sensitive spending than, you know, buying a house and having a mortgage. So
Fed's Powell says we have significant housing issues in the country.
Is having an effect on economic activity in the housing sector, and you
adding that the pandemic has created new distortions in housing.
For housing is to succeed in getting inflation down to 2% on a sustainable basis, so that rates can come down, so that the housing market can get back to what was the pre-pandemic normal, which is to say, still a housing shortage, but not dealing with the kinds of specific
Adds that our tighter policy is having an effect on activity in the housing sector.
I'm speaking not necessarily from a housing cost interest, and you're correct on the things you just brought up. I'm speaking more from a standpoint of economic growth, in that there are plenty of small businesses, schools, hospitals, Main Street businesses that can't hire people, they can't expand because there simply is no place for them to live. How does that fit into your economic outlook metrics? Because I think it's, from my perspective at least, I think it's limiting the opportunity for expansion, it's limiting the opportunity for entrepreneurs, business startups. And does that fit into the economic picture that you look at?
So our mandate is for stable prices and maximum employment. And again, I think for housing supply, the best thing we can do is get inflation under control so that rates can come back down, so that we can have a more normalized set of rates and a more normalized housing system. But I think policies to increase housing supply are really not so much in the hands of the Fed, they're in the hands of legislatures, you know, state and federal.
Do you believe that if we were to put forth some housing incentives, whatever they may be, that could have if those incentives resulted in more affordable workforce housing on the market, that would have positive impacts on the economy?
You know, these are questions for you, but I would say this, that I'm aware that housing is in short supply, and that for many it's a critical need for the workforce.
Okay.
And so more of it is better, but as to where the fiscal policy how you should prioritize that, that's not up to us.
Look, I want to talk about the independence of the Fed for a second, because I know that you are a strong supporter of independence, as am I, and political influence, I don't think, helps with monetary policy in the country. And so give me your perspective, at least, on why the central bank independence is so critically important.
Thank you. I'd be glad to. So Essentially, all advanced economies have adopted a policy of central bank and operational independence, and that just means that we make our decisions, we're instructed to make them without taking in extraneous factors, one of which would be politics. And the record is pretty clear that that's a good it's a good institutional arrangement that serves the public well. And we just want to stress, as we do periodically, that this is an institutional choice that we make as a country, and that as long as it's seen to serve the public well, it's a good choice. We think so.
Okay, on advanced economies, there's some that talk about the economy of this country not being in very good shape. From your perspective, tell me how the economy of this country is doing compared to other advanced economies that have central banks.
So I'm in lots and lots of international discussions as part of my job, and the story for the last 2 years has been just how exceptional the performance of the U.S. economy has been, and that's not a secret. Clearly the U.S. economy has performed very well compared to sort of our advanced economy colleagues.
Is there any country in the world with a central bank, any advanced economy that's performing better?
Better as a central bank?
Any economy that's an advanced economy that has a central bank that performs better than us?
None comes to mind. As I think of the majors, the answer would be no.
Okay, thank you.
Thanks, Senator Tester. Senator Rounds of South Dakota is recognized.
Thank you, Mr. Chairman. Mr. Chairman, first of all, thanks for coming in again and visiting with us. I just want to focus on two specific items, and I'm going to start with the Basel III endgame discussion. I think Senator Scott did an excellent job of kind of laying out the concerns that many of us have had with it. I would like to go back into just one particular issue, which I think a lot of folks out there that follow this, and I know it's technical in nature, but let me just ask a specific question and you can kind of pick it apart for me, please. Both you and Vice Chair Barr have confirmed that there will be material changes to every risk type outlined in the proposal. Since there will be significant changes, do you believe where the agencies have landed now would be considered a logical outgrowth of the original proposal from last summer?
For those people who are not familiar with, that's the legal test for that turns out to be if it's a logical outgrowth. If it's not a logical outgrowth, that would legally require a reproposal. And I don't want to make the legal judgment. I will just say again, from my standpoint, my view and strongly held view of some of my colleagues on the board is that it will be appropriate for us to put out the changes again for a period of comment, just because it's the right thing to do. It's what we would do typically in a situation where there are material changes to a proposed rule.
Do you feel that you have a consensus in the board to allow that to move forward in terms of an additional comment period?
Yes, but of course we have to get the FDIC and the OCC. We're in discussions with them to work on something that would meet that need, and we have to get their agreement too.
Assuming it sounds like that's the path that you would like to go down.
Yes.
If that were the case, would it be fair to say that we'd probably be looking at final determinations or recommendations for a Basel III endgame proposal probably into next year before it would become anything of a final determination?
I think that may be right. That's something like that could be right. Yeah. I mean, it's hard to be precise. We would put it out. It takes some time to write this stuff up. Then you put it out for comment. Then you get the comments. Then you read the comments. Then you write the final rule. Beginning part of next year is a good guesstimate.
The only reason why I push is because there are so many folks directly involved with this and the impact on our economy here and with a lot of our financial institutions. This is a significant change, and it's one that a lot of people are following. So I'm trying to get you to get into the depth of this as much as possible, and I thank you for that. I'd also want to go into one other area, and once again, this is something that you and I have had visits about in front of this group before, but I want to talk about what the parts of inflation are and what parts
Yellen says that I believe the big inflationary impulses seen in 2022 was global in nature and stemmed from problems after the pandemic. Says many of those problems have been resolved. Wage pressures are easing.
Side of the equation, which is still out there. And I want to just lay this out because as we do this in this setting, it naturally becomes political in nature because one of the starting points that we talk about is when this administration took office and what happens with supply side issues at that time. And as I work my way through this, I just want to share the concern that I've got.
And adds that inflation will continue to come down over time. Rents are keeping it higher than we would like.
About what you can control and what you can't control with regard to making changes on inflation through the processes that you have. When President Biden took office, gasoline prices, since President Biden took office, gasoline prices have risen over 54%. Energy prices have risen 41%. Fuel oil prices have risen 37%. Now, I can go on, but you understand what I'm saying is that energy has increased substantially. And I think one of the reasons for this has been additional demand as we've come out of a pandemic. But the other part of this has been whether or not investors really want to go back in and invest in traditional energy resources after the president made the specific determination to cancel the Keystone XL pipeline on the day that he stepped into office. When he did that, he sent one heck of a message to investors about traditional energy and investing in traditional energy in the United States, and the fact that a multi-billion-dollar contract or contract could be canceled with the stroke of a pen. Now, my question to you is, what percent, or has there been a discussion about what percent or what amount of the inflation that we've seen, over 20% increase in terms of affordability for a lot of our products, how much of that is attributable to the demand side and how much of it really is attributable to supply side challenges?
U.S. Treasury Secretary Yellen adds that I see less inflationary pressures from the labor market.
Thought about a lot, and any attempt to reduce that to a precise number would be inappropriate because it's so uncertain. But I think we can say, I believe strongly, there's a significant demand element and there's a significant supply element. And we've seen the supply side heal so much over the course of the last year or so, and we clearly see that that's contributing to lower inflation. We also see cooling demand, for example, in the labor market. So the two forces are working together. I can't really break it down. It would be such an imprecise estimate.
Just simply an acknowledgement, though, that it is both demand.
It's both. It's definitely
and
both.
It is supply.
It is both. Yeah.
For
sure.
Thank you, Mr. Chairman. My time has expired.
Chair Powell, unemployment
Powell just comments that
point over the past year.
Powell commenting you can't break down inflation into supply and demand elements.
50%, the hiring and quit rates are now below pre-pandemic levels. I'm concerned that if the Fed waits too long to lower rates, the Fed could undo the progress we've made on creating good paying jobs. Full employment is part of the mandate, as you say over and over. How are you assessing the risks of higher interest rates in the labor market?
So I completely agree with your characterization. The latest data do show that we've had considerable cooling in the labor market, and we're very much aware that we have two-sided risks now, as I mentioned earlier, and we're determined to balance those as best we can. We want to see more good inflation data, and we also want to continue to see a strong labor market. And those two things are equal under the law. We have this challenging thing to balance them, but we're very much conscious that that is our job, and we're trying to do that.
Well, and you know that if unemployment trends upward, you must act immediately to protect Americans' jobs. Workers have too much to lose if the Fed overshoots inflation target and causes a completely unnecessary recession. We will say that over and over and over again. I think you understand that. Housing, higher interest rates are making housing more unaffordable. Higher rates are supposed to lower cost, yet housing prices continue to soar. By keeping rates high, the Fed ignores the economic reality of the millions of Americans struggling to make ends meet and get ahead. Let me ask you three quick yes or no questions, if you would answer that way. Since late 2022, when the Fed began raising rates, has the volume of housing sales decreased?
I believe it has, yes.
Since late 2022, has the median home price increased?
I believe it has.
Since late 2022, have monthly mortgage payments become more affordable or less affordable for home buyers?
Less affordable.
Okay, thank you.
U.S. Treasury Secretary Yellen adds that Trump tax cuts are costly and regressive.
Single-family home has increased by nearly $20,000. People are spending a greater share of their income in mortgage payments. So in some higher rates, it's clear from your answers and data, it's clear higher rates are not bringing down housing costs. The cost of home ownership is only going up. Let me shift to the Synapse bankruptcy. Since mid-May, tens of thousands of people, including many Ohioans, have lost access to their money due to the bankruptcy of this fintech middleman. Reports indicate that as much as $95 million may have gone missing. The Fed oversees one of Synapse's former partner banks, Evolve Bank and Trust. As a regulator, it's your job to make sure that banks protect the people whom they serve. What's the Fed doing to help customers who felt the impact by the Synapse collapse? What are you doing to regain access to their money?
So we do supervise the bank. We don't supervise Synapse, or let alone the fintechs that feed into Synapse. And we're strongly encouraging Evolve to do whatever it can to help make money available to those depositors. We also, as you may know, did an enforcement action against, before this all happened, we did an inspection, or looked at Evolve, and we hit them with an enforcement action around these very risk management issues, again, before the current situation developed.
Okay, it's critical that consumers are made whole as soon as possible. We will continue to talk to you about that. We will watch. We will let you know we're watching. The Fed needs to use its supervisory authority to ensure that Evolve is committing the resources necessary to return those funds to the account holders. Last comment, I want to note one last thing. Last year's Fed report on the failure of Silicon Valley Bank noted how incentive-based compensation encouraged excessive risk-taking that led to the bank's failure. You either watched or had reports of when those bank CEOs testified in front of this committee. The report, the incentive-based compensation that led to the bank's failure, I mentioned, it said that SVB managers, quote, had a financial incentive to focus on short-term profit over sound risk management. That's what a number of us, Senator Smith, Senator Butler, Senator Warner and I have said over and over, that short-term profit over sound risk management causes significant problems to our financial system. Compensation practices still pose a threat to our banking system. I urge you to move quickly to join your colleagues in the long overdue rulemaking on executive compensation. I mean, you know, you read the reports at the outrage of the public about executive compensation continuing to go up and up and up and up. You have a role, a significant role, a legal role to deal with that. Thank you. Senator Tillis is recognized.
Thank you, Mr. Chairman. Thank you for being here. I want to be real quick on Basel III Endgame, and I want to be mindful of time. Just simply, can I get a commitment from you on releasing the results of the QIS?
Yeah, we plan to release the results of the QIS.
What time frame?
Well, first we have to get agreement with the other banking agencies, but as soon as possible.
Can you imagine any agencies having a concern with any other banking agencies having a concern with releasing it, or is it just a matter of pro forma? Okay.
No, it's just a matter of the bigger picture of getting agreement on the revisions to Basel III and also how to proceed.
That's great, and I really appreciate the feedback that I've received from you. I should have started by thanking you again for your continued accessibility and discussions outside of the committee. They're very productive, and I appreciate that and your leadership at the Fed. I grew up in the 70s. Got my Social Security number in 1973 when I was 12 years old. That's when I made my first payment. So I've been following the economy even as a youngster. And that was a really lousy time to enter in the workforce. Tell me, and I'm hearing discussions among some of our members now that would almost be reminiscent of discussions with prior Fed members saying, look, we got to lower interest rates and we've got unemployment out of control. So it sounds like we're taking some suggestions from some of my colleagues or plays from a playbook that didn't prove to be very effective back in the 70s. What can we learn? I'm not going to ask you about where you go from here, but if we look back into a postmortem on some of the decisions that were made when we had consistently high inflation, we had consistently high unemployment, what lessons can we learn there, or what mistakes should we not necessarily repeat? And I know that this is a fingerprint of a challenge. It's not exactly like the stressors that we had back in the 70s, but what can we learn from the decisions, what I think are arguably the wrong decisions made back then when we were dealing with high unemployment and high inflation? What did we learn?
I think the number one thing we learned was that it's up to the central bank to take it on and stick with it until it's done. And that doesn't sound controversial now, but it actually was back then. And so people didn't really get in there and get it done, and inflation kept coming back. I also think there are significant differences this time to the questions a minute ago. This is a combination of a supply side that we had very significant supply shocks, along with big demand shocks from the reopening of the economy and from all the other things that happened. So I think we have to, each one of these things is different in its own way. We try to learn the lessons of history, though.
You agree or disagree? Any disconnect between inflation and inflation expectations from the 2% target should be addressed now and not at a later time?
Absolutely.
I like that answer. I want to go to something different. I'm trying to go into a lightning round now and finish on time. We've seen the 2024 stress test results for the U.S. banking system. It looks like to me, by every objective measure, we've got a banking system that's on strong financial footing. Do you agree?
Yes.
One last thing, as the Fed considers making broad and material changes to the Basel III proposal, back on that one, can I urge you not to overlook the second-order issues important to FBOs and certain regionals to ensure that the banks are not unduly influenced? If the current proposal, for example, the outsized operational risk costs were high, are we going to take care of that in any sort of reproposal?
Let me just say we're very conscious of the comments across the spectrum: foreign banks, domestic banks, small, medium-sized banks. You know, everyone's going to get heard carefully as part of this process. That is our obligation.
Okay. And I think in response to Senator Round's question, you did indicate there's probably, because of the nature of the likely changes from what Mr. Barr expected to what may ultimately come, we are going to open it up to comment again.
That's the strong view of the Federal Reserve. We're working on that question with the FDIC and the OCC to try to find a path to do that. But
Very good.
From our standpoint, that's essential.
I think it's a strong view from at least several members on this side of the dais here. That would be very, very important, because I think it's going to materially change. Thank you, Mr. Chair.
Thanks, Senator Tillis. Senator Warner of Virginia is recognized.
Thank you, Mr. Chairman. Chairman Powell, it's good to see you again, coming this late in the questioning. I'm going to at least hit a couple of the items that my colleagues have otherwise already hit, because I make sure it's noted that I raised them as well. First of all, I want to agree with the chairman. You know, I probably hear more on housing and housing affordability than any other issue, and I agree with the chairman. I know we've discussed this around a rate cut, and I understand most of your answer, but I still want to add my 2 cents here. We've got to find a way to start bringing mortgage rates down and let people get unlock that housing market. And again, we've discussed the rate cut issue, and I know you've got to navigate that, but I hope it's sooner than later. I will not recap what I've done in the last couple hearings with you, but I do think the discount window proposal that I've gotten, that I know you're working on, you know, before we think about additional regulations, and we do need in some cases. I think the discount window is an underused tool, was one of the original tools for the Fed. A lot of my colleagues have talked about quantitative easing, Basel III endgame. I do hope when we get the revisions that we'll see the quantitative analysis that, again, Senator Tillis already raised and other colleagues have raised. I also hope that one of the questions I raised in my March letter to you was, you know, making sure any new regulatory structure, how it intersects with existing regulatory structure in terms of market risk, credit risk. And I, again, hope that we will have that as the revisions come out. I think one of the things that this debate around Basel III raised was that it is, my understanding at least, looked at, you may be all looking at revisions to liquidity standards as well, and wanted to see what you could say about that and whether that part of
The US had to sell $90 billion in four-week bills on July 11th, settling on July 16th.
That actually connects to the Silicon Valley Bank questions as well. Where
So Treasury boosting the size of the 4- and 8-week bills by another $5 billion.
Assumptions about liquidity. And that's a separate proposal that we're also working on. And, you know, very important. I think we saw how fast that run was. It was just exponentially faster than prior runs. That's the new world, and you know, that's some estimate of what that world is baked into things like the liquidity coverage ratio, for example.
Right, and wasn't that the case? You know, if you had 25 cents on every depository dollar leave in 6 hours, no matter what the capital standards are.
Yeah.
And one of the things, I guess, you know, there was a lot of talk after SVB that we need to think about internet-driven runs. A lot of us raised concerns. Candidly, I'm not sure I've heard any good proposals. So whether it comes from you guys or from folks listening, how we think about this new internet-driven world. And frankly, I think some of the irresponsible behavior by some of the folks that were major depositors in SVB who in many ways shouted fire in the crowded theater, and we've not seen any action there. So I would welcome additional ideas as well. And that kind of brings me to my last questions around supervisory reform. I know the GAO criticized the Fed's supervisory procedures in the role they played in the 2023 failures. It is a whole brand new world. Are we going to look at, will your changes to supervisory standards be comprehensive? Will they be one-off? How do you think about that in light of the GAO report, and also in light of just the SVB and the few of the other failures we saw last year?
Vice Chair Barr is, who's Vice Chair for Supervision, is leading a process of looking at the way we supervise banks and thinking about how we can be faster where it's appropriate, more forceful where it's appropriate. And I think, you know, they've taken a pretty deep dive and tried to learn these lessons and then implement them in a way that is appropriate. So that's a big project going on at the Fed right now, which really Vice Chair for Supervision leads.
I think I remember lots of conversations with the chairman, with you, with the FDIC, and that Thursday through Sunday. And I think the solution you guys came up with, the administration came up with by Sunday night was a good one, but they were a pretty scary 3 or 4 days there. And it did seem like the process, I don't know completely how you get fully ahead of that, but I firmly believe that there should have been a clearer early warning system and trying to make sure that we wouldn't be in that kind of crisis situation going forward. And again, I would strongly encourage any additional thoughts on this technology risk and how we get that right. Thank you, Mr. Chairman.
Thank you, Senator Warner. Senator Kennedy of Louisiana is recognized.
Thank you, Mr. Chairman. Mr. Chairman, our economy is slowing, is it not?
Yes, although still growing at a solid pace.
Our unemployment rate is rising, is it not?
Yes, it is, although the labor market is still strong.
Our labor market is slowing, is it not?
Yes, but I'd say unemployment is still, you know, is still low by historical standards. But yes, it is. We've seen cooling. Yes.
Mm-hmm. And I was looking at the recent jobs numbers. I know you've glanced at them too. About 3/4 of the net new jobs that were created in June were in government, healthcare, and social assistance. What does that tell you?
So that's a concentration. You'd rather see broader job creation than that. Those three areas have, in some reports, they've been, as it was this time, they've been the predominant creators of jobs. That tells you that job creation is becoming less broad in the economy and it's narrowing.
It tells you the government's creating those jobs, doesn't it?
Well, it's government. It's also in-person services. It's also some of it's government.
Manufacturing's been flat.
Yes, manufacturing's not creating a lot of new jobs these days.
Information technology shed jobs over the past 2 years, hasn't it?
I don't know.
Leisure and hospitality jobs have slowed almost to trickle.
So that's a place where there was a desperate worker shortage, and they've done quite a bit of hiring, but they're catching up now.
I mean, three quarters of the jobs that are being created in our economy can be related directly or indirectly to our spending deficits, can't
Fed's power says job creation is narrowing in the economy.
In this report, in this single report, I don't know that healthcare is really government spending. I mean, that's something people are
Where do
consuming.
you think these hospitals get their money?
They may get it, but I mean, people are not. The spending on healthcare is not necessarily directly related to deficits. Is my point.
I would disagree with you. I mean, here's my point. We talk a lot about expectations in terms of inflation. How if we expect there to be inflation, we'll get inflation. It seems to me that consumer expectations play a bigger role in the economy than we cede to them. Most of our economy in America is consumer driven, is it not?
Yes.
Unlike, say, China, which is manufacturing driven.
Very much so.
And I listened to you cite the statistics about the economy, but most Americans don't feel good about the economy, do they?
No, and we don't tell people how to feel about the economy.
I mean, isn't it a fact that most people, if you ask them to define Bidenomics, they would say that's easy. We get to pay more to live worse.
I wouldn't touch
you don't want to answer that
a sentence with that word in it.
Yeah. I mean, we can pretty this up all I guess my point is, and I know you're going to do this anyway, but I'd be really careful with this economy. I mean, people just don't feel better off today. And one can marshal a persuasive argument that, well, you should, compared to Europe or compared to China, compared to Canada. But feelings are feelings. People don't feel good about this economy. And it's primarily because of inflation. Let me use my final 30 seconds to ask you. I listened to my good friend, the chairman, give his opening statement. Do you think inflation was caused by corporate greed?
I hate to comment on something the chairman was speaking about.
Oh, go ahead.
Well, so I will just say, we see at the Fed, we see inflation as when there's an imbalance between supply and demand. And we use our tools to work on the demand side of that and bring it back into line with supply.
I got 2 seconds. So when are you going to lower interest rates?
I'm today not going to be sending any signals about the timing of any future actions.
Thank you, Mr. Chairman.
Senator Smith of Minnesota is recognized.
Thank you, Mr. Chair. Welcome, Chair Powell. It's good to see you again. I want to follow up on kind of the line of questioning that Senator Tester was on a bit ago. He was talking about how the U.S. economy has been outperforming other advanced economies around
Fed's power
the
says
world
I am
in
not
terms
sending
of
any
growth
signals
rates,
today
in
about the
terms of
timing of
unemployment,
future
in
Fed
terms
policy
of,
actions.
Inflation, getting inflation under control, though I think we obviously can all agree that we're not, at least from my perspective, we're not done yet, and we don't want to rest on our laurels, but I'm wondering if you could share what you think that we have learned from this experience. What have we done right, and why is it that we are doing better than some of the other advanced economies in the world?
I think that it's down to the fundamental strengths of our economy. So, as you may know, European economic officials are very, very focused on this question. They really, it comes up in all of our discussions. Europe has seen productivity increases of about 1% a year for 40 years. We've seen 2%. If you take a number and compound it at 1%, then compound it at 2%, the difference is just enormous after 40 years in terms of incomes and living standards. And their question is, why is that? Why is that? And the standard answer that Americans tend to give and that I would give is it's down to more flexible labor markets. They in the pandemic, they stayed in their existing jobs. In the United States, we had people changing jobs at record levels. And, that's the kind of thing that adds to productivity and contributes to rising living standards, going back to school, getting skills and things like that. Another one is our financial sector. We don't just have banks, we have a highly developed ecosystem of financing sources that will fund early stage investments. Banks are really not set up to do that. They're prudentially regulated. And so those are some of the things. And I think we just have these natural strengths as an innovative, more flexible economy. We can grow faster.
Mm-hmm. I appreciate that. I think sometimes there's a tendency to sort of trash our economy and to sort of say, oh, we suck. And actually, I think that there's great resilience in our economy. I would argue that it has also to do a lot with the incredible resilience of our workers and their creativity and their talent and the training and the education that they have. And I think I would also argue, though I wouldn't expect you to make this case, that the way in which our federal government responded to the pandemic in order to make sure that people weren't evicted, that they still had money to pay their bills even when they weren't able to work, meant that overall our economy survived and was ready to kind of be off to the races when we emerged from the pandemic. But Chair Powell, I'd like to ask you a question, something that you and I have talked about, I continue to be thinking a lot about, which is the commercial real estate risk that we have in this country. I think particularly for office space, we know that has been under strain the last several years. The sector has remained largely stable, but we are hearing about some additional default risk. And one thing that I'm noting is that there's some expectation or concern that may fall disproportionately on smaller banks. I think that commercial and regional banks hold an estimated 2/3 of all the commercial real estate loans in the country. And so unlike larger banks, these smaller institutions might find it a little harder to deal with this. So could you discuss this with us about how you see this risk and particularly whether this poses some additional risk that we might be seeing more concentration in the banking sector as these smaller banks are maybe under more pressure?
Yes, so this, to your point, this is a risk that has been with us and will be with us for some time, probably for years. And banks need to be, honestly assessing what their risk is. They need to be assured that they have the capital and the liquidity and the systems in place to manage this risk. The stress test that we apply to the largest institutions stressed commercial real estate pretty hard.
Fed's Powell, when asked about commercial real estate loan risks, says the risk will be there for banks for years.
This problem. And most small banks can too, but it is in some smaller banks that tend to have that local concentration in commercial real estate. And, we're in touch with those banks. The supervisors and regulators are in touch with those banks and making sure that they can manage them. And it's going to be an issue for many banks, but it's one that we're trying to work through, one that we're very much aware of. And again, it'll be with us for some time.
Thank you. I think so much about the importance of these small regional community banks in small towns, even big towns in Minnesota, and how important it is that, in my book, that they can stay independent and better serve their communities in that way. So I worry about this risk. Thank you, Mr. Chair.
Thanks, Senator Smith. Senator Butler of California is recognized.
Thank you, Mr. Chairman. Chairman, good to see you. And I am going to make you do the whole last 5 minutes since I'm the last one for today. You'll recall the first time that we spoke, I tried to engage you around 3 specific areas. One was how the monetary policy impacts the quality of life for young Americans in the future and the work that you are doing there, the space of climate risk, and what I see as potentially a future challenge down the road, and that is the state of commercial real estate. You and I have had that conversation before, and no surprises today. I'm going to stick to those three topics. Somewhat related to questions that you've been asked before relative to the housing market, housing affordability, and interest rates. I want to narrow the scope just a little bit to ask about those issues and challenges impact, again, the quality of life for America's next generation. Given the severe shortage of affordable and available homes to buy, coupled with high interest rates, young Americans are continually unable to afford homes and are
So
pushed
the
into a
Fed bids
rental
for
market,
52-week
driving
bills
rental costs
totaling $2.6 billion.
Sort of trickle-down impact here. A recent Washington Post analysis showed that Gen Z is spending 31% more on housing than their millennial counterparts were 10 years ago after adjusting for inflation. How do you view, that was a long lead-in to just ask the question, how do you envision or view the interest rates of today and the monetary balancing, policy balancing that the Fed is doing on contributing to the future generation predicament if we are to extrapolate the conditions of today?
So our job, of course, is the whole economy and inflation for the whole economy. And the absolute best thing we can do for younger people is to restore price stability so that as we benefited from, I graduated from college in 1975, near the end of the big inflation period. So during most of my adult life, inflation has just been not a factor. And that means, stable interest rates, relatively low interest rates. We want to get back to that, and that is what the Fed's job is that we're not supposed to look at the housing market as separate from the overall economy. In the meantime, though, there's no question that higher interest rates are making it harder to buy homes in the short term, but in the longer term, this is the best thing particularly for younger people who are not yet in the housing market.
Let me sort of in line with that community, constituency, population, and definitely aligned with the concerns of my state that's actually facing some severe climate impacts, just as we speak with wildfires and our colleagues and fellow Americans in Texas and the impact of the hurricane. I wanted to pull in your sort of thoughts about the Fed pilot on the climate scenario exercise. In May, the Fed conducted a pilot climate scenario exercise and asked the 6 largest U.S. banks to examine their balance sheets and how it would be effective if a large hurricane hit the Northeast. They reported facing data gaps on property characteristics, their counterparties and insurance coverage. How does the Federal Reserve intend to invest in expanding the modeling resources for banks that are implementing climate-related financial disclosures?
So we haven't made any decisions on what to do with that information or whether to repeat that exercise. To your point, it was really a learning exercise. How are banks thinking about this, and how are they modeling it, and how does it work really? It's a very, very challenging thing to model. And so that was really the nature of this exercise. In terms of disclosures, we don't really have that's not really our job. That's really the SEC. So, but we don't have a big job on climate, but what it really is to make sure that the institutions we regulate are aware of and understand the risks that they run, including risks from climate.
And that they're prepared, and learning how to, as would be the point of a pilot, learning how to mitigate those risks over time. So what criteria will you use to evaluate whether or not you would run the exercise again and or share more broadly the results of that exercise?
I think we did publish, most of the results of that exercise. So I don't know what to say about that. We're looking at it and we're asking ourselves, what did we learn? What do we need to learn next time? I'm not exactly sure what factors we'll be looking at, but we'll be doing a careful assessment of what more we need to do.
Thanks. Thank you, Mr. Chairman.
Senator Hagerty is recognized.
Thank you, Mr. Chairman. Chairman Powell, welcome. Chairman, last week in Portugal, you said that you wanted to be, quote, more confident that inflation is moving sustainably down before you begin to cut rates. You also said in your testimony that you need greater confidence and more good data before lowering rates. Can you give us any color as to what it is you're looking for in the data and how long it might take us to get there?
We need just to see more good inflation data. That's all. We had 7 months of good inflation data at the end of last year. Then we had a quarter, really a month or so, where inflation went up, and now we had one really good inflation reading and one pretty good one. We just need to see more so that the confidence rises. I'm not going to tell.
Fed's Powell reiterates that we need more good.
Yeah, I mean, I'm going to try to avoid.
We need to
sending
see
any really
more
specific
just
signals
good
about
inflation
time
data.
today, because it's going to depend on the data. It also matters what's going on in the labor market, though.
That's
we've
Fed's
also
Powell
said
saying
that
we
if
need
the
more
labor
good
market
inflation
weakens
data in order to
unexpectedly,
cut rates.
That could be
That
a
would make
case
confidence
for
rise.
loosening policy as well. Really, we're weighing both those factors.
Here's one of my concerns. I'm sure you probably share it, but we're coming off of a 40-year high in inflation. We've seen the rate of inflation coming down, but we haven't gotten to the 2% target. And my concern, for lack of a better term, is whether or not this might be transitory in terms of the data that we're seeing right now.
That's exactly why we're approaching this question carefully.
I thought that might be your answer. Thank you, Mr. Chairman. Can we shift now to the issuance of Treasury debt? The Fed is the largest holder of Treasury debt. In February, you and I talked about the pressures that our fiscal deficit is exerting on interest rates, which by extension makes your job more difficult. I'd like to talk this time about
So in
how
10 minutes'
Treasury
time now, at the
issuance
bottom of the hour,
is
the
impacting
US
our
is due to
economy
sell
and our monetary
$46 billion
policy.
in
First,
52-week
just a
bills.
basic question.
The
If
prior high
Treasury
yield was
issuance were to
4.915%.
shift drastically
Prior
either to
bits
the
cover
long
was
end or the short end of the
2.87.
curve, would that affect interest rates, or maybe more simply,
Fed's
the
Powell
changes
also
in supply
repeated that if the
across
labor
maturities
market weakens
impact interest
unexpectedly,
rates on
that
the
could also
yield
be the
curve?
case to cut rates.
I mean, I think in theory they can.
Yeah, I agree. As you know, the Treasury Borrowing Advisory Committee recommends that T-bills comprise between 15 and 20% of total U.S. debt. Right now, the Treasury is issuing T-bills significantly above that recommended range. Some people, including myself, believe that this is being done to artificially stimulate markets in the run-up to the election. And it's shocking how little attention this is getting. Any manipulation of debt management of this nature stimulates inflationary pressures and increases taxpayer burden because it's higher cost to issue these bills. So given that Treasury is issuing an excess of short-term debt, which pulls down longer-term rates, isn't it working at cross purposes with your monetary policy goals of taming inflation?
So we take Treasury's debt management decisions. We don't comment on them. We just do our job.
No, I'm not asking for a comment on their decision, but just as a simple mathematical truth, if they're pulling down demand on the long end of the curve, doesn't that?
I wouldn't say that has important inflation implications, no.
It just feels to me the same way that the Biden administration drains the Strategic Petroleum Reserve, that undermines our ability to respond to energy shocks. When the Treasury manages its debt in this manner, it constrains our ability to respond to future economic shocks. And that opens our nation up to very real risk, whether it be amplifying the effects of the Fed's balance sheet reduction, flooding the supply of one of the most important short-term debt instruments. The risks seem to me to be mounting for Treasury market disruption. I'd like to know what your thoughts are, Mr. Chairman, about how the Fed will navigate this and whether you've had discussions with the Treasury about this growing dangerous dynamic.
No, we don't have a seat at the table on Treasury debt management. Treasury makes those decisions, and they don't have a seat at our table on monetary policy.
I just think the risk is very obvious here, though, where we're headed with this type of portfolio
Honestly,
management.
it's completely out of bounds for me to comment on Treasury debt management in any way.
I think you've been dealt a very difficult hand here, Mr. Chair. The Biden administration's policies aimed to gin up the economy ahead of the election. These efforts directly undermine your policy goals at the Fed. That includes excessive issuance of short-term debt. Think about it, Freddie Mac's backstop of second mortgages, unlawful student debt loan cancellations, the draining of the Strategic Petroleum Reserve to suppress fuel prices, and President Biden's own jawboning of the FOMC to lower rates. As you know, the Federal Reserve was structured to shield monetary policy from political influence, and that independence has given the Fed unique credibility in executing its mission. If the FOMC were influenced in any way by political calculation rather than economic data, it would severely damage the Fed's credibility as an independent institution, it would increase uncertainty in our markets, and it would jeopardize the dollar's status as the global reserve currency. Thank you, Mr. Chair.
Senator Warren of Massachusetts is recognized.
Thank you, Mr. Chairman. When the CEOs of giant banks can boost their bonuses by getting the banks to take on more risk, they run the risk that they will end up running their banks into the ground. It happened in 2008 and it happened again in 2023. Back in 2010, though, Congress passed the Dodd-Frank Act. Section 956 told financial regulators solve this problem. 2 months ago, regulators put forward a proposal, but the Fed refused to join. Now, in 2018, you told this committee, Mr. Chairman, that you, quote, expect that banks will have in place compensation plans that do not provide incentives for excessive risk-taking. In other words,
In 5 minutes' time now, at the bottom of the hour, we see the release of the US 52-week bill auction. US is selling $46 billion. The prior high yield was 4.915%. Prior bid to cover was 2.87.
Of critical employees who are able to gamble with the bank's finances, like the head of a trading desk, for example. Chair Powell, in the 6.5 years since you said trust the banks to regulate themselves, how many of the 10 biggest banks have put policies in place to delay annual bonuses for this broader group of critical employees whose risk-taking could endanger the bank?
I don't know specifically. My guess is all of them. Since the financial crisis.
You're the regulator who said trust the banks to self-regulate so we can avoid another financial meltdown or another bailout. And you don't know if they did or didn't do that?
Well, it's a very, very specific, narrow question you're asking about.
Because it's something a regulator should do. You think the answer is 10 out of 10? The answer is 0 out of 10.
Yeah, I doubt that.
Well, go back and look, because we've looked at their statements on this. Another thing the proposed rule would do is require the banks to consider flat-out banning bonuses and bonus pay for executives who took risks that threatened the stability of the bank. So let me ask you this one, Chair Powell, in the 6.5 years since you said trust the banks to regulate themselves, how many of the 10 biggest banks now have policies that would require them to flat out deny bonuses to executives that have engaged in inappropriate risk-taking?
I don't know the answer to that. By the way, I never said trust the banks to regulate themselves.
I'm sorry, do you want me to go back and quote you again exactly?
Trust the banks to regulate themselves?
When you say, I expect that the banks will have in place compensation plans that do not provide incentives for excessive risk-taking.
Right, pursuant to the guidance that we issued in 2010, which is quite detailed.
And you have not issued a guidance since you made these comments, since you became chair. And how many banks have actually put in place the regulations that you said, I expect the banks will have in place? The answer is, out of 10,
it was covered
0.
by the 2010 guidance.
No,
actually.
you said in 2018 that they would put these in place.
I said they would have in place.
No, that is not what you said. So look, Chair Powell, the last guidance on this subject, as you say, was in 2010, which is before you were at the Fed. The Fed has now refused to join the other financial regulators in finalizing a rule implementing Section 956 as Congress directed. So my question has been, how many of the 10 biggest banks have done this? And the answer is 0. Dodd-Frank was passed 14 years ago. There are still no rules to stop banks from rewarding executives' risky behavior. When you were asked about these Section 956 rules or lack of rules in March of this year, you said, quote, that you wanted to understand the problem we're solving before proposing a rule. Chair Powell, the law does not say Jerome Powell, in his infinite wisdom, should decide if we have a problem with executive compensation. The law passed 14 years ago says executive pay is a problem that threatens the stability of our economy. So write the
Shortly
rules
expecting the results of the 52-week bill auction. On release, I'll lead with the high yield.
Financial regulators have proposed such a rule, but the Fed has not joined. Chair Powell, I understand why the 10 biggest banks in the country like your approach. You let them do whatever they want, but you don't work for the giant banks. You work for the American people. I urge you to do your job. Thank you, Mr. Chairman.
Senator Vance from Ohio is recognized.
Thank you, Mr. Chairman, and thanks to Chair Powell for being here. I appreciate you coming by our office last week to discuss some of these issues. I would ask something I imagine most of my colleagues are not asking, which is the relationship between immigration, particularly extremely high illegal immigration levels under the Biden administration, and the persistence of the inflation problem. And I recognize this is not your policy focus, but you are the Federal Reserve Chairman, so I just want to get your views on this. And in particular, I want to read you a quote from Mickey Bowman, who's one of your governors. And this says, in a quote, "There's a risk that increased immigration and continued labor market tightness could lead to persistently high core services inflation. Given the current low inventory of affordable housing, the inflow of new immigrants in some geographic areas could result in upward pressure on rents as additional housing supply may take time to materialize. With labor markets remaining tight, wage growth has been elevated at around or above 4%, still higher than the pace consistent with our 2% inflation goal, given trend productivity growth." The Bank of England, I believe, produced a recent report on this issue in the United Kingdom, obviously a different economy in a different country. But what do you see as the relationship, in particular, given that housing is such a big driver of the inflation that we've seen over the last few years? As Senator Haggerty said, the highest in 40 years. What role do you see illegal immigration playing in driving up housing costs, which, of course, is a main driver of inflation for American citizens?
Let me quickly start by echoing your first comment, which is we don't comment on immigration policy, but we do comment on inflation. So I would say this. Many people came into the country over the last couple of years, many of them through asylum requests, and went to work. Labor supply increased a great deal. It's not, there's no clear answer, but my sense is that in the long run, immigration is kind of neutral on inflation. In the short run, it may actually have helped because the labor market got looser because there were more people. But to you're talking about housing specifically. There will be, I'm sure there are places in the country where new people coming into the country, I'm sure you can find places and they exist where that will have contributed to an already tight housing market. But overall, in terms of aggregate inflation, I wouldn't say it's a driver one way or the other.
So I want to
high rate 4.775%, 4.775%, with the bids cover of 2.85 to 2.85. The US sold $49 billion, awarding 47.07% of bids at high.
Example of this particular concern, straight from the horse's mouth itself. Now this letter, I want to quote from it. "Springfield has seen a surge in population through immigration that has significantly impacted our ability as a community to produce enough housing opportunities for all. Springfield's Haitian population has increased 15 to 20,000 over the last 4 years in a community of under 60,000 previous residents, putting a significant strain on our resources and ability to provide ample housing for all of our residents." And end quote there. And Mike,
without objection, so
thank you. In my conversations with folks in Springfield, it's not just housing. They're trying to build 5,000 new housing units, which is a very Herculean task in a town of about 55,000 people, but it's also hospital services, it's school services, there are a whole host of ways in which this immigration problem, I think, is having very real human consequences. But I want to go back to just one other question, Chair Powell, on this immigration and labor supply question. So one of the euphemistic ways in which economists, I think, sometimes talk about labor supply and immigration is they'll say something to the effect of, well, an increase in labor supply has put downward pressure on labor prices. And what they're effectively saying is that increased immigration has put downward pressure on the wages of American workers. I wonder, when you hear sort of your colleagues and other economists outside of the Fed talk about the influx of immigration and the fact that it, I think, admittedly has put downward pressure on wages. Okay, so obviously, that has put some downward pressure on inflation, but it also puts downward pressure on the wages that people earn to pay for their families. Why do we see that as a good thing? Or maybe that's wrong. Maybe the premise is fundamentally incorrect. But why do so many economists treat an influx of new labor as a good thing? If labor is constrained, labor supply is constrained, doesn't that lead to rising wages for American workers?
So I'm certainly not trying to put a value judgment on it. I will say that this is all happening over the last couple of years in a context of an extremely tight labor market. Now a little bit less tight, significantly less tight, but you've got a worker shortage. You've got businesses who have jobs that are open. You have, more than one job opening for every unemployed person. So you've got a very tight labor market, and it's addressing that. And we're having wage increases are still very high, but they're coming down to a more sustainable level.
Fair. And Mr. Chair, I know I'm over time. Could I just one more question on this? Thank you. I understand your point, Chair Powell. And again, I'm not ascribing value judgments to you, but if we say we have a really tight labor market and we say that there are more than one job openings per worker, there are two ways you could plausibly solve that, probably more than that, but two obvious ways you could plausibly
Fed's
solve that.
Powell says
One is
wage
through a new
increases are still
influx
very high,
of
but coming
workers
down to
via
more
the
sustainable
immigration
levels.
system. Another way is by raising wages and bringing some of the workers that are on the sidelines. I think specifically of the 7 million prime age men that have dropped out of the labor force. Like, why isn't that more the focus of policymakers rather than, you see a labor shortage, rather than bringing in a large number of new immigrants, why not try to boost wages in a way that brings some of those workers off the sidelines? That seems to be a much better focus from my perspective.
Certainly, that's a very constructive focus. I would agree. I don't think it has to be one or the other.
Thank you, Mr. Chairman.
Senator Van Hollen from Maryland's recognized.
Thank you, Mr. Chairman. Chairman Powell, it's good to see you. And let me first applaud you and your team at the Fed for, at least so far, being on track to bring down inflation without, so far, triggering a surge, big uptick in unemployment. But you know very well that that's a risk if the Fed does not act with full awareness of that danger. When you were here in March, you said that you were, quote, well aware, unquote, of the risk to
Oil
unemployment
prices extend losses, with Brent and US futures falling by $1 a barrel.
Of avoiding it, unquote. Since then, we have seen a slowing in the economy and a rise in unemployment. I'm just reading something today, an analysis with Diane Swank, KPMG's chief economist, who summed it up by saying, quote, the ice is thinning, red flags are emerging for the U.S. economy, unquote. The engine of the economy, the labor market, is cooling faster than previously known. The unemployment rate is above 4% for the first time since 2021. It is taking workers longer to find jobs. Economic activity in the service sector, which is responsible for 2/3 of economic growth, slowed in June. So my question, Mr. Chairman, is how do you take all of these factors into account? Do you share my concern that as of today, there is a real risk of an increase in unemployment larger than is currently on your radar screen?
Yeah, I mean, absolutely. I do, even more so than in March when we were here, see that. So we've seen, and I think the latest data show that labor market conditions have now cooled considerably from where they were 2 years ago. And I wouldn't have said that until the last couple of readings. And I would say also that for a long time, the risks were more that we would fail to hit our inflation target. I think the risks as to the two statutory targets we have, price stability and maximum employment, I think those are coming much more into balance. My colleagues and I are looking at that, and we fully understand that we have to manage this process of administering the federal funds rate and deciding what to do with it in a way that manages both of those risks. And, the two mandates are equal under the law. And so, yes, we do get that.
Well, I appreciate that. And I appreciate the fact that you've seen that that calculation change since you were last here, because I think the data indicates that we are at risk now of not acting soon enough to curb the increase in unemployment. And that if we allow that to go too long, we may see a real uptick there. And so I'm pleased that that is very, very much on your radar screen, and hope that that will be a really deciding factor as you and your other Fed colleagues determine what to do with respect to interest rates. And as has been said, in the housing sector, we are seeing the continuing drag created by high interest rates. So that has been I think all of our colleagues, as you probably heard today, are really hearing from our constituents, understandably, about the very high housing prices, and it's slowed investment in other sectors like manufacturing as well. In my final minute, I would like to turn to the question that Senator Warren asked, because I asked your colleague, Vice Chair Barr, about exactly this question of implementing Section 956 of Dodd-Frank when he was before the committee just a short time ago, May 16th of this year. And I asked him about why the Fed had not moved forward along with other agencies with respect to implementing what the law is and what the law has been for 10 years. NCUA has signaled their intent to propose a rule. The SEC has indicated that they're moving forward. I said to Vice Chair Barr that I've not seen any notice of proposed rule from the Fed, and can I get a commitment that the Fed will quickly begin to process implementing this law by issuing a notice of proposed rule? His answer was, and I'm quoting, "In discussions with my colleagues, it became apparent that at the board, we believe we need to conduct some further analysis before deciding what steps to take. We are committed to following the law, to implementing Section 956, but we have further work to do." Count me among those who are very frustrated that we're now 10 years after this law was passed. Vice Chair Barr committed to following the law. I'm sure, Mr. Chairman, you would commit to following the law. But why is it that it's taking the Fed so long to move forward with implementation of 956?
So I like to look at the actual language of the statute when and what it says is it calls on the regulators to make determinations about specific incentive compensation practices that cause excessive risk taking. And then, and we haven't done that. We did, that we put in place pretty serious guidance back in 2010. After putting it out for comment, we looked at all these questions. It's been in place for 14 years. We supervise on it. And, so the question I'm asking is, okay, let's go out and look at what the practices are that are happening now, not that are happening before the global financial crisis when it was obvious that things needed to be changed. And we put the guidance in place. It seems to have largely worked, certainly as it relates to the large firms. And then let's design something that is designed to the residual risk, as opposed to just taking something off the shelf from 15 years ago and doing that. And we're working on that at the Fed now. And again, the statute requires us to prescribe regulations or guidelines to prohibit those things. And I want to do that. In a sense, we have done
just very briefly, and is it your testimony that the Fed has already met the requirements of? Okay,
no.
Just want to make that clear, and we do look forward to the Fed moving forward. Thank you, Mr. Chairman.
Thank you, Senator Van Hollen. Senator Brett from Alabama is recognized.
Thank you, Mr. Chairman. Chair Powell, thank you for being with us today. My colleague from Maryland actually just touched on something, but as I was listening to the exchange from my colleague from Massachusetts and her closing remarks, particularly about Dodd-Frank and 956, there was also a comment at the end where she mentioned you working for giant banks versus the American people. Now, I have a long list of questions I want to talk to you about, but I did want to get you to respond to that.
Yeah, that's completely untrue. The things that we're doing are consistent with our international obligations, and they're meant to be the best thing for the American economy, and that's really our only consideration. We have policy differences.
U.S. Treasury Secretary Yellen says Biden is extremely effective in the meetings in which she participates.
Absolutely, thank you. Chair Powell, I have repeatedly talked about my concern with long-term debt proposal and just think that it has not been well thought through. First, I have concerns that it blatantly undermines the tailoring requirement. And on that note, do you believe that 2155 will be applicable to the long-term debt requirement?
I think it applies to everything.
Absolutely.
And on the long-term debt requirement, we have voluminous comments that we're looking at carefully and thinking through the process of what to do about them.
No, I appreciate that because I do believe that currently it lacks a real cost-benefit analysis, and I think it really does need serious reconsideration. And additionally, when you take a look at it and its overlapping nature with Basel III, it seems inappropriate that we would move forward with a new long-term debt proposal, finalizing that rule when we don't even really understand what Basel III is going to mean for capital requirements for banks and obviously financial institutions. So my question for you is just that. Would it be inappropriate to move forward with the long-term debt proposal, finalizing that rule prior to Basel III being finalized as well?
I don't know that I would give you, I can't give you a clear answer on that. It will depend. I mean, Basel III won't be finalized for some time, but that's not to say we wouldn't.
And
reach a
US
place
Treasury
where
Secretary Yellen
people
says, I'm not
understand
aware
and
of any
accept and
discussions among
support,
cabinet secretaries
what it is that
invoking
we're
the
doing.
25th
And I
Amendment.
think at that point, we could certainly move forward with other rules.
I heard you mention to one of my other colleagues that probably by the time this all took place, it would be the beginning of next year. I would just say my concern, the Fed has said that the long-term debt rule will directly be impacted by the final Basel product. And so, why would it be inappropriate or appropriate to move forward with that before banks can fully understand what they're facing from Basel? So I would just ask that y'all are thoughtful about that. These are a lot of things that people are dealing with and trying to really understand the implications of. And I think we have seen consistently that people are not taking a look at the cumulative impact of these things and not really taking a look at the trickle-down effect. And on that, on Basel, when you testified in March, you said the Fed was aware and fully considering the potential impacts of a proposal on our commodities markets. And I do want to talk about that. The commodities market, our agriculture industry is 1 in 5 jobs in the state of Alabama. It's 20% of our economy. I am a big believer food security is national security. And the proposal would increase hedging costs by 80%. Meaning banks would be far less likely or inclined to offer clearing services. So this could have a detrimental effect to our agriculture community and increase other costs providing food and fiber for our nation. When you look at inputs such as feed, seed, fertilizer prices, those have skyrocketed and prices have ended up just getting passed down to the consumer. I mean, grocery prices are up 21% since January. So do you believe that the revised Basel proposal will alleviate these concerns that our farmers and our ag community have had about Basel III? And has the Fed done anything specifically to take a look at this? And if not, will you commit to doing so?
So I don't want to get into the specific changes that we're going to make. I'll just say that we're very well aware of and very focused on that particular set of changes and paying close attention to the issues you've raised.
I appreciate that, and I also hope that the Fed when you craft these types of regulation, you really consider the relationship between the economic impact and the ability of community banks to serve their communities as well. I have heard you mention that to another one of my colleagues, so I know that you're committed to doing that, but that is incredibly important to Alabamians and our main streets all across the state. In my last few seconds, I want to touch on one more topic. So finding solutions to expanding affordable childcare is a top priority of mine, and it is something that I know a number of my colleagues on the other side of the aisle share an interest in and believe is an important issue as well. So Chair Powell, do you believe that increasing access to affordable childcare would positively impact labor participation in our country?
I do believe that.
Thank you.
Stowe of Nevada is recognized.
Thank you. Excuse me, Chairman Powell, thank you for joining us, and I always appreciate visiting with you in my office as well and your comments. Let me start by a comment you made in the opening. Over the past 2 years, you said the economy has made considerable progress toward the Federal Reserve's 2% inflation goal. Labor market conditions have cooled while remaining strong. Reflecting these developments, the risks to achieving our employment and inflation goals are coming into better balance. And what we know is that since Biden came into office, the United States has added over 15 million jobs. Under President Biden, we had 41 consecutive months of job growth, and you just said it again here today, that wages are up as well. Average U.S. wages and salaries grew by nearly, 16,700 between January 2021 and April 2024. So would you agree with the statement by a ranking member earlier today that the U.S. has the greatest economy on the planet?
I certainly would.
Let me ask you this. Jumping around, and there's been talks today about the Fed's independence and how important the Fed's independence is. The Wall Street Journal recently reported former Trump administration officials drafted policy options to weaken the independence of the Federal Reserve if President Trump were to be elected in November. Allegedly, former administration officials discussed policy options to erode
In 10
the
minutes' time
Fed's
now, at the top of the hour,
independence
we see the
to
release
make
of
it
the
easier
EIA's
for a
short-term energy
president
outlook
to
report.
impact interest rate decisions or fire the Fed chair at will. Chairman Powell, how important is it that the Fed has independence to provide economic stability and anchor our inflation expectations?
So I think it's actually essential, it's literally essential. And the good news is I think that's pretty broadly understood, and particularly on Capitol Hill on both sides of the aisle. I believe that people do understand that we need to do our work in a way that's outside the political process to the maximum extent possible. Of course, we need to be accountable and tremendously transparent. If you look at the box in the Monetary Policy Report on central bank independence, it's really a box about transparency. That's the other side. So I think it's really important. I think it's an institutional arrangement that has served the public well. And, and I do believe that there's pretty wide support for it.
And you just said that it has been intentional and institutional arrangement over the years for this very reason. Correct?
Yes, this is a choice that we make, and I think it's countries around the world, advanced economies have all made this choice effectively, and the results are clear that you now have independent central banks, and you have better anchored inflation expectations, and you have better performance on inflation and better performance in the economy generally, which isn't to say there won't be shocks and crises and that kind of thing.
And then let me touch on a subject that one of my colleagues just talked about, because I was going to ask about this, which is our immigration. In Nevada, immigrants are extremely important for our economy. They're essential workers, doctors, nurses, and teachers in my community. Can you, without getting into other ancillary issues that don't impact what you do, can you talk about and elaborate on how immigration affects the employment rate and why you look at it and for what reason you look at the immigration issue?
So we don't, as you, just to make the point that you made, we don't take a position, we don't comment on immigration policy. We have no responsibility for it. It's not our job. But so we just look at the numbers and we sort of try to assess the economic consequences of immigration. And over the last 2 years, 2 years ago, we had an economy where we really had a labor shortage. And what's happened is we've had a wave of immigration, and many of those people have gone to work and gone to work legally through the asylum process. Not all of them. There's also a group that has not been legally processed, but many of this latest group have been have sought asylum and gone through the process of getting a work permit. So what that means is that employers wanted workers, and there were more job openings than there were people actively seeking work or working. And so now you have a new supply of workers, and they've filled those jobs. So we have a bigger economy, but it's not a tighter economy because labor supply has increased the economic capacity. That's just the arithmetic. That's not saying it's a good thing or a bad thing. There are other policy choices that could be made, and they're not for us to make.
When you say greater economy,
a larger economy.
In other words, it has improved the growth of our economy.
The economy grew 3.4%, I believe, last year. Mm-hmm. And some part of that was that, as Congressional Budget Office analysis showed, and to many surprise, there had been a really significant uncounted group of workers coming into the country who had gone to work And that's part of the story of how the economy managed to grow that much while inflation was coming down pretty sharply. Inflation came down 2 full percentage points during 2023 while the economy was growing at 3.4%. So, and while these people were coming in. So that is part of the explanation for why we had such an interesting and pretty good year in 2023.
Thank you.
Senator Kramer of North Dakota is recognized.
Hi, Mr. Chairman. Thank you, Chairman. As always, all of my prep goes out the window with the last question. So on the legal immigration workforce front, and I know this isn't your bailiwick, but the issue of workforce is important to the economy. I would submit to my colleagues, beyond even the people who come here seeking asylum suddenly being available for the workforce, we have 1 million plus people who we welcome in legally every year, the vast majority of whom don't come in with a job or even a skill set. And we have so much work to do, colleagues, on the legal immigration front to create a connection between economic demands for workers and the skill set and education that our
In 5 minutes' time now, at the top of the hour, we see the release of the EIA's short-term energy outlook report.
Skill set useful in the economy. We don't do much of that. So that's just my speech for the moment. I know, Mr. Chairman, you've gotten already lots of very specific questions, and I've heard a couple of them on Basel III. So I'm just going to make an illustration, and you can comment on it if you'd like. But there's a large generation and transmission utility in North Dakota, rural electric cooperative, Basin Electric, very large G&T, members all over the upper Midwest. And they recently testified in front of the CFTC on Basel III, and they expressed a concern about how operations would be impacted if lending was curtailed or limited in any way. And they gave a real-world example, and I want to just give you that example. Now, remember, this is an electricity supply that we're talking about. It's critical it remains reliable. It's critical that it remains affordable. And part of an electric cooperative's risk management program, of course, is how it buys the fuel that generates the electricity. In this case, natural gas. They may buy natural gas in advance at a fixed price, realizing natural gas is one of those commodities that goes up and down in pretty big swings at times. But they can hedge by buying it at a fixed price for a power plant. And it protects the cooperative financially, since electricity prices, again, follow those spot prices generally. So spot prices spike, so do electricity prices. However, with a natural gas hedge, the cooperative can generate electricity at a lower fixed fuel cost, protecting itself and its consumers from high prices. It's an upfront cost on the balance sheet between the cooperative and its bank, but it protects the reliability and affordable supply of electricity. I give you that very specific example, not even to mention that the cooperative model itself has some unique qualities about it. If you would like to comment on it, you've already stated that there are going to have to be changes. I just throw that into your box of things to think about, and you're welcome to comment if you'd like.
I'll just say we're well aware of that issue, and I appreciate you bringing it up.
Thank you, Mr. Chairman. With that, then, I'm just going to speak to this independence issue. I think that the senators that have questioned you on it are correct. I share that concern, as you know, that the independence of the Fed is essential. I have resisted moves within my own party to change it, but those moves are very narrow and not very, I don't think, very realistic. And I appreciate you pointing out that from what you can tell, at least on Capitol Hill, we're all pretty much united on that front. Perception does matter. It matters a great deal. And you and I have had discussions over the years on, you were very, you admonished us strongly as Congress to spend what we needed to spend to get through the pandemic and to maintain the economy. I think you were right to do that. You were just as aggressive in not responding to calls to rein it in a little bit when Democrats brought the Inflation Reduction Act and the American Rescue Plan to the forefront, and I think really basically hijacked the economy and put fuel on inflation. But perception matters, and so I would just submit to you, and you haven't said you're going to do this. I don't have any reason to believe you'll do this, but any move to lower interest rates or move interest rates either direction before November 5th could certainly be a bad perception, even if there's even if there's a strong push to do that. I know you understand that, but I just want you to know that as long as you remain independent, I'll be on your side. I think neutral is a good place to be. And by the way, you have one of those jobs where being boring
Shortly
is one of the most
expecting
fun
the
things you do.
EIA's short-term energy
great job.
outlook report.
Thank
We
you.
do our
Thank you,
best.
Mr.
Senator Kramer. Senator Warnock is recognized, who is decidedly not boring.
Thank you very much, Mr. Chairman. The latest monetary policy report shows inflation in housing costs is gradually easing. That's good news. But many Georgians still feel the sting of unaffordable homes and mortgages. And one reason for this, you and I have discussed this, is that we aren't building enough houses. 2022 study published in the Journal of Economic Geography found that for every 10% increase in the housing stock, rents decreased by 1%. We've discussed this issue, particularly the effects of housing supply on housing costs. And we agreed that while the Federal Reserve does not control housing supply, it can help create the environment that encourages the construction of new housing, particularly affordable housing. Chair Powell, how has the Fed been working to foster an environment that encourages home construction, and what, in your view, are the challenges that remain?
So, I mean, in the long run, the absolute best thing we can do for the housing market and for the economy is to sustainably bring inflation back down so that people aren't talking about it anymore. And it's just assumed by everybody in their daily lives that inflation will be around 2%, so we don't need to talk about it, which is where we were for a long time. We want to get back to that. Interest rates can come down then, and the housing market can return to the state it was in before the pandemic, which was to say really tight. We don't have enough housing, and that's not really a monetary policy issue. In the short term, though, I would say tight monetary policy weighs on the housing market. The policy works through interest-sensitive spending, and housing is definitely at the top of the list of interest-sensitive spending. So we understand that we're suppressing, not suppressing, but our higher interest rates have led to lower housing starts and lower activity in the housing market. But we're doing that to get back to 2% inflation for the whole economy so that the housing market can be on a better foundation.
Well, yeah, and related to that, when you have these high interest rates, of course, you see across the country, but particularly in a state like Georgia, these institutional investors who are coming into the space, and they're buying houses in all cash, boxing out first-time, first-generation home buyers. And, of course, the conditions for them doing that improve to their favor with higher interest rates. Would you agree with that assessment?
I know some of that's happening. I don't know that higher interest rates make it. I mean, some of that's, they're working with...
Well, you got higher interest rates and you got institutional buyers who can purchase it all cash. Doesn't that further...
But they have to borrow the money at higher interest rates. I'm just saying higher interest rates doesn't make their investment
The
any cheaper.
EIA steer report notes the current year crude forecast nearly unchanged at 13.25 million barrels per day, from 13.214 million barrels per day beforehand.
It's not an issue for us. They're a legal buyer
Looking
of
for
housing.
next year's as well, the forward year crude oil production forecast at 13.77 million barrels per day. So that is up slightly from the 13.71 million barrels per day that was seen in the previous steer report.
Key inflation objectives like housing affordability.
I think the best thing we can do is kind of what we think we've been doing, which is to move carefully as we think about loosening policy and make sure that we do that when we've got greater confidence that inflation is moving sustainably down toward 2%. We're also keeping a close eye on the labor market, and if we see unexpected weakening there, then we could respond to that too. But that's really the best thing we can do for the whole economy, and very specifically for the housing market too.
Sure. You well point out that you're limited in terms of your influence there, and there is a role for Congress to be sure, which is one of the reasons I wanted to be on this committee, to introduce a down payment toward Equity Act with my colleague, Senator Butler. This bill would help first-generation home buyers compete with Wall Street institutional investors by helping with down payment costs, closing costs, and costs to reduce interest rates. I look forward to continuing productive conversations with you and looking at how we can make housing more affordable for all Americans. If I'm running out of time here, but one of the other concerns that I maintain is with respect to reducing the racial wealth gap is this issue around home appraisals. And the Fed is part of the interagency task force on property appraisal and valuation equity. What expertise and perspective has the Fed brought to this task force? How are you responding to this issue of home appraisals?
So, as you know, we've been an active participant in that task force, and we bring all of the expertise we have in the housing market, as well as regulatory, supervisory, and economic expertise generally, as we look at that. And I'll also say that our strongly held view is that discrimination has no place in the banking system, and that includes appraisals and other valuations.
I agree with that, and quickly, I was glad to see that CFPB and other agencies recently finalized a rule that creates strong anti-discrimination standards for automated home evaluations. The Fed has not yet approved this rule. Why not, and does the Fed plan to do so?
Sorry, why do we?
You've not yet approved the rule that was made, that was suggested by the CFPB. They finalized the rule.
But do we? Sorry, I'm not aware that it's a rule that we have to finalize too. Is that the case?
That is my understanding.
Let me follow up with you on that. I'm not aware of that.
Okay.
Thank you.
Senator Daines of Montana is recognized.
Chairman, thank you. Chairman Powell, thanks for being here today. Certainly, it's not lost on anybody here. Election season's in full swing. And so from now until Election Day, my Democratic colleagues in Congress, as well as the Biden-Harris administration, will waste no time attempting to sell a fairy tale to the American people that financially and economically, they are better off now than they were almost 4 years ago. When President Biden took office, inflation was at 1.4%.
So in the EIA and the STIA report, they forecast this year's US oil production up by 10,000 barrels per day, now expecting output to grow by 320,000 barrels per day year over year to 13.25 million barrels per day.
They see the everyday impacts of the decades-high inflation brought on by the policies of the Biden administration and facilitated by congressional Democrats. The cost of most goods and services across the economy are more expensive than they were in 2020, and that is a fact that no amount of political spin or mental gymnastics can make go away. Here's just a couple of examples. Breakfast cereal prices have increased 28% since January of 2020. Gas prices increased 36% from a national average of $2.63 a gallon to $3.58 per gallon. Egg prices have jumped $3 per dozen in 2024, double the cost of $1.45 in February of 2020. And this dishonesty doesn't stop.
So we have posted out the full EIA short-term energy outlook report on the feed for anyone interested.
President Biden and Senate Democrats are celebrating a victory lap in light of the recent jobs report showing a 206,000 new jobs last month. They're willfully ignoring the fact that more than a third of these job gains came from the government sector. Mr. Chairman, I commend you for the job you have done thus far in trying to rein in inflation. I encourage you to continue the fight despite the political pressures you may face. I'm also encouraged by the comments you made earlier this month about the dire need for Washington to address its fiscal imbalance. I couldn't agree more. I've said many times and continue to believe that Washington's culture of reckless spending, of excessive borrowing, is leading us down a very dangerous path by leaving future generations with mountains of debt. And I'm happy to hear you agree with that assessment. Mr. Chairman, given that it's an election year, you're undoubtedly facing immense political pressure to lower rates. Thus far, you've done an admirable job in using the tools at your disposal to fight inflation, and I urge you to continue to be led by data and not calendars or political influence. You said as recently as last week that while things are trending in the right direction, you would need to see further evidence before cutting rates. So here's my question, Mr. Chairman. What specifically are you looking at and looking for as we head into the next FOMC meeting, and how do you factor in this recent labor data, and certainly the significant part of that being government jobs?
So we're looking for two things, really. One is just more good inflation data. And we had quite a lot of good inflation data the last 7 months of last year. Then we had kind of a bump in inflation in the first quarter. And now we've had one good and one very good inflation reading. And we need more good data so that we can be confident that what we're seeing is really, that's where inflation's going, that it's going back down toward 2%. We don't need to see it at 2%. Right now we're at 2.6%. So that's on inflation. On the labor market, to your question, we've seen that the labor market has cooled really significantly across so many measures, and a number of people here today have pointed them out. But
Powell says we've had one good and one very good inflation reading. Need more data.
Pretty much where it was in 2019. It's not a source of broad inflationary pressures for the economy now. But it's still a strong labor market. You know, 4.1% unemployment is a very good.
Powell says labor market has cooled considerably across so many measures.
We have a mandate to support maximum employment,
and adds that labor is not a source of inflationary pressure right now.
Weakening unexpectedly, which is to say, you know, more than what we've seen in a material way. If we unexpectedly, then we could also respond to that because we have a dual mandate, and we now see the two mandates as more in balance than they were a year ago. Really, the focus had to be and was on inflation. Now we need to be focusing on both goals.
Chairman, thank you. I want to get one question on Basel III, and then we will. In March, this committee agreed that it was seriously flawed and need to be completely rewritten. I was encouraged to see reports last month that the Federal Reserve had provided other financial regulations with possible changes to the proposal. My question is, I continue to believe the proposal should be scrapped altogether, but could you share what changes you're planning to make and the status of the ongoing development of the updated proposal?
So we've had extensive discussions led by Vice Chair for Supervision Barr with the FDIC and the OCC. We've made a lot of progress in getting close to an agreement on a set of proposed changes. The work that remains is to agree on a process forward. How are we going to move forward? It is our view institutionally that we need to put the changes out for comment for some period of time so that the public, all members of the public who want to comment, can see them again and comment on them again and see them in the context of the quantitative impact survey that we did. And that's the right way to proceed. That's how we would ordinarily proceed, and we don't see why we would deviate from that. And this is the conversation we're now having with the leadership of the FDIC and the OCC. And my hope is that we'll be able to come together around a way to proceed forward, you know, very soon. I'd hope we would have done so by now, but I believe we will do so fairly soon.
Thank you for joining us today, Chair Powell. I look forward to working with you to strengthen this economy. For senators who wish to submit questions for the hearing record, they're due 1 week from today, July 16th. To Chair Powell, please submit your responses to questions for the record 45 days, no more than 45 days from the day you receive them. Thank you for your testimony. The committee's adjourned.
All right, and of course, you've been listening to Fed Chairman Jerome Powell. And let's get a check on these markets, how they've been moving during the Fed Chair's
Powell
testimony.
concludes the testimony before the Senate committee.
High right now, up about 0.2%. You take a look at the NASDAQ 100, it's the same thing. Again, record highs on the stock market. The bond market, this is interesting. I mean, it's a small move, but it's a move nonetheless. You've seen yields climb at the long end throughout the testimony. Yields currently up about 3 basis points on the 10-year yield. We're back above 430. Of course, we're going to unpack on what Jerome Powell actually said and what the follow-through to markets is.
You know, the interesting thing is, if you look at the GIP of the 10-year, and Joe, if you could just bring that up, one chart of the 10-year yield moving throughout the day, you see that it climbed higher and higher, the yield did, throughout Powell's testimony. And in my very basic understanding of the bond market, that means that no one's expecting a rate cut to come anytime soon because they're selling this debt and pushing the yield higher.
And of course, Jerome Powell didn't want to commit to anything when it came to timing. Let's unpack this all with Mike McKee, sitting to our left, very patiently listening to the Fed chairman. Tell us about the substance of what he actually said today.
Well, it was pretty much exactly what we expected from him. He talked about the economy being strong and the labor market coming into better balance now. He said at the very end that it's not a source of inflationary pressure or a lot of inflationary pressure anymore, which is kind of a key view for the Fed because they've been looking at the service industries and wages going up there as a sort of guidepost to when things would get better. Inflation is getting better. He says they're not there yet, but the Fed has said in the past, although he didn't repeat it today, that they would start cutting before they get to 2%. So kind of leaves things where they are. Now, I had to make up a graphic of the key quote of the day, which was what the markets were waiting for, and Jay Powell said this.
So the EIA lowers their forecast for 2024 world oil production by 200,000 barrels per day. So they now expect output to grow by 600,000 barrels per day year on year to 102.4 million barrels per day.
Cutting rates. A lot of stuff on banking as well, a lot of bank regulation questions. He didn't go very deep into that. He basically said that the proposals that they're working on, the Basel III implementations, should be finished sometime soon, but probably because they're going to go through another commentary phase, wouldn't be put into practice until next year. One interesting question that he was asked about was the Supreme Court ruling in the Chevron defense case. He was asked if the Fed makes regulations and the Supreme Court or some other court could overturn them, what would happen? And he said, we work very hard to keep our regulations within the law, and we think that that will not be a problem for us. But he said it's a new decision, so we don't really know.
I also want to bring in now Liz McCormick of Bloomberg News, of course, who covers global macro for us. And we were talking a little bit outside, of course, of the initial talk around rate cutting. You also had a lot of topics outside of that, but you did still see the Treasury market respond as we have been talking about. Liz, how are traders repositioning now a bit and positioning into Thursday's CPI reading?
Yeah, and I think Mike is my brother from another mother because that one quote he sent, I sent that to my boss as well. You know, he was not going to give timing. But Shanali, I think bond yields are up slightly. I think because Powell was balanced, like Mike said, but you don't see the real pricing going away. They're still seeing 2 cuts. So I think people weren't able to say, oh, he got more dovish. Some people thought he might because of Friday's soft jobs. And he did say the labor market is cooling significantly, but he really stressed we need more data. Our mandate is more balanced. So I think it wasn't enough for people to kind of push yields lower. Plus, we have all
EIA raises their 2024 WTI price forecast to $82.03 a barrel. That's from the prior forecast of $79.70. So they're raising the 2025 forecast to $83.88 from $80.88.
So I think that left people saying, hey, let's put yields a little bit higher.
Mike, I thought the labor discussion was really interesting. I just find the theory fascinating about the growth of the labor force via immigration. And Mickey Bowman had commented a couple weeks ago about this. I was talking to you about it then, that if we get more restrictive in terms of incoming labor, we're going to see more tightness in that labor market, right? So if you do have, millions of people flowing in, that gives more demand to the labor side and actually brings inflation down a little bit.
Well, it could work both ways. If you have a very tight labor market because you've cut back on immigration, then that could push up wages. And we have cut back on illegal immigration. It's fallen quite a bit since the president put in his new policies. But economists have been looking at the level of immigration, both legal and illegal, and noting that it has contributed to a lot more people in the labor market. Jay Powell talked about that today without making
And the EIA have raised their 2024 Brent price forecast to $86.37 a barrel. That's from the prior forecast of $84.15. They've also raised their 2025 forecast to $88.38 a barrel. That's from $85.38.
the more immigrants we have, the better the labor market can do, because more people equals, in theory, more productivity. So it's an ongoing, interesting issue for economists, and of course, certainly a political issue in Washington.
And Liz, I'm going to give you the last word here. We only have about a minute left, but of course, we've been talking about CPI. We get another release this week. JP Morgan finds that the S&P 500 is priced to move 0.9% in either way. How important is this for the bond market? How much potential for volatility is there?
Yeah, I think it's very important because, you know, there's more data that Chairman Powell wants to see. Front and center is CPI, right? Inflation, as he said last week in Sintra, we're seeing that disinflation come, but they want to see more. And so if somehow this is a surprise stronger than expected CPI, because it's supposed to kind of show a tempering again, I think the bond market's not going to like that. And I think, like JP Morgan, I wouldn't argue with them, is saying you're going to see a lot of volatility in stocks. I can't see you're not going to see it in bonds as well. It's just that we're going to go from data to data because that's what the Fed's doing. So you're going to see these big moves if things are, you know, way below or way above expectations. So yeah, I'm on their page. It's going to be a big deal for markets. We'll be busy.
Yes, certainly. And of course, there's 3 more CPI prints before that September meeting. So a lot to look forward to there. Our thanks to Bloomberg's Mike McKee and of course, Liz McCormick. This is Bloomberg.
You actually offer a payout at 7 years to encourage people to explore if they don't find themselves in management position. I mean, what's the thinking? I mean, like, what's that about?
We're not forcing everybody to be kicked out, right?
But you encourage people to explore.
Exactly. We encourage people to think about their, because sometimes it's easier, even for me, if I don't need to change everything, it's easier, right? Change is really tough thing for everybody. Should I do this job for next 5 years, 10 years, or should I try a new thing? If I had to think, that is a great opportunity to think about it. We need to think about what kind of talents I can have for the next 5 years, 10 years. What's the best way to contribute to the world?
So the EIA says US oil output to increase by 40,000 barrels per day in July to 13.28 million barrels per day. That's the highest since November 2023.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
During his testimony, Powell said that regulators are close to agreeing to change their plan to force big banks to hold significantly more capital. And it's a move that could mark a major win for Wall Street banks because, of course, we know those rules are in the process of being revised. For more on this, we're joined by Bloomberg banking regulation reporter Katanga Johnson in Washington, has been breaking a lot of news just on this subject. And when you heard the dispute happening amid lawmakers right now in the Senate Banking Committee, what did you think about the debate itself? How much more can these new rules really face more contest?
It was really interesting to hear Powell describe that, yes, there will be changes, and yes, they're close to bringing those changes to a reproposal. But what he didn't mention was what the substance of those changes would be, or exactly how the big banks would benefit. We've done much reporting on where the discussions are, including a story last month that talked about the trading books of the biggest banks being most impacted, among other changes, of course. But really, it will really matter how substantive the changes are, one, and two, whether the OCC and the FDIC, the other agencies that have to vote on this plan, whether they can come to an agreement that everyone is satisfied with. Powell's made clear that there should be consensus, and I think a lot of the debate internally now is about what consensus looks like across the three agencies.
Katanga, what did you make of the fiery back and forth between Elizabeth Warren and Powell? Van Hollen kind of piled on there as well in terms of regulations that the Fed still needs to make dealing with bankers' pay.
It's an interesting debate. I think in a lot of ways the Fed should consider whether the FDIC's move ahead on that particular plan gets in the way of them making a move that could see the plan advance. There is a lot of expectation, as we saw, because of those heated exchanges on the Hill. Of course, banks are eager to hear where the Fed would land on that executive comp rule. But whether the Fed will take the cue from the FDIC and the OCC or whether they come up with a new plan entirely is yet to be seen. It is an interesting tension point, particularly as you think about that plan and other pending rules separate from the capital plan that regulators might be thinking about and are trying to get closer to, but really the capital plan takes a lot of oxygen out of the room. So on executive comp, we'll have to see whether they're able to get to that ahead of capital or afterward.
You know, the other thing you mentioned is the potential trading desk changes, and one thing that was interesting in the most recent stress test is the concern that they drew around what would happen if the 5 largest hedge fund counterparties failed. Hedge funds at max leverage at the end of last year heading into this year. How do you think that plays out in terms of how those new rules might look for the trading desks?
That's an interesting question. I imagine, and big banks wouldn't admit that they perhaps have been pricing in what the impacts of the capital plan would be on their trading desks. But I imagine they're weighing all together what the cost of these regulations would mean. But it's perhaps too soon, beyond just a forecast, it's too soon to say exactly what it would cost them in terms of complying with these new rules and how their trading desks might be impacted until the agencies decide how they want to address the capital plan and how that market risk is priced in. Other aspects to their trading books, I imagine, are front of mind for them, but it may not be front of mind for the regulators in the same way. So really, it comes back to capital.
It comes back to capital. That's a good place to leave it. Katanga Johnson in Washington, really appreciate your reporting. After several hours of listening to Jerome Powell on Capitol Hill, you take a look at these markets right now. The S&P 500 on track for a 36 record close so far this year. Of course, it's an even split if you take a look at the actual composition of the index. NVIDIA and Tesla leading the way. Big tech also rallying there. And the bond market, a little bit of a sell-off. Now, Bloomberg Crypto with Sonali Pasek is coming up next, but that does it for Bloomberg Open Interest. This is Bloomberg.
Arch has laid plenty of groundwork for future revenue, but for now, Mark Messler's most pressing challenge as CFO is conserving capital.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, and but we also have to be nimble around that as well because things change by the day.
Archer went public in 2021 in a reverse merger with a SPAC, Ken Moelis's Atlas Crest Investments. Through August 2023, the company raised over $1 billion from investors including Stellantis, Boeing, United Airlines, and Cathie Wood's ARK Investment Management.
Does that ARK investment open doors for you to bring in different kinds of institutional money going forward?
It does. I mean, I think there's a lot of credibility that comes in with an investor like ARK. As I think about, my top targeted list of investors over the next 2 to 3 years, an investment like that gives us some credibility and gives us a little bit of staying power as I go in and talk to other investors.
With the SPAC pipe now closed, Archer's facing a new phase of raising capital.
I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. I'm wanting to show them progress. I want to create credibility with them that we are marching towards our goals of commercialization.
Jason Kelly, and this season on Power Players, we're taking you behind the scenes to see how the business of sports has gone global.
I want sports to grow. I want sports to be bigger because we have talent.
And how mammoth value is coming from the smallest of players. 3,184 hits, 431 home runs, and of course, the most famous stat that everybody knows, 2,632 consecutive games played. Unmatched career. Why are you doing this?
What we have achieved in the NWSL from an investor perspective over 2 years is the equivalent of what it took other leagues 25 to 30 years to achieve.
You've got to have a business that's sustainable. The only way it's sustainable is got to make money.
There's only one word, winning. You win on the court, you win off the court. And as you do that, you bring people along.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders. From breakfast cereals to pet foods, General Mills has an iconic array of brands. But future success depends on efficiency, innovation, and insight. CFO Kofi Bruce does much more than crunch numbers.
Our first job is to intimately understand and anticipate the consumer's needs.
Watch Chief Future Officer. New episode Wednesday on Bloomberg Television.
Live from Bloomberg's World Headquarters in New York, I'm Shonali Bassick, and welcome to Bloomberg Crypto, a look at the people, transactions, and technology shaping the world of decentralized finance. And of course, today I'm joined by Bloomberg Intelligence Senior Analyst Eric Balchunas, one of the main authorities on crypto ETFs. I bet that's not a job you thought you would grow up to have.
No, let's just say I'm learning a lot. But, you know, ETFs to me are like bridges between the traditional finance world and the crypto world, and we go back and forth on the bridge all the time now.
And it's a big week, of course. We will talk much more about it in just a second here because investors are eagerly waiting to learn the fate of ETF applications for both Ether and Solana. And this is as SIBO files a request to list Solana funds by 2025. And we're going to talk to Bitwise's Catherine Dowling about how she views the chances of Ether ETF approvals this month. We're also going to discuss the price swings in Bitcoin as Mt. Gox fallout and fund flows cause volatility. Taking a look at the snapshot of the market first here because, of course, Bitcoin seeing 438 million in inflows in 2 days, and you are seeing a rebound in the market to the tune of about 2.5% today in Bitcoin. Ethereum also gaining to the same degree, and Coinbase up almost 2%, snapping 4 days of losses. MicroStrategy up for a second day, up more than 1% as well. And the recent drop in Bitcoin prices stems from the concern around the Mt. Gox bankruptcy, which happened a decade ago. But the firm is now returning about $8 billion of Bitcoin to creditors in stages, spotlighting the potential for a wall of supply to come into the market, and some jitters have been showing up in pricing. Bloomberg's Olga Karif joins on this now. And if you could explain the difficulties here that the market is facing with this slew of Bitcoin coming into the market because of Mt. Gox.
Sure. So Gox used to be the world's biggest Bitcoin exchange. It was based in Japan, and all of the early Bitcoin OGs had money on this exchange. And then in 2014, it went bankrupt. Some Bitcoin disappeared, and people have waited for 10 years to get their coins back. And finally, just a few days ago, the trustee overseeing the bankruptcy of Mt. Gox announced that he started repaying Bitcoin and Bitcoin Cash coins to some of the creditors. And, a lot of the creditors are expected to get their repayments by the end of October. I talked to some creditors. They haven't gotten the repayments yet, but, they're coming. And so a lot of the investors are worried about this billions of Bitcoin and Bitcoin Cash all of a sudden dropping onto the market and potentially pressuring prices.
Olga, I'm really curious about the nature of some of the holders here. You think, for example, the country of Germany, and you wonder whether some of the people who are receiving claims here would be willing to put money back into the crypto markets or not.
So the claimants in the Gox proceeding. So they're mostly, so a lot of them are funds that have bought up claims of smaller creditors, but there are still some creditors as well. And the Mt. Gox repayments are happening at the same time, as you mentioned, as the German government is selling their cache of bitcoins that they have about, over $2 billion worth of Bitcoin that they received by earlier this year by closing off some illegal activity in the country. And so they're starting to sell their Bitcoin as well, and this is pressuring prices as well. So a lot of supply concerns in the market right now.
Olga, we thank you so much for keeping an eye on the market, and of course all of the sellers. I know you'll be talking to the buyers as well. That is Bloomberg's Olga Karif. And we're going to turn to the latest, as we've been talking about, on the ETF filings under consideration by the SEC. And Eric has been so ahead of this story. If we think about what is around the corner, what is your expectation for an approval of an Ethereum ETF? And also, what kind of demand can you expect?
Yeah, so I think we're going to get response and guidance from the SEC sometime this week. And everything's done, basically. We're just waiting for the formality of the SEC to say, okay, issuers, here's our game plan. Send in the final documents by next Tuesday, and you can launch on Thursday. We're that close to the finish line. We just need to know, what the SEC says. So we're waiting to hear that. If you ballpark estimated, I would say next Thursday is probably a reasonable estimate for when they'll launch. How much money will they take in? Look, I look at silver and gold. I look at Ether and Bitcoin in other parts of the world. I estimate 20% of the assets. So, a little bit of a sidekick, to be honest. I don't think Ether is going to really grow much bigger. I think Bitcoin is the stud crypto asset. It's easy to explain to, any investor. It's digital gold. Ether's a little trickier. It's harder to explain what it is, what the value is. Maybe I'll be wrong. Some of the Ether people think I'm underestimating it. They tell me all the time. But based on those other paradigms, I would say Ether would be lucky to get 20% of the $60 billion that the Bitcoin ETFs have gotten.
It's fascinating because you're seeing this at the same time that people are starting to talk about the next ETF for crypto, Solana being among the top of that list. And if you think ETFs for Ethereum would be a sidekick, why even look to the Solana ETF right now?
Yeah, because if you are first, you're probably going to get a nice payday. So right now, these Solana applications, in my opinion, are basically call options on a Trump victory. Because if Biden wins and we get like Gensler Part 2 or somebody like Gensler, they're not going to approve these. It's a long story why, but they're just probably not going to. Trump wins, let's say he appoints someone like Hester Peirce or a more libertarian chair, well, anything's possible. So there's a 240-day clock that just started that will be March 2025. So the election is between now and then. So this is a little bit like just a flyer, a call option on what if there's a change at the White House, and we'll see what happens. If there is, then we're looking at maybe more coins even beyond that. If there isn't, I think we're kind of locked into these two coins for a long time.
Something to circle your calendars for March of 2025. Eric will be sticking with us, but for more, we're also joined by Bitwise Chief Compliance Officer Catherine Dowling. And if you think about what we're seeing in the market right now, it's such an interesting time to think about all of these new products that are coming to the surface around the crypto community because of the weakness you're seeing in Bitcoin. Catherine, how do you think about this as an issuer? You're on one hand seeing a lot of interest in the cryptocurrency really waning, but new products coming to launch. What's the dynamic?
Yeah, thanks so much for having me. And we've actually dialogued with the SEC about the possibility of what's coming down the pike with new products. And it is interesting, as Eric pointed out, some of those new products may have to wait on a new SEC chair if that comes to turn in January, because otherwise I think it's going to be a really long haul to get some of these products out in the market, given the history we've had with getting these products to market and the fact of not having futures trading in some of these potential products. But it's an active dialogue, and I think our communication with the SEC about the prospects for these products has actually been quite welcoming.
That's fascinating. And if you think about the other thing Eric was pointing out was there's the SEC as one part of things, but then there's the retail investor interest or even institutional investor interest. How do you see investors really rallying around the idea of Ethereum? Do you find it a harder sell than Bitcoin?
It's definitely a more nuanced sell, but I don't think it's a harder sell. I think it's got its own market structure that is explainable, not as easily explainable as the digital gold qualities of Bitcoin. You know, Bitcoin is the big leader, right? But we're 6 months behind here, and we're close to a launch of the spot ETH ETFs. Chair Gensler said it's going to be sometime over the summer. You know, everyone has a different definition of summer. It's been a little bit of a long, hot summer for the issuers waiting for that. But we're seeing in the S1 amendments that are filed that there are fewer and fewer issues that are being vetted back and forth between issuers and the SEC. So that points all signs in the direction that we are close to the finish line on the launch.
And let's talk about the marketing of Ether, right? So let's say you're talking to, a cousin or your uncle or aunt, and you're trying to explain Ether ETF. You just told them Bitcoin is digital gold. What's the buzzword or the sort of four-word marketing sort of slogan that you can give Ether where someone will be interested in it?
We try to explain Ether, and we have at heart Bitwise as a research institution. And what our research team does day in and day out is they create kind of easy to digest explanations of Ether, of these products, and what impact they're having on the technological furtherance of moving money over the internet. And I think once you break it down and explain that, it's not just a currency. It's not, you're not issuing another currency so that you can just go buy coffee at Starbucks. These are technological innovations, and these are businesses that are being run on the blockchain. So once you get into the explanation of that these are businesses and liken them to the evolution of the internet, I think it's more easily explainable and something that folks can grasp that maybe have no background, or even folks that do have background or have been investors in Bitcoin and are looking to see, okay, what's the next diversification move we can make? So those are conversations that you can step function and explain. And we have a lot of research and kind of easily digestible items on our website that I think help investors every day.
And we're going to have a race, right? We had the Bitcoin ETF was, I think, 11 or 10 ETFs launched in the same day. That's rare. We're going to have it a part two. You're going to be up against Fidelity and BlackRock. What is your plan to stand apart and get out early with assets and flows in really one of the most competitive matchups that we've seen in a while?
Well, first, it's great for investors that there are a number of us coming out at once, if that's how it plays out, and it's looking that that's the way it's going to be directed. And second, from our perspective, Bitwise, we set ourselves apart as the crypto asset specialist. We've been doing this for years. Yes, some of the other names you've definitely heard of, but we have been trading and we have been working just within crypto as specialists for many years now. And a lot of the behind-the-scenes operational mechanisms are really important to the trading of these products. So it's important to kind of look behind the names and see experience and who's been out there and who's been working with some of these traders in that operational mechanics behind the scenes mechanisms. Those are very important. And ultimately, the investor will win when you keep the trading spreads tight, and you can do that through that specialty behind the scenes.
Catherine, another thing I'm curious about is something that you put in your notes. This is the idea that someone needs to launch a new ETF that's 10% Ether and 90% tech stocks. Will you be the person to do it? And how soon could you get it done?
I can't speak to our future products, unfortunately, but we are definitely looking at what's going to be good for the investors. And we, every day, Bitwise folks are talking to institutional investors about what their clients are asking them for, what they're looking for, and it's it's an ongoing conversation. And we always look to be ahead of the curve and figuring out what's next and what's important for the investors for their diversification needs.
Catherine, we thank you so much for your time. That is Bitwise Chief Compliance Officer Catherine Dowling, of course, at a hot moment for this market. Now, coming up next, we're going to talk to Securitize CEO Carlos Domingo. He's going to talk about the hundreds of millions of dollars in assets flowing into his company's tokenized Treasury fund. And to access all the latest data and news on crypto, check out CRYP Go on the terminal. This is Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal.
The Deal.
That deal.
The Deal.
Huge deal.
Who dug this up? What are y'all's in trouble?
When South Africa has an election, Bloomberg Television has it covered.
South Africans are very connected politically. They know exactly what they want.
In developing countries like South Africa, when there is one-party dominance for too long...
Fed bids for 3-year notes total $9.4 billion.
Whatever we do will be based on stability.
Nobody covers global elections like Bloomberg. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
BlackRock's Institutional Digital Liquidity Fund, also known as BIDL, has become the first tokenized money market fund to reach $500 million in supply in under 4 months since inception. BlackRock launched the fund through the firm Securitize, and we're joined now by Securitize co-founder and CEO Carlos Domingo. And still with us, Bloomberg Intelligence's Eric Balchunas. And a lot of things at play here, of course. Carlos, when we talk here about this idea of money market funds becoming more tokenized, why do you think this one has brought in so much money so quickly?
Well, if you think about where the market fit for tokenization has been, I think the first asset class that was successfully tokenized was the dollar, right? So stable coins, which are essentially tokenized dollars, it's at 150 billion plus size. So I think that the next, more natural asset class to do that was the closest thing to a dollar, which is treasuries, right? So money market funds are basically short-term treasuries and repurchase agreements, which is what the BIDL fund is. And I think the reason this has been successful, obviously, one of them is because it's BlackRock. So it's issued by the largest asset manager and the most reputable in the world. But I think the other part is that it's really a full on-chain, tokenized money market fund where the tokens are issued on the public Ethereum blockchain. They're transferable peer-to-peer across whitelisted institutions. They have instant redemption through selling it through Circle using USDC. So it has a lot of features that make it not just like a tokenized money market fund, but something very useful for the crypto economy.
Well, the other thing about this, too, is that if you think about the people who buy even normal way money market funds, a lot of people are considering the prospect of a rate cut as early as September, the market increasingly believing so. How do you think that will impact the product? Do you worry that we are kind of looking at a boom time here, but facing a plateauing later on?
Well, obviously, the money market funds are more attractive when you're in a high interest environment like we are now. I think even if you get a rate cut, you still get a good return. I think it's 5.3 now. So even if it goes down to like 5%, it's still a good return. And it's also a very safe asset class, right? So you're basically investing in treasuries from the U.S. government. So I think a lot of people will continue buying and consuming money market funds, even if interest rates go down. And then what I think will happen is that the next kind of natural asset classes that give you a higher yield and that are still, safe, like, private credit and other type of funds will kind of emerge and start growing from there.
And so I was just in Europe and I was told that tokenization is coming for ETFs and they're going to be the next big thing. And I got to make sure that our ETF analysts don't need to start analyzing tokens soon. But here's my question is, ETFs, right? You want exposure to high yield debt, treasuries, S&P. You log on to your Schwab account or whatever. You hit buy, and then you own it. It costs nothing. It was a frictionless transaction. I just don't see what's disruptable there. I find that tokenization of stuff that ETF covers could be a solution in search of a problem. Am I missing something?
Well, you're absolutely right. Like, if it's tokenization for the sake of tokenization, just use a different ledger to represent the securities. It doesn't add any value. And national market securities like ETFs are pretty accessible.
So in 10 minutes time now, at the top of the hour, we do get the 3-year notes auction. So the US expected to sell $58 billion of 3-year notes with a prior bid to cover of 2.43 and a prior high yield of 4.659%. So just taking a look at a preview before this auction then. So lower yields and fair valuations and elevated near-term risk suggest further concession from Monday's closing levels would be needed for good auction results. That's coming from JP Morgan's strategists. So latest CFTC positioning data shows speculators were net short 1.5 million 5-year note futures. It's near a record and a possible source of covering demand. So dealer inventories in the 2 to 3 year sector were net long $13.6 billion in the week ended June 26th, as versus $8.9 billion average net long over the past 12 months.
So we've actually, the first kind of like major asset manager that worked with us was KKR, where we did a tokenization of a private equity healthcare fund. That was exactly the same idea that you mentioned, Eric. I think that in terms of regulation, it all, funds can be registered to be sold to investors, right? So there's something called the 40 Act funds that are basically registered funds that, individual investors, even retail, can access. Of course, these days, because we use blockchain as a ledger to represent the securities, it's a bit like a lengthier process than it should be with regulators to register these funds. But hopefully those barriers will disappear over time and we'll see tokenized asset classes for retail people accessible.
It's interesting, Eric's question, because you have a lot of private equity, private credit firms, other firms that are looking at private assets largely to go to retail investors. And I'm wondering, Carlos, if you think that the effort to tokenize them can also fuel the ability to lower fees on a lot of these products as well, given the intense demand there is from that private asset industry to attract this kind of money.
So certainly tokenization should be a cheaper way of managing a fund, right? Because if you think about, for instance, what we're doing with the Build fund from BlackRock, when we issue dividends, we do just one blockchain transaction and we issue millions of dollars of dividends into all the wallets of the holders of the tokenized money market fund. We do instant redemptions without any manual intervention, etc. So and there is also less, if you want, reconciliation errors because you use a better ledger that is a blockchain essentially. So I certainly see lowering fees as an important thing, but I think that it's always more important when you bring new use cases and new functionality to a security, because it's easier to lend against it or it's easier to trade it than just like making it cheaper. I think always innovation happens when there's new stuff happening, not when you just make something existing cheaper.
Securitize co-founder and CEO Carlos Domingo, we thank you so very much for keeping an eye on this part of the market for us. And coming up, Bitcoin seeing a resurgence of sorts, inflows as people start buying the dip. More on the flows up next. This is Bloomberg.
News in New York. I'm Menace Credit.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg. Context changes everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
In 5 minutes' time now, at the top of the hour, the US is due to sell $58 billion in 3-year notes. The prior bid to cover was 2.43, the prior high yield 4.659%.
Digital asset projects saw inflows totaling $441 million in the week ended July 5th, according to CoinShares, and that's the first week of inflows in a month. We saw another $400 million poured into Bitcoin ETFs in the past 2 days. Eric, what are these new inflows? What do they mean? Where are they coming from?
Yeah, well, if you look at the tickers, I mean, almost all of them took in money the past 2 days, but I was more interested in the 20% drawdown over the past month. How strong are these hands? And I gotta say, they took in net inflows. Now, there was a couple weeks and days where you saw some outflows, but over that drawdown, it did not shake people out. ETF investors, in my opinion, I try to tell people this all the time, they're stronger hands than people think. They typically have this as a small allocation. It's not a big deal to them. Their main investment's the S&P. So they're just gonna be more tolerant of these drawdowns. So it's a good sign that they've kept the net flow year to date at $15 billion, even during that drawdown. So if you can hold the line during a drawdown, that number should go up the next time there's a rally.
Eric, we thank you so much for being with us today here. It's pretty incredible. You have Bitcoin ETF investors really still buying the dip, even though you see really a $15,000 change in the price of Bitcoin from its peak. That's all for Bloomberg Crypto. For Eric Balchunas, I'm Sonali Basak. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything. From the world of politics to the world of business, 2 times a day at 1 p.m. and 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world twice a day at 1 and 5 Eastern.
Shortly expecting results for the US 3-year note auction. The Treasury's pre-sale when issued yield comes at the top of the hour. Auction results will follow a couple of minutes after this.
From the world of politics to the world of business, this is Balance of Power. Live from Washington, D.C.
NATO converges on Washington. Welcome to the fastest show in politics as the alliance marks its 75th anniversary later today with a speech from President Joe Biden. I'm Joe Matthew alongside Kaylee Lines in Washington. Thanks for being with us on the Tuesday edition of Balance of Power on Bloomberg TV and radio. This is the latest test, Kaylee, for Joe Biden, as well as an alliance that's
Treasury when issued 3-year yield 4.407% ahead of the $58 billion auction. So again, that's the pre-sale when issued yield on the 3-year 4.407%.
Speech tonight and his press conference later on this week in terms of American voters and even allies, but also members of Congress, both House Democrats and senators, as they return to Washington, had some family meetings, shall we say.
So again, we're now shortly expecting the results of the 3-year note sale. On release, I'll be leading with the bid to cover ratio.
The nominee. We'll be getting into this with our panel and with a member of Congress, Brad Sherman, a Democrat who was in that meeting. Will join a bit later on, Kaylee. There was no kind of exodus that was predicted yesterday when Adam Smith raised his hand, who's, of course, the ranking member on the House Armed Services Committee. We thought maybe we were on the brink of the dam breaking, but it just hasn't felt like that today. And the White House thinks it's been a pretty darn good 24 hours.
Yeah, we'll see about the next 24 to 48 as we see the president in action at the NATO summit. So we have a lot to talk about this hour. First, though, as always, considering Chairman Powell was testifying on the Hill earlier today as well, let's get a check on the markets with Charlie Pellet up in New York.
Hi, thank you very much, Kaylee Lines. Welcome back. We are at the best level of the day right now on the Dow Jones Industrial Average. Right to the numbers with the Dow up 109 now, up 0.3%. We got the S&P pushing higher, up 12, gain there of 0.2%, and NASDAQ now up by 16 points, a gain of just about 0.1%. Stocks holding near records as Wall Street views Jay Powell's economic remarks as balanced, reinforcing speculation the Fed will be able to cut rates this year. We've got the 10-year at 4.30%, the 2-year 4.63%, gold down 44 cents the ounce to $23.58, little change, and West Texas Intermediate crude down 0.6%, 81.85 a barrel on WTI. Jury deliberations now underway in Bill Wang's market manipulation trial over the collapse of Archegos Capital Management. Intel shares, they are back in the green.
2.67, 2.67 with a high rate of 4.399%, 4.399%. The US sold $58 billion in those 3-year notes, awarding 78.35% of bids at high. Primary dealers take 14.78% of the sale, direct 21.26%, indirect 63.97%.
Up 0.2% on track for another record close. Balance of Power continues now. Back we go to Washington, and once again your hosts, Joe Matthew and Kaylee Lines.
All right, Charlie Pellet in New York, thank you so much. Kaylee and Joe, indeed, coming to you live from Washington, which is a busy town, I must say, this week. A lot of roads leading to the Bloomberg office here. Blocked off, closed. I think traffic was a nightmare this morning because there are a lot of important people in town, Joe, including the NATO countries.
True, yes.
There's more than 30 of them, and it's all teeing up a very big moment, or moments, plural, for President Joe Biden.
Yeah, if you want some real elitist complaining here, you can't get around the nation's capital. It's brutal outside. It's also about 100 degrees if we put those two together. That's kind of the backdrop for this summit. And can we welcome Kaylee Lines back? It's great to see you. We missed you for the last week. Now that we get serious about some stuff here, this is an important moment. Joe Biden's going to speak around 5 o'clock, about 4 hours from now. That will be followed by his news conference on Thursday. The world is watching, not just Washington, and we'll bring you up to date on what's been happening on Capitol Hill earlier today. Let's bring in Nick Wadhams first to talk about what's behind this summit and what we should be looking for. He runs our national security coverage here in Washington, and it's great to see you back here, Nick. This is a big deal, 75 years. It's got a bit of a cloud hanging over it because of domestic politics, questions about Joe Biden. All of these leaders are being asked about their relationships with him, but also some of the uncertainty following elections in Europe. This is a peculiar moment for this summit.
Yeah, I mean, it's the timing in a lot of ways could not be worse. I mean, this was supposed to be a summit that was going to be a celebration of NATO, talk about unity, project a real show of force against Vladimir Putin, talk about the defense of Ukraine. And in a lot of ways, it's doing exactly the opposite. So you have a lot of concern about the long-term viability of these leaders. Obviously, Joe Biden over his age, but the fact that he trails Donald Trump so much in the polls. French President Emmanuel Macron made an election gamble that didn't turn out so well for him. He's looking hobbled. Germany as well, rise of the far right in a lot of ways. So you have these leaders coming in where their focus really is elsewhere. And then underneath all of that, you have the fact that they can't agree
The US
on
Treasury
Ukraine.
3-year yield dipped slightly after the 3-year auction. Still up on the day. It last up around 1.6 basis points. Though keeping an eye across the assets as well. Dollars saw a little bit of weakness come through following that tail on the auction. S&P a little bit of strength came through.
And of course, Ukraine is going to make the case in person here. President Vladimir Zelensky is in Washington for the summit. If not an invitation to be a member, can Ukraine expect anything tangible to come from NATO within the next few days?
Well, I think what you will see, what we're hearing is that there will be an announcement around air defense. What they really want is additional air defenses, so maybe some more Patriots, a few more batteries, something like that. And then a potential form of a longer-term commitment. But what we're not really going to see is anything that actually changes the situation on the ground that would allow Ukraine to expel Russian forces from its territory. We're going to see Ukraine basically be in a bunker mode. And so that's really the bigger question on Ukraine that hovers over this whole thing. Okay, you're going to continue flowing weapons to Ukraine, but not give them the weapons they need to expel Russia for good. So then what is the long-term end game here? Do you just keep going indefinitely? Something they have not been able to answer.
Questions about, you mentioned air defenses, the use of F-16s, which we labored over for months, Nick. We talked to you about it. It was a no, then a maybe, then a yes. Now apparently there are some real challenges in training pilots, even getting runways to be adaptable in Ukraine. Was this idea a failure? Did we finally say yes at one point? We should have said no.
Well, I mean, I think what you saw there was a desire to essentially, this was something that Vladimir Zelensky really wanted, but it's a real numbers game. Obviously, the question of pilots. So the number of pilots you would be training, it's a pretty small number in Ukraine. You have language issues. These guys would be flying a system and working with trainers who are speaking English when they may not speak English. And then just the broader term issue of, well, what's this going to look like? How long is this going to take? And how many planes are you actually going to be able to get up in the air to make a difference? And right now, it's one of these things that, the time lag is so long. I mean, you're looking at years to get these jets in operation over Ukraine, and then you'd be talking about a small number. So it's a big investment for not a lot of show.
Well, and if we're talking over the span of years, a lot could change within the course of just the next year, including potentially who the president of the United States is. How much should we expect to hear from NATO members about their plans for the potential of a Trump 2.0? How much will that dominate the conversation this week?
Well, I mean, it's a great question because there is no question that it is one of the biggest things on everybody's mind, essentially, aside from Joe Biden's age. But there is also no question that they really do not want to be talking about it, or they will be talking about it in a way that they don't acknowledge it. So you have Canada coming and saying, okay, we're going to offer our path to the appropriate level of defense spending, 2% of GDP. We're going to tell you how we're going to get there. We're not there yet, but we want to get there. That is something that's really aimed at appeasing Republicans, Donald Trump, who say, listen, everybody in NATO needs to be spending that amount. So you're going to see a lot of Trump-proofing / Trump orientation in anticipation of him coming, but this is not something, I mean, I'd be shocked if you hear any one of the 30 or so NATO leaders who are in town actually say his name publicly. They're just not going to do it.
Isn't that something? We're going to spend a little time later this hour with the foreign minister of Latvia. What does a successful summit look like to her?
Well, the Latvians, like the Baltic countries, they want Ukraine to get far more guarantees. They want a much more robust path for Ukraine to get to NATO, and they also want NATO to make very firm commitments about protecting the eastern flank, because Baltic countries fear that if Vladimir Putin starts to look beyond Ukraine, the first place he's going to look is to them. Yeah. So what we are hearing so far is that Baltic countries are not especially happy with the language that's coming out of this one. They feel that leaders have not budged sufficiently to offer the guarantees that Ukraine wants. I mean, they are certainly an outlier in the overall sentiment of what NATO feels toward Ukraine, but they're not happy right now.
Even as Europe has stepped up contributions, what will we hear on that front?
Well, I mean, again, what you're seeing is a lot of dispute between the fact that there are some countries like the Baltics that want more financial commitments. Obviously, they don't have the kind of money that the U.S. and Germany and the UK have, against countries, the big countries, the U.S., the UK, Germany, not wanting to commit long term. I mean, that's what NATO really wants. Jens Stoltenberg, the outgoing Secretary General, he wants long-term commitments from all these countries, basically to move well beyond Trump and offer those guarantees to Ukraine. They do not want to offer that. So I expect you'll see some financial commitments, but certainly not in the tens or 20s of billions of dollars that Ukraine would want.
All right, Bloomberg's Nick Wadhams, who leads our national security coverage. Thank you so much, setting the stage for us.
Great primer.
On this first day of the NATO summit here in Washington. And as we spoke with Nick about, it comes at a time of great domestic question for the United States and President Biden as he gets set to speak at NATO later this afternoon. Just about 4 hours from now is when he is expected as lawmakers on the Hill debate whether he should be the Democratic nominee as they return. We're joined now by one of them, I'm pleased to say, live from Capitol Hill, Congressman Brad Sherman of California. The Democrat is with us. Now, Congressman, we do want to talk to you as you sit on the Foreign Affairs Committee about NATO and some other matters as well. But, of course, there was a caucus meeting with you and your colleagues this morning. Did any consensus about the future of Biden as the nominee emerge from that meeting, or did it just create more confusion?
Well, we had a consensus that Biden has been an outstanding president. Biden had a bad night. Trump has led a bad life. As to what we should do now, I won't say that, we're a Democratic Party. We've got a lot of different views. Some thought that no matter what, Biden should be our nominee and it shouldn't be discussed. Others thought we are to urge Biden to drop out. I took kind of a midpoint. I think that the delegates will make the best possible decision if Biden provides more tests and more information. We'll see that in the press conference he's going to do in a couple of days. I would like to see him for 90 minutes live at 9 p.m. In the next couple of weeks, because on September 10th, he's got his second debate with Trump, which will be 90 minutes live at 9 p.m. And it's important that the delegates have a chance to see him perform under a similar circumstance.
This isn't an endless conversation, obviously, Congressman, and I can hear your support for Joe Biden here. While I realize you want to see more, how much time is there for Democrats? Is it between now and the convention in Chicago, or are we looking at a couple of weeks here, knowing that we've got issues potentially getting on ballots and so forth, if it's not going to be Joe Biden at the top of the ticket?
I think it's clear that we can get on all the ballots if we act at the time of our convention. Ohio was an outlier. They've changed their rules. So although we were planning to meet Ohio's requirements by having a virtual vote in early August, we can now do this on August 20th, and that will work for all 50 states.
So he's got a month. The convention is the deadline.
Yes, and yet I think we'll be making a decision, a collective decision, long before then, and it's I think important that we see before the convention that Biden can meet that test of September 10th when he debates Trump a second time.
What we have heard from the president, Congressman, is a suggestion or a pushback against polling that suggests he is lagging behind Donald Trump in a meaningful way, or perhaps that has widened since his debate performance at the end of last month. Do you believe what you're seeing in the polls?
Well, It takes a while for a major event to really register with the public and really be reflected in the polls. And so I think it's polls for a few days from now that will reflect what happened on June 27th. But I don't think anybody would say that the debate performance helped the Biden campaign. And I think a similar performance on September 10th would be a big problem. And that's why I think we need our presidential candidate, the leader of our party, to demonstrate that, in the words of Nancy Pelosi, that was an episode, not a condition. I think he can meet that test. I prefer the test to be as close as possible to the one he'll face on September 10th. But there'll be a number of ways in which he demonstrates to the delegates, who are the ultimate decision makers here, that he is fully up to the job, not only of beating Donald Trump, not only of beating him in the debate, but also in governing this country until the end of his second term.
Well, as a Democrat who has not yet made up his mind on this or found common ground with colleagues in the House, and from your perch on the Foreign Affairs Committee, Congressman, what are you looking for when Joe Biden speaks at the NATO summit today at 5 o'clock? What do you want to hear? What spirit do you expect him to bring to the podium?
I want him to deal with tough questions that he may not have anticipated, and to acquit himself well. I am very sure that his policies toward NATO will be reasonable and ones that I would generally support. So I'm
Shortly expecting results from the Fed reverse repo facility.
Does he have the right views about our foreign policy? I'm looking at that press conference to see whether he can convince the country that that one debate was just an episode.
Okay, so if you're not looking for policy, Congressman, others might be. Is there a tangible outcome you would like to see from the NATO summit this week as it pertains to Ukraine or anything else?
Well, I think we need European countries and Canada to step forward and meet that 2% commitment. The majority of NATO countries have done that, but most of that majority are the smaller countries with the smaller gross national products. We need to see Germany and France step forward. We need to see Canada step forward and spend more on their own defense. They used to think that they're on a totally safe continent. That is clearly not the case.
73 counterparties take $423.152 billion at the Fed's reverse repo operation.
And the idea of European nations looking to stand up their own armies, possibly an EU army, in a world in which the United States is no longer leading as the tip of the spear in this alliance. Is that a conversation that you're allowing?
I think that if they spend the money, and particularly on equipment, and develop their own military forces, that the NATO command structure will work well. I think that if there are so many reasons for Europe to be able to do more, maybe one of those reasons is that under a Trump administration, America would do less.
It's great to have you, Congressman, weigh in on that, given your seat on the Foreign Affairs Committee. Just in our final moment with you, knowing you also sit on House Financial Services, what's your top question for Fed Chair Jerome Powell when he testifies before you tomorrow?
Well, the big issue here was his testimony today that they're going to completely revise and republish the Basel III banking regulations. Too many of our regulations push the banks to put their money on Wall Street and not to make those small loans to businesses on Main Street. And we need bank regulations that don't unfairly discriminate in favor of buying $1 billion bond portfolios, and instead push the banks to their traditional role of making loans in local cities.
Great to have you back, Congressman. We'll be watching and listening. That hearing starts 10 a.m. tomorrow as Jay Powell moves to the House side. Brad Sherman of California with the view from a Democrat in the middle of this conversation today. Kaylee, pretty interesting. That was a private meeting that we were talking to him about. No cameras or microphones.
Yeah, just a lot of questions for reporters who are out there sweating in the heat as lawmakers emerged. And as the congressman suggested, doesn't seem like they emerged with one idea of whether or not Joe Biden should continue.
I think we got a TBD on that one. Joe Biden speaks next, 5 o'clock. We'll bring you that speech live here on Bloomberg TV and radio.
Asia is at the forefront of some of the world's biggest stories. I'm Chevryan in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Lots happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been.
It's been 10 minutes time now at the bottom of the hour. We're expecting possible comments from Fed's Bowman.
Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything. Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders. From breakfast cereals to pet foods, General Mills has an iconic array of brands. But future success depends on efficiency, innovation, and insight. CFO Kofi Bruce does much more than crunch numbers.
Our first job is to intimately understand and anticipate the consumer's needs.
Watch Chief Future Officer. New episode Wednesday on Bloomberg Television.
DOJ or other authorities.
Could face bigger challenges.
What's next?
It was going to keep reading World Cup.
This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
When South Africa has an election, Bloomberg Television has it covered.
South Africans are very connected politically. They know exactly what they want.
In developing countries like South Africa, when there is one-party dominance for too long, we don't get that economic growth, we don't get accountability.
Whatever we do will be based on stability.
Nobody covers global elections like Bloomberg. Context changes everything.
It's 1:21 on Wall Street. We do check markets all day long here at Bloomberg. We begin with a developing story and a headline right off the Bloomberg Professional Service. Oracle shares now trading lower, down 3.7% after the information reported that talks with Elon Musk's XAI about potentially expanding an existing server deal have ended. Now, according to this report, the companies have been discussing a multi-year agreement to rent NVIDIA chips from Oracle for a planned supercomputer in what would have been a $10 billion deal. Again, we've got Oracle trading lower, down now by 3.3%. As for NVIDIA, holding on to its gains, up now by about 1.2%. Stocks are trading mixed. However, NASDAQ is now lower after earlier gains, down 6 right now, a drop of less than 0.1%. Little change there. The S&P up 7, a gain of 0.1%. The Dow up 78, up by about 0.2%. 10-year 4.30%, the 2-year 4.62%. Gold up 50 cents the ounce to $23.59. Little change there. And West Texas Intermediate crude down 0.4%, 82.03 a barrel. Again, repeating our top story, Elon Musk's XAI and Oracle have ended talks on an AI server deal. This according to the information. Again, Oracle shares are lower. Right now, Oracle down by 3.2%. Balance of Power continues now. Back we go to Washington. Once again, your hosts, Joe Matthew and Kaylee Lyons.
All right, Charlie Pellet with a look at the top stories in financial and business news today. Meanwhile, here in Washington, we have a few top stories, and to some extent, they are related, as one pertains to the future of President Joe Biden as the Democratic nominee in this 2024 election cycle. The other pertains to something else on his plate this week, which is the NATO summit that is being held here in Washington. He will be speaking at that summit less than 4 hours from now, Joe.
Yeah, we'll bring you some of his remarks to get a sense of how it's going. I don't know, he's going to make a lot of news today, Kaylee. This is kind of the opener. But every time Joe Biden is in front of a camera, it's a moment here. That's just kind of the world that we're in. Just hours after House Democrats met on this matter. You were hearing us discuss it earlier. There doesn't appear to be, following our conversation with Congressman Sherman, any consensus moving forward. Everyone's in a wait-and-see mode, and I suspect that goes for our panel as well. Adam Hodge is with us today, Democratic strategist, managing director of the Bully Pulpit International, and a veteran of the National Security Council in the Biden administration, joined by Lester Munson, of course, Republican strategist, back with us from BGR Group. It's great to have both of you with us here. Adam, this is another test today, as we've been seeing for Joe Biden. But coming off of that conversation we just had with Congressman Sherman, is this good news or bad news when you hear a California Democrat saying, I support Joe Biden, but we haven't found consensus yet?
I think there's no question that the president has had a good 24 hours. And if you look at where the conversation was leading into this weekend, I don't think what you heard from Brad Sherman there was what you would have heard of if we didn't have the last 24 hours from the Biden campaign. The president has been forceful. He's been clear about what his vision and what his record is. He has to maintain that for the next 119 days to prove to the voters why he should be the Democratic nominee. Only he can do that, and that's the task at hand for this week.
It's been 5 minutes time now at the bottom of the hour. Expecting comments from Fed's Bowman.
And at the debate in September through Election Day.
Well, Lester,
So Fed's Bowman speaks on promoting an inclusive financial system, followed by a Q&A at an event in Washington.
Could one speech this evening at NATO or one press conference later on this week that we're expecting Thursday go to erasing some of those concern, or is it going to take more than just a few good moments to erase the bad ones?
I think it's gonna take more than a few, Kaylee. The speech today, I don't think is gonna push things one way or another, absent some dramatic event, because he'll be likely reading off a teleprompter, and he can do okay in that kind of situation. The press conference later this week is a little more interesting. Is he going to get some unexpected questions? You know, the White House the staff have been hit for trying to manage these things a little too closely. Can they have a freewheeling event, and can the president be in the moment and be fully responsive and give clear and complete answers? That would be a nice step forward for him. But he's going to have to do that consistently for the next 4 months.
A lot of questions about the president's relationship with his doctor and whether he was seeking some sort of therapy for something more than just getting old. Parkinson's came up a number of times in the White House press briefing yesterday, and his doctor had to issue a letter last night, 2 pages long, to clarify. I want to bring you back to the White House briefing room yesterday. Karine Jean-Pierre, the press secretary, and a back and forth with reporters on this.
Was this expert's visits, was multiple visits to the White House pertaining at all to the president?
Well, here's the thing. I've said he has had 3. He has had three physicals. In those 3 physicals, that's when he has seen a specialist, a neurological specialist. I cannot speak to every person because there's actually a security reasons to protect their privacy. We respect and protecting people's privacy, so do not want to share. I'm not going to share people's names from here.
Very basic, direct question.
Wait. Hold on. Wait a second.
8 times, or at least once, in regards to the president specifically.
Hold on a second.
That's what you should be able to answer by this point.
Wait, no. No, wait a minute. Ed, please. A little respect here.
That's Ed O'Keefe, our colleague at CBS News, from the briefing room yesterday. So we go to a 2-page letter from the doctor, Kevin O'Connor, who visited the White House. He said, Kevin Kennard visited the White House several times over the last year. This is the neurology consultant to the White House medical office, and he apparently holds neurology clinics at the White House for active duty military members. This is difficult for people to start getting through their heads here. Exactly who's coming, who's going? Did he see a neurologist? Does he have Parkinson's? You know, there's something about if you're explaining, you're losing, I think, is the line. Is the White House communications office, the press office, up to this?
Look, I think what you heard from the White House last night is that the president has seen a neurologist. The words were very careful. A neurologist at each physical. Having been in the White House medical unit, having seen people who've come in and gone out of that room, there are a lot of experts who treat a lot of active duty and reservists who work at the White House. There's an act. I mean, he is the commander-in-chief. Let's not forget that. Sure. He has military aides who are with him all the time, and they also get care through the White House medical unit. The doctor was very clear.
Shortly expecting possible comments from Fed's Bowman. Again, they are speaking on inclusion in the finance industry, and so unsure how much monetary policy talk we'll be hearing from Bowman at this speech.
They determined and did an assessment, and they determined he did not have Parkinson's. That's what the doctor, I mean, he's a doctor. He's has a medical oath that he has to follow, and he has made clear that that's not the president's diagnosis. And so I think what you saw yesterday was the White House not quite able to speak to the full breadth of what Dr. Kennard, I think his name,
that's right.
What his full scope of work is there. They then got that clarity and informed the public. That's what you saw last night.
Well, I guess it becomes a question of knowing the intensity around of the scrutiny into Joe Biden and his mental and physical health right now. Is it not a moment in which the White House or the campaign needs to be embracing a kind of radical transparency? There's been a lot of talk about taking a cognitive test for both Joe Biden and Donald Trump. Would it not behoove President Biden, as a candidate who wants to be elected for another 4 years, go deeper into his 80s in the meantime, to just say, all right, fine, I will do it. I will put the questions to bed? My understanding is that the neurological exam that as part of his physical is more robust than a cognitive test. So I take that as, I'm not a doctor. Sure. Neither the three of us are doctors, but I'll take that from what I
So Fed's Bowman, as expected, does not comment on monetary policy in the text for her speech.
Should do over the next 119 days is everything they can to dispel this idea that the president is unfit to serve another 4 years. And so, like Congressman Sherman said, it's a good idea. The White House can have him do more press conferences in prime time. Also will help prep for the debate in September. Have a great speech at the convention. Do all those steps to show the American public that what you saw from Joe Biden over the last 24 hours is what you can expect throughout the rest of the campaign and in the next 4 years. That's his job.
Lester, I don't know if you read the New York Times this morning. I don't know if you go near the New York Times, but James Carville's writing an op-ed today, and man, it's a doozy. He says that Joe Biden is not going to be the nominee. Mark my words, the top line, Biden is not going to be the nominee. Will be out of the 2024 presidential race, whether he is ready to admit it or not. And he's proposing a new approach here. Forget all those people in the White House. Carville calling for a super democratic process, as he names this, to choose the nominee, starting with 4 regional town halls moderated by former presidents Obama and Clinton. I don't know what James Carville had with dinner last night, Lester, but what would happen if that took place?
Well, boy, talk about the clash of egos. It's pretty spectacular.
Say no more.
I did see that piece. I do like the New York Times most of the time. I think Carville is probably correct. This again, common sense tells us this. The condition of the president is only going in one direction, and he can, as much as the White House staff, God bless them, they're doing their jobs, are trying to offer some spin and some cover and explanations. People see what is happening. They saw it very clearly during the debate. The president he's going to have to be flawless going forward here if he's going to stay in this position and be at all competitive with Donald Trump in November. That's the real issue. And I think James Carville, I'm old enough to remember when he was only middle-aged and a pretty good campaign consultant for Bill Clinton. He really cares about the Democratic Party and about defeating Donald Trump, and that's where this is coming from. And so I think we should, the mechanics may not be perfect for what he's describing, but the sentiment, I think, is spot on.
Adam, you want to quickly weigh in on this? We've got about 30 seconds left.
Super democratic process.
I mean, I think the chances of Barack Obama stepping into an event like that are virtually zero. I think he has shown he has no interest in stepping into that. I think Lester raises a good point about where the Democratic Party is. We've got to figure out, and Joe Biden has to make the case of why he should be the Democratic nominee. If he does that, if he decides he's the nominee, then Democrats have to unite behind him.
All right, Adam Hodge, Democratic strategist and managing director at Bully Pulpit International. Thank you so much for joining us today alongside Republican strategist Lester Munson, who is the co-head of the international practice at the BGR Group. While we've been talking about the Democratic nominee and where the delegates ultimately are going to go, political reporting now, Joe, Nikki Haley releasing her 97 delegates and telling them to vote for Donald Trump
just like
at the convention.
So much for a contested convention in Milwaukee. We'll find out about Chicago.
Indeed, we will. Let's find out about some other stories in world and national news now and head over to Nancy Lyons in our 99.1 newsroom here in Washington. Hey, Nancy.
Thanks, Kaylee. Despite the chatter among many in the Democratic Party, a majority still say they're standing behind the candidacy of President Biden in the 2024 race. One of them is Michigan Governor Gretchen Whitmer, who has been on hypothetical short lists as a replacement. She told Good Morning America today she's not upending the 2024 race.
He has my full support. I'm a co-chair for the Biden-Harris campaign. I have great confidence in this president. He's got receipts he's delivered for the American people, and I'm glad that he's ready to continue this fight.
Whitmer says Biden is showing he has the energy to do the job. Well, President Biden will be hosting a high-stakes NATO summit in Washington this week to mark the 75th anniversary of the alliance. A special event is planned for later today. Since Biden became president, NATO has expanded with the addition of Finland and Sweden. Beryl may have left Texas, but the storm's impact will be felt for days. Many of the millions left without power when Beryl crashed into the Houston area as a Category 1 hurricane now face days without air conditioning as dangerous heat threatens the region. Global news 24 hours a day and whenever you want it. With Bloomberg News Now, I'm Nancy Lyons.
In global leadership are on Bloomberg.
We are 40 millions. We're a big country, and we really depend on the aid from the world. And we depend on the aid and the position and the stance of the US. So I would like to understand, what would it mean to finish war fast? If Trump knows how to end this war, he should tell us today. Because if there are risks to Ukraine's independence, if there are risks that we will lose the statehood, we want to be prepared for this. We want to understand whether in November we will have the powerful support of the US or we'll be all alone. Only our lives are at stake here, and nobody can just trade our lives.
Nobody covers the top global leaders like Bloomberg Television and Radio. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
You are also an owner, I should have pointed out, of 3 major sports teams.
That's right.
Right? And you're the first woman, as I understand it, the first woman to own 3 major, have a stake in 3 major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the, I guess, the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, Zay Poland. He did come to me and Susan O'Malley, and they said, Abe Polson says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me, and I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
The top names in business are on Bloomberg.
You need to have an AI game plan. We used to say that every company needs to think about becoming a software company. Now we say that every company needs to become an intelligent software company.
Context changes everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
It's 1:40 on Wall Street. We do check markets all day long here at Bloomberg. NASDAQ back in the green. The Dow, the S&P, they are both higher right now. 10-point gain on NASDAQ, up by about 0.1%. Stocks holding pretty much near their peak on a Fed Tuesday with Jay Powell speaking. Yes, you heard his remarks and saw the remarks on Bloomberg television and radio. S&P right now up 8, gain of 0.2%. The Dow up 59, up by 0.1%. We've got the 10-year now yielding 4.30% with a 2-year 4.63%. Spot gold up 0.1%. Little change right now. Gold 23.61 the ounce, and West Texas Intermediate crude down 0.7%, 81.75 a barrel. Oracle shares trading lower right now. We've got Oracle down 2.6% after the information reported that the company's talks had ended a potential $10 billion cloud deal with Elon Musk's artificial intelligence startup. Musk says XAI will go it alone. Volkswagen, meanwhile, lowering its forecast for operating return in 2024. ADRs of Volkswagen, little change right now. They are trading lower, down by less than 0.1%. Boeing delivered 44 commercial aircraft in June, the highest monthly total since the company curbed work in its factories in the wake of a harrowing near miss in early January involving a 737 MAX jetliner. Today, we do have Boeing shares trading lower. Boeing down right now by about 0.3%. Rival Airbus also trading lower. Right now, we've got Airbus down by about 3.1%. BP's ADR is trading lower after warning of significantly lower refining margins. It also predicted a write-down on the value of a plant in Germany of $1 to $2 billion. ADRs of BP, they are trading lower today as well. BP right now down by 4.3%. Again, recapping here, S&P up 8, gain there of 0.1%. Balance of power continues. Back we go to Washington. Once again, your hosts, Joe Matthew and Kaylee Lyons.
All right, Charlie Pellet, thank you as we keep our eyes on the markets, always here on the fastest show in politics, the Tuesday edition of Balance of Power here on Bloomberg TV and radio. I'm Joe Matthew. Indeed, Kaylee Lyons is back with us today as we usher in the start of an important summit this week in Washington, the 75th anniversary of NATO. And Kaylee, we've been talking about this so much through the guise of Joe Biden's well-being. He's going to be speaking later today. We'll bring you that address, of course, around 5 o'clock, at least some of his words to see how he's feeling and how he's projecting himself. But of course, this is a critical time for the alliance, Kaylee, to be meeting, not only because of Ukraine, but uncertainty throughout Europe following elections over the past week or so here, and a lot of questions about the future of politics here in the U.S.
Yeah, absolutely. These country's leaders may also be bracing for the potential return of Donald Trump, questioning what that might mean for this alliance that now, of course, is much larger as it celebrates its 75th anniversary with the addition of Sweden and Finland, of course, that we've seen under this administration. But you're absolutely right, Joe. We do expect that Ukraine will feature highly, as well as concerns about what Russia could do next if it indeed is victorious in Ukraine. And that's a concern that especially the Baltic states we know very much have. And we want to bring in now a foreign minister from one of those states, Latvia, the country. Baiba Braja is with us now here in our Washington, D.C. studio. She is indeed the Latvian foreign minister. Minister, thank you so much for being with us here on Bloomberg TV.
Thanks for having me.
And radio. Welcome to Washington. I'm sure it's going to be a busy several days for you.
And
what
very
are you
hot ones.
hoping to, and very hot ones, yes. What are you hoping to leave here with? What is your outcome that you were looking for from this summit?
All right, so NATO is a defense alliance. It has a particular meaning. It's political military alliance, the only of its kind. So the primary purpose of that is, of course, the defense of allies. So there is a lot of change that is happening with Russia's attack on Ukraine. So we have moved from out-of-area operations where we had choice of sending people to Iraq, for 6 months and then rotating them again, to a collective defense, back to collective defense, what we had in the Cold War times with General Eisenhower establishing the basis of that after the Second World War. So defending allies, having troops in place, having capabilities, having command control in place, ability to reinforce, and so on and so forth. So that package is the most important outcome. It goes hand in hand with support to Ukraine, obviously, because what Russia is doing in Ukraine is something that is considered a threat to all allies. So supporting Ukraine in its liberation fight is crucially important. They are fighting for freedom. That's what we all are there for. We all want freedom, right? So winning Ukraine is very important for all of us. And then, of course, working with a wider range of partners from Indo-Pacific, for example. They will be here for the summit to address other challenges and threats, such as, challenges from China, constant cyber attacks you would have seen, trying to change the balance of power globally. So that is also important for all of us, because it's not just about Russia's conventional war, it's also about the challenges to all of us, to who we are and how we function as democracies.
There's a conversation, of course, in Europe right now about levels of commitment when it comes to Ukraine, but also NATO more broadly as the alliance. Because of your border, you're on the front lines of protecting democracy as a NATO member. Do you worry about a fissure in European politics, having seen elections recently when it comes to this issue?
Well, NATO has had a borderline with Russia since it was established in Norway and other places. So now it's longer. Now it's Finland joined. The Baltic states have been bordering Russia since we were established 106 years ago. And since we joined NATO 20 years ago. So we are all peaceful countries, but we want to continue being peaceful countries. So that's why we established that defense capability together with the U.S. And U.S. is an essential member of that alliance, so that link is crucially important. So of course we are interested in successful U.S. Of course we have a share in U.S.'s concern, whether it's China, whether it's other challenges that we face together. So that's why we are together here in Washington as NATO alliance to address any threat to any ally.
Well, it's you, though, among the allies that potentially are most immediately affected if Russia were to decide to move beyond Ukraine. But that, exactly, Article 5, theoretically, if Latvia or any other Baltic country, any country in the alliance were to be attacked, theoretically that would trigger all of the NATO forces coming together in a defensive way. How should we think about what that attack could actually mean? Knowing we've seen hybrid attacks, cyber attacks, for example, Russia has been conducting in the region.
And China.
China as well, moving buoys in the river that separates Estonia and Russia. How should we be quantifying what an Article 5 triggering event actually might be? Could it be something like that?
So the important part is actually to have that situational awareness, which means to have the intelligence, reconnaissance capabilities to understand the threat. That means both on the Russian side, but also globally. It's about terrorists. It's about cyber attacks from wherever they can come. We have called out also Iran on cyber attacks. So it's important to have that situational awareness to be ready, because once you know what is happening, it's easier to respond. And this is where NATO together, we have invested so much. That's why we have that defense growth in terms of defense spending. That's why we have additional defense capabilities, and that means expensive technology. Satellites, that means, reconnaissance capabilities, that means drawing all the data together. Working with the private sector, giving back to the private sector contributing to that open source awareness. So it's a pretty complicated algorithm, but altogether as the alliance, it's not about the Baltic states, it's about whole of NATO, because we are in it together. And once we have that situational awareness, once we know what is threatening us or not, we are able to respond as necessary. So for now, there is no direct military threat to any of the allies because we have invested so much work to make sure that we have that deterrence capability. And deterrence is what we are seeking.
Well, Minister, I know you're here to engage with the administration and your allies here at the Convention Center just a couple of blocks away from where we are. And you're not here to talk about Donald Trump, but there is a debate about redefining Article 5 right now if he were reelected, and he's called into question whether certain members would qualify for Article 5 protection based on their contributions. Are you concerned about, or do you expect Article 5 to be redefined if Donald Trump is reelected?
No, we don't expect that. We worked very well with the Trump administration before, and we work with all the administrations, and I don't recommend to any politician to comment on another country's internal politics. But whoever is elected, we will work with him, her, them, and it's important for America to know that it has friends and allies. I mean, for all the countries, it's important to have those friends and allies, and there's no closer friend or allies at any country in NATO for America. And I think that's why also when President Trump was in power the previous time, it was very clear that there were all types of rumors that he would withdraw America from NATO and so on and so forth. But it never happened because at the end, we are better off, stronger together. And as I said, currently the defense spending is at the rise as never before. 23 allies are about 2% of GDP on defense, and it will be rising.
Speaking of spending money on defense or other countries' defense, we don't only have questions about what this election means for potentially U.S. membership in NATO, but also the amount of money the U.S. is going to be willing to continue to provide to Ukraine. It was very difficult for Congress to get the aid passed earlier this year across the finish line. If the U.S. could no longer provides that aid to Ukraine, what would that mean for other NATO countries if Ukraine is less in its ability to defend against the Russian invasion as a result?
Let me be straightforward. I think that it's in the U.S. interest to provide that aid because most of the money, almost all of it, goes back into U.S. economy, in the U.S. defense industry, sort of increasing its own capabilities, research capabilities. Also in terms of lessons learned from the war in Ukraine, it's both the war of the past, but also war of the future from what we are seeing with the drones, with targeting through mobile phones, with applications used for identifying the targets and so on and so forth. So I think all our military and defense industries are really working closely with Ukrainians to learn and prepare for those future wars that we might be faced with wherever. We don't know. We don't know where it can arise. So from that perspective, U.S. aid to Ukraine is a help to the U.S. itself to prepare for the future.
Do you expect to leave this summit with a clearer path for Ukrainian membership?
Listen, Ukraine is one of the strongest fighting forces in Europe today. I mean, it's a country, it's a power that has shown with the biggest army in Europe that it's able to defend itself. Yes, with the Allies' help, obviously, and that's will make NATO stronger. It will make America stronger once Ukraine joins NATO.
Should there be a timeline?
Possibly. Again, it depends on the success on the battlefield. The sooner Ukraine is victorious and we can reach a deal on the end of the war, as sooner we can sort of finish financing the war. But very clearly also then we can have a sort of post-war architecture with Ukraine in it.
But effectively, the war needs to end first before any of that
Ukraine needs to achieve that victory, that it has to define what is a victory. Nobody else but Ukraine has to define what is a victory on the battlefield. And we have to be there to support them to achieve that.
What do you make of the conversation that we're having here in the United States about our president now, 81 years old, and questions about whether he has the mental acuity to continue, whether his counterparts in NATO think that he should continue in the job? What's your thought? What does Latvia
Well, I met President Biden both when I worked at NATO, and I look forward to seeing him tomorrow at the summit.
Yeah.
And I wish at age of 81 I would be as strong as he is. We all have our ups and downs, you know, at some moment, so sure. I don't expect it to lead any kind of tragic outcome or anything. But quite clearly, American democracy will be able to handle all the challenges, and you will find a way through this or through other challenges. I don't doubt that, and you will be as strong as ever and as powerful as ever.
And so essentially what you're saying is the strength of the country is more about the country as a whole versus the figurehead?
Again, the figurehead is important, obviously. I mean, we all look up to
we
President Biden
president
or
as
President
the leader
Trump
of the free world.
Absolutely. So it's very important. But in the same time, obviously, we all have our ups and downs, and we cannot predict when that happens. But I don't doubt that U.S. is as strong as ever.
We'll be carrying his remarks when he speaks, marking 75 years. What do you want to hear from President Biden later today?
I want to hear that America and the link with allies is as strong as ever, that we are as united as ever, and the strength and the belief in freedom and democracy, both in Europe, in America, and support Ukraine is there.
Yeah.
All right, Minister, we appreciate you joining us here at Bloomberg today. That's Latvia's Foreign Minister, Baiba Braja, here with us around the table, and enjoy the remainder of your very hot time here in Washington. Make sure to hydrate. We appreciate your time, Minister. Thank you so much. And it's interesting, Joe, to hear from her there that effectively the alliance is looking at the United States of America. And sure, the president is important, given his, as I described, position as the leader of the free world. But ultimately, what it might come down to is whether the U.S. is still going to be there as a leading democracy.
And a system of politics that could be tested yet. The next test for Joe Biden comes at 5 p.m. Eastern Time. We'll have our eyes and ears on his address from the NATO summit. And we'll meet you back here at 5 o'clock for the late edition of Balance of Power. It's on to Bloomberg Business Week now, live from New York on Bloomberg TV and radio.
The linear business is not going anywhere. The sports business is moving and is going to figure itself out between digital and linear. It's an unbelievably healthy market. They all have to be in it. They all want to be, every single one of the players want to be in it because of the audience. We have two assets in the sports business that don't have are year-long, don't have a season. I don't believe prices are going down. You're going to figure out the bifurcation of the rights and give things up, not give things up.
How long do you think it is before Netflix actually jumps into sports?
You know, they're in sports right now, but they just do the shoulder programming.
Yeah.
I think their point of view, and you'll ask Ted tomorrow, is we build up we don't want to be in the bidding of rights and then not have any long tail. So I'm not sure. They did bid on Formula One, but ESPN got it. So I think that was a smaller package, meaning smaller economics. So we'll see.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine. Plus, global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenivek on Bloomberg Radio.
Live from the Bloomberg Interactive Brokers Studio here in New York, streaming on YouTube and Bloomberg Originals. It is Tuesday, July 9th, 2024. Carol Masser and Tim Stenivek are both off today, but not to worry. I'm here, Jess Mitten, Deputy Team Leader and Senior Reporter at Bloomberg News, and the one and only Bloomberg News' David Gura was with me today for the next 3 hours.
Great to be here, host of the Big Take podcast, and kind of wearing a bunch of different hats here, but very glad to be here on a day when we had Fed Chair Jerome Powell testifying before the Senate Banking Committee, the first of 2 days of testimony. He kind of reiterating what he said at meetings past. I know that we're going to get into that a little bit later today on what's a very busy day in Washington, the NATO summit taking place there in D.C. All eyes, of course, on President Biden as he makes his way through the formalities of that summit, dealing with international leaders and dogging still these questions about his capacity to serve another term in the White House.
That's right. And even with Fed Chair Jerome Powell on Capitol Hill, he will be back tomorrow in front of the House. And so we'll get a recap of that from, of course, Mike McGee over at Bloomberg News here, as well as Molly Smith on our economics team to kind of walk us through what else we should expect to potentially hear from him tomorrow. But I know there's another story you're excited about talking about later on why Elon Musk's own brand of cancel culture is thriving at SpaceX.
Yeah, Josh Idelson, who covers labor for us, with a tremendous piece looking at allegations that have been made against SpaceX and its founder, Elon Musk, about it being a difficult workplace full of harassment, an effort by some former employees to sue that company, being stymied not just in that pursuit, but also Elon Musk and SpaceX suing the National Labor Relations Board, really trying to do away with that institution, that part of government. Fascinating story by Josh. We'll dig into that just a little bit later here on the show.
That's right. And then also later, we'll be speaking with serial entrepreneur Laura Gassner-Otting. So she's going to be talking about women leaving the U.S. workforce. And then we're also going to be speaking about a book on crypto. So it's called Crypto Confidential, Winning and Losing Millions and the New Finance Frontier here. And we'll have the author with us later in the program. And so that'll be another fun thing to catch up on, David.
Yeah, I mean, so much has happened here. With crypto, everything seems so compressed. The entire history is so short. The rises and the falls likewise. And this is just a fascinating kind of personal story about riding that wave and the lessons that the author learned just about the perils of investing in that new asset class.
That's right. And then taking a check here on the S&P 500 and NASDAQ 100, both still trading around records. We'll have more coming up, but first, let's get a business check with the one and only Charlie Pellet.
Hi, thank you very much. And here's what's going on. Welcome on board. By the way, we've got the Dow, the S&P, NASDAQ all advancing. NASDAQ 100 index, though, just turning negative, down 2 points right now. Little changed on the NASDAQ 100 index. Right to the numbers, S&P up 6, a gain of 0.1%. The Dow higher by 6, little change there. NASDAQ up 12, a gain of just under 0.1%. 10-year 4.29% with a 2-year yielding 4.62%. Gold up 0.1%, 23.62 the ounce. And West Texas Intermediate crude down 0.8%, 81.70 right now for a barrel of WTI. Bottom line, stocks hovering near records as Jay Powell's economic remarks to lawmakers did little to alter bets that the Fed will be able to cut rates this year. Briefly, we've got Boeing shares trading lower, down 0.6%. Boeing delivered 44 commercial aircraft in June, the highest monthly total since the company curbed work in its factories in the wake wake of that harrowing near miss in early February involving a 737 MAX jetliner. Again, Boeing shares, they are lower now by 0.7%. Rival Airbus down 3.1%. Recapping, Dow just turning negative, down 7, little change there. S&P holding on to a gain of 0.1%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Thank you, Charlie. We appreciate it, Jess Minton. And David Gura here in the Bloomberg Interactive Broker Studio. We were just speaking about how Fed Chair Jerome Powell did say more good inflation data would still need to boost the Fed's confidence. But of course, we will get another update on CPI, David, here on Thursday. So traders looking at that. And I wrote a story earlier today looking at sort of the options market, what they were pricing in at the JP Morgan trading desk, seeing a potential move here of about 0.9%. So that actually would be the biggest in about a month, because just a month ago, we had CPI and the Fed decision on the same day, but that is in line with the last 3 CPI prints. But we have 2 really great guests coming up to speak with us on this. So we'll also have Molly Smith, who's on our economics desk, but also Ira Jersey, who's at Bloomberg Intelligence headquarters in New Jersey, that's going to speak with us. But first, we're going to get a clip here, hearing a little bit more of what Fed Chair Jerome Powell had to say. So listen more of what he had to say about inflation as well as the path of interest rates.
The most recent inflation readings, however, have shown some modest further progress, and more good data would strengthen our confidence that inflation is moving sustainably toward 2%. We continue to make decisions meeting by meeting. We know that reducing policy restraint too soon or too much could stall or even reverse the progress that we've seen on inflation.
All right, so that was obviously Fed Chair Jerome Powell on Capitol Hill, who will be speaking tomorrow as well in front of the House. So I want to bring in Ira Jersey, who here works at Bloomberg News, he's our U.S. interest rate strategist, and he's based actually at the Bloomberg Intelligence headquarters in New Jersey, as well as Molly Smith, who is one of our top editors here for the economics desk. I'll start with you, Molly, to kind of get a recap here of what people were expecting Fed Chair Powell to say versus what we ended up getting here.
Yeah, two very different things. I think people were obviously hoping to get a bit more about the timing of when we might be seeing some interest rate cuts, and Powell on 2 occasions said he will not be offering any signals on the timing of interest rate cuts, which I said to the chat, I guess we can all go home, because it seems like that's really what we were all here for. And he then said again, when another lawmaker had pressed him on the topic, had also said, yeah, I'm not really going to get into that today. So bit of a bummer. So we're all still here sitting, okay, maybe 1, maybe 2.
Right.
TBD.
TBD. Ira Jersey, let me turn to you. That's the editor's perspective. Let me get the market strategy perspective on this as well. What were you listening for, and what did you hear from the Fed Chair today?
Well, first, let me say that Lori does a great job with the T-Live chats. So if you're, if you can't listen to radio or watch TV and you have a Bloomberg terminal, definitely hit up T-Live. Yeah, for sure. I participate, for example, and try to give my insights onto the rates market on those blogs as well. So I think from Jay Powell, like Lori said, he said even in his prepared remarks that they were going meeting to meeting. He tried to say we're as data dependent as we can possibly be, and he reiterated that. So he didn't say anything broadly new in terms of the monetary policy perspective, but the fact that he reiterated basically what was said in the June meeting minutes, which were released last Wednesday when the bond market was closed, at least, I think was just telling in and of itself, because it's pretty clear that they're trying to say, like, look, it might be September, it might be November, it might be December, but we're going to cut. The one thing that he did say that I think was important was he did reiterate that he didn't think that the next move as a hike was likely. And that's something that, remember, just 2 months ago, we were pricing for almost a 20% probability of a hike. That's almost being completely priced out of the market now.
Well, Molly, I want to bring you back into the conversation because David and I had mentioned we will get another update on CPI on Thursday. What are the expectations here from economists?
Yeah, so probably going to get something that's a bit more of a maybe inflation still gradually coming down. If anything, maybe moving still a little bit sideways in this range that it's been in. We've seen, which, Powell alluded to today, the big moves in inflation are past us, which, is to be expected at this point. There's less progress to be made, and it's going to be coming in, smaller chunks with each report that we get. So there was definitely a lot of questions on housing inflation today, and that there's, the best thing that Powell said that the Fed can do for the housing market is to get inflation back to 2%. So that will hopefully then bring, Treasury yields and interest rates back down, and then make, mortgage rates also more affordable. So that's really, to be expected from him. They can't really control, of course, that the U.S. has a persistent structural shortage of housing, and that's when he was saying, well, this is you on lawmakers to try to, that's more your job, and that's not something we can do.
I know we're going to get into that a little bit later in the show, but Molly, let me ask you about the crucible in which this is happening. So this is before the Senate Banking Committee. You had a pretty forceful statement from the chair of that committee, from Sherrod Brown, basically saying to the Fed chair, stop raising rates, bring rates down, that this is having a really deleterious effect on the American consumer, on those who want to buy houses. And there was also this kind of moment of emphasis on the chair's part about the independence of the Federal Reserve, as we see this kind of swirl of politics surrounding what might happen if Donald Trump were to be elected again. How did he deal with that? How did the setting of this kind of color your sense of what the Fed chair had to say?
Well, it seems like at least Powell and pretty much everyone on the Senate Banking Committee agrees that the Fed is and should remain an independent institution, and that there was pretty unanimous support on that front. And, without, of course, addressing the elephant in the room, that if Donald Trump were elected president, that's something that he's kind of looking to attack, right? That he, wants to be a bit more involved somehow in how the Fed sets monetary policy, and perhaps ousting Powell. This was someone who he appointed. So, clearly that there's a bit of, there's certainly a backdrop to all that, and I think he handled it pretty delicately, and just stressing, the Fed's credibility really relies on its independence.
Hey, Ira, I want to bring you back into the conversation. What are you seeing when we're talking about, say, speculative net positioning when you're looking at the bond market, and what that tells us about where traders are betting where rates could be headed in the second half of this year?
Well, a lot of the spec positioning right now is really basis trade. So it's people trading futures versus cash. There's a little tiny bit of money to be made. So in order to make that money, though, you have to lever yourself a lot. So that's one reason why you have such large shorts in some of the contracts. I want to go back to something that Molly said just a second ago, and that's about what Jay Powell and the Fed independence argument. Because from a market perspective, I think that if the Fed were to lose a significant amount of its independence, then you'd wind up in a situation where the bond market would probably sell off quite a bit, and certainly get a much steeper yield curve, because it'd be worries that the Fed would keep interest rates too low for too long in a future environment where you get more inflation. So I think that there is a risk there that something like that happens. And of course, way back when Jay Powell was first appointed, I was actually surprised that Donald Trump appointed him, because he appointed a mainstream kind of thinker from the Fed Board of Governors instead of someone more dovish. So Donald Trump will still have the opportunity to appoint a dovish Fed chair. He'll just have to wait 11 months to do that, and because that person won't take office till the beginning of 2026.
Molly, we've talked a lot about inflation, which is of course what we're all supposed to be talking about at this point in time, but we did get a little color from the Fed chair on the labor market as well, and I wonder what stood out to you from his comments. Of course, we have the rate now at 4.1%, but what did he say just sort of about his perspective, I guess the Fed's perspective on how healthy the jobs market is now?
Yeah, I think this is now starting to look a lot more like the jobs market that we had before the pandemic, which was a very healthy jobs market, and that Powell said something today that he hasn't really said yet, but has probably been true for a while, that the labor market is no longer inflationary, and that's something that one economist I noticed that he had sent around to his distribution list, that this has been the case for a while, but it's nice to see Powell finally acknowledging this, because there has been so much concern about all of these job openings, and perhaps if that's propelling wages higher, or what kind of inflationary environment that might get us into. But he seemed to be a bit more comfortable with where the labor market is in relation to inflation, but certainly that like he's been saying, any unexpected weakening in the labor market could force the Fed to act a bit more aggressively.
Molly, great to speak with you. Thank you very much. That's Molly Smith from our econ team. Our thanks to Ira Jersey as well, our chief U.S. interest rate strategist at Bloomberg Intelligence, joining us from Bloomberg Intelligence headquarters, just a bit south of here in New Jersey. And I know we want to get into some of what we were talking about, just sort of the knock-on effect of this kind of very strange economic environment.
That's right, and especially because why high rates have failed to dent record stock prices right now, as well as home prices too. So who better to bring in than Bloomberg's own personal finance reporter, Suzanne Woolley, who's here in the Bloomberg Interactive Broker Studio. Thanks so much for joining us this afternoon. And it's interesting because you wrote about how more people in the market right now, especially when you're thinking about stocks and what's happening with housing prices staying relatively high here, but it's still a confusing world of finance. And this is also what you wrote for her latest Bloomberg Business Week story here. So walk us through this sort of dynamic, especially coming out of the pandemic, and how unique this is compared to history.
Yeah, well, for most of us, we went through such a long period of really rates near zero. You know, back in 2020, as early as 2022, though, they were at 0.08%. Now, this is the federal funds rate that I'm talking about. Now it's around 5.3%. So very abrupt ramp up. You know, there were like 11 Fed hikes in something like a 16-month period.
Right.
So came on big. And normally the script would be that we would expect the stock market to take a hit, and housing with mortgage rates now at 7%. In 2021 they were like around 3%. You'd expect that to take a hit. Hasn't happened, obviously, and a big reason with the stock market is, of course, AI.
Right.
It's just like powered over everything. And when you look at the S&P, NVIDIA, it contributed like 30% of the index's gain to date. Microsoft contributed another 10%.
Right.
So AI is just sending it, a market cap index flying.
And even things beyond traditional tech and growth stocks, if you look at utilities, with people think it's more kind of steady dividend, low volatility. But if you have the particular sub-industry groups within it that are related to data center businesses, those have taken off at certain points this year too.
Exactly. It's like AI is, an energy play. It's such a huge energy guzzler. So those things have propped it up. And underneath, when you look under the hood at the S&P, I was just listening to Goldman Sachs' mid-year investment outlook, and one of their experts was talking about how, the average gain in the stock in the S&P for the year is like 3%. So beneath the breadth, as we know, is just so narrow in the Mag 7 or Mag whatever they are now, 6, 5.
Right, we've gone from a lot of different acronyms.
We're whittling it down. I want to ask you about the kind of consumer psychology aspect of this. There's such a great line in your piece about how, for most people under the age of 35, they never had to live in a world where rates are what they are. You talk about sort of what we've become accustomed to. How have you found, as you talk to people reporting out this piece, what counsel have they given people who might long for those lower rates, or not even know that they used to be as high as they are and higher still?
Right. Well, I mean, some people are saying, listen, these rates are really not that unusual when you look over the long scheme of things. So, people are thinking that rates. I mean, a lot of people think rates will go down. Now people are saying with the Fed, maybe we'll get one cut in September and such. But you really have to sort of rethink some of your basics. There are a lot of people who have gotten into buy now, pay later loans.
Right.
Which we know so little about still.
Right, exactly. It's sort of a black box in a way. And we had a poll done, a Harris poll done back in April that showed that 43% of people in those loans were behind in their payments. And, that's an area where they're going to feel a lot of interest rate pressure. But also, just in buying a home, you have to sort of think through it a bit differently, because if you want to get a 7% mortgage rate, and rates don't go down that much, you really can't. I mean, it's not wise to take a flyer and just think, oh yeah, a year down the road I'll be down to whatever,
Do we see people taking more flexible rates or trying different types of mortgages, or are they just wedded to the notion that it's going to be high or where it is for
There are little
a while?
pockets that are starting to pop up. Like there's something called, it's a little complicated, but it's an assumable mortgage, and it's when you can actually assume the seller's mortgage at their rate.
Interesting.
At their, it's complicated to do, but more startups are popping up to create a sort of a more organized market for these assumable mortgages, because it's so appealing. If you could just inherit someone's 3% mortgage, that would be great.
Right.
But it's very expensive because you have to sort of pay the premium on their home, and you have to pay off the equity that's in their mortgage. So you need a lot of
Find
cash.
the money for that.
Yeah,
Yes.
it's not appealing option for most people.
Well, we only have about 45 seconds left, but what do you think are the biggest takeaways for people to take from your story, as well as how long this dynamic can continue? Which obviously $1,000,000 question. Yeah.
I think a lot of people that I spoke with, the more of the financial planner types, were just giving some good solid advice about diversification. And if you're sitting on some really big equity gains now, particularly in tech, they've been telling some of their clients, maybe do a little profit taking. Just make sure you're diversified. Yeah. Because there's just so much talk right now about expected greater volatility, how long can this last, which we've been hearing forever. But they're just kind of telling people to remember, if they need to rebalance, now they can get 5% on a bond.
Right. Well, that was Suzanne Woolley, personal finance reporter at Bloomberg News, on why high rates have failed to dent record stock prices and housing prices here. Thanks so much for joining us.
Thank you.
We'll have more coming up. This is Bloomberg.
Politics to the world of business. 2 times a day at 1 p.m. and 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world twice a day at 1 and 5 Eastern, only on Bloomberg TV and radio. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Lots happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
Good morning from our world headquarters in New York. I'm Menace Crennick.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg. Context changes everything. Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders. From breakfast cereals to pet foods, General Mills has an iconic array of brands. But future success depends on efficiency, innovation, and insight. CFO Kofi Bruce does much more than crunch numbers.
Our first job is to intimately understand and anticipate the consumer's needs.
Watch Chief Future Officer. New episode Wednesday on Bloomberg Television.
It's 2:21 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow Jones Industrial Average now trading lower, choppy session. S&P 500 index up by about 6 points. A gain right now of 0.1%. NASDAQ holding on to a gain of 19 points, up 0.1%. To be sure here, any advance today for both the S&P and NASDAQ will be another record. 10-year 4.29%. The 2-year 4.62%. Spot gold little changed, up $5 the ounce, $23.63. That is a gain of 0.2%. And a retreat for West Texas. Intermediate crude oil down 1%. WTI 81.53 a barrel. Paramount Global may have its credit rating cut to junk by Moody's Ratings after the company agreed to sell itself to Skydance Media, with the bond grader citing, quote, significant secular pressures on Paramount's businesses. Paramount Global up today by 2.4%. Again, recapping here, stocks are trading mixed. We've got the S&P holding on to a 6-point gain of 0.1%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
Charlie, thank you very much. David Gura here with Jess Menton in for Carol Masser and Tim Stenivek on Bloomberg Business Week. Turning now to a story that's one of our most read on the Bloomberg terminal today about SpaceX, a company founded, of course, by Elon Musk that's become so ingrained in so many facets of our lives, crucial to the Defense Department, to NASA, which relies on its rockets to get satellites and other technology into space, and allegations of harassment within that company detailed by Josh Idelson, our labor reporter who's based in San Francisco, and Lauren Grush as well. And Josh joins us now. Josh, great to have you with us as always. And maybe we could start broadly here at what you uncovered, both through lawsuits that have been filed against this company and allegations that have been made to the National Labor Relations Board. In your piece, you say the place really did feel like a frat house. What's the culture like, or what's it reported to be like within SpaceX?
Thanks for having me. Yes, people who work there describe a company that in many ways Elon Musk created in his own image, and that has felt like his playground, where people are encouraged to imitate aspects of Elon's behavior, this work hard, play hard mentality, where deadlines that were unrealistic were set and then people were berated for not meeting them. People were encouraged, in order to get resources to meet impossible deadlines, to act, quote, like a selfish child, unquote. And a line between the workplace and outside of work was blurred at best. So you had people trying to decompress from that intense, unreasonable pressure by doing things like setting up drinking games on the company email, employees chuckling about coming back from heavy drinking to observe a launch, and vile jokes, former employees say, that were made by Elon Musk that set a tone for the workplace and were repeated, to the point that when Elon Musk was posting a tweet about his so-called pretend tits university, you then had men at the company musing about which of the women that worked there would do well at that make-believe university. These former employees say there was sex discrimination, that there was this culture of disrespect and men doing things like staring at women's chests, saying that they were biologically incapable of being engineers, mimicking Elon's humor with crude jokes, and that the people who got punished, rather than being the ones perpetrating misconduct, were the ones who tried to do something about it.
You also write about how regulators were in retreat as well. Why is that the case?
So after a group of workers circulated an open letter calling on the company to change, to have more equal enforcement of its policies, to bring its culture in line with its official standards, workers involved in that letter were fired. They brought claims to the U.S. National Labor Relations Board, which a year and a half later, this January, issued a complaint accusing the company of illegal retaliation. And the next day, SpaceX responded by suing the NLRB, arguing that it is unconstitutional and its proceedings were going to be illegitimate and violate SpaceX's rights. And by getting that lawsuit into the conservative 5th District, by bringing it in Texas court, and then bringing appeals to get before these appellate judges, SpaceX has created a situation where the NLRB's case against the company is on hold indefinitely, and the NLRB, in retreat as part of its effort to get the case moved out of the Fifth Circuit and to California, has floated putting its case against the company on hold until the company's case against it is resolved.
Josh, teasing out that metaphor a bit, going from cancel culture to the safe space of the Fifth Circuit, which has had a lot of conservative justices and rulings in favor of companies and conservatives in particular. I wanted to ask you about the kind of broader trend that you outline in this piece as well. So not to say that the National Labor Relations Board is up against the ropes, but there is a potential consequence here if what Elon Musk and SpaceX is doing here results in a victory, and that is a significantly neutered or weakened NLRB, one that might not have, dare I say, the relevance or the authority that it's had for many decades.
That's right. SpaceX is relying on the current judiciary, which under President Trump in particular has moved further to the right, and making arguments that echo ones that were made against the NLRB early in the agency's existence, all the way back in the 1930s, but that there's reason to think may get more traction now than they did before. And initially, their lawsuit had a setback when a district judge appointed by President Obama agreed with the agency that it didn't belong in Texas, that the lawsuit should be moved out to California. But with a series of appeals, including coming back saying that it was urgent that the company be not required to go to a teleconference on preliminary discussion related to subpoena issues because an agency judge, the company said, was unconstitutionally insulated from being fired, the company was able to get a majority Republican panel of appellate judges who agreed to find enough merit in the company's claims to put the NLRB case indefinitely on hold. And the consequence ultimately could be judges deciding to wipe out protections for NLRB members and NLRB judges. It could allow the next president, perhaps Donald Trump, to replace all the judges and all the members who consider these cases. They could go further and paralyze the agency unless Congress steps in. And all of this could affect hundreds of pending cases. It could affect the way that labor law is enforced throughout the country, not just at SpaceX and not just for union members, but in terms of anyone's right in the public sector to talk to each other about their working conditions and raise things that they don't like where they work.
Josh, you also were talking to us earlier about how so far Elon Musk has successfully stalled the government's case, partly because of legal action in a friendly jurisdiction with relation to SpaceX. But we do know Elon Musk owns a number of other companies, for instance, X, formerly known as Twitter. Do we have an indication of what the culture is like at some of these other companies as well that he owns?
Discrimination issues have been raised at other places where Elon is in control, such as Tesla, where there was a record racial discrimination jury award. These companies have denied wrongdoing, we should note. There's also a pattern of workers alleging retaliation, and the labor board at Tesla, at X/Twitter, at SpaceX repeatedly has accused Elon's companies of retaliating, terminating workers because of collective action they tried to take around their working conditions.
NYMEX diesel August futures settle at $2.53, gasoline August futures $2.52, natural gas August futures $2.34.
Interwoven it is with so many government agencies. We have seen the great success of SpaceX's rockets and the outsized ambitions that it has as well.
And now NYMEX WTI crude August futures settle at $81.41 a barrel, which is down 92 cents or 1.12% on the session.
Sort of the government's tack, perhaps, in this circumstance.
Sure. In particular, as the budget for NASA has been relatively flat for years, adjusting for inflation, the existence and the partnership with SpaceX has allowed the government to expand its ambitions without expanding significantly its investment in space. And the company has not been shy about pointing this out. In fact, in legal filings in these cases, SpaceX has repeatedly pointed to its role as a government contractor and the work that it is doing for U.S. national security and space exploration as a reason that it says it shouldn't be subjected to these proceedings before the NLRB about the workers it fired following their open letter. And so the company has come to feel to some people like it could be too big to govern, and like Elon is in the driver's seat, and people who get in his way end up having to change course.
Josh, great to speak with you. It's a terrific piece as well. That's Josh Idelson, a senior reporter here at Bloomberg News who covers labor. The piece that he wrote with Lauren Grush is Elon Musk's own brand of cancel culture is thriving at SpaceX, and just a fascinating look, kind of pulling back the curtain at one of these places. And we talked a bit about that lawsuit that's been filed. 8 former workers who have brought that suit against SpaceX. And we didn't get into too much detail there with Josh, but just the way that retribution happened. He alluded to that open letter that was written, 400 people signed it, and then the circumstances that followed, pretty sobering. In the day that followed, several of them dismissed almost immediately over a Zoom call. Again, just a really interesting look at a company that, as Josh was saying there just a moment ago, Jess, is such a huge part of our lives and part of, as you were noting as well, this giant portfolio of companies that Elon Musk either owns or has a sizable role in.
That's right.
Or runs. Anyways, I can't commend the piece enough. One of our big take stories. I'll selflessly promote that as well, selfishly and selflessly, as the host of the Big Take podcast. Really elevated and wonderfully illustrated on our website. I would urge everyone to check it out. You can find that at Bloomberg.com/Big Take. This is Bloomberg Business Week. David Gura with Jess Menton filling in for Carol Masser and Tim Stenivek.
Now let's get a check on the latest world and national news with Nancy Lyons in the Bloomberg 99.1 newsroom in Washington, D.C. Nance.
Thanks, Jess. Democrats are lining up behind President Biden after the president made it clear in a letter to lawmakers yesterday he has no plans to leave his campaign. Congressman Jerry Nadler is reversing what he said over the weekend, that Biden should step down.
The president yesterday made it very clear he's running. I'm fully supportive of him. I plan to campaign for him, and it's essential that he win.
Nadler says Biden is still the best candidate running. House Republicans, though, are taking a different approach to Biden and accusing Democrats of covering up Biden's health issues. This is House Speaker Mike Johnson.
Most of the Americans, people understand that Joe Biden is not fit for that office, and it's a terrible thing. The Democrats have misled us, and they need to be held accountable for that.
Again, that's House Speaker Johnson. Jury deliberations are underway in the criminal case against Archegos Capital Management founder Bill Huang. He's accused of manipulating stock prices before the 2021 collapse of his $36 billion private investment firm. Huang has pleaded not guilty. And jury selection gets underway today in actor Alec Baldwin's involuntary manslaughter trial concerning a shooting on the set of the film Rust. He's maintained his innocence and says he did not pull the trigger of a gun during rehearsal. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Nancy Lyons. This is Bloomberg.
You actually offer a payout at 7 years to encourage people to explore if they don't find themselves in management position. I mean, what's the thinking? Yeah. I mean, like, what's that about?
We're not forcing everybody to be kicked out, right?
But you encourage people to explore.
Exactly. We encourage people to think about their, because sometimes it's easier, even for me, if I don't need to change everything, it's easier. Right? Change is really tough thing everybody, should I do this job for next 5 years, 10 years, or should I try a new thing? If I had to think, that is a great opportunity to think about it. We need to think about what kind of talents I can have for the next 5 years, 10 years. What's the best way to contribute to the world?
This is Bloomberg.
When South Africa has an election, Bloomberg Television has it covered.
South Africans are very connected politically. They know exactly what they want.
In developing countries like South Africa, when there is one-party dominance for too long, we don't get that economic growth, we don't get accountability.
Whatever we do will be based on stability.
Nobody covers global elections like Bloomberg. Context changes everything.
We're operating in a very volatile environment. So JetBlue has a very large presence here in New York, and there are air traffic control challenges. And so we've had to overinvest in hiring excess crew members and building flexibility into our planning process. And so over time, we hope to wean some of those investments back as the operating environment around us stabilizes.
We made the decision early on that we were only going to invest internally on key differentiating technologies, and clearly the powertrain is the key differentiating technology. So our investment is a recurring investment with respect to the powertrain team, the battery team, which is part of it, the engine team, electric engine team, which is part of it. And we also have a lot of non-recurring costs with the other components because we're not developing those internally. We're using the existing aerospace defense supplier base for most of the other components.
We invest a lot in the offices, that you feel home, that you can actually be at your best yourself, and people work very differently. We take a lot of input from the sports world, actually, the athlete spirit, right? Building a sports team that can perform at the best, but also talking a lot about the explorer spirit. How can we really tap into new things, continue being disruptive? We have 80 different nationalities at On. It's very important to have a diverse team because we have a very diverse landscape of customers.
It's 2:40 on Wall Street. We do check markets all day long. Here at Bloomberg, we have got the Dow trading lower, the S&P, NASDAQ. They are both holding on to gains. If we end with green on the screen for the S&P and NASDAQ, that will be yet another record. S&P right now up 6, gain of 0.1%. We've got the NASDAQ Composite Index up 17, up 0.1%. NASDAQ 100 Index, little change right now, down by about half a point. The Dow lower by 25, a decline of 0.1%. Bottom line here, stocks hovering near records as Jay Powell's economic remarks to lawmakers this morning did little to alter bets that the Fed will be able to cut rates this year. 10-year 4.29% with a 2-year that's now yielding 4.62%. Gold up $5 the ounce to $23.64, up 0.2%. And West Texas Intermediate crude down 0.9%, $81.62 a barrel on WTI. Briefly, Nike has rehired a a retired senior executive, to oversee retail partnerships after relationships with sneaker sellers soured and sales dropped. That executive, Tom Petty, worked at Nike for 30 years before retiring. Nike today down by 0.4%. And Pfizer planning to replace its top scientists after a more than 15-year career in charge of the company's drug pipeline. Pfizer shares down now by 1%. Recapping, stocks are mixed. S&P holding at a record up 6, up 0.1%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Thank you, Charlie. We appreciate it, Jess Minton. And David Gura here in the Bloomberg studio. Carol Masser and Tim Stenovic both have the day off. And another really interesting story, David, that is in the terminal that we've been reading here is about looking at Bobby Jane's complex hedge fund debut and how it's spawning fans as well as doubters. So who better to come in than the author of this story, Ahema Parmar, who's here at one of our hedge fund reporters at Bloomberg News in New York in studio with us. So walk us through your story here about Bobby Jane's fund. What makes it so complex, such that it is unprecedented?
Yes. So what he's trying to do here is launch a fully formed multi-strategy hedge fund. That means it's going to trade 6 strategies on day one when it launched July 1st, trade all of those strategies, have the teams built out, have everyone hired in the right seats, all the operational infrastructure and back office teams. It's a pretty big undertaking. It's never been done before. Typically, hedge funds start out small with 1 or 2 strategies, and then they add on more over time. What he's doing here is birthing a fully formed multi-strat hedge fund.
Why is he going this route? So you described the complications of doing that. Yeah. He has been ambitious about what he hoped to raised a little less than I think what he wanted to at the very beginning here. But I think of a hedge fund starting in this environment in particular, how complicated that must be, how difficult it must be to line up the talent, the technology, infrastructure to do all of this.
Absolutely. It's very challenging in this fundraising environment too. His thinking is that it's more efficient. When you start a firm of this size doing these many different types of things, if you build the infrastructure from the ground up, ready for all the different parts, then you're less likely to have duplicate costs, duplicate talent. It's going to be more efficient. Every system will have everything it needs in order to get going. And you don't need to add on things later and then double over on expenses and everything. He also is trying to build a system where even if in the future he adds more talent and has more money to invest, that the costs of operating the business don't scale proportionally to that.
Talk to us more about the asset raising environment right now and some of the top challenges.
It's really tough out there to be raising money. So 5.3 is a good amount of change to be starting a hedge fund with. It's the second biggest launch that we've seen in years. It's the biggest launch we've seen this year. But the environment is tricky for a few reasons. Firstly, investors are not getting as much money back from private equity, from distributions as they have been in the past. And so that limits how much money they have to put to work. They're also a lot more cautious about every dollar they want to put to work. You know, you have an option. You have optionality between the hot private credit markets or a multi-strat fund, and they've been
Brent crude futures settle at $84.66 a barrel, which is down $1.09 or 1.27% on the session.
With each dollar, do we want to take the day one risk in investing in a brand new manager and a new fund versus a tried and true option? So LPs are weighing all of these things, and every dollar is harder to get these days than it has been in some time.
The piece opens with a meal, a pitch at the seafood restaurant at the Breakers in South Florida. Bobby Jane making this overture to a Middle East sovereign wealth fund. I believe ultimately ponies up, I think, about close to $1 billion to the fund. How has he made that pitch? How is he trying to convince investors, yes, that this model that you've described as being kind of unorthodox is likely to work, and B, that this is the moment to do it. That, you know, don't bide your time. Don't watch all of this unfold. Get in now, and this is likely to reap rewards here in the next, I guess, 12 months to 18 months.
Exactly. So he has gotten ADIA, which is the Abu Dhabi Investment Authority, with $1 billion ticket. Other big name investors too, a number of bank platforms. So, his pitch is, yes, you get the ground, day one opportunity to invest in this fund. He's offered a lot of concessions, and his fees are cheaper. He's lowered fees. The bigger the tickets, the better fees you get for investing. He promised them future capacity. So if you're an investor, any future optionality, if you like what you see, you can get in later on, and that will be guaranteed. Some investors got co-invest opportunities. The liquidity of this fund means that you can get your cash back in 3 years versus other competitive firms are a little more like 5. And there's a number of other investor-friendly terms. So you do see in this environment needing to have more concessions, make it worthwhile. And I think even Bobby Jane understands that there's a day one risk to doing this kind of thing, and made these perks advantageous for them.
And you talked about, obviously, the concerns and the caution that investors have. Clearly, there's different issues when it comes to lofty targets, but what are some of the underlying problems and the root of where those concerns lie?
With investing in hedge funds?
Right.
Yes. So, people use hedge funds in their portfolios in a few different ways. It could be to hedge against, if the markets take a downturn, then maybe you invest in some of the multi-strategy funds. Multi-strat funds aren't typically aiming to always beat the market. They want to be a steady return, roughly 1% a month, tried and reliable and true. And so that's sort of how they would think about it. But if you want, really huge returns, there are hedge funds that are incredibly volatile, where you can see double-digit gains one year and then double-digit losses the following year. So it really is like strategy dependent, fund dependent, liquidity dependent. As this strategy has shifted to become a lot more illiquid, the assets themselves are pretty liquid, but the structure of these vehicles means it's harder to get your money back, and it's become a lot more expensive to run these multi-strategy funds. There's been more caution when it comes to this specific strategy from investors, because they're thinking, well, do I want to be locked up for this long, and what am I paying for? Because they're paying for the talent and the compensation of these traders.
Your world is one in which I think personality matters, and the head of these funds are can really shape the way that the business works. I think Bobby Jane is as close to a household name as you can get. But what can you tell us about him? And is he in the mold of his Englander? Is he somebody who has taken a lot of inspiration from the time that he spent at Millennium? Sort of how does he operate? How is he as a manager? Sort of what's his personality like as somebody who's overseeing these billions of dollars?
Yes. So if you look at his tenure, he spent more than 20 years at Credit Suisse. He spent about 6 at Millennium. So really, experience at big name reputable firms. At Millennium, he was co-CIO, worked very closely with Izzy Englander. At Credit Suisse, he helped to build out various businesses. So he's sort of known for building businesses, working with teams, being sort of on that like higher up level versus being in the weeds on necessarily a trade. But he has been described to us as being more cerebral, more like a philosopher, thinks in matrices, and can jump between sort of the big picture idea and the in the weeds details. But we have also heard from investors that he struggles to communicate some of his ideas clearly and succinctly. And what that's meant is some investors have walked away from meetings feeling either frustrated that they didn't really understand things, or walked away with ideas of the firm that were not really what the firm is, or unclear as to what Bobby's trying to build here.
And Bobby trying to use that sort of seeing things as a matrix to oversee what I think he describes as a smorgasbord of options here at this fund. Just a fascinating piece by Emma Parmar on the Bloomberg Terminal, Bobby Jane's complex hedge fund debut spawns fans and doubters. I was just fascinated by, I guess, the ambitions principally of doing this and trying to do it in such short order.
No, it's true. And then obviously the challenges that come with it and the money that they've been able to pull off, but still the other issues they have to deal with. But thanks so much for coming in the studio and having fun with us. We appreciate it. But we'll have more coming up, especially as we get closer. We still have a little over an hour left before the closing bell, but stick with David and myself. We'll have more coming up. This is Bloomberg.
Arch has laid plenty of groundwork for future revenue, but for now, Mark Messler's most pressing challenge as CFO is conserving capital.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, and but we also have to be nimble around that as well because things change by the day.
Archer went public in 2021 in a reverse merger with a SPAC, Ken Moelis's Atlas Crest Investments. Through August 2023, the company raised over $1 billion from investors including Stellantis, Boeing, United Airlines, and Cathie Wood's ARK Investment Management.
Does that ARK investment open doors for you to bring in different kinds of institutional money going forward?
It does. I mean, I think there's a lot of credibility that comes in with an investor like ARK. As I think about, my top targeted list of investors over the next 2 to 3 years, an investment like that gives us some credibility and gives us a little bit of staying power as I go in and talk to other investors.
With the SPAC pipe now closed, Archer's facing a new phase of raising capital.
I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. I'm wanting to show them progress. I want to create credibility with them that we are marching towards our goals of commercialization.
Fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything. Now, your company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pellet. We've got Oracle shares trading lower right now. Oracle down 3.1%. The Information is reporting talks have ended on a potential $10 billion cloud deal with Elon Musk's artificial intelligence startup. Again, shares of Oracle trading lower by 3.1%. Boeing delivered 44 commercial aircraft in June. That is the highest monthly total since the company curbed work in its factories in the wake of a harrowing near miss in early January involving a 737 MAX jetliner. We've got Boeing down by 1%. Rival Airbus trading lower now by 3.2%. Paramount Global may have its credit rating cut to junk by Moody's Ratings after the company agreed to sell itself this week to Skydance Media, with the bond grader citing, quote, significant secular pressures on Paramount's businesses. Moody's placed Paramount's ratings on review for a downgrade. Paramount Global shares today, they are advancing by 2.7%. Strategists at Citigroup say the rally in artificial intelligence stocks may show little sign of flagging, but a historical review suggests it is time to take profit in the biggest names. According to the Citi team led by Drew Pettit, sentiment toward AI-exposed equities is the strongest since 2019, and free cash flow at the bulk of those firms is forecast to outstrip analyst expectations. Among AI names, we've got NVIDIA pushing higher today. NVIDIA up by 1.9%. Taiwan Semiconductor shares, they are trading lower, down now by just about 2%. And the SOX, the Philadelphia Stock Exchange's Semiconductor Index, now down by 0.3%. And those are our top company stories, and this is Bloomberg.
This is Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio and Television.
Jess Mitten and David Gura here in the Bloomberg studio, in for Carol and Tim, who both have the day off. We'll be chatting a little bit more about what traders are pricing in the options market for CPI in a bit. First, though, let's get a check on the latest world and national news in Washington, D.C. with the one and only Nancy Lyons.
Thanks, Jess. As concerns over President Biden's continued presidential campaign continue, Republican House Speaker Mike Johnson is aiming his criticism at congressional Democrats. He spoke during his weekly press conference and accused his colleagues of misleading the public on the president's condition.
Democrats, our colleagues, for 3.5 years have been covering up this glaring
Comments from the White House, who note that Biden commits to serving a full term if he is re-elected.
Despite Johnson's comments, there is no evidence of a cover-up. House Democrats held their own caucus meeting today, with leaders calling it a listening session on the presidential race. Former Senator Jim Inhofe of Oklahoma has died. He was 89. He was elected to a 5th Senate term in 2020, but he stepped down early last year. He was known for his support of defense spending and his denial that human action was responsible for climate change. Closing arguments continue in New York City in Senator Bob Menendez's corruption trial. The New Jersey Democrat is accused of selling his influence as chairman of the Senate Foreign Relations Committee in exchange for gold bars, a cash stash, and a Mercedes to help 2 New Jersey businessmen to get deals with Qatar and Egypt, and another to avoid criminal prosecution. He has denied any wrongdoing. And jury selection is getting underway today in Alec Baldwin's involuntary manslaughter trial in the shooting of a cinematographer on the set of the film Rust. He could get up to 18 months in prison if convicted. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Nancy Lyons. This is Bloomberg. Now back to you, Jess and David.
Nancy, thank you very much. David Gura here with Jess Menton, filling in for Carol Masser and Tim Stenivek on Bloomberg Business Week. And I should say, it sounds like that courthouse in Lower Manhattan extremely busy with that verdict due any day now in the Bob Menendez case and also the Bill Huang case. So we'll be monitoring that very closely here at Bloomberg. And Jess, one of the joys of filling in on this show with you is that I get to draw from your reporting. You have a piece out today on the Bloomberg about JP Morgan's trading desk, Andrew Tyler at that desk, issuing a warning. We talked a bit earlier in the show about the inflation data that we're going to get later this week. He making a, dare I say, forecast or prediction about what might happen as a result of that. Walk us through what you found in his note most interesting.
So Andrew Tyler, so he's specifically on the trading desk at, as you mentioned, JP Morgan. So each month they put out different scenario analysis where they potentially see the probabilities of where CPI could come in. Obviously, we know PC is the Fed's preferred gauge for inflation, but nonetheless, if you're looking specifically at what the options market is pricing in for Thursday, so that data will come out at 8:30 a.m. Washington time. So he's seeing the S&P 500 pricing in about a 0.9% move in either direction that day. It would be the biggest actually since last month's CPI report, because that was one of those duel where we saw CPI and the Fed rate decision actually fall on the same day on June 12th. But it's also in line with the last 3 CPI prints. So you still see that elevated. And to put into context, the S&P 500, when it comes with a move of either direction, last time it saw a swing above 1% was actually in early June. And then the last time it declined more than 1% was actually in late April. So actually relatively over the last month, even though it seems like we may have had a few big days here and there, we haven't seen big gyrations overall. But still, nonetheless, if you're looking at what core CPI is supposed to come in, about 0.2%. Obviously, we know super core, especially stock traders, watch that very closely, especially the month-over-month numbers. So we'll keep a close eye on that. And you know, David, of course, Fed Chair Jerome Powell and other Fed officials always like to look at super core because it strips out, obviously, what's going on with housing, and then they can get more of a better read of what's happening with wages and inflation.
All of this happening at a time, as you point out in that piece, when volatility is pretty subdued, quiescent, as I think Tom Keene would say, the VIX at about 12.5. This is Bloomberg Business Week. David Gura, Jess Menton.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day. This is the close.
A glimmer of hope for rate cuts as Powell lays out a scenario of economic balance. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Alex Steele. I have a surprise for you.
What's the surprise, Alex
Another
Steele?
record on the S&P.
Another record on the S&P, Alex Steele.
36 record highs. S&P up 0.1%. But again, we're just sort of grinding higher with nothing to write home about. What is doing well within the stock market, Romaine will get to this in just a moment, are the banks. Powell talking about potentially we're going to see lower capital requirements for some of the big guys. 210 spread. It's what everyone's really looking at when it comes to those steepeners, as well as the 530s as well. So a little bit steeper, but it's where we see that steepener that is the real question. And dollar yen, it is a favorite of mine to go to. The dollar is a little mixed on the day, but not when it comes to the yen, Romaine. That dollar continues to be strong, even though Powell was neutral to dovish.
A close eye on FX, a close eye on what's going on in treasuries, a close eye on what's going on in stocks as Jay Powell wraps up the first of 2 days of testimony to Congress just 3 hours ago. It was a wide range of comments that we heard out of him, where he talked about the risk of lowering interest rates too little or too late, with the labor market and the economy coming back into balance.
This is no longer an overheated economy. This is an economy, as I mentioned in my opening remarks, that is more or less back by most measures to where it was before the pandemic. And that was a strong labor market, but it was not an overheated labor market.
And we should point out that the market reaction somewhat muted with oscillation in Treasury yields and a broader equity market clinging to what could potentially be another record high. Financials out in front on the day, but a huge drag from tech and the software stocks. Salesforce down about 2%, Oracle down 3%, and Unity Software hitting a record low on the day. And that's raising a lot of questions out there about the tech and AI trade with strategists at Citi and at Morgan Stanley. Among those saying it may be time to take profits from that relentless run-up in valuations that ostensibly kicked off last November as traders correctly bet that the Fed, Alex, was done raising rates.
Yeah, and that's when the two-sided risk, right? This is really what this chart shows. Let's take a look at this. The top is jobs, bottom inflation. So the pink line here is the 3-month moving average when it comes to employment. And you can just see here, we're just sort of slowing down. The trajectory is just a little bit slower. On the flip side, you have inflation at the same time, the lowest level we've seen on an annual basis since March of 2021. Inflation coming down, jobs coming down. And the question we have, Romain, really is, when does the Fed pivot more to growth than inflation? And from what Jay Powell was saying, I wonder if we're very much nearing that pivot point.
Stuart Paul joining us right now over at Bloomberg Economics. They'll kick us off to the close. And Stuart, when you listen to the testimony that we got out of Jay Powell today, you did get this theme of balance there. Is there that shift to a little bit more focus on growth rather than just the inflation side of the equation?
He did emphasize that the balance of risk has basically been restored. That's really to say that the risk of a surge in inflation is about the same as the risk of a more rapid rise in the unemployment rate. The second thing that he really emphasized is that the labor market has been cooling dramatically. And the third thing, an unexpected increase in the unemployment rate would warrant that policy pivot. But with the Fed and the FOMC members expecting the unemployment rate to basically hold steady through year end and then actually come down a little bit, any modest deterioration of the labor market would warrant a pivot. We're expecting the unemployment rate to hit about 4.5% by year end, which keeps 2 rate cuts in play.
When would that rate cut start then? If you're looking at 4, I mean, that feels like a big jump. 4.1 to 4.5, I feel like would freak some people out.
It would. I think that if we hit 4.2% by September, that puts a September cut in play. And I think that that's definitely well within our reach. 4.1 in the June jobs report, it puts us right on the cusp of that 4.2% threshold, which would get people getting a little bit nervous. They'd start checking their SOM roll calculators. And
You're already doing that, man.
And I think that the folks at the Fed would be doing the same. And they'd start becoming a little bit more antsy and would potentially consider cutting in September.
What's the data point, though, that gets us to that? I mean, when Powell was asked about this question, as always, he was evasive, but he seemed to kind of suggest that they need to see, I guess, more good inflation data. I forgot the exact terminology he used, but the idea here is that they don't necessarily have everything they need right now to make that choice.
I think that his primary inflation indicator is going to remain super core services. So that's core services excluding housing on the inflation side. I think that on the labor market side, he's really looking at the vacancy to unemployment ratio, which is now basically back to where it was pre-COVID. And so any little uptick in the unemployment rate could be enough to tip the scales.
All right, Stuart, thanks a lot. Really appreciate it. Stuart Paul of Bloomberg Economics. More good data, I think, Romain, is what he said, for inflation. More good data.
Yeah, which I was like, which I had to wrap my head around because I was like, does that mean you want higher inflation?
I know.
Lower, but as good as bad, bad as good.
It's a whole,
it's a topsy-turvy world, Alex.
It's too hard when he's talking like that. All right, Gargi Chowdhury is BlackRock Chief Investment and Portfolio Strategist for the Americas, joins us now. Her team also just released their latest mid-year investment outlook, which we will get to. But Gargi, we wanted to talk about the Fed first. September cut, more likely, or November, December?
Hi, Romain, Alex. It's wonderful to be here. Thank you for having me. So we think that September is likely when the Fed's going to begin the cutting cycle. Still in the camp of expecting 2 rate cuts this year, so September and December most likely. Definitely, I was listening to your colleague from Bloomberg earlier that was talking about the data and what the Fed's looking at. Obviously, if the unemployment picture worsens significantly, much more than what the Fed or the market has expected up until now, I think you can expect the market to price in more than 2 cuts. But I think what the market's pricing in now, around 2, seems absolutely fair to us. And I think they start in September.
Does that happen? So what happens to the curve in that point in terms of the steepener? Do we get a steepener finally that's sustainable? And is it the front end that really comes down, or is it the back end that gets hit harder?
Yeah, so we've been talking about this for a while, that, there's such attractive income in the fixed income markets right now. You can get this diversified income at 6% or over that with a whole host of fixed income securities. But where you source that duration is important. And we've been on the camp that you want to source that in the belly of the curve for now, expecting the curve to steepen out. We've seen a little bit of that steepening, of course, but I would imagine as there is more concerns around the fiscal deficit, or if there's more concerns around, just the amount of supply that's coming into the market, I think we can certainly see bouts of steepening. And eventually, for us to get a lot more positive on the very long end of the yield curve, we'd have to see a positive term premium return to the market. For now, if you can clip 6% or so quality high coupon in the fixed income market with, we like owning investments such as BlackRock Income ETF, why not do that and clip that coupon?
I am curious, though, on the term premium side, Gargi. I mean, how much of that is sort of still correlated with what the Fed is doing or may do, I should say? Or are there other factors here that have driven that premium to where it is? Or lack of it?
Yeah, so, historically, absolutely. It's a great point. Historically, when we think about what drives different parts of the yield curve, obviously you have your growth and policy and all of that driving sort of the very front end. Then you have other factors that drive the very long end. So if you're looking at anything that's 10 plus, obviously it's growth and inflation too, but you do have concerns around supply, concerns around deficit, which is why investors will demand a higher return. And you're not getting that right now. Right now, why would you stick around for another extra 25 years while getting less yield for those extra 25 years? So I think a lot of this is on valuations, and the drivers of the long end are related to demand supply and deficits like we talked about, which are all pointing to a little bit of a steepener further from here.
All right. Well, Gargi, I think we'd all like to be around for another 25 years, but sit tight. We're going to keep you around for at least a few more minutes. Gargi Chowdhury, she's the Chief Investment and Portfolio Strategist for the Americas at BlackRock. She's sticking with us. When we come back after the break, we're going to get her thoughts on highlights from the latest mid-year investment outlook over at BlackRock, and a big focus there on AI and tech. This is The Close on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
DOJ or other authorities
could face bigger challenges next.
It was going to keep rain World Cup. This is a three
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
As promised, BlackRock out with its mid-year outlook today. Artificial intelligence a top theme, strategists writing, while AI will streamline operations, improve customer experiences, and drive human innovation, identifying the most promising AI-driven opportunities requires expertise and vigilance. Gargi Chowdhury is Chief Investment and Portfolio Strategist for the Americas at BlackRock, back with us. All right, you teased it up. How do you do with it?
Yeah, absolutely. So look, one of the themes that we're talking about in our mid-year investment directions is the idea of having quality at the core of your portfolio. So quality which can be defined by companies that have strong profitability, that have low leverage, that have stable earnings. And we've certainly seen that come to fruition through the course of this year and last. And that, we believe, will continue to be with us for the next few months. Now, in addition to that quality being a part of your core, there are other trends in the marketplace, such as AI that you just referred to, that are going to be with us and drive not just returns, but actually growth and probably even inflation for many, many years to come. And here, this is where I think there's a few interesting things. Obviously, the traditional AI plays, such as semiconductors and going to areas of the market such as stocks, have played out and can continue to play out. But the broadening of AI, which I'm very excited about, is really about looking at what else is going to get impacted by the AI trade. And this is where we think areas such as utilities, areas such as energy equities, that have been not as loved, I won't say unloved, but certainly not as loved as the tech play, have much more room to go. So we're talking about the AI trade as well as the broadening out of the AI trade, and then keeping quality both with active management and with funds such as Qual at the core of your portfolio.
Where do you see that AI trade, though, going, Gargi? I mean, we've already talked a lot about the power needs and how that benefits the power companies and utilities, and we've seen some people gravitate to those stocks. But when you talk about that true broadening of the trade, you have to start to get to the end use cases, which I know for a lot of these companies we're still a long way away from. But as an investor, how do you map that out?
Yeah, I think that, look, when we look at the flows in utilities, for example, to your point, obviously that a lot of people are focusing on that now. But if you look at the flows, and we spend a lot of time looking at that, that hasn't actually played out. Sectors like utilities are still more or less in outflows. So I think this is just the beginning. We're in the early innings of the AI, as well as the AI broadening out trade. And I don't think it happens in the same straight line that we saw, semiconductors or just the technology sector move. I think we're going to have fits and starts, especially as rates and fear around elections, et cetera, drive some of these sectors. But I do think that this is a longer-term opportunity given the power needs of AI.
When we talk about the tech trade overall, so let's just broaden that out from beyond just AI and those that benefit. There's been a lot of talk here that some of that juice, or some of the buying that we've seen in the AI space has been at the expense of other tech stocks that don't necessarily have an AI theme. Has that created any opportunities there? Are you seeing people at least maybe kick the tires in that space?
I think some of this was just around earnings expectation, right? Even if you look at earnings season expectation for just this earnings season, which is kicking off on Friday, the expectations for earnings growth are strongest in technology and communication services at around 17%, right? Now, what we are going to expect to see, especially as we get towards 4Q, is that gap narrowing a little bit. So I think that this is the time to still keep quality at the core. That can mean sectors like healthcare, and then broadening out the AI trade, like we said, to energy and things like utilities, and then be very quick and nimble about rotating when the other sectors that are away from the broad tech plus sectors, if you will, start showing some of that earnings growth, which frankly is yet to be seen. We just haven't seen it. The performance has been related to the earnings growth, which has been missing.
Right, and I wonder if we continue that theme, do we see that this earnings season, or we have to wait for the next quarter where we finally see the big tech players' earnings start to come down a little bit and that earnings momentum to gather elsewhere?
I mean, as of right now, if I look at expectations for this earnings season, if you look at the S&P outside of the top 6 or 7 names, it's still a positive number, the expectations for earnings, but it's significantly lower. It's about 5 or 6%, much, much lower than the top names. I think we need to see that turn a little bit, and I expect some of that to begin to get priced as the earnings momentum and the earnings picture changes, which looks, as of right now, to be Q4. But obviously, we we will wait to see how these companies do. And frankly, I think there is something to be said about many of these large communication services and tech sectors that are posting these healthy margins, which other sectors are just not able to. Again, like I said, I think broadening out to sectors such as energy, which has shown some good margins come through, is something that we think investors should do as one of those offshoots. It's not your core of your portfolio. It's something that you add to your core. I think that works as we go into the remainder of this year, but quality at the core remains the key, especially if we get a little bit of softening of data as we go into the second half of 2024.
All right, Gargi, you got to leave it there. Always a great conversation, always smart. Gargi Chowdhury there is Chief Investment and Portfolio Strategist for the Americas at BlackRock, helping us kick you off to the close. Alex Steele, here on this Tuesday afternoon, I thought it was interesting too, like when you talk about the long-term AI play and whether it evolves beyond just chip stocks and a couple of utilities and software names. Like, where does that go? Like, what is the end case? Because I don't know anyone who actually uses this, at least or pays for it. Let's like regular people. I'm sure some companies are paying.
I'm not a regular person who does that, so there is that. But I think what you're bringing up is the whole how you monetize it and how it grows, and then you get to the cyclicality of it too at the same time.
Yeah. Wait, you're saying this is cyclical?
No, we don't know yet.
Oh, okay.
Like, of course it's going to be.
So we hype this all the way on the way up, and you're saying in a few months or a couple years, we're going to talk about the big hype on the way down.
Yeah, it's going to be, but we don't know what that is. Is that like a decade?
I love that. You know why, Alex?
Why?
Because it keeps us employed. All right, a lot more coming up here on the big program here, or maybe. Who knows? They might get tired of us soon. Who they're not getting tired of is Bobby Jane, actually pulling off one of the biggest hedge fund launches of all time, raising more than $5 billion in a very tight market.
All right, plus our stock of the hour is the consumer products company Helen of Troy. Shares falling the most intraday on record. We're going to look at what caused that big dive.
Do you know what Helen of Troy makes?
No, you told me.
OXO Good Grips and the Braun.
Is that the hair thing?
No, OXO Good Grip for the kitchen, kitchen.
Oh, yes, right, that guy.
Okay, all right, don't make me make another kitchen joke about you here. All right, and we're going to take a look at shares of the home builder Lennar, up about 1% today on the back of an upgrade by Wedbush. We're going to talk to the analyst behind that call. Don't go anywhere. This is The Close on Bloomberg.
Jason Kelly, and this season on Power Players, we're taking you behind the scenes to see how the business of sports has gone global.
I want sports to grow. I want sports to be bigger because we have talent.
And how mammoth value is coming from the smallest of players. 3,184 hits, 431 home runs, and of course the most famous stat that everybody knows, 2,632 consecutive games played. Unmatched career. Why are you doing this?
What we have achieved in the NWSL from an investor perspective over 2 years is the equivalent of what it took other leagues 25 to 30 years to achieve.
You've got to have a business that's sustainable. The only way it's sustainable is got to make money.
There's only one word, winning. You win on the court, you win off the court. And as you do that, you bring people along.
The top names in business are on Bloomberg.
You need to have an AI game plan. We used to say that every company needs to think about becoming a software company. Now we say that every company needs to become an intelligent software company.
Context changes everything.
All right, let's get a view from the sell side. Our top calls, the big movers on the back of analyst recommendations. And we start off today with McDonald's. Gordon Haskett not loving it at all, cutting its price target to $2.80 from $300, with the firm saying that the initial customer response to that $5 meal deal, it's been underwhelming and has barely moved the needle on foot traffic. But The firm does expect this to prompt an aggressive sales push, so they're going to stick at least with that buy rating for now. The share is down 1% on the day. Next up, Chewy, a downgrade to hold. This over at Argus Research, with the analysts citing declines in Chewy's active customer list. They're saying more households are tightening their purse strings. She also has some concerns here about substantial investment spending as Chewy expands into Canada. Those shares down about 3% here on the day. And let's take a look at Bank of America. Before today, they only had one sell rating. Today, they have none. Piper Sandler upgrading to neutral, predicting large banks will see net interest income bottom in the most recent quarter and then head higher for a sustained period. They no longer see a good reason to single out Bank of America for underperformance, bumping the price target to 42 from 37. The shares bumped up by about 2% on the day. And those are some of our top calls. We do want to stick in the sell side space and take a look at one more call, and that came out of Wedbush on Lennar. Wedbush sold on Lennar's Landspin spinoff, upgrading the stock to neutral from underperform with the unchanged price target of $144. Now, while the analyst has a cautious view on entry-level and spec-heavy builders like Lennar, that hasn't changed. He still believes, though, that the deal may be the next catalyst for the shares. Joining us now is the analyst behind that call, Jay McCanless, Wedbush Senior Vice President and Equity Research Analyst. All right, let's start off with this here. How does Landspin help, Jay? I think we're having some issues with Jay's audio there. So, Alex, I mean, this gets to a bigger issue here when we talk about kind of these, I guess, lower-end entry-level home builders, I guess you can call them, and sort of what gives them sort of a better line on profitability. And maybe these types of acquisitions can help with that here or not. But I don't know, I feel like the housing sector, the new home sector, is right at this point just kind of riding on, I guess, kind of just the momentum that we've seen for quite some time, which is just low supply.
Yeah, and also the low supply, but because affordability is so tough, what kind of concessions these guys have to make to get people to buy their homes, and that really creating some difficulties.
All right, great conversation. Let's go back to Jay McCanless.
We were great there. We were really good.
Who is still with us right now. Jay, thanks for being patient with us as we sorted out those audio issues here. Talk to us a little bit about this Landspin deal. Explain it to us for our viewers.
Sure, and thanks again for having me on. You know, they haven't announced the timing of the deal yet, but what theoretically this deal is going to do is create a new land banking opportunity for Lennar. It should help improve, in their opinion, ROEs and returns, and make them a more efficient. And you know, we all heard the just-in-time theory in school, and that's where some of these larger home builders are wanting to go now. Is when they have the buyer in hand, or when they feel like they need to start a spec, they'll be able to essentially take a lot that's ready to build on. And that's what Landspin, and that's our term, by the way. Lennar hasn't really named it yet, but you know, we think Landspin, that's what it's going to become for them, is a just-in-time provider of finished lots, so that Lennar can concentrate on what they do very, very well, which is build homes.
And that's a good point here, Jay. And by the way, you should trademark that before Lennar does. But I am curious that now, with this sort of out of the way and the idea that they can focus more on this, I mean, what is kind of the health of the market, of the new home market, particularly at that entry-level point that Lennar is known for?
So we think right now that the entry level, and you know, you mentioned it in the open, but we believe the entry level consumer is really stretched on affordability. When the builders can solve for the payment, whether it's through incentives or mortgage rate buy downs, they are getting people into the homes. But at the same time, we also think that the builders may have started a few too many homes at the beginning of the year. Understandable, because at the beginning of the year, a lot of people thought mortgage rates were coming down, et cetera. And I think now they've just got to let the demand catch up to supply. And we got negative on the stocks about 3 months ago because of those factors. Mortgage rates also went against the entry-level buyer in April and May. That seems to have kind of settled down now, but we still just think there's probably too much supply out there, and not enough buyers that can qualify yet to start bringing down that supply quickly.
Hey, Jay, then where's the trough in gross margins for these builders?
Would say it's at least another quarter, maybe two away. You know, we in the promotions that we've seen from the builders, including Lennar and the other public ones that we cover, we have seen, I think, a little higher pace and tempo of incentives and some things that we haven't seen before. They're offering blinds in the houses, extra appliances, things that you normally don't see the entry-level builders providing in those homes. So that's a quirk versus what we've seen the last couple of years. And I think it may be negative for gross margin, at least consensus gross margin estimates.
Hey, Jay, we appreciate it. Thanks so much for sticking with us.
Thank you.
Jay McCandless, Wedbush, Senior Vice President, Equity Research Analyst. Blinds with a house. I totally didn't know that. I thought mortgage rate buy-downs with blinds, you know how expensive those things are?
Blind? Yes, I know.
They're crazy expensive.
I know. The first house I ever bought, it had all these beautiful windows. I remember when I bought, oh, this is great, until I realized I had to put, window coverings over all of them, which I think costs about as much as the house.
Oh yeah. No, 100%.
It's a racket, by the way, right? It's just fabric or plastic or vinyl or whatever.
Yeah, but then they can be so pretty when they're like shimmery and or they're windproof. I don't know. But point being, they're expensive, and that's definitely a perk. You get those free blinds. All right, coming up.
I should point out the neighbor across the street from me, he's just got sheets in his window, or her window.
It's choice. It's definitely a choice. Coming up, we're going to talk about the rapid growth of private equity. Is that a bubble waiting to burst? This is Bloomberg.
You are also an owner, I should have pointed out, of 3 major sports teams.
That's right.
Right? And you're the first woman, as I understand it, the first woman to own 3 major, have a stake in 3 major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, it was Abe Pollin. He did come to me and Susan O'Malley, and they said, Abe Pollin says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me, and I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, The China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, The China Show. Weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Alex Steele. Staying with tech for a second and also hedge funds. Let's put the two together for a second.
Put the two together.
Because apparently some tech-focused
heavy.
Yes. Yeah. Ooh, that's good. Some tech-focused equity hedge funds like Whale Rock and Light Street, shocker, have done really well because you know what?
Yeah.
They have NVIDIA.
Well, that's what I say. I want to see what's in that portfolio. Like what got them there? Is it just NVIDIA and a couple of the other big AI plays?
Yeah, pretty much. Yeah. But it is performing and it is delivering. But how much you want to pay for that, I guess?
And most investors don't care, right? As long as they're getting their returns, right?
Yeah, but the fees are still pretty steep. But let's stay in hedge funds for a second.
Well, they wouldn't be a hedge fund if the fees weren't steep, would they?
No, they would not. But let's stay in the world of hedge funds. Bloomberg's Hema Pamar has been taking an in-depth look at how Bobby Jane pulled off one of the biggest hedge fund launches of all time. It uses half a dozen trading strategies and employs hundreds of people around the world. Hema joins us now, who also incidentally wrote the story about tech hedge funds and how they're doing. Okay, so this Bobby Jane story is fascinating. It's a really long-form piece and sort of digs into how it got to where it is and the expectations. Just tell us what you learned by creating the piece.
Yes, so it's a really fascinating thing that he's doing here. Is doing something that's never been done before, launching a giant hedge fund that is already built out as a multi-strategy firm, meaning it trades 6 different strategies like SRTs to physical commodities to stocks and bonds and arbitrage bets and quant investing, and building out a firm that's this complex, that has this talent, the capital raising, the infrastructure. It's a big undertaking. And typically when we look at the hedge funds, they have historically started with one strategy and then added more over time. And what we're seeing, he's doing it all at once.
It was an interesting strategy, and it's funny, we laud him for this $5 billion, but he had intended to raise a lot more than that.
Yes.
Why initially was there reticence to this? Was it just because of market conditions, or was it more concern about, I guess, the structure and complexion of this new firm?
It's a few things. It is a very difficult fundraising environment, so every dollar is harder to get. There's a bit more concern over the multi-strategy space. There's less dollars that the investors have because some of it's tied up in private equity. So they're a lot more thoughtful about every single dollar that they put to work. And private credit is so hot, so there's competition there. So, and then you have the day one risk of investing in a brand new fund, doing something that's very new. So you can see some people sitting on the sidelines waiting to see how it does after the first year, and then maybe jumping in later.
It's a brand new fund, with a lot of old folks, meaning experienced
a lot
folks.
of tenured experienced people.
Not old as an age.
Yes.
You know what I mean?
Yes. And Bobby Jane worked at Millennium. He was co-CIO, spent 2 decades at Credit Suisse. A lot of tenure there, for sure.
All right, Hema, thanks a lot. We really appreciate it. It was a great piece. Everyone should check it out. Hema Parmar joining us from Bloomberg. So speaking of, let's go to private equity from hedge funds. In her latest Bloomberg Opinion column, Allison Schrager writes, markets today pose a new existential question. Can there be a bubble in something if it has no price? Joining us now is Allison. She's also a senior fellow at the Manhattan Institute. Good question. Can you? Is there?
I think it's the question of our time, really. So because so much capital is now going to markets where there is no price. But and I think this has actually been one of the things they argued was great about it is, prices can't collapse if there's no price at all.
Well, so what does a collapse look like, though, in this situation? I mean, just hypothetically, because, these guys will always make, folks in the private equity space, they'll always make this argument about not having to mark to market and that they have more flexibility and renegotiating things here. So if there is real trouble there or trouble afoot here, what does that look like?
Well, it's more of a slow bleed than a collapse with like a bubble that would say exists in public markets because, the LPs also just can't pull their money out like the way they can in public markets. So you don't just get everyone running for the hills and freaking out and sort of pulling all their money out, and then you have this sort of overcorrection in prices.
Well, sorry, but on that point, because that's a really good point, and we've heard from a lot of LPs grumbling about this, how does that, though, affect the potential for new funding rounds, and whenever those vintages, and they do get their money out, are they going to put that back into private equity, or are they just going to say, we're done with it, and they're going to move on to something else?
I think that's where the damage happens, is they just, especially pension funds who are sort of not sort of getting their money back now, and are finding, they're struggling to make sort of pay benefits, is they just don't go to private equity at all. And in some ways, there's nothing wrong with private equity. I mean, maybe it got a little too big, but it does fulfill an important purpose in our economy. And that might be the overcorrection, is just like people get really scared of putting money in their asset class at all. And then we find a lot of companies that have become a lot more dependent on private financing over the years for a variety of reasons, can't get financing.
So does that money, though, get weirded out by private equity but go to private credit instead?
It might, but private credit might get some of the same issues. I think people underestimate a lot of the risks with private credit. I think for years. I mean, a lot of us wondered what the low rate environment where bubbles were brewing, and it might have been largely in private markets. And I think what people don't appreciate sometimes with private credit is that, a lot of their loans are floating rate. So if rates don't go back down, then, they might have a lot of companies that struggle to refinance and they might see more defaults.
In the private equity world, though, has secondaries, I know secondaries have been around for a really long time, but I feel like they've grown so much in a short amount of time also. Has that helped stem bleeding?
Not yet, but I think that might be a symptom for the issue is that, there's reports of these zombie funds where people can't get their money out and they're having to sell on secondary markets and take a big discount. So, I mean, so far, we all read Matt Levine. It does seem like it's a fairly opaque market that's not functioning that well either. But if it gets big, then honestly, then is it really private equity anymore? Because then you do have a market price on these things.
We do. Does Matt Levine get paid by the word? Because his columns are always so long. I mean, they're great, but they're always so long. And yours are very just short and sweet here.
Yeah, I have a stricter word limit than he does.
And inquiring minds want to know. In all seriousness, though, but you mentioned this idea here, too, of floating rates, and I've heard this argument, too, particularly from the private equities firm's perspective, the idea that they will continue to profit off of this. But, of course, that kind of hobbles the company itself. And I do wonder if a crash or whatever we're going to call this, a slow bleed, if this does become a situation of liquidity drying up, the companies that are saddled with these loans can't do anything else to invest back in their business, and effectively they either tip under or at least sort of just kind of limp along.
Yeah, which, I mean, I don't know what's worse is if you just, like in public markets, like we have with the tech bubble, this crash, and then there's just this recession and, a lot of this sort of, this cleansing element of the economy. Or if you'd get this slow bleed, because people will also lose jobs. I said if their employer can't get financing, and I think people underestimate how much more people are turning to private markets and not going public.
But we've heard from the Fed, I mean, for the first time in a long time, I forgot it was a few meetings ago, we actually saw this mentioned actually in the Fed statement. We saw this come up also in the recent bank asset test where they mentioned the role or the connection with private markets here. So it's clearly on the radar of regulators that this is an outsized influence right now in our economy, and no one seems to really know exactly how healthy it is.
Yeah, I mean, I think it always concerns regulators when a lot of money is going to a market they can't really measure or control or regulate. So, I mean, and rightly so. I mean, one thing I feel like we learned after the 1930s is it's a lot better for people to invest in things that are transparent and have a clear market price and are well regulated. Yeah.
That doesn't sound like our market today, does it?
It sounds like actually we've now decided that's all a bad thing.
All right. Well, Allison, you always have a great perspective on these topics. Allison Schrager, she's a Bloomberg opinion columnist for us here, and also a senior fellow at the Manhattan Institute. A great column today here on, I guess, the question of whether private equity is in a bubble headed for a crash.
Although I do have to wonder, the defaults that we've been waiting for and sort of the fallout and the blow up from higher rates, like where is that?
Well, that's a good question too, because they are happening, but it's not like en masse.
Right.
And some people have posed this argument that we may end up with just as many defaults as maybe what we had during sort of a traditional recession, but they'll be so spread out over 2 or 3 or 4 years, as opposed to all happening within 8 or 9 months, that the impact to the economy will be felt less. I don't know if that's true, but that's the opinion.
And somewhat idiosyncratic, right? Like with commercial real estate, it's not like all office towers are toast.
Yeah.
Right? Like it's a very idiosyncratic, specific thing. And how do you then make a big how do you proclaim something from that if it's just sort of this rolling default over time?
Yeah, I agree, and it makes it harder too, because I think we all like kind of things that are very sort of dramatic and final and definitive, and the slow bleed. It's hard to do a show around it, Alex. Too.
It is.
All right. When we come back, we're going to talk about some of the big movers in the market today. One of the biggest decliners is Helen of Troy. You may not know that name, but you know what they make: Hydro Flasks, OXO Good Grips, as well as a lot of other